a higher start for the Indian market. Crude oil prices hold steady as trade talks take the front seat. Brent trades at $68 a barrel. Gold prices extend losses following reports that the US and European Union were closing in on a 15% tariff deal. Prime Minister Narendra Modi has arrived in UK ahead of the signing for the free trade agreement with the United Kingdom. That will take place later today. Sources tell CNBC-TV18 that under the agreement, India will cut average tariffs for UK goods to 3% from 15% earlier. And in key earnings, Infosys reported a good set of numbers in Q1 FY26. Revenue beat estimates while margins came in line. Tata Consumers also reported largely in-line numbers. Meanwhile, pharma major Dr. Reddy's reported a mixed set of numbers in the first quarter. Hello, good morning. You've tuned into CNBC TV18 and you're watching Power Breakfast with me, Vinny Motiwala. An interesting day that shaped up yesterday, but today also the cues that we're getting from the Asian markets as of now, a bit of a mixed cue is what we're watching out for. You know, the Japanese index, Nikkei, that's managing to hold on to very strong gains for the second day after that US-Japan trade deal has been signed. But other than that, Taiwan index, Hang Seng, that's quite muted in today's trading session. Even ASX 200, very muted, just 0.04% of decline. So, you know, it's not much of a downside or an upside that we're seeing. Very muted day of trade coming in for most of these Asian indices, I beg your pardon, other than the Nikkei as well as Shanghai, which are managing to hold on to some bit of a gain. Now, what is Nifty implied open indicating? Seems like a positive start is what we could watch out for. Again, today from the Indian markets, will that sustain is a key to watch out for. As of now, Nifty implied open is up 43 points in today's trading session. But that's the action that we have in terms of the Asian markets this morning. How are all these cues that we picked up from the US market, Asian markets impact our Indian markets? We have a team of research joining in with us to set us up for trade, tell you which are the important stocks to watch out for, as well as the cues in the world of F&O. So we have Sudarshan as well as Gaurav will be joining in with us as well. But Sudarshan, first, before I come to you, let me actually set you up for the trade. What are we watching out for over there? Now, US markets, obviously, we saw that S&P 500, NASDAQ saw a bit of a rally coming in, Alphabet earnings that beat estimates as well. So that is also something, that we'll be keeping an eye out on. All the indices in the US market closed on the positive front. FIIs, what did they do in our Indian market yesterday? We saw FIIs actually sell around 4,200 crores, while DIIs continued to be buyers for 4,300 crores. So FIIs were selling while DIIs continued to buy. Important reactions that we'll be watching out for in our markets today. Obviously, a lot of earnings that were reported post-market hours, Dr. Reddy, Tata Consumers, Infosys, among some of the reactions we'll watch out for today. And earnings today, we have SBI Life among important earnings, Bajaj Finance, IEX. Obviously, that coupling news that came in as well, market coupling news plus its earnings today, will see some reaction. Nestle among some of the names that we are watching out for. Other than that, we are watching out for Tilaknagar Industries. The news break that was confirmed, the CNBC news break confirmed after the company is acquiring Imperial Blue. Keep an eye out on that. CDSL could see some impact. We have seen NSDL that has come out with the date of its IPO opening. 30th July will be the IPO opening date and will close on 1st of August. We have an IPO that opens up for issue today as well. That is Brigade Hotel Ventures that is opening up. Other than that, cues to watch out for as PM Modi is visiting UK, the signing of the UK FTA and India FTA. That is something we'll be keeping an eye out on. PMI data in India as well as in the European front, ECB's rate decision will be coming out. Keep an eye out on that. What are they going to be doing will be key to watch out for. Yesterday, obviously, Nifty reached those record high, highs of, reached those high intraday highs of 25,233. Now, obviously, resistance is at 25,320 for the Nifty. Keep an eye out on that level. And like I had mentioned before, Nifty implied open indicating a positive start. But cues in the world of F&O. Sudarshan, what are we watching out for today?
So yesterday it was a good day of trade, and that was majorly led by financials, especially HDFC Bank and ICICI Bank. Both these banking heavyweights have hit record high, and that helped Nifty close firmly above 25,200. And also big gains were seen in Nifty Bank, which was up almost 500 points. For today also, tracking the strong earnings that Infosys has reported, and also some of the mid-cap IT companies, Gift Nifty is indicating a start in the green, and currently it's up around 40 points. Now, talking about the flows in the cash market, you'll see FIs continue selling in the cash market, but it's not a concern. Yesterday, we saw FIs selling 4,200 crore, but it was fully offset by DIs, which I bought more than rupees 4,300 crore. In the derivative market, if you see, FIs have built positions majorly on the long side. So, in the index futures, they have bought more than rupees 760 crore. Even they have added long positions of almost 2,000 contracts, and also they have reduced short positions. And here, reduction was almost of 2,000. Now, there is a slight increase in FIs long exposure. Yesterday, it was around 14.4%. Now, it's currently at more than 15%. Now, interesting data is on the option front. In the option market, if you see 25,100 call has seen shedding of more than 90 lakh shares. 25,200 call has seen shedding of 30 lakh shares. So what it tells you that on the downside for Nifty, now the first support remains around 25,100. And which call has seen the addition? 25,300 call. It has seen addition of more than 4 lakh shares. Now on the put side, 25,200 put has seen addition of more than 92 lakh shares, and also 25,150 put was active and has seen addition of almost 77 lakh shares. So now support for Nifty is around 25,060, but above that also first support, immediate support would be around 25,130 to 150, 25,150. But if it falls below, then support comes around 50 DMA, that is 25,060. Resistance, first resistance would be 25,320, that is 20-day moving average. If we manage to breach that or cross that, next support comes around 25,520. Stocks in focus, 3 stocks in the band: RBL Bank, Bandhan Bank and IEX. Keep an eye on stocks like Infosys, which has reported a strong set of earnings. Basically, it has outperformed all the peers amongst all the large cap IT company. It's the only IT company which has reported growth, and also focus on auto ancillary companies like Sona BLW, Samvardhana Motherson and Tata Motors. On the back of there are some reports that US might sign agreement with EU, and also it might involve auto companies, auto tariffs, and that might be reduced to 15%.
Okay, Sudarshan, thank you so much for that. And Gaurav, which are the important stocks that we are keeping an eye out on today? Good morning.
Well, good morning. There are many stocks which will be in focus on the back of the earnings. First, let's talk about some of the IT giants. First, let's talk about Infosys. Very good set of numbers is what we saw, where we saw net profit actually increase, and at the same time, they have also increased their lower range of the guidance from 0% to 1%. So that was actually a key thing to watch out for. Second is Dr. Reddy's. Here also we saw good set of numbers. The numbers were actually higher than what we were estimating. At the same time, we also saw margin expansion. Now they stand at around 28.2% versus what it was at 26.7%. Tata Consumers, on the other hand, actually came up with inline set of numbers, we could say, because profit was actually in line with what the street is expecting. What was positive is that the EBITDA margin fall was actually lower than the gross margin fall. So some kind of efficiency, cost efficiency is what we saw here from the company. Coforge, on the other hand, actually came up with very good set of numbers. Once again, the revenue increased almost by around 8% versus the expectation of 6 to 7%, and at the same time, EBIT margins also remain unchanged. Persistent System also came up with good set of numbers, where we saw revenue was actually a little bit higher than the poll, and at the same time margins were also increased almost by 20 basis points. Bajaj Housing Finance also came up with good set of numbers. We saw AUM growing at around 24%, and at the same time profit also increased almost by 17% on a year-on-year basis. Let's also talk about some of the stocks which will be in focus on the back of the news flow. First is IEX, because there is a negative news flow here. Now CERC has ordered market coupling implementation. Now, as per market experts, this is going to be negative for IEX in terms of market share, PAT and price to equity. Inox Wind is also in focus today because company has approved equity share raise worth 1,250 crore rupees. This will happen at 120 rupees per share. Natco Pharma is also in focus because, as per news sources, the company is going to acquire around 35% stake in Adcock Ingram for around 2,000 crores. And lastly, let's also focus on Tilak Nagar, because as per CNBC Newsbreak, now company is going to acquire Imperial Brew for the cost of 4,150 crores. So definitely watching out on all these stocks today.
Okay, thank you so much for that, Gaurav. We'll keep an eye out on the stocks. But like you were mentioning, Infosys, that's the important one that came out with his numbers as well, and has delivered revenue growth in constant currency terms at 2.6%. Rima is joining in with us to give us more details on the number. Rima, what are we watching out for today in terms of Infosys?
Indeed, it's a good start to the year for Infosys. Good Q1, dollar revenue growth up 4.5% quarter on quarter. In constant currency terms, it was a growth of 2.6%. Big beat versus the 1.5% growth that we were anticipating. And even on a year-on-year basis, the company has clocked in a growth of about 3.8%. As you rightly pointed out, in the large cap IT space, Infosys now is the only IT company to report growth. But bear in mind that this also comes in on the base of last quarter when revenues had fallen 3.5%. So after last quarter's shock, the negative surprise, this time they've managed to reverse and clock in a good quarter. So margins are a clear beat. Revenues are a clear beat. Margins have come in line with estimates at 20.8%, a small drop of 20 basis points on a quarter-on-quarter basis. Profits ahead of estimates are led by the revenue beat. The company for the full year is now guiding for 1 to 3% revenue growth. It perhaps includes the 2 acquisitions that they have done, and plus the macro environment has not deteriorated in the prior quarter. Operating margins remain in line with estimates at 20 to 22%, no change there. The other positive is the deal wins. The deal wins are up nearly 45% on a quarter-on-quarter basis at $3.8 billion versus $2.6 billion the prior quarter, and 55% of the large deal wins are net new. So all in all, it's a steady and strong quarter for Infosys, meeting the mark on profitability, beating on the revenue front.
Thanks so much for that. On that note, listen into the Infosys Management MD and CEO, that is Salil Parekh, and what he had to say at the press conference on their revision in terms of guidance.
The guidance, what we have seen this quarter is a strong performance in terms of where we have delivered the 2.6%, as you pointed out. With that and with the current outlook, where we have seen a lot of the discussions on the economy worldwide having come to more stable situations, but still seeing that it's not fully settled. Given that, we've increased the lower end of our guidance as we go closer into the, progress into the year, closer towards the end of the year.
Okay, on that note, we're going to slip into a very short break, so don't go anywhere. We'll give you more news and updates after the break. Welcome back to Power Breakfast on CNBC TV18. And in the US markets, what we saw was that Wall Street ended with gains. The Dow Jones adding over 1% in yesterday's trading session. Record highs coming in there, while S&P 500 clocked yet another record high. Its 12th such close of the year. On the earnings front, we had Tesla that reported a 12% decline in terms of revenue and a 16% decline in the automotive revenue as sales fall for a second straight quarter for the company. Meanwhile, what we saw coming in for Alphabet was that they reported a beat on the revenue, which saw a 14% uptick year-on-year basis. The company also said that it would raise capital investments by $10 billion in 2025. The shares of the company saw a rise of 3% in after-market hours trading. Let's go across to CNBC's Steve Kowak, who's here to give us more details on this front.
U.S. markets were up across the major indexes in Wednesday trading as Tuesday's trade deal with Japan sparked hope on Wall Street that more deals would be finalized before the August 1st deadline. The Dow adding 508 points, the S&P 500 climbing 49 points, and the tech-heavy Nasdaq rising 127 points. Another tough month for home buyers and sellers. According to the National Association of Realtors on Wednesday, sales of previously owned homes dropped nearly 3% in June. Analysts were expecting less than a 1% drop. And with fewer homes selling amid stubbornly high mortgage rates, supply continues to grow. The number of units for sale last month was up 16% year over year. The average rate on a 30-year fixed-rate mortgage is just below 6.8%. And Uber announced a new feature Wednesday that allows women riders to request to be paired with women drivers. The new tool will begin piloting next month in the U.S. Women drivers can also set their preference to drive other women. The company says there is no guarantee the app can always honor the request, but the goal is to give women more choice, control, and comfort when using Uber. Competitor Lyft started a similar service 2 years ago. That's what's happening here in the U.S. Back to you in Mumbai.
Thank you so much for that. Now, getting you the latest on Trump-related developments, we have Dia joining in with us in a special segment, Trump Watch. Dia, good morning.
We begin with the movement on the trade front. The U.S. and European officials signaled progress in tariff talks Wednesday after U.S. President Donald Trump announced a pact with Japan, and China said its vice premier would attend bilateral negotiations next week. Listen in.
Just made a deal with the European Union where they're going to pay the United States of America 100% of the cost of all military equipment. They're going to ship it to the European Union, and then they'll distribute it, and much of it will go to Ukraine. It's been a long time since you've heard those words, because we're in for $350 billion. But now we send it to Europe, and Europe pays, and we're in the process of completing our deal with China. And as you know, the UK, we made a deal. It was a very good deal for everybody. Everybody's happy. It's always nice when everybody can be happy. But mostly we'll be charging straight tariffs to most of the rest of the world, because we have over 200 countries. People don't realize that's a lot of deals. Even if you're like me, a deal junkie, that's a lot of deals. That would be too much for anybody. Ooh. And we're making deals with various Asian countries that need it. And it's actually hard to believe, you don't think of it, but Asia is very close to Alaska, relatively speaking. It's not the closest, but it is pretty much the closest when it comes to oil and gas and energy. And we're making some incredible deals.
And responding to a story by the Wall Street Journal, the administration called it part of a series of fake news stories against the president. Now, the Journal had reported that the Justice Department informed Trump in May that his name appeared in the Epstein files, a claim that the White House flatly denies. Now, the U.S. has stepped up military support for Ukraine. The State Department said that it has approved $322 million in proposed weapon sales to Ukraine to enhance its air defense capabilities and provide armored combat vehicles, coming as the country works to fend off escalating Russian attacks. And in other news, President Donald Trump signed executive orders to put in motion a new White House plan to boost artificial intelligence development in the U.S. by loosening regulations and expanding energy supplies for data centers. Now, the orders that Trump signed include a measure addressing energy and permitting issues for AI infrastructure. Next, a federal court appeals ruled Wednesday that President Trump's order seeking to end birthright citizenship is unconstitutional, affirming a lower court decision that blocked its enforcement nationwide. Moving on, Columbia University announced that it had reached a deal with the Trump administration to resolve several federal probes into allegations that it had violated anti-discriminational laws following months of negotiation to restore federal funding to the school. Columbia did not admit to wrongdoing but agreed to pay the government a $200 million settlement over 3 years and an additional $21 million to settle U.S. Equal Employment Opportunity Commission investigations. That's all for today. Now back to you, Vinny.
Okay, Dia, thank you so much for that. But on that note, we're going to sip into a very short break and we get you the latest on India-UK Free Trade Agreement after the break, so stay tuned in. Welcome back and thanks for staying tuned into Power Breakfast on CNBC TV18. Now, Prime Minister Narendra Modi has arrived in the United Kingdom ahead of the signing for the free trade agreement with UK. That will take place later today. Now, Parikshit is joining in with us to give us more details on this one. Good morning, Parikshit.
Well, yes, the most important aspect is the average tariffs for UK goods will come down from 3% from 15% earlier. Now, this is the important headline in terms of the reduction in average tariffs between India and the UK. The FTA will eliminate tariffs on 99% of goods traded between India and the United Kingdom. Notably, shrimp, tuna, fish meal, feeds, marine exports in general, 99% of them will see zero duties in the United Kingdom. Tariffs on Indian leather and footwear will be eliminated from 16% to zero. Duties on Indian textiles will be reduced to zero as well. We're also learning from our sources that India's footwear, textiles, and leather exports to United Kingdom will get preferential access over Bangladesh, Pakistan, and Cambodia. Tariffs on engineering goods will also come down from 18% to zero. India's generic medicines market will also get zero duty access in the United Kingdom. Overall, all our labor-intensive sectors, including gems, jewelry, toys, plastics, chemicals, auto parts, to benefit from tariff relaxations. On the agriculture side, zero duties on 95% of agriculture and processed food tariff lines. But our core areas on dairy, apples, oats, edible oils, wheat, and rice, that is excluded from the free trade agreement. So that's a big move that is coming in terms of the India-UK FTA. Tariffs on automobiles will also be reduced by India, but these are only on electric vehicles and futuristic cars, which will be reduced to 10% over a 10 to 15-year period.
Okay, Parikshit, thank you so much for that. But with that, we are absolutely out of time on this edition of Power Breakfast. Thank you so much for tuning in. Up next, your Bazaar Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Thursday morning, we are coming to you live from the CNBC-TV18 Motilal Oswal studios. Enough and more to talk about. Not very much at a broader level, but in terms of single stocks, well, it's going to be really a long list of names, which we will get to shortly. I'm Prashant. With me, my colleague Surbhi and Nigel. Guys, good morning.
Hi, morning Prashant, morning Nigel. Morning. Even at a broader level, there's so much of tariff joy suddenly in the air. It's, across Europe, across Asia once again this morning.
None for us.
None for us. We're still waiting and watching. But yeah, I think that's the overall tide that seems to be lifting all boats, at least last 2 days.
Good things take long to come, if you want to sound optimistic. So we'll have to wait by for that. But this 15% tariff and the way it's being accepted by global markets is telling you the kind of situation we are in terms of global markets. A few months ago, 15%, the markets would be jittery. Now 15, 20%, that's beautiful. Grab it and look ahead. That seems to be the case.
Nigel, art of the deal.
Yeah.
Start very high and then
absolutely.
Don't be desperate and just...
I think, Prashant, it's like when you tell your wife, right, I'm coming home in the wee hours of the morning. You reach home at 12 midnight. She's like, wow, well done.
All right, well, let's just quickly run you through what you need to know as we start another fresh session. So, US markets are doing just fine. I mean, there's no problem. S&P 500, new highs, basically. I mean, 10, 12, 13, who's counting, right? But for this year, S&P 3/4, NASDAQ 0.6, the Russell 2000, a 1.5% pop. So that's the picture. WIX, the fear index in the US continues to decompress. 15.4 or so is where the CBOE WIX finally left off at. As far as the 10-year is concerned, it was down about 4 basis points, 4.38. Dollar index, flattish, 97.2 or so is where that was. And that's it. I mean, in terms of macro markets, oil prices barely budged. So there was not very much in that sense. The Financial Times yesterday evening reported, this was around the time that Europe was closing, that US and EU were closing in on a 15% tariff deal. No real confirmation. It was, of course, Peter Navarro, who's one of the top trade hawks within the Trump administration, who the president apparently listens to very closely, rebuffed this later. Said, well, nothing of this sort. But it kind of gives you an indication of maybe some talks and the number there of 15%. We'll see, because it's these are trade agreements, actually. We should not call them trade deals, but kind of almost like handshake deals, and then details will have to work out, etc. Trump revealed a new AI, and I was talking about this yesterday, right? That interaction with David Sachs. Trump revealed a new AI action plan. I mean, essentially, the idea is how can America extend its and sort of widen its lead in AI supremacy. And of course, the main competitor here is China. He said many things, and we'll probably, through the course of the show, play out some sound bites, etc. But he emphasized close collaboration with Silicon Valley. He kind of also said, we're gonna let this fly. Instead of trying to regulate AI, ethical AI, and kind of putting guardrails around it, we're going to let it fly. And then when we have the lead, then we look at regulation, etc. So it's important, because think about what is leading the US markets higher. It's basically this entire AI theme. It's singular in what is happening there. Magnificent Seven, etc. It all kind of boils down to artificial intelligence, if you can sort of call that the motherlode. And this is what Trump said. Now, as far as tariffs are concerned, he kind of sort of posted, and I'll just quickly read this out. He said, I will only lower tariffs if a country agrees to open its market, if not much higher tariffs. Japan's markets are now open for the first time ever. USA business will bloom. The point is, access to markets is something that Trump and his team has talked about with regards to India as well. So is this a sort of a statement indirectly pointed at India, countries like India? We'll have to wait and watch. But I mean, I'm just putting that out because we are yet to strike one. We reported, of course, earlier that a deal before the 1st of August is unlikely. Yesterday, the market for the first time, and for the last 2 days, we've been saying, are we starting to see the first signs of reversal? Day before yesterday didn't work out. Yesterday, maybe it did, right? Nifty made a higher high. Now, the levels don't change very much, but 25,255 is the first resistance, the recent high. And above that, the 61.8% retracement of the entire decline stands at 25,369. So these are two levels on the upside for the Nifty. Support stands at the low of 24,882. And then the 40-day exponential moving average comes in at about 25,050. For the Nifty Bank, we've climbed back above the 20-day moving average yesterday with what we've seen. We need to see a decisive close back above 57,286. This is the level we put out for the last couple of days. And support for the Nifty Bank comes into this recent swing low, which is 56,690, 56,700 roughly is that level. GIFT Nifty will come up on your screen, gives you a quick sense, 45 points higher. But as I said, I mean, if you're looking for the moves, the excitement, all of that stuff, right? It's basically in single stocks. And, some stuff up, some stuff down as well prominently, which we will get to in just a bit. Surabhi.
Absolutely, and I'll come to single stocks in a second, but it's a big, wide tidal wave of green across Asia this morning, building up on gains that we saw yesterday. So this whole tariff joy, tariff optimism, it spread across continents. I mean, we saw that in European markets yesterday, the way the US markets closed out yesterday. Of course, they had good tech earnings like Alphabet as well, though Tesla missed the mark. But look at the Asian screens this morning. Hang Seng is up 0.5%. That's not the story. The story is Japan. The Japanese markets are rocking away. The topics, the Nikkei itself, Nikkei 225, these markets are up 2% as we speak. The topics hit another high today, I mean a record high that is. There's good news coming in for South Korea as well. South Korean markets are up about 1%, and because that economy has avoided a technical recession, second quarter GDP came in above estimates at 0.5% growth, so that was good news. By the way, this optimism, this tariff optimism is showing up in the currency markets as well. A lot of Asian currencies have managed to bounce back a little bit over the last 24 hours. Starting with, of course, the yen itself. The yen had a big move yesterday. This morning, for a brief second, actually, it broke above the 146 handle as well versus the USD. So that charge continues. The yen, not only the yen, the yuan has been rising as well. The offshore yuan actually has risen to the strongest level since November of last year. The offshore yuan at about 7.149. Now you can see it was 7.144 actually in earlier morning trades. So currencies are higher, equity markets are higher. For us, the question is how much of this global sentiment is going to rub off on the Nifty. At least yesterday there was some sign of that because we finally had that close above 25,200 to at least begin with. The flows position is still not inspiring. FPIs are still selling this market and perhaps still looking at other markets in Asia. Look at the flows yesterday. A slam dunk of 4,200 crores net selling coming through, 4,300 crores of buying. And of course, a lot of this is skewed by a lot of the large block trades that are happening. But net FPIs are selling and it's being offset by DII buying, at least for now. Now let's come to stocks. We have good news coming in from Infosys. And the key question is whether Infosys's beat will inspire further confidence in the rest of the IT pack. Maybe as a tactical trade, will the IT names come in and support the Nifty and take it higher today or not? Infosys has beaten estimates on the top line. It's the best-in-class growth coming in, constant currency growth of 2.6%, well ahead of estimates. The guidance has also been increased, as was widely expected, from 0 to 3%. Now it's 1 to 3%. Margin, you can say, maybe a couple of basis points shy of estimates. The company is saying it's seeing traction across financial services, especially in North America. And it's also, giving positive commentary on AI, saying that it's seeing new revenue streams possibly opening up because of AI in enterprise. That's one stock. The other one to watch out for is going to be IEX for sure. Market coupling after months and months of back and forth is finally a reality, at least in a phased manner. That could spell slight trouble for IEX. We'll get to that with our experts in just a bit. And coming back to earnings, it's a full slate today. We have to digest earnings that came in yesterday, for instance, Tata Consumer, and there's a big margin compression for Tata Consumer. Let's see if the market can digest that. Dr. Reddy's, America has been a little weak for them. Then there is SBI Life, there's Bajaj Finance, there's Nestle today. So plenty of numbers, big numbers to watch out for in today's earnings action as well. So busy Thursday coming up. Nigel.
Well, that's right. It's going to be important to see whether or not the Nifty can drive home the advantage, because starters indicate that we could start off in the green, which is going to be an important mark. The question is, can we get past the 20 DMA? It's going to be extremely crucial because today is the weekly expiry as well that we'll be working out. So the start in the green, that's going to be important. And Infosys, that's going to lead the way, at least in the initial part of trade. And if we pull up the intraday chart, you'll see that yesterday in the last few minutes, someone sensed that there was a disappointment. They either sold, they added some short positioning as well. So that's going to give that cushion actually to Infosys to see a bit of a bounce in today's trading session. That's going to be an important one to track because the kind of slide that we saw in the last 5 minutes of trade. Moving to what the FIs did, in yesterday's trading session. It's important because they added some short position yet again. But in yesterday's trade, on the whole, you did see there was some covering both on the Nifty as well as the Nifty Bank. So both those two indices moved higher. The Nifty Bank clearly has taken up leadership, and that in fact did end higher in yesterday's trade. Moving to the F&O market then, the positioning that you have in yesterday's trade, there was some short positioning that did take place as well. Just take a look at that. Some shorts getting covered out in yesterday's trade, both on index futures as well as on stock futures. In the previous trading session, we made this point that there was some addition, on the short side, which yesterday resulted in some covering. And that's how they positioned yet again. Shorts at close to around 85%, long positioning at around 15%. Now, besides the shorts that got covered in yesterday's trading session, there were some puts that were written. And because of that, the PCR has moved up to around 1.15 odd. Because we saw aggressive writing yesterday on the put side. And after a while, in an uptrending market, you saw some put writing, which is telling you the bulls now, they're trying to defend the 25,000 odd mark. And we had some writing, 25,200 put, 25,150 put. Both of them saw aggressive writing. And given that today's expiry, that's going to be the important factor to track. Even if you're looking at the positioning from the FIs, in yesterday's trade, both the FIs as well as the clients, there was some put writing that we saw. So putting everything together, we'll bring up a couple of levels. On the upside, the 20 DMA, extremely important level. If you can get past that mark, the bears are going to be, running for cover because the call writing has been very aggressive. And the recent low, that becomes a reference point. So for now, you've got roughly around this 450 to 500 point band that you're working with. The Nifty Bank, that's taken up leadership, and that's holding above the 20 as well as the 50 DMA. So, that's the important leader that we are seeing that continues to hold above the 20 DMA, 200 points away from here. The Reliance Industries stock, that's going to be important because that's corrected a little bit from the top. But on the longer trajectory, the street is quite bullish out there. Now I'll keep an eye out on this resistance mark, the 20 and the 50 DMA. You'll want to see Reliance Industries gradually move towards that mark, which is around 3% away from current levels. So we'll keep an eye out on that factor as well. In terms of stocks that we're going to be looking at, well, Tilaknagar Industries, we told you that source-based information indicated that they could be making their entry into the whiskey market. That's happened because they've taken Imperial Blue. I'll keep an eye out on the reaction on Tilaknagar Industries because of the run that we have seen. And also I'll keep an eye out on United Spirits because, suddenly you have a domestic player that's entering the whiskey space. So both those two stocks on the radar for today. But driving home the initial uptick is going to be the important point to track.
No, absolutely, Nigel. So important stocks and, so we mentioned IEX. Is that going to be the big accident of the day as we start today? It looks like it, right? I mean, the coupling orders coming through a little later, but that should be at least 10-15% straight off the bat. We'll see. William Lee is with us, Chief Economist and Executive Director, the Milken Institute. William, good to have you with us here. Thank you very much for your time. Everybody seems to be getting a deal, or at least looks like it, in terms of reporting, etc. But that's not, we talk trade every time, but this, did you see Trump's speech on AI? I mean, almost a plan, right, to let it fly and working in close collaboration with Silicon Valley companies. So very seized of the idea that China is catching up, William. Does it provide another fillip to the Magnificent Seven companies in the US?
Well, China is always going to be one of our most robust competitors, as Jensen Huang has said. Half the world's AI researchers and scientists are Chinese, and most of them are located in China. But I think President Trump is showing you, first of all, the template for trade is you be a partner with the U.S., invest in the U.S., and you get to get a good deal on the tariff levels. Open up your markets, lower your non-tariff barriers, you're going to get a good deal. You do both, you get a great deal. And that's exactly what Japan and South Korea seem to be doing. And as far as the AI is concerned, where would you invest in the United States? If you're going to bring capital into the United States, you bring it into the most innovative and technologically advanced sectors and companies we have, and AI is exactly where it is. So President Trump essentially is laying out the platform for people to come be partners with the U.S.
Yeah, and William, kudos to you, because I remember all our conversations through the last couple of, I think, weeks, if not months, and you've been maintaining that this is a big change, but not necessarily a negative one for the U.S. economy. And let's see if that really plays out. But, well, what this means is the markets are just going from strength to strength because earnings have not been too bad, and now there's fresh hope on trade. So what? I mean, do we see bigger upsides ahead? Do we see a lot of money rushing back to the U.S., that whole diversify away from America trade? Do we see some of that reversing? I mean, what do you make ahead for markets?
every time I've come on your show, I've always maintained the position that capital should go to where it is best used, right? The highest rates of return. And I've introduced the notion of the Lucas paradox to you several times, where people think, oh, gee, because emerging markets have so little capital, they must be most productively used there because capital is so scarce. And I think the data and what's happened is showing you that sources of innovation are everywhere in the world. And with the right set of environments and institutions to promote that kind of technological innovation, that's where capital is going to flow. And in a way, that's a lesson for India, right? Because for India to get the kind of capital infusion that the United States is getting, it has to bolster its institutions to reassure investors that corporate governance and legal standards are there. The United States has those standards. So in that sense, many of the emerging markets are competing not just with the United States, but with the lack of or suffering from the lack of institutions that reassure investors that governance and legal principles are there to guarantee their investments. So
Really?
in terms of
Yeah, but William, sorry, if I could, offer a small counter there, but I'm not sure because we've had foreign capital coming in. Isn't it more about earnings, which is maybe the missing piece here in India, or you think it's more about governance?
Well, it has, my reply to you is investors are very patient, willing to be very patient with current earnings, right? Look at Tesla, right? People are still investing in Tesla, even though he's warning you for the next several quarters, we will have very bumpy earnings. But if he can assure, what he's done is to assure investors that we are a source of innovation and we have credible track record of putting together those innovations, and he's getting all the capital he needs. I think, but again, he's doing it in the United States because the institutions are there to reassure investors that corporate governance rules and legal standards are there. And while I'm not saying that India doesn't have the necessary ones, I think India could benefit from strengthening exactly those standards in order to entice more global investors, not just U.S. investors. But again, innovation is the drawing card, right? That the magnet that draws in capital, especially a track record of successful innovations.
All right, William, we'll leave it there. Quick conversation today. Thank you very much for joining us. Really appreciate your time here on CNBC TV18. Well, I think we've got a packed schedule coming up in the next, 2.5 hours or so. We'll get the ball rolling. We'll take a break. Let's take a quick commercial break here. Our research team will be with us. Those stocks in focus on the other side coming right up.
Welcome back. So like we've been telling you, it's a big tidal wave of green across Asian markets. And let's see how much more of that rubs off. The other markets which are up are obviously Japan. South Korea is doing very well today. Let's get the implied open up on our screen. We last checked and I think it was giving us a sense that we'll probably start 40 odd points. Yeah, still about 40 odd points higher. So that's where we are at. Now, can Infosys add to the bulls party today? Finally, we have a good number coming in from the IT pack. So let's get to our top 10 list. And you guessed it, Rima is going to do the honors, kicking it off. Morning, guys. So, Rima, finally some good news from large IT.
Finally. So, Infosys was actually a strong beat on the top line. Not just a beat, a pretty good beat. So, the company reported a 2.6% constant currency revenue growth, higher than estimates of 1.5%. And we've been reporting how the rest of the large cap IT pack actually had negative top line growth this time. Margins in line at 20.8%. FY26 guidance now stands at 1 to 3% versus 0 to 3%, which basically means the lower end of the guidance has been raised. 0 has become 1%. The margin guidance remains unchanged at 20 to 22%. Deal wins are healthy at $3.8 billion in Q1. Now, the ADR was up only 1%. Now, you would ask that despite such a strong Q1 numbers, why didn't we see a bigger reaction in the stock price? Here, I just want to add now this guidance change of 0 to 3 becoming 1 to 3 includes 40 basis points of acquisition. So basically, the upper end of the guidance, which last quarter was 3% pure organic, has now become 2.6% organic. So analysts are a bit disappointed that despite a strong Q1, your upper end of the organic guidance has actually come down, which is why some of the optimism has faded for Infosys. But that said, Q1 is a very good set of numbers, and I would go with green for Infosys today.
Okay, all right. Rima, thanks a lot for that. Green on Infosys. And because of that last hour or last few minutes downtick, that'll get an additional lever in terms of the shots having to cover out. But let's go across to Ekta. She's here to tell us about Dr. Reddy's. Morning, Ekta.
Morning. Well, for Dr. Reddy's, the commentary was better than what they reported. So the revenue was up around 11.4%. The street was anticipating 13% growth. Margins were better than estimates, came in at 26.7% versus estimates of 25%. And a profit, which was up around 1.3%, it was lower than what the street was anticipating. What probably will weigh is that North America was down 11%, but other geographies such as India was up around 11%. Now, in terms of guidance, what they have said is that US is going to be flat to single-digit growth, which is expected for FY26. They are going to see more price pressure in their key drug, Revlimid generic. That's going to be the case for most companies. EBITDA margin should be expected to be north of 25%. India, Europe, PSAI expected to show double-digit growth. And the launch is planned for semaglutide in Canada in Jan 2026, which would be the big trigger. The only thing which would probably weigh on the stock today is the North America decline. And obviously the uncertainty that, until the semaglutide launch does take place, the street would probably be a little bit on tenterhooks. Otherwise, the commentary looked okay.
All right. Ekta, thanks very much for that. You'll hear from the Dr. Reddy's management in a bit from now. So they'll be coming up shortly. Mangalam is here with Tata Consumer Numbers. Mangalam, morning.
Good morning. So it was a decent set from Tata Consumer, largely in line with street expectations. We were expecting a gross margin decline. But the good part is that was just contained to the gross margin. The EBITDA margins actually declined by just 250 basis points as against a gross margin decline of 500 basis points. The revenues largely in line with street expectations, mildly below. The EBITDA 607 crores. The street was working with a number of 620 crores. And the net profit coming in at 331 crores. The street was working with what? A 330 crore number out there as well. India, beverages grew 8%. The street was working with 8 to 10%. Foods grew 14%. Street was working with 13 to 15%, largely in line. So where is it that, the mild miss came in? That was on account of Nourishco. That actually declined by 13% versus expectations of 2 to 3% growth. International constant currency revenue growth was also in line. The management has guided for better times ahead as tea prices have come off the highs. So margins are likely to improve going forward, along with, growth businesses picking pace as well as the transitory impact of the acquisitions are behind. So see some green on Tata Consumer today.
Okay. All right. Got that. Thanks very much, Mangalam. Let's talk about IndusInd as well. We've got Gaurav joining in. Gaurav, IndusInd is raising some funds.
Well, yes, IndusInd Bank is definitely going to be in focus, and there are two reasons. Now, the board meeting recently happened, and what they have decided is that they have went ahead and approved the fundraising worth 30,000 crores. Now, this will be in two parts. First is 20,000 crores worth of debt securities will be raised, and second is the QIP or GDR, which can be up to 10,000 crores. Now, if we calculate this number, this comes as 2.3% of the CET1 ratio. Let's not forget, it currently stands at 15.1% as of FY25. Other reason to follow IndusInd Bank today is that the board is now seeking approval to allow promoters to nominate one more director on the board. Now, why this is important is that we already know that promoter was looking to raise funds in IndusInd Bank, and now experts believe that this is actually fueling existing optimism that RBI can allow IndusInd Bank's promoter, which is Hinduja, to raise stake in the bank. Let's not forget that currently the stake is at around 15.8%, which is slightly lower than the voting right allowance of around 26% as per RBI. So definitely this gives room for speculation, and as a result, we are watching out on IndusInd today.
All right. Thanks very much for that. So that's IndusInd for you. Let's talk about the next one, which perhaps is the stock of the day on the downside maybe. Vivek is here with IEX. Vivek, morning.
Well, good morning. Every time we've spoken about IEX, we've always ended the conversation saying that the biggest overhang remains the implementation of market coupling. And that particular overhang, unfortunately, has fructified as far as IEX is concerned. So last evening, a bit of a surprise given the fact that, there were still a few steps that the market was anticipating before the implementation of market coupling. So what's actually happened overnight is that the Central Electricity Regulatory Company has actually gone ahead and approved the implementation of market coupling. And this will be done as soon as Jan 2026. And this particular development will be done for the day-ahead market. So who will actually do the price discovery? All three of the exchanges on a rotational basis will be doing the price discovery. Not only that, they also started the consultation process for implementation of market coupling as far as the RTM or the real-time market is concerned. Why is this so important for IEX? Number one, 50% of revenues came in for the DAM market or the day-ahead market. 30% revenues came in from the real-time market. So two of the largest contributors to the top line is something that will be under threat. In terms of IEX, number one, markets immediately will cut the PE valuation multiple. Transaction charges at almost 4 paise per kilowatt is something that could come down significantly given the fact that the company will be forced to reduce transaction charges. And also, along with that, expect EPS cuts, expect volume decline. Overall, a negative development for IEX, and we'll also get key stakeholders throughout the day to understand the implication and whether IEX can have any say in this matter.
Yeah, absolutely. I mean, because this is this big structural change. It questions and challenges perhaps the current business model itself of the company. In fact, Nikhil Nigania of Bernstein will be with us shortly to talk about the implications here for a company like IEX. We'll get to Nikhil in just a second. Thanks for that, Vivek. But let's quickly complete our top 10 list. Still got plenty of IT earnings to talk about. Persistent Systems, Coforge and Oracle. And I think Coforge is still charging ahead on the growth path, Rima?
Indeed, 8% revenue growth on a quarter-on-quarter basis. Expectations were high, 6.5%, 7%, but Coforge has gone and beaten that. Remember last quarter, the company said FY26 is going to be an exceptional year? Well, it's clearly started off like that. And just to put it in context, look at the peer performance. Persistent was at 3.3%, LTI Mindtree was at sub 1% growth. Now, the quarter growth was led by the Sabre deal ramp-up. Remember, it was this large $1.6 billion deal. People were questioning the receivables, etc. But, very strong revenue growth. Margins unchanged at 13.2%. And that statement will come up for you. The 9.6% dollar revenue growth in Q1. The next 12 months signed order book is 46% higher. A very large, robust deal pipeline. Pathway to 14% EBIT margins in FY26. These are all pointers to what we believe will be an exceptional year. So that's Coforge for you. Persistent, on the other hand, has also clocked in a very good set of numbers, healthy set of numbers. It's not a beat, but it's a good set. 3.3% revenue growth on a quarter-on-quarter basis, EBIT margins at 15.5%, and profits too are higher. And the last one is Oracle Financial Services. Again, decent set of numbers, revenue growth at nearly 8% quarter-on-quarter, 6.5% year-on-year. Margins have expanded to 45.8%. Profits are on the flatter side. Back to you.
Okay, all right, Rima, thanks a lot for that. Well, we told you first, and now it's official. Tilaknagar Industries has gone ahead and bagged Imperial Blue for around 4,150 crore rupees, which includes roughly around 200 crores that will have to be paid over the next few years. The deal is done at actually an attractive valuation. And I'm going with green over here in spite of the stock already running up big time. The reason is it goes from around a 1,500 crore company, revenue company, it'll become a 4,500 crore revenue company. It's going to go up basically close to around 3 times in terms of revenue. The company says the EPS is going to be accretive immediately itself. And why is the deal okay? You know, if they did the deal at around 6,000 crores approximately, the street would be a little bit concerned. That'll be 2 times sales. They've done it around 1.3 times sales, which is a fairly good number. And it makes their foray from a brandy player, they're going to become now a whiskey player as well. They have core market in South India, now they'll have pan-India presence as well. To give you a few more numbers, how will they fund it? That's going to be important. You know, they have announced the plans to raise up to 6,500 crores, out of which they say up to 2,500 crores can be via equity and up to 4,000 crores via debt. So going with green out here, because the valuations are done at an attractive level, it puts Tilak Nagar Industries into another league in terms of scale. And I'll be tracking from here on, what are Imperial Blue's margins? Because we have the sales number, but what is the margin that they can achieve? And what are the cost synergy benefits as well that will play out? To give you a comparative number, United Spirits, which is a core whiskey player, their market capitalization is close to around 1 lakh crore. They do sales of around 13,000 crores. Now, this company is going to be, close to around a 4,500 crore revenue company. Let's see how the street reads it. But it appears in the longer term, this could be a structural positive for the company because it puts them in another league itself. So going with green, even though the stock has run up 20%.
All right, Nigel, congratulations on the deal.
Yeah,
cheers.
That's a great one. Yeah, we raise a toast on Friday.
Keeping the record straight, right?
Nigel's taking us out.
happy to be on it, and we thought it will take a couple of weeks, but it happened pretty soon.
Quickly.
Yeah,
the best.
Always
time.
good.
Natco is the next one. Ekta has got details here. Ekta, morning.
Morning. Well, for Natco Pharma, they will be acquiring, or they've offered to acquire 35.75% stake in Adcock Ingram, which is a South African pharma company, for 2,000 crores. It is the second largest pharma company in South Africa when it comes to private market share. The deal is at around $4.27 per share, which implies a valuation of around $632 million, or 1.1 times revenue and 7.8 times EBITDA. Natco, in terms of the total revenue for Adcock, it was at around $536 million, up 6% in FY24. Margins at around 14 to 15% with profit of around $45 million. So it is going to be EPS accretive. Acquisition is going to provide Natco access to one of the largest EMs. The company's indicated, interestingly, that they are looking at further M&A to diversify from the US. They have around 1,500 crores of cash post this transaction. Nuvama says the deal is likely to be 7 to 9% EPS accretive. Target price is 1,110 versus 990 earlier.
Okay. All right, Ekta. Got it. Thank you very much for that. We'll keep Natco on the radar as well. Let's quickly recap our stocks to watch today then. The ones that have positive news flow are Infosys, Tata Consumer, Coforge, IndusInd Bank, Natco Pharma, Tilak Nagar Industries, and Oracle Financial. Stocks with negative news flow would be Dr. Reddy's, Persistent Systems, and of course IEX. Speaking of IEX, let's straight away get to Nikhil Nigania now to understand what this implies for the company. Nikhil, I was just going through your note briefly, and your title is interesting, as bad as it gets. And the thing is, the market wasn't prepared, I think the market kind of, because this was going on for so many months and quarters, the market kind of put it on the back burner. Let's get to the hit first. 46% of IEX's volumes are coming in from the day-ahead market. Now, what's the hit in terms of your own estimates, earnings, etc.?
Sure. See, the impact we think will be twofold. Number one, the impact will be on loss of market share. So on the day-ahead market, as you rightly said, about 45-46% volume for IEX's day-ahead market. Where if you look at global peers, in UK, we saw coupling impact the largest player losing market share from 80% to 60% post-coupling. In India also, in our estimates, what we are building in, we are cutting IEX market share in the day-ahead market from 100% to 60%, but that's over a period of 3-4 years. And second impact, which I think will be equally big, is transaction charge. Now with coupling, we think the only thing exchanges will have to compete against other is transaction charge. And they will start giving discounts to larger players, larger buyers or sellers on the exchange, which could bring the transaction charge down from 4 paisa to 3 paisa or even lower possibly over time. So combining these two, we have cut our target for the company from 160 to 122, given the impact of loss in market share and transaction charge reduction.
Nikhil, the very sort of fundamental reason for why the exchange is there, that's kind of gone, right?
You're absolutely right. I mean, the exchange, the moat they have is liquidity. To put simply, what it does, if I take a stock market parlance, what it means is, for example, if you place a buy bid on Bombay Stock Exchange, that could be netted against a sell bid on National Stock Exchange. So the liquidity advantage is gone. It's a similar play in power. So whichever exchange you're putting your bid on, buy or sell, there'll be one common demand-supply book that will happen post-implementation of this.
So, you since you cover it, does it have a lot of institutional holding, yeah, just trying to understand how's the who are the players long only, or and what will their behavior be? I mean, over a period of time.
Sure. See, as per the government regulation, no single entity can own more than 25% of a power exchange. So it has multiple shareholders, mostly institutional shareholders, which are long only mutual funds, mostly domestic funds, and decent bit of retail shareholding as well. Other than them, I think it had become a favorite among hedge funds looking to play it for the volume or this big event, given it moves a lot and it's in futures and options. So yeah, it's very relevant from an institutional shareholder perspective, the stock. It's a good company.
Yeah, go on.
No, so I was saying it's a good company, but the regulatory overhang is massive. And this was possibly the most negative event that could have happened for the company.
Yeah, that happens in some of the older economy sectors, and power is one of them, right? Regulations can change, even oil and gas for that matter. Just recapping, what you're saying is that the market share will reduce from obviously near 100% right now to about 60% in the day-ahead market over next 2-3 years. Now, this is the first order impact, right? Because what the order says that they'll see how it goes with the day-ahead market, and then they'll roll it out to the real-time market, the RTM market, and then the term-ahead market as well. So then what happens if we talk about coupling to become a reality for all segments?
No, you're absolutely right. Even in our base estimate, we had not built in all three products getting impacted. But the way the order reads, all these three items, starting with the day-ahead market, the biggest one, and the second biggest one, RTM, that could also get impacted 6 months to 1 year after the day-ahead market is streamlined, coupling of day-ahead is streamlined.
Okay, so, what's the advice? I don't know. I mean, this is such a big structural blow. The company loses its moat, monopoly, call it what you want. So I don't know if there's a way out. I mean, is the stock, you mentioned you've lowered your price target. Is it a sell, buy, hold for you? What's the advice to investors?
See, we had been a sell on the stock for the last 3.5 years. We changed our rating to market weight given good volumes it is seeing. So volumes, for example, on IEX is up 15% in the first quarter of this financial year. So volumes we think will still be good, but this event, it's massive. So hence our fair estimation of value of the stock is 122 is what our new target price is.
Yeah, no, absolutely. Nikhil, we'll leave it there. Quick conversation. Thank you very much for joining us here on CNBC-TV18. We'll take a quick commercial break here. We're going to come back with Dr. Reddy's to discuss their first quarter numbers. And we'll also have Sumit Gupta of Centrum to talk to us about pharma and, of course, a bit about Dr. Reddy as a stock as well. Stay tuned.
Welcome back. You're tuned into Bazaar Morning Call. Well, let's focus on Dr. Reddy's, who's the first management on the show. It reported actually a mixed set of numbers in the first quarter. The revenue came in at a healthy number, but the margins contracted marginally. We're now joined by Erez Israeli, the CEO at Dr. Reddy's Labs. Hi, sir. Good morning. Thanks a lot for joining in. Well, the US sales number declined by 11% on a year-on-year basis. Could you help us out with how much did Revlimid generic contribute in the past quarter? And how much competition did it see?
It's not so much about the competition. Each one of the company has a certain quota and certain timing in which the customers are buying it. This quarter, we had less of this product, and also the price is less. It's part of a normal anticipated situation for this product, as this is obviously the last year of the contract.
Got that. So what is your guidance on US sales for the next 3 quarters?
No, they will be normalized. Obviously, the linadulemide will be wind down. So we have basically next quarter and a little bit of the quarter after. And that's no more after that within the current framework. And as for the rest of the product, we see that as a normal course of business with the launches. So it's supposed to be around flat to mid-single digit growth like it normally does on the normal business, at least in America.
You've also said that margins after Revlimid generic would be 25%. What is that predicated on? And what are some of the key launches? What's your pipeline looking like that could perhaps support margins?
We are having 4 levers of growth that also affecting margins. First, the base market, everything that is not semaglutide or abatacept or linadulemide, this is going in double digit, including the US that I mentioned. So even if the US is flat, the overall business, which is more than 30,000 CR, is growing in double digit. Second, we are going to launch semaglutide in the last quarter of this fiscal, and abatacept in the year after. In addition to that, there is a certain adjustment. We naturally use the time that we have a linadulemide in order to invest into the future. We timed some of this investment in a way that we will not have them after that. So you'll see some of the investment in the future, like R&D and some of the other costs going down accordingly. So overall, we are planning to maintain the overall profitability as well as the growth. So the double-digit growth and the profitability are meant to continue also into the future.
Well, Mr. Israeli, the company guided for double-digit top-line growth at FY26 and flat margins. Now, some analysts think this guidance is a tough ask. According to you, is it a challenge? Does the guidance still hold?
You know very
and for
well.
the remainder of this year, what's it looking like?
You know very well we are not guiding. So whoever guided this is our analysts that believe that this is what we are going to do. What we are saying is obviously the profit that will come from the current arrangement of linadulemide will go away, and it will wind down through the year. The company will do a double-digit growth. What will be the profit is very much determined how much potentially semaglutide will be able to sell in the end of the year.
Got that. Just a sort of a quick sense on, these are estimates, of course, projections, right? Now, there are street estimates which say that you could make up to $280 million in FY27 from semaglutide, from key markets such as Canada, etc. Is that estimate close to your internal estimate? Could you give us a sense?
It can be a very big product. It can be more than that even. Of course, it can be less than that. It's very much It's very much depends on one, the ability to get the approvals day one for each one of the market, which what we are planning to do. And second, of course, of how many competitors will be in each one of the market, which will obviously determine the price. So the numbers that you're mentioning is considering certain scenarios, which can be reasonable, but obviously we are preparing for other scenarios as well.
Mr. Israeli, what is your expectation from Mr. Trump when it comes to tariffs, any kind of roadblocks with respect to your exports to the US?
I wish I knew. We are obviously looking forward to the news. The pharmaceutical sector, especially in India, which is affecting most of what we are doing, is it will be either be affected by a potential agreement between India and the United States, if this agreement will be, or it will be part of the solution of Section 232, which is more of a sectorial segment that right now is under some sort of examination by the US government. So we don't know if we'll be impacted by the sector or by the country. Naturally, whatever will come, we'll have to address it. And what we hope that it will create advantage for India over maybe other companies from other countries, and even create an opportunity to increase market share.
Oh, yes, absolutely. I mean, in hope we trust, but in the interim, there also has to be a game plan. So let me ask you this. I mean, are you, having said what you've said, are you still considering onshoring, setting up plants in the US to mitigate any potential risk?
We are not planning onshoring. We are not against making in the United States, but we are not doing it because of onshoring. It's only if it makes sense from economy point of view, from a customer segmentation point of view to make United States. We used to have a plant in the United States. We still have one plant in the United States. As we speak, there are no onshoring activities.
All right, so no onshoring, but confident on the business overall. Got it, Mr. Israeli. Thanks very much for joining in. Good to get that perspective with you on the business and the year ahead. Well, let's get a street view on Dr. Reddy's as well. We have Sumit Gupta joining in. He's AVP Research at Centrum. Sumit, good to have you on. So what do you make of things? The India business is firing. US is where it's getting a bit sluggish. Your thoughts on the numbers?
Hi, good morning. Thanks for having me. Yeah. So overall, obviously, it was a miss on the numbers, but from medium to long-term view, we remain positive. So see post of Revlimid. So Reddy's has a very good pipeline in the US also. So be it a Betasept or denosumab and some other pipeline products which are there in the end of filings are also good. 505B2 products are also there. So US also remains interesting. Apart from that, if you see in India, growth is in double digits. Even in Europe, ex of NRT also, it is growing at around 14%. So it remains in a positive trajectory from the revenue growth point of view. Apart from that, obviously, on the profitability front, there ex of Revlimid, we can see an improvement in margins because if you see, they have also revised on the basically R&D guidance to around 7.5%. Currently, it is at around 8.5%. So in that case, and you will see a bit of expansion in the EBITDA margins as well as some bit of cost savings of around 400 to 500 bips. So over the next medium term, 3 to 5 years down the line, so we are positive on Reddy's.
3 to 5 years down the line, you're positive on Dr. Reddy's. Okay, tell us about more in the near term. So FY26 now, ex of Revlimid. What is your take on their launch pipeline? Do you see any interesting products ahead that can at least get US back on track? And what is your estimate with respect to their US business for this year?
The US business as such, obviously it will see a decline obviously because Revlimid, they will, so going off patent, there will be a lot of price erosion. So majority of the price erosion Revlimid is facing, so US will continue to see a decline. Yes, having said that, it's just that post of FY26, FY27 might might be a bit of sluggish, and then FY28 will be positive. But in the near term, obviously, Revlimid is facing continued price erosion.
And how much are you building in from the semaglutide opportunity? And just give us your overall rating, price target, and your view on the stock.
We have a buy rating on Reddy's, considering the fundamentals are also going towards positive trajectory, and second, from the valuation point of view, it is currently trading at around 19-20 times first FY28. So we have a straight multiple of around 23-24 times. So
baking in what kind of growth, Sumit? CAGR growth of what? Margins of what?
So growth of around 7%, revenue growth of around 7%, and EBITDA of around, so basically 2 to 3% kind of CAGR. So in that sense, we continue to see EBITDA margin contraction for FY25 to 28 of around 300 bips. So in that case, so that is a kind of trajectory that we are building in for Reddy's.
300 bips contraction
so that
in EBITDA margin for the next 2 to 3 years. Got that. And just final point on Revlimid. I mean, what value are you ascribing to it? Sorry, not Revlimid, semaglutide, that opportunity?
So Sema will be so overall on basis. So basically Canada is coming next year, India is also coming. So on overall basis, so around 200 billion. So in that sense.
All right, Sumit, appreciate you joining in. Wishing you a good day ahead. And thanks a lot for giving us that view on the pharma pack. Look forward to chatting up with you rather soon. For the timing, slip into a short break. We go look at technicals on the other side. Sudarshan and Mitesh are waiting for us. Welcome back. Well, let's get our focus then on the technicals of the market. Yesterday, we had a good run, actually. But today, the GIFT Nifty suggesting maybe another 50 points on the upside. Remember, today's weekly expiry, so it's going to be quite important. Now that's narrowed down the gains. It's indicating just around a 10-15 point gain. Let's go across to Mitesh as well as Sudarshan. Good morning, gentlemen. Mitesh, come across to you first. More in store, that 20 DMA, I think, is a line in sand. How would you trade the Nifty today?
Yeah. So, on the index, while there are moving averages and pivots, I think broadly the setup is such that the indicators are showing flatness, which means that most likely outcome is going to be a sideways activity. And I've been maintaining that view, saying that 24,900, 25,300 broadly is the range. And only if we see a breakout or breakdown on either sides, then we'll get some kind of a directional movement. Below 24,900, I expect 24,500, 550 zones to be tested. And once we get past 25,300, 320, 340, then you can look at about 25,600 plus level. So index right now isn't offering a very, good directional bias. It's just chopping around within that 400 point kind of a band.
Okay, got that, Mitesh. Let's ask Sudarshan as well. Sudarshan, hi. Good morning to you too. What's the approach? I know the last couple of days we've been talking about steering clear of the index, but today?
Yeah, good morning. Actually, yesterday I said go and buy the Bank Nifty, and that continues to be the view today. The Bank Nifty and the Midcap Index are buying opportunities on dips. The Nifty is essentially, even though we saw a gap, say rally yesterday, the point remains that it is in a trading range. It's not worth dabbling when we have two other options. As I said, the Midcap Index and the Bank and Nifty, both are buy on dips. And for the Nifty, there's a warning. Today is a weekly expiry day. Please do not dabble in expiry options.
Okay. That's good advice. Sudarshan and Mitesh, good to have both of you here. We'll take a break here and we'll come back and do trades on the other side. Coming right back. Okay, welcome back. There's 15 minutes to go for the market open and just a couple of seconds to go for the pre-open session, which should kick off shortly. Mitesh and Sudarshan are with us. They've been running us through what to do in this marketplace. Gentlemen, thanks for staying on. Sudarshan, what are your individual trades?
Again, they're mainly on the buy side. SRF is a buying opportunity with a stop under 3140. JSW Energy may be breaking out. It's a buy with a stop under 523. I have some shares in JSW Energy. NTPC is a buy with a stop under 335. And finally, Nestle surprisingly has come out as an intraday short, only intraday with a stop above 2500, but mainly focus on the buying.
Mitesh, what about you?
I have three buys to a sell as well. Morning, Prashant. I have a buy on Bajaj Finance. It was recommended 2 days back as well, still does well. Looking at a price target of 1,000 and a stop at about 953. A buy on Chambal Fertilizers. Here I would recommend keeping a stop at 551, looking for a target of 570. And once we cross this 570, 575 band, you might look at further upsides. Macrotech Developers is a sell with a stop at 1356 for a a price target of 1280, and the final call is on NMDC. Buy with a stop at 71 for targets of 77.
Okay. IEX will have the first rates in the pre-open shortly, and it should be sharply lower. Mitesh, there you go, 10% straight up. That's the first kind of stop. But I suspect if that's the end today. But Mitesh, where are supports placed, if any?
Yeah, I think there was this range of about 178, which is where the stock had a trading low around 19th of June. But I think it will open below that as the pre-open is suggesting. So good chance that we are looking at 165, but even a stronger chance of heading towards 152, 153, which is where the stock had made a major bottom way back in March. So there could be more declines post the fall as well.
Yeah, it's a tricky one there because, that circuit will get revised and there'll be a huge amount of pending orders as well. Thanks a lot, gentlemen, for joining in and, filling us in with those cues. We'll keep coming back to you. Well, let's connect with the management of Borosil Renewables to discuss their Q1 numbers. We have with us Mr. Shrivar Kheruka, the MD and CEO at Borosil, who joins us. Hi, Mr. Kheruka. Good morning. Always a pleasure talking to you. Well, give us a few details then, in terms of the trajectory for the year. What kind of growth are we looking at, for the remainder of this year? And what kind of a margin number should we work with as well?
Well, as far as the growth is concerned, in the first quarter, we had more than a 35% revenue growth, about 37% to be precise. And our EBITDA margin came in at about, on a standalone basis, about 28 odd percent. And I think it would be reasonable to sustain that growth through the rest of the year. We also have a new capacity coming on stream next year. So the numbers won't be impacted this year, but that's another 60% capacity addition, which will come on stream from 26-27 in financial year 26-27.
All right. So, and the steady state margins you said would be?
So at the moment, like I said, this quarter, we declared about a 28% standalone EBITDA margin. And I believe that's something that we would need to achieve slightly better than that going forward. So, we would hope to hit the 30% number.
30% number, and you're talking about the India operations now because of that write-off that you'll have taken in the overseas business. You'll mention that on a quarterly basis, the gain will be close to the tune of around 27 crores. Because I think 9 crores of savings per month.
Yeah.
So that starts off from the second quarter onwards.
Yeah, well, actually, that's right. The German entity has declared insolvency on the 4th of July. So all the costs associated with that have kind of evaporated from that moment. So from the second quarter onwards, we should not have any of those losses per month.
Mr. Kheruka, hi, morning. Could you tell us when will consolidated results be declared?
As you can imagine, it takes a little bit longer, overseas. I think we're on track to do that within the, SEBI mandated timeline, which is, I think, by August 15th. So I believe that will be done by then. But out of abundance of cautions, we have taken a write-off or a provision, let's say, in the books for the entire amount that is our holding in Germany, just to clean the balance sheet once and for all.
And no further provisioning required, right?
Obviously the auditors are the best place to answer that question, but from my perspective, I don't think so. And we'll know exactly, but we've taken a large chunk of it, most of it off. So I don't think there's any further.
And by 15th of August, we will know. You should be able to put out the consolidated numbers.
Yes, that's the goal, yes.
What's the India business looking like? What's the guidance for volumes in FY26?
So, as far as volume growth is concerned, we are at about 1,000 tons per day of production, which we're running flat out. And till we add capacity, which will happen next year, as I mentioned already, volume growth will be, muted. Of course, you have some efficiency gains, which may be in the high single digits. But, last year we had a really bad, pressure on dumped goods from China. And we were, Chinese companies have been suffering as well and selling at much below cost of production. So in December, the government had passed what's anti-dumping duty for a period of 5 years. So the growth will come from just the mean reversion in terms of pricing reverting back to the mean from artificially low prices from last year. So most of the growth this year will come on account of pricing reversion back to the mean.
All right. So high single-digit volume growth. That's correct, right?
Yeah, and that's coming from, because we are running at the
realizations.
Yeah, that's right.
And so for the year, you're guiding for around a 30% growth on revenues.
That's right.
So you'll be closer to that vicinity of around 1,500 crores for the India business, with margins in excess of around in that vicinity of mid-30s. Should we work with?
I think 30% is, we did 28, I think we'll get up to about 30 this year.
And from around 1,000 tons per day, when do you go when does your expanded capacity come on stream? Which quarter? And what does it go up by?
So we are adding another 600 tons, so 60% our capacity will go up by, and that is likely to come on stream by October of 26.
Okay. Okay, all right. If you had to give us a number about current realizations and compare it, say, by with the March quarter, how much higher are realizations today versus that? Because that's where the delta is coming in. Since the government of India has obliged, they've gone ahead and protected the domestic industry. How much have realizations moved up? And is there scope for it to go up further from here?
So actually, we as an industry association, we wanted to have a fair price, and I believe the government of India has gone ahead and protected the industry from the unfair dumped pricing from China. As a result of that, if I was to look at it compared to 2020, we're back to where we were on 2020 pricing terms. So it's not that the price has moved up; it's just that the price has reverted back to the mean where it was already 5 years ago. So I think to answer your question specifically, I don't believe we will be adding much for the price increase anymore. There's a kind of minimum import price from China in a sense that's in play, and our pricing has gone to that level, and we'll sustain it. We're not looking to profit here or anything from that. So we're
right. Right. And domestic players, they are on board, right? Their demand is strong. The module players, solar module players are buying from you. You're not seeing any resistance.
Well, no, I think if you see the results of the module manufacturing companies, they're also doing very well, and we hope that they'll continue to do very well. They are customers, and we want our customers to keep making more and more profits, so we can grow on the back of that. But yes, I don't see any challenge in demand. India is just in the starting point of solarization. The government has very good policies in place to not only grow the solar end demand, but also for the manufacturing side of the whole solar industry. And we're seeing lots of capacity addition. So we don't see any challenge on the demand side at the moment.
Shrivar, just one question, and we've spoken about this in the past, about whether, the capacity which is coming up by very large players, big conglomerates in the space. One line of argument has been that, well, most of it is for internal use. I mean, they're going to be sort of, setting up their own stuff, so it's all going to be used internally. But for example, there were reports which said that Reliance, for example, has begun external sales as well. I mean, did you take note of it? Any thoughts on it?
I mean, look, frankly speaking, not my space to speak on what others do. And obviously, everybody has their own strategies. And I can only say that the demand in the country is phenomenal. And the demand is beyond just electric energy to supply to the grid. There's off-grid, which is a big segment. There's green hydrogen, which is, going to be huge. So I think the demand is far bigger than even the supply which everybody is putting up. And the whole world is going towards electrification and more, energy from electricity versus fossil fuel. So I don't see that demand generation will be a big issue. And I see that we are very well placed from our perspective on a cost of production basis, where we are a low-cost player in the whole industry. And I think given our 50 years or 60 years of glass-making experience, I think we should be able to, be a reasonable player in the market.
Okay. All right. We'll leave it on that note. Thank you very much for joining in and giving us perspective on your business. Good luck with the rest of the year. That's Borosil Renewables. By the way, pre-open has settled 23 points higher, and some interesting early indications or reactions. So IEX in the pre-open is straight away down 10%. That's one. Coforge in the pre-open is not running away. Let's see how the market sort of reacts to it. The quarter's been fantastic, but the stock is right now lower by about 1.5%. Let's wait on this and see what plays out. And Tata Consumer, like Mangalam was saying, margins have been under pressure, but I think the market's just squarely focused on growth, and the company is doing well in growth in terms of its growth businesses themselves. In the foods business, I think 14% growth. So top line itself has grown almost 10%. So I think that's where the focus is. Stocks holding up. Let's get back to our technical experts, get some final trades in before we hit the opening bell. Sudarshan, what's your call?
NTPC, buy NTPC with a stop under 335.
Okay. And Mitesh, let me ask you, what's the stock?
Yeah. I'll go with a buy on NMDC for targets of 77.
Okay. All right, gentlemen, got that. Thanks very much. Let's, quickly move on. I think Sud's looking at a bunch of names, including Kajaria, Ceramics, Strength, as well as wealth managers. Perhaps some interesting notes out there. Sudarshan, morning. What's on your radar?
Good morning, Surabhi. So I'll start with UBS on Kajaria Ceramics. It has upgraded the stock to buy and target is increased to 1600 per share. And this upgrade has come after company had reported Q1 earnings and those earnings had looked very strong. So now UBS is saying that Q1 margin has expanded by 560 basis points on a sequential basis. And management is saying that there is a likelihood of further improvement in the margin going ahead. So as per UBS, market is not pricing in sustainability of improvement and considering the improvement in the margin that company has already seen and also with an expectation of improvement, market may be positively surprised. Also, uptick in demand should lead to improved operating leverage and that's the reason UBS has increased FY26, 27 and 28 margin estimates in the range of 17 to 19% and also on the back of that, it has increased earnings estimates to 36% for FY26. 25% for FY27 and 31% for FY28. Now there is another negative brokerage note for Trent. Today Goldman Sachs has come out with a note and it has downgraded the stock to neutral and target has been cut to rupees 5,500 from rupees 6,970 per share. Also it has cut FY26-28 sales and EPS estimates in the range of 5 to 9% and 8 to 13% respectively. Now what is the thesis? So GS is saying that earlier thesis was Zudio was supposed to gain the market share and market share gain was up to 5% of April market in India and that expectation was off by FY35. But in FY25, increase was just of 1.5%. Now, GS believes that pace of market share gains will likely be slower than earlier expected. Also, it believes that stock is likely to trade in a range-bound mode or also it's likely to trade around current levels. Now, third note is Bernstein on wealth managers. It has initiated coverage with outperform on Novama and target here is 9,790. Initiated coverage on 361 with outperform call and target is 1410. Also initiated coverage with market perform on Anand Rathi and target is 2580 per share. And main thesis for this is it believes that rising wealth of India's uber rich provides pathway for a multi-year secular scale-up opportunity for these organized wealth manager company and that's the reason it's positive.
No, absolutely. Thanks very much, Sud. Keep an eye out on those names as we begin trade this morning. Just want to make a quick mention of a few stocks before we go any further. Let's just look at, basically the top 10 stocks, right? IEX, I think still down 10 in the pre-open. There is Infosys, which should come up. So numbers look much better. Based on the upper end of the guidance for the full year from Infosys, you're basically looking at a CGQR of about 1% for the next 3 quarters based on full year estimates, which is better. And of course, there's possibility that, there are more upgrades maybe at the end of the second quarter, the third, we'll see. Coforge is another one. Coforge is down about 1% and we'll have the management come up shortly at about 9:30 or so. So we'll ask them. Revenue growth is pretty strong and there are some questions on one-off margins, etc. But there are some one-offs here. So we'll talk about that. So 1825 on that one. Tata Consumer perhaps will come up on your screen, which gives you a sense of what that is doing in the pre-open session. 2% on Tata Consumer.
Tilaknagar Industries, Nigel's break. Stocks up 1.5%.
It's swaying away.
It's been swaying higher, I think, already so far this week, this month, right?
Yeah, it's done. Scalability comes in there. But besides that, smaller stocks as well. Like a Mukand, I'm just looking at it. They have executed a land sale of around 670 crores.
Yeah.
So that will help them in terms of a balance sheet. We'll talk about that in just a bit.
VA Tech as well. We saw that order flashing, right? So maybe we'll put that up. Well, we got the market open coming up. So let's just address that. So absolutely flat. Nifty 25,233. You've got the Nifty Bank, which was absolutely flat, 57,273. You've got the mid-cap index down 0.14. The small-cap index will come up on your screen. That is also down a little bit, but not very much. What do you have otherwise? I mean, 1160 up for about 500 lower, but this is just, I mean, initial first out of the gates rate, which is, and things will change, market breadth, of course, in terms of how many up and how many down. Heat map, the Nifty heat map will give you a quick sense of where things lie on the Nifty 50 index. Yeah, Tata Consumer on one end, Dr. Reddy's there, Hero, Trent, etc. Trent, I think there's a Goldman downgrade as well. But it's kind of evenly split, about 25 up and about 25 lower, roughly, this morning. Subhi.
You know, on IT, the market's first reaction is, ye dil mange more, not enough. Whether you look at Infosys, whether you look at Coforge, whether you look at Persistent, let's get all these three stocks up on the screen. Infosys is, flat to slightly negative, despite that good, strong top-line beat. Look at Coforge, 8% constant currency growth, steady margins, good commentary. Market's not, happy enough with it, 3% down. And Persistent has managed 3% constant currency growth. But no, not enough. I mean, you can argue the stocks have already run too much, perhaps. We'll talk about that with our market experts as well. But that's your IT reaction. Market saying we need more. Let's get to what else is working. Tata Consumer, as Mangalam said, he went with green on this one. And yeah, that's exactly what the stock is doing, 3.5% up. The growth business is working, foods business is working. And it seems that the market is focusing on the top line improvement and not so much on the slight margin compression. Dr. Reddy's is working well. Despite the US business being a little sluggish, at least it's in line with estimates perhaps. And the margin actually on Dr. Reddy's is better than estimates, remember? So 2.5% up on Dr. Reddy's. Tata Motors is up. Eternal, look at the stock go. Eternal, by the way, so far this week has put on 20%. That's the move on Eternal. And fourth straight day of gains continuing. There's IndusInd Bank, JSW Steel, Tata Steel adding a little bit of firepower as well. Overall, consumer is a good space today. Lever, Nestle ahead of numbers. Tata Consumer, I mentioned Eternal. So consumer is a good space. Banks are very flat. HDFC Bank managing about a 0.5% increase. Trent is down on that brokerage note. That so just flagged off 1.5% lower on Trent. And then, like I said, a lot of the big stocks are dragging their feet. Infosys is down 1% now. Reliance is dragging. Bajaj Finance ahead of numbers, a little quiet. TCS is down. SBI, ICICI. So IT and banks are not firing. Consumer is your trade. IT, the debate is wide open. Nifty now down 8 points.
All right. Well, a few stocks that you all haven't mentioned actually from the broader markets. First, let's talk about Tilaknagar Industries. After that 25% rally that we have seen in this month itself, the stock is up another 2.5% and volumes are massive. The street clearly believes that this is a re-rating event because, now they move into another league with regard to revenues, profitability, and also the deal value is fairly digestible at around 4,000 crores. If it was 20-30% higher, maybe the street would not have liked it. So that explains why there is buying in spite of such a big move. Otherwise, there could have been seller news that would play out. So that's one stock. The other one is Sinores Pharma. We'll have the management later on that will be joining in. And I remember Mangalam and me had interviewed him on Chartbusters, the promoter. And they were sounding very optimistic. For the time being, the street likes the numbers as well. Sinores Pharma, that's up more than 10%. So big move out there on that particular name is what we're seeing. SENORES. Let's get that one up. Jaiswal Nico. Nimesh has been telling us that the ARC has been selling out, gradually reducing stake. Yesterday, they reduced another around 1 crore shares or thereabouts. But the street clearly believes that this is a turnaround candidate. Remember, the ARC had close to 25% stake in the company. Jaiswal Nico is the one that I'm talking about. That's flying away. It's up 10%. Volumes are massive. Yesterday, only 1 crore shares were sold by the ARC. So there'll be a supply overhang. But for the time being, the street is buying into that because just take a look at the move that you're seeing today. After a 20% move, it's up another 10%. Mukund, that's the other one that we're looking at. The reason being that they've sold land of around 650 crores approximately in Thane. Their interest cost last year was around 130 crores approximately. And the net debt appeared like it was around 1,500 crores. So effectively, if all the money is used to retire debt, we'll have to see what the taxation is. Then in fact, they could have been halving their net debt. So I guess that's the reason why that stock is running away. And Bombay Dyeing, again, one of the top volume movers today. That continues up close to around 2.5% or thereabouts.
Just a few other names, right, before we go across to our market master. Force Motors is the number one volume-led gainer. So coming up out of the blue in that sense, big one, 5%. But there is so much else. Blue Jet, these are all in the 2 to 3% range. Blue Jet, Electra, Viatech Vabag, Max Healthcare, PNB Gills is up about 5-6%. Kajaria is up 2%. Thyrocare 5.5% pop this morning. So, yeah, I mean, it is very, very vibrant kind of screen right out of the gates that you have on your hands. Coforge and Persistent are the top losers, biggest volume-led losers. But we'll see how they finally end. Natco is down about 1.5. Trent is down 1. It started lower as well. And of course, IEX remains down, limit down at 10%. MGL is down 4%. I don't know if Nigel mentioned, but MGL is down 14.22. We just spoke with Borosil Renewables. That is starting about 2% lower. And DAM Capital is down 7.5%, 232 coming in there as well.
Prashant, on IEX, Hormaz just points out that it's in that freeze, 10% freeze, and there are 4 crore pending sell orders right now on IEX. So let's see. That's been the real casualty of the morning, and not sure if it's entirely over just yet. We'll keep an eye out on this and try and touch base with the management as well and see if they have something to share with their stakeholders. But with that, let's move to our market master. Ashwini Agarwal, founder and partner at Demeter Advisors, is with us now. Ashwini, good morning. Great to have you on. So we're in an interesting situation here, right? I think it's earnings, earnings, earnings. That's what the market is squarely focused on, because earnings need to deliver. That's the only critique on India right now. Otherwise, the overall macro narrative remains very positive. Now, what do you make of the market's mental construct? And I want to take today's IT numbers as examples. Infosys actually delivered a beat, not sounding too bearish also. The mid-cap IT companies that have been the market's darlings, Persistent and Coforge, both have delivered. They've not missed at all in the first quarter. But the stock reaction is sharply lower. What does this tell us about the way the market's thinking about earnings and IT in particular?
Good morning, Surabhi. Thanks for having me here. So you're dead right. The reaction of the market to earnings is telling us something that the market is tired. Where earnings are being met, stock prices are not moving. And where earnings are disappointing, stock prices are giving up a lot of gains. In the sense that in some of the disappointments, even in the mid-cap, small-cap space, you find that stocks are down 15%, 20% on disappointing earnings. So, good earnings are not giving you a reward, and bad earnings are being punished. So that tells us that, the market overall is a little concerned about valuations. So while there is a hope out there that later in the year, demand conditions will improve, and obviously we are seeing some of that in the consumer names as well, there is some fatigue that's beginning to set in. In IT services in particular, which you highlighted just now, I think valuations are quite expensive. I think, when we look at a PE ratio, a lot of the PE ratio comes from a terminal growth, which is built in. And I think there's a big question mark on that in terms of IT services. So, I haven't really been a huge votary of IT services for nearly 3 years now, and I still don't think that they're cheap enough for me to buy. And I think the market's also starting to kind of recognize that there are some issues that need to be addressed, and valuations are not cheap.
So where does one put one's money to work? Ashwini, morning.
Morning. This is a great question. I think, on a bottom-up basis, like, again, if you look at the opening remarks that you guys made on some stocks which are up, I think on a bottom-up basis, there are some opportunities which one continues to find. But otherwise, the markets are expensive. I think, financials look fine by and large. I don't think you can make a lot of money from here in financials, but I think over the next couple of quarters, you will see some of the stress in microfinance going away. So, that's one hope that might help, stocks, especially in the NBFC area. Banks overall look fine. I think there will be some compression to NIMs, but hopefully growth will pick up. So that looks a macro area. Consumers, like I mentioned, there are a lot of reports that rural demand is starting to improve. There again, you have to be choosy because some companies which have a very high penetration already, for example, Colgate, and just to clarify, I don't own the stock. They will find it difficult to grow. But I think other areas where you have consumers looking forward to more purchases, there you might see some improvement. So I think it's a mixed bag. I think one has to be more bottom up, and overall one has to be cautious. I think the markets had a huge run, and there's a huge wall of paper ahead of us.
Indeed. Hi, Ashwini. Good morning, and good to see you in. What do you make of these stock market players? Some of them had re-rated big time. Exchanges, we'll keep the energy exchange aside for now. But these capital market players, they were going hammer and tongs. Now, volumes are dipping actually. Even yesterday, if I compare it with the previous session, the volumes on the NSE were down by close to 7-8%. And, if at these valuations, maybe participation will start beating off a little bit. Probably. The longer term story is very good. But in the near term, do you think they've run their course? Exchanges, brokerages, wealth management companies, or still do you find value in some of these?
Great question, Nigel. You have to break it up. Okay, so wealth management, asset management are franchise businesses. So, let's say, I'm not saying it'll happen, but let's say the market falls by 20%. The earnings of these companies will fall by well less than that because they continue to see inflows, which is a construct of how financial savings are being deployed in this country. And that's true for wealth management. It's true for asset management companies. On the other hand, exchanges and brokerages, they're directly linked to volumes in the market. And if volumes in the market were to go down, you will have a sell-off in these names. Exchanges are very expensive. Brokerages are not that expensive, but brokerages is a highly cyclical business. And exchanges are expensive, but at the same time, it's a highly moated business. I mean, you're not going to get a third exchange or a fourth exchange, in the country. So to that extent, my sense is that I think the wealth management and asset management have the best franchise value, followed by the exchanges. Exchanges probably have the best franchise value, but they're expensive. So I would put exchanges next. And third would be brokerages. So I think valuations are expensive and one has to be careful, but that's how I think about it.
So Ashwini, the question is, when you gave some examples, you said financial services, you said maybe part of consumer. But again, where? Give us some examples. I mean, if not necessarily a stock idea, you can put the caveat there, but where there is at least some semblance of sustainable growth. Because the problem with the market is growth. So when you say, for instance, if you say consumer or FMCG, if not a Colgate, then what? Because even, let's say, within the QSR space, it's been very, very different. Different companies are doing different things. Westlife yesterday was a good number. Sapphire was weak. So where do you see some semblance of growth within financial services as well? Tier 2 financials showed up various added asset quality and credit costs issues. Large banks relatively outperformed. So just slightly more granular on where to put the money in this tough market.
Okay, let me try. Okay, and I don't want to cross any lines here. So in the financial space, in NBFCs, while you're right that the June quarter numbers were not that exciting and credit costs continue to be a bugbear, but I think incrementally the direction of credit losses or incremental stress is coming down. So what you're seeing flowing through the P&L is mostly what has already happened. Now, come December quarter, which is 6 months away, you will start to see a very favorable base effect kick in, and the fact that your incremental NPL generation is coming down, you'll start to see a much better sort of credit cost line for a lot of the NBFCs, especially in the microfinance area. Now, you have to look past the next couple of quarters. That much we have to do. Otherwise, it's very difficult to kind of invest. I mean, you can't invest based on every quarter. So I think that's one area in the NBFC space, in the microfinance space. I think banks are fine. Banks are doing well. There is no major issue, in the banks, and they're not terribly expensive. Relative to the rest of the market, they're not terribly expensive. So even the frontline banks are not expensive, despite the kind of stellar returns that you've seen in some of the frontline names like ICICI Bank, for example. Now, coming to consumers, I think there one has to be a little more selective. So there are products that people want to consume. So if you look at the consumer today is looking to upgrade his choice of lifestyle. So whether it is cosmetics, whether it is fast food, whether it's instant delivery, whether it's white goods, So there you have to look at on a very bottom-up basis, where do you think surprise is likely, and where do you think valuations are have some room for improvement. It's a very bottom-up market in that space, but and I agree with you. So, for example, in the QSR space, there are some that have done very well and some that are struggling. So that's the bottom-up work that one needs to do. But that's an area where I see at least the consumers, putting more money to work.
Okay. Bottom up, it's a hard work market. It's not an
Yes.
easy market. That's the
Not an
takeaway
easy
from the conversation. Ashwini, got it. Thank you so much for joining in. That's helpful perspective. Good to have you on. By the way, guys, I just want to mention that, in an overall environment where equities are doing really well, Asian markets, etc., trade deal optimism, all of that. Look at this. I mean, our markets turned negative without any major earnings accidents. We haven't woken up to really disastrous earnings or anything like that. Mostly numbers are missing the mark, but the market's moved.
But just look at numbers in the broader markets. You look at a Force Motors. The stock has doubled in 4 months, and the stock is up 5% even right now. This Syneris Pharma, just citing a few examples. The stock has already rallied big time, and now it's up more than 10%. These are stocks that have already rallied, and the market appreciates the numbers, and they're taking it even higher as we speak. So market's clearly distinguishing. They want growth, they want good numbers, they'll reward it. If it's not good, then they're slamming it.
Yeah, but one thing is clear. I mean, just look at the screen. As I think Ashwini started by saying, it's not holding. It's not It's tired.
It's tired. I think that's a great description.
That's what I think it is. Let's talk about the next management which is with us. Coforge is the company that I'm talking about. Absolutely solid performance for the first quarter. 8% quarter CC growth quarter on quarter. And still the stock is down 4.5%. Now, we're of course not going to ask the management about the stock, but we'll try and understand what kind of growth they are looking out for. Sudhir Singh is CEO at Coforge. He's with us now to take some questions. Sudhir, great to have you with us here. Congratulations on a very well executed quarter. I want to just start by a few things. I mean, if you read through commentary across the board, everybody, the general mood amongst analysts says revenues were very good. Margins maybe fell short by a little bit compared to what expectations were. In this quarter, I think there are a few one-offs. Correct me if I'm wrong. I think there is like one-off bonuses, some legal fees, etc. as well. Some 70-80 odd crores of that. Just take us through the quarter.
So the quarter from a performance perspective has been it's been an exceptional quarter. It's been a fantastic, solid quarter. Growth on the growth side, as you said, sequential CC growth has been 8%. The sequential dollar growth for the firm has been 9.6%. Margins, again, the commentary that I just came off from the investor call, we've talked about the fact that the EBIT is going to hit 14% for the current fiscal. And our business, our firm has always seen a sequential increase in EBIT in margins across the quarters. This is quarter one. We've landed at 13.2% despite very strong growth off the back of the ramp up of the Sabre large deal that we talked about. We feel extremely confident that the EBIT number that we will deliver in the current fiscal is going to be 14%. So from our vantage, 5 large deals, a next 12 months signed order book that is almost 47% higher than where it was at the same time last year. EBIT margins profile which should improve very significantly this year. All in all, as you rightly said, a very solid quarter that sets us up very, very well for delivering an exceptional fiscal year 26 as well.
Absolutely.
Sudhir, so we'll put that flash out because the call was this morning at 8:15, 8:30, right? You're saying FY26 EBIT margin will be 14% compared to the just under 13.5% you are right now.
That's right. We delivered 13.2% for the quarter. What we've shared on the investor call is that we expect to deliver 14% for the full year, and that factors in the 13.2% for quarter one.
Okay. Any other numbers? We've been on the air, but any other numbers you've shared on the call, which in terms of forward-looking estimates you'd like to sort of lay out there, apart from the margin number?
I think the other thing that we underlined is the fact that the organic growth in CC terms, this is organic, on a sequential basis was almost 6%. We expect organic growth in the current quarter, which is Q2, to be equally robust. The third thing that was asked and that was addressed was H2 in turn again should be materially better than H1. So the year from a revenue growth perspective and from a margin improvement perspective seems to be turning out to be an exceptional year.
H2 materially, so I'm just repeating, I mean, this is something you've already shared with your investors in the call, so for the benefit of viewers, 14% EBIT margins by the time FY26 ends and a materially better second half compared to the first half. So sounding as confident as ever, Sudhir. I want to just talk about the BFS vertical where Q1 there's a minor decline, quarter-on-quarter decline. So what happened? Was it one client off or, 1 quarter off, or is there any sort of concern on BFS at all?
There's absolutely no concern. BFS is still on a YOY basis growing 32%. So that's very robust growth. This is a quarter blip numbers, and we said this in the investor call, will correct starting the quarter that we're in, which is Q2. So banking, insurance, travel, healthcare, retail, all seem to be in a good place, and that's why the YOY growth, the QOQ growth is where it is right now.
Just on the point of 14% EBIT margin, while that's the the numerical outcome that you've put out, just walk us through the levers as well. I mean, is it just deal ramp-ups which will take you there? Is it internal efficiencies? And what's the sense on overall pricing for your services? Is there any legroom at all, or is this not the environment to be talking about price hikes?
We're not baking in any pricing increase in the confirmation that we will deliver 14% EBIT. Almost 70 to 80 bips increase in EBIT is coming from a very structural reason. Our ESOP cost this year is going to be materially lower than our ESOP cost last year. The second reason, of course, is going to be with the significant scale-up that we see ahead of us, the revenue growth. We expect SG&A as a percentage, not in absolute terms, to come down materially. And third, again, because of the significant scale-up that we see, and with offshore continuing to build up at the rate at which it is offshore revenues, we expect margin accretion to start becoming extremely visible starting Q2 onwards itself.
Hi, Sudhir. Good morning. Good to see you. Now, we have been talking about that $2 billion annual run rate. You're at around $442 million itself, in terms of a quarterly run rate. By the end of this year, do you think instead of FY27, you get to the $2 billion run rate? That means $500 million on a quarterly run rate. By the end of this year, is that possible?
Getting to a $500 million run rate, let me just take a step back. We don't offer a revenue forecast or revenue guidance. But what we are absolutely clear around is, to the point that you asked me earlier as well, we had said a year back that it will take us fiscal year 27 to hit 2 billion. And the assumption was that somewhere in one of those quarters, we'd hit a $2 billion run rate. As I said last time as well, we'd be very disappointed if it takes us that long to hit 2 billion. We don't want to put a peg in the ground and say that we will necessarily or hit it this year, but we will certainly hit it, at least from a run rate perspective, much earlier than what even we had anticipated, given the fact that we're almost hitting $450 million run rate in this quarter itself.
Okay, all right. You'll be disappointed if you don't get to it in FY27. You said that last time around as well, so we'll watch that. A quick question on the CAPEX. The CAPEX spent in this quarter was around $65 million, for the quarter. And because of that, the FCF went into negative trend. Explain to us, what is this CAPEX for? What is it being used for?
It's for an AI data center that we've set up. It is not a dedicated data center for any client. It's a data center that's being used to deliver services to our clients. The CAPEX was at an aggregate level $85 million, out of which $62 million has already been recognized. So our exposure is extremely limited. It was a point-in-time quarter-heavy CAPEX, and it's a CAPEX that will play into what we believe is continued, very robust growth going forward as well.
But will we look forward to more such CAPEX in the coming quarters?
No, you will not see that. We were asked that question in the investor call as well.
Yes.
CAPEX from our vantage is going to be largely directed towards acquisitions. It will not be directed towards data center related operations.
got that. And just to sort of complete that loop on what you mentioned, acquisitions, anything in the works?
There are quite a few assets that we're considering, but there's nothing that's imminent, Prashant.
We've often and I think you've kind of sort of, in a way, responded to it. The R systems kind of thing, it keeps coming up. Anything, is there anything to it, Sudhir, you can tell us?
No, we just stick to what we put out in the market. We have no plans and no intention of acquiring our systems.
Okay, that's very, very clear. You did mention the margin trajectory, right? 14% for 26. Again, one other thing is, while revenue growth remains best in the industry, margins perhaps are a little lower than some of the peers, etc. Is there a slightly, do you have visibility beyond FY26? Where do you want it to take? What are the levers you have, slightly longer term, beyond this financial year, where margins can head to?
Prashant, this year the only guidance that we gave was a margin guidance, and this is not an EBITDA guidance, this is an EBIT guidance, right? If you look at this quarter results also, 13.2% is the EBIT margin. The EBITDA has already jumped more than 60 bips sequentially this quarter to 17.5%. We believe at 14% we will be right in the middle, possibly above average when it comes to our peer set. 14% is an EBIT margin. Obviously, EBITDA will be materially higher. It's an EBIT margin that we will be very comfortable with, while we then start focusing again on trying to repeat the kind of growth that we saw last year, which was 31.5% growth, and the kind of growth that I just described right now. We've grown 8% CC. Organic growth has been 6% CC. We expect organic growth again in Q2 to be extremely robust, more or less on lines with Q1. We expect the year to be very strong. So EBIT at 14%, EBITDA obviously much higher, which we believe deliver this year itself, should be the minimum threshold that we operate at going forward.
So there you continue to sound fairly optimistic. Just give us a word on what you're thinking in terms of wage hikes and hiring as well, and just the growth. Qualitatively, ex of Sabre, what makes you so confident of driving growth in an environment where larger peers are struggling at 0% or sometimes even a decline in the top line?
Well, I am sounding optimistic, and you've always heard me being optimistic, and I trust that you recognize that optimism is always...
And the numbers have come through. You've delivered. Yes, absolutely. The company is, as they say, walk the talk. Absolutely.
Correct. We walk the talk, and we walk the talk for this is the 9th year of continued, robust, sustained growth. So it isn't a 3-4 quarter, 2 or 3 year growth record. It's a 9th year record. Growth going forward, the confidence stems from what we've built over the years. With AI having come in, there is compression that is happening on the run the enterprise budgets. But there is great openness, there is great willingness right across the world to have conversations around the change the enterprise budget. We have always characterized our operations as carrying an execution intensity that is uniquely our own. We have always talked about hyper-specialized industry experience across very focused industries. And we've talked about being able to use that execution intensity that I talked about and marry it with our deep engineering capabilities to actually deliver real-world impact. That's a track record that takes some time to build. That's a track record that once built cascades. So a lot of that growth, not a lot, I'd say almost all the confidence about the numbers that we're talking about. One comes from our track record of 8 years of walking the talk. 2, it comes from the large deal pipeline that we're looking at. 3, it comes from the fact that as we speak today, our next 12 signed order book is 46.9% higher than where it was at the same time last year. 4, it comes from the fact that despite the bleak macros, we signed 5 large deals in Q1, and we'd be disappointed if we don't sign at least 20 large deals this year compared to 14 last year. Those are the metrics. That's where the confidence comes from.
So at least 20 large deals this year. Got you.
All right, so they very quickly, before we let you go, third-party costs constituted close to around 10% of revenues. I think that's a little bit high, right? What explains this? Could you tell us, are you taking up relatively lower margins? Just explain this to us.
No, we're not taking up lower margins. If we were taking up lower margins, our EBITDA would not have jumped sequentially by 61 bips And I
Right.
wouldn't
So
have given
explain this to
guidance
us, third-party cost.
a very significant jump. It's tied to the data center operations that I spoke about earlier.
Okay, got it.
That's the cost that it stems from.
Got it. Okay, all right. So there, the market seems to have run a little bit ahead of itself, and that's why we're seeing some profit taking. But you're sounding very optimistic. You'll be disappointed if you don't hit the $2 billion run rate in sometime in FY27, and margins actually will perk up, EBIT margins towards that 14% odd mark. So that's about Coforge. Well, let's move on then to our next management, Bikaji Foods. That's on our radar. The company posted actually a decent performance in the first quarter, healthy revenue as well as volume growth. We have with us Mr. Manoj Verma, the COO, and Rishabh Jain, the CFO of Bikaji Foods. Hi, gentlemen. Good morning. Thanks a lot for joining in. Well, tell us, what's the volume revenue growth that you're factoring in for the remainder of this year? And also, if you could help us out, what's the margin trajectory?
Good morning. So as we had said earlier, so we'll be in mid-teens. That's the revenue growth we are looking at, say 15-16% kind of a stuff. And volume growth would be a 3% growth. So around 12% would be the volume growth by end of the year.
12% volume growth, right?
Yeah.
All right. And what kind of margin outlook should we work with?
So from margin perspective, you'll see last 2 quarters. So December, the third quarter of last year was tough, where olive oil price was on a very higher side. And we sequentially, if you see quarter, we improved. And this quarter is the highest gross margin what we've seen in the last 7-8 quarters. So at the year end, what we see that we should be at EBITDA of close to 15%, including PLI, of course. So that's the EBITDA margin what we're targeting this year.
Okay. And price increases, what will you work with?
So we've taken some price rise in last 2 quarters, and that's how you see the margin this quarter. And this year, we don't see any major price hikes, so we are comfortable with the prices what we have as of now.
Okay, explain this to us. Why was there a spike in the other expenditures? And what is the targeted ad spends as a percentage of sales?
So from ad spend perspective, so we have as a company budgeted close to 2% of overall revenue. That's the budget what we're taking. And from other lens, basically other expense, so we've done lot of hiring in people, so to drive growth. There are a lot of other professional services what we're taking to drive growth and bringing a lot of tech into the system.
Give us the targets on, Bhuja Lalji, I think, as well as Hazelnut. Those are the 2 inorganic growth, like you have done. Yeah. How is that shaping up? For this year, what kind of contribution will we be looking at from them?
So Hazelnut is doing extremely well. So we had an acquisition in third quarter last year. And the last year, the revenue was close to 60 crore rupees, 55-60. This year, they will be touching 100 crore ARR. So doing very well, this year, they will open close to 10 stores in UP and NCR area. So doing very well. And regarding Bhuja Lal, it's also doing fairly well, focusing more on margins. So this year, there will be some 45-50 crore rupee top line.
So Hazelnut will do 100 crores and Hazelnuts for the year, right?
Yeah.
And margins are improving out there? I think it was
They are into building phase currently, so opening aggressively. So of course they're not EBITDA depriving. So they are good in their premium stores, opening premium stores. So they'll be at close to 6 to 8% EBITDA this year. But their potential is to be at 12-13% EBITDA in next 2 years.
Okay, so Hazelnut is at 6 to 8% EBITDA as of now, but you see it scaling up to 12 to around 13%. I think your earlier estimate was that Hazelnut will improve even more to more than mid-teens. That's the trajectory you're looking at. Is that correct?
Yes.
All right. And Bhuja Lalji, what will it contribute this year?
So from top line perspective, it will contribute close to 40-45 crore rupees top line. From bottom line, it will be largely break even. That's it.
And exports, could you tell us, it's only a very small part of your business, but on a low base, it's been growing. For this year, how much will it contribute?
So exports has done extremely well, and that's what we always spoke about. So currently, if you look at in Q1, it's upwards of 4% is the contribution coming out from our exports business, and much better on the EBITDA contribution standpoint, from the bottom line standpoint.
Okay, all right. So you're already done around 30 crores for the first quarter. For the year, exports will be how much?
Close to 125-130 crore rupees.
125-130 crores. Got that.
Top two quarters are important because Diwali and festivities, so first 2 quarters
People are enjoying the chakna. Yeah, got that. All right. What about you mentioned about the PLI benefits. How much of it was realized in the first quarter? Could you quantify the number? And for the year, what are the benefits you look at?
So for the year, we'll book for close to 50 crore rupees, and it's equal in every quarter.
Okay.
So
50 crore rupees is what you realize.
Yeah, in a year. So
in a year is what you will realize, right?
Yeah. Yes.
Got it. All right, gentlemen. Thanks a lot for joining in. Wishing you all the best. Keep snacking. We'll hold you all to these numbers. The growth that you have given us, the inorganic growth, scaling up of both those two businesses. And as you look to feed not just the domestic population, globally as well, people want to have a bit of a snack.
Nigel, it's such a study in contrast, right? We had Coforge earlier, data centers, AI, and you have the
Bhujia business here.
Bhujia business, and that's the thing, right? We, as an investor, you don't have to be in fancy areas to make money. You can make money through good businesses anywhere, I recall that famous saying, right? I think it was Buffett who said once, he said, he was asked why he invested in See's Candy. And he said, well, I can't figure out technology, IBM, Microsoft, etc. But I'm sure that technology is not going to change how you chew gum. So similar kind of analogies. But I thought it's interesting. We just spoke with Coforge and then we had the Bhujia business in focus. Well, we'll take a quick commercial break here. We're going to come back in just a bit with Brigade Hotel Ventures. So Nirupa Shankar joins us as their IPO opens up. So a conversation coming up.
Welcome back. You're with us. And of course, the corporate conversations, the earnings conversations continue. But we also have IPO conversations because there's so much action in the primary market. So we are now putting the spotlight on Brigade Hotel Ventures. The IPO has opened out for subscription today. The company is looking to raise about 760 crore rupees, and it's a fresh issue. So let's discuss all the details, the structure, the business, and the prospects with Nirupa Shankar, Managing Director at Brigade Hotel Ventures. Nirupa, great to have you on. Thank you so much for joining in. And, We wish you all the best as you start your public journey. Now, I want to get the model understood correctly first, because you have several properties and then you have tie-ups with a lot of brands like Accor, Intercontinental, Marriott, and you pay these global brands obviously a revenue for the use of the brand name. But you are not an asset-light model. You own the properties, right? In fact, you've actually, part of the issue proceeds will be to pay back promoters for some land that you've bought from promoters. So just can you tell us whether you'll be buying more land from the promoter group? What is the model? And, what about this royalty that you're paying to these global hospitality brands?
Good morning. Thank you so much for having me here. Yes, it is definitely exciting times with the issue opening this morning. With regards to our portfolio, ours is a build and own model. So as builders, we build the hotels and we own the hotels. We give the operations of the hotels to global international top tier 1 operators such as Marriott, Accor and IHG. There are management fees that we pay to them. So it's not really it's kind of a royalty, but we call them management fees. So there's a base management fee and there are incentive fees. So that's a percentage of the top line and a percentage of the gross operating profit. With regards to the land, so currently Brigade Hotel Ventures has about 9 hotels and all our hotels are either owned or leased. In some cases, we buy the land. So we buy the land and in some cases we do long leases for the land. Could be a 30-year lease, a 45-year lease, a 99-year lease. As you know, Brigade Enterprises is the parent entity and the major promoter of Brigade Hotel Ventures. And as Brigade Enterprises is one of the few builders in the country that does all asset classes. So be it office, residential, hotels, and malls. So in some cases where we do large mixed-use townships, because we were one of the pioneers of mixed-use township concept in the country, in some cases we have hotels as part of these large mixed-use townships. So what we do need to sort of move aside or share or buy out the undivided share of the land. So I'm just giving you an example. So suppose we have a 4 million square feet development of all assets. And the hospitality composes about 10% of the overall built-up space. We will, Brigade Hotel Ventures will buy the undivided share of the land. Maybe.
Yeah. So just I got the model. Understood that. That was quite helpful. So just on this, Nirupa, two-part question. The management fee that you're giving to the international brands as of FY25, it was about 4.4% of your total revenue. Now, do you have visibility? Will it remain that for the next, 2 years, 3 years? What is the frequency of, or is this an annual fee? How does that cost go? And also in terms of buying more land versus leasing, going forward, will you be looking at more land acquisition, in which case the debt question will become important?
That's right. So the management fees are going to be kind of the same for the years ahead, because the percentage is sort of fixed based on the revenue. So it is going to be 4 to 5% is what our management fees are, as they have been for the last many years of us operating hotels. So there's going to be no change in the management fees. By and large, all the top tier 1 hotel operators have similar models. So our management fees will stay the same. With regards to our strategy when it comes to buying versus leasing, it really depends on the property, right? In some cases, if it's a CBD property where land value is extremely high, we might decide that it's better to lease that property, because hotels as it is are capital intensive assets. You don't want to be spending too much on construction of the property and also on the land. We believe that the success of a hotel is very greatly dependent on the cost of land as well. Land is extremely important component. So in some cases, especially CBD properties or where land is extremely expensive, we prefer to lease and rather than buy, because if we buy, then maybe residential is the better option for better IRRs. But we do have many, I would say currently the portfolio is 50-50. 50% is leased and 50% is bought.
Nirupa, hi, morning. Just a quick word. I mean, have you sort of considered a REIT, creating a REIT kind of structure, putting some of these assets in there, helps you recycle your assets, right? And help sort of raises capital for you and allows you to sort of move on to newer projects, newer properties?
Yeah, I mean, that was definitely, something we pondered on, whether to do a combined REIT with some office assets and hospitality assets, or just do a standalone hotel IPO. I think we decided that, the hospitality sector, has very specific kind of investors, and it's a very different business model. So we decided that it's better to have a hotel company separate, doing its own hotels and growing that business individually, having a focused team and effort, because building a hotel is very different from building an office. But we have, of course, our office portfolio is also growing, so that's something we could have considered. But I think we have taken the call to take the hotel portfolio by itself and grow that company separately.
As a listed entity now, you won't sort of look at within the listed Brigade hotels trying to create a REIT structure down the line or anything, right? For example, we speak with a listed infrastructure company which has done this. Actually, a few have done this now. They're already listed, but down the line, would you consider it?
I don't think that hasn't been our thought process thus far. We do. I'm not sure if you're aware, but with Brigade Enterprises, we've been building a lot of commercial assets, including many of the World Trade Centers. So World Trade Center, Bangalore, Chennai, Kochi, Hyderabad, Trivandrum is coming up next. So we like to place our hotels next to large office parks as well, considering that office parks are the largest demand drivers for hospitality. But thus far, our thought process has been to keep the commercial assets separate and to keep the hospitality assets separate. Once we've, go ahead with this IPO and we become a listed entity, the idea is to just grow the hotel portfolio, within this entity. There's no plans to do a REIT further down the line with regards to hospitality.
All right. Hi, Nirupa. And, since you're going to be listed, we'll be speaking way more often as well. So we look forward to that. Since you're raising this money, I think you'll be virtually debt-free, post repayment of these borrowings. But for the next phase of growth, how do you fund it? If you could give us the broad outlook out there.
Yeah, so you're absolutely right. Once primarily use of the IPO proceeds will go to debt repayment, and then we will practically be institutional debt free. With hotels, they do have a longer construction cycle, around 3 years, and all our hotels are in the next phase of construction. So they're just going to be starting construction. The funds required initially are not as much. In hospitality, most of the funds required are back-ended towards the third year. Initial year is just design development, approvals, initial start of construction, all the civil work. And then second year also typically is most of the civil structure. And then the third year is the fit outs, and that's when you need most of the cash flows. So while we will be institutional debt free, probably for the next 18 months or so, as and when we do require more funds, we will go back to get more institutional debt. The good thing is, because of the parent entity and the great banking relations we have, and our cost of borrowing is one of the lowest in the country for the parent entity in the real estate space, and that is transferred also to Brigade Hotel Ventures. So our cost of borrowing is around 8.5%, and maybe with the lowering interest rates, that could decrease as well. So cost of borrowing seems to be in check right now. Like I said, we won't require debt immediately, but as and when we do need it, we will sort of enhance our leverage.
And what's the maximum cap in terms of gearing that you'll go to, like a rough debt equity cap that you would definitely have in mind for future expansion?
See, ideally, right now, of course, our debt is a little bit on the high level when you compare it to equity. But going forward, immediately post this, it will be 0:1.5, so hardly any debt. Probably the maximum we would be okay with is a 2:1. I know in the real estate space, we've spoken about a 1:1, but in hospitality, a slightly higher leverage is okay. So I think we'd be okay with even a 2:1 in the peak construction cycle. But on a regular basis, you'd probably want to limit it to 1.5:1.
Okay, so 1.5:1 at an average as you fund your future expansion. And that expansion includes so much, right? 5 new hotels, 1,000 keys coming up all the way to FY30. I'll end with one small question, because we'll talk more, of course, when you list. But your average room rate, I think, is around 6,500. You know, just yesterday we were talking to Schloss Bangalore. Of course, different offering, different segment. They were talking about ARRs of 20,000 by the end of the year. So for the segments that you operate in, do you see more elbow room for higher ARRs and maybe even better margins?
Yes, I actually watched that interview, so I did see their ARR of 20,000 plus. You know, we have 9 hotels, and our portfolio is spread amongst many tier 2 markets like Mysore, Kochi, GIFT City. There, the rates are sub 5,000, right? But of course, if we are talking about some of our hotels in Bangalore, it could be between 10,000 to even 15,000. So it really depends. You know, I think Pune, Maldives has extremely high ARR. So it really depends where your portfolio is. But I think one thing we can look forward to with the Brigade Hotel Ventures portfolio is that we are coming up with a lot of 5-star deluxe properties. Currently, the portfolio has a 3-star, 2 4-stars, smart business hotels of 5 stars, but nothing in the 5-star deluxe category, which is where my colleague spoke about yesterday. But I think going forward, we are looking to enhance our portfolio in the luxury deluxe segment. So we have a Ritz-Carlton coming up in Kerala. We have a Intercon coming up in Hyderabad. We have a Grand Hyatt coming up in Chennai. So these are all in the 5-star luxury deluxe categories, and that will and then you will see the ARR go up once those hotels come into operations.
I must say, Nirupa, you poured a little bit of cold water on my hopes, because looking at that ARR, I was very sure where I'm going to check in next time in Bengaluru, because Nigel is going for the Schloss properties. I was very happy. You're looking at 6,500, 7,000 ARR. But as she describes, those are not Bangalore city properties. Those are probably outside. But thank you so much for joining in. Good luck to you with the issue, and we look forward to chatting more frequently now.
Likewise.
Thanks for joining in today.
Thank you so much for having me.
All right. That's the hospitality space booming and thriving, and more players coming to the market. With that, I think we need to take a very, very quick break. We'll do that and come back and I think take some trades with Mitesh in just a bit.
Okay, welcome back. Just take a quick look at the market, down 60 points, 25,160. And Coforge is cracking big time. It's down 8% now. That's the stock 1,710 rupees, coming under severe amount of pressure. We'll sort of talk more about this as we sort of go along. But for now, let's get Mitesh in with quick thoughts on what he'd want you to do in terms of trades. Mitesh, what do you have?
So, Prashant, I think On the stock side, I have one buy and one sell recommendation. SRF, after a good collection, is turning positive again. So this is a buy trade. Recommend a stock below levels of 31.80 here and a target of around 33.60. And the other stock is Astral. That's something which has turned negative on the hourly, 2-hourly charts. So a sell recommendation with a stop just above levels of today's high, which is 1489. So 1490, 1491 could be a good stop here. And look for targets in the range of 1420 to about 14.
Okay, all right. Thanks a lot for that, Mitesh. Well, I'm focusing on a few stocks that are moving around. Let's talk about Mukund. The stock is higher in trade. Why? Because they had a parcel of land that they have sold. They've realized roughly around 38 crores per acre because it was a large land parcel, and they've realized close to around 670 crores or thereabouts. So they've sold their land in Thane. The street was awaiting this trigger, and that's why, in fact, the stock is celebrating it. If you do just, the rough calculation, 673 crores, and they've sold around 17 acres, 17.77 acres. Rough calculation comes to around 38 crores per acre. This is good for them, and they've already received 110 crores. Why is it good? Last year, their interest cost was around 130 crores approximately. And if you look at the net debt number, that's the long as well as the short term put it together, will be roughly around 1,500 crores. So effectively, they can cut their debt by half if all these proceeds are used to bring down the debt. That explains why the stock is higher in today's trading session, moving higher on very, very large volumes. The stock actually had corrected from around the 190 odd mark once the Bajaj family took over. There were a lot of hopes of a turnaround. Then it corrected to around 120. But as you can see in the last 1 month or so, it's pulled back from the lows. And today, moving on very large volumes. Sri likes this development. For the time being, we slip into a short break. On the other side, we have our special segment, Indianomics. How much stake can foreign entities own in Indian banks, and should the rules change? Lata discusses this and more with two former RBI deputy governors, Anand Sinha and S.S. Mundra, and banking expert Harshvardhan of Bain Capital. You don't want to miss this conversation.
Welcome to Indianomics. Foreign banks like Sumitomo Bank of Japan and NBD of Emirates want to own larger stakes in Indian banks. But the laws are not exactly welcoming because the Banking Regulation Act says no entity, Indian or foreign, can have more than 26% voting rights in a private bank. Now, it is tough for a Sumitomo Bank to convince their shareholders back home that they have 50% stake in, say, a Yes Bank, but only 26% voting rights. That explains why even the IDBI sale is taking so long. Separately, in PSU banks, FPIs, now I'm not talking foreign banks, FPIs, foreign funds, can own only 20%. But there is no such a cap for private banks. FPIs can own up to 50, 74%. So the weightage of PSU banks like SBI and BOB in, say, the MSCI and the FTSE Emerging Market Index suffers. Does this cap need to go? For both these very important questions, I'm joined by former policymakers, actually two former Reserve Bank deputy governors, Mr. Anand Sinha and Mr. S.S. Mundra. I'm also joined by a banking expert, Harshvardhan, senior advisor at Bain & Company. Gentlemen, thank you very much indeed for your time. Mr. Sinha, let me start with the more easy rule first. This 20% cap for FPIs in PSU banks, is that even needed right now, since, you know, can that rule be just dropped?
Well, you see, we have to see why there is a cap. Now, government has to have a minimum of 51% shareholding in a public sector banks. So for other shareholders, you have 49% available. Now, the cap of 20% for foreign investors means that in the non-government space, they can go up to 40% of shares. Balance 60% is there for the domestic investors. So this can be modulated. I mean, one can even think of a very market-based situation where you remove the cap altogether and live with the possibility that the entire 49% is taken over by foreign investors. So that is one scenario which can be thought of over a period of time. But I would say that there should be, you can tilt the balance in favor of foreign investors to a certain extent, but not crowd out the domestic investors. That is how I would look at it.
Okay.
So maybe you raise 20 to 25 to 30, but I won't think we are prepared to create a situation where domestic investors can be completely crowded out.
Okay. No, Mr. Mundra, let us look at it more from a stock market angle. I mean, practically, do you think any foreign fund or even set of funds will want 49% when you know that the government of India is going to call the tune in these PSU banks? Why should we even assume that a bunch of foreign funds will cartelize and try to buy 49%? The problem is, because of this rule, and I'll put up a table for you, which IIFL alternate desk has put out. Because of this, the weightage of SBI and BOB is less. It's a qualitative rule which lessens their weight in the MSCI, and they don't get enough foreign funds, even from passive funds. So, Mr. Mundra, your take. Can this rule be dropped? It's not serving any purpose.
Okay, Lata, there are, I think, to my mind, there are 2-3 angles to it. One, as Mr. Sinha has rightly pointed out, from any, nation's perspective, government's perspective, it would not be a great idea to completely crowd out the domestic investors. They have to have a say and pie in the public sector banking space. That is one point. The second point is the point which you mentioned, but tell me today, despite the government ownership, despite the government calling the shot, whether public bank performance is found wanting in any way. In fact, if you look at the recent history, I think they are performing better than their counterparts in the private sector banks. So that's the second point. The third point is, yes, from the perspective of the market capitalization of the bank, it will be a booster if the foreign investors can have a larger share, and the ultimately beneficiary for that would be the government. But looking to the recent history and where we are today, I don't think government is in a hurry to cash out on that portion. So beyond the economics and the logic of it, I think there is a political part to it, there is a sentimental part to it, and ultimately, even if you want to do away with 20%, it would need an amendment in the Banking Regulation Act. So while the argument is tilted on both sides, I agree there is a room. Room is not that from 20% you go up to the 49%. There could be a midway. But yes, that would need a political preparedness. That is how I look at it.
Okay, two things, sir. I am not accusing banks of performance at all. But what I am saying is the presence of this cap, it is a qualitative rule in MSCI. Wherever there are such caps, since there can be a future restriction on the floating stock, the MSCI automatically gives it a lower weight. I will put up that table again for the benefit of our viewers. See, 20% is allowed. The maximum is 11% stake that foreigners have in SBI. In BOB, it is like some 5%. In PNB and other banks, it is in low single digits. It's not as if people are crowding even to the 20%. They will come when they feel like. So the point is, SBI, for instance, could have easily got $1.4 billion more of passive funds. They raised a QIP now. You know, instead of raising it at probably 800 rupees, they could have raised it at 900 rupees if this cap was not there. So, Mr. Harshvardhan, from a purely market point of view, since no purpose seems to be solved by this existence, can't we quietly drop it?
Lata, totally agree with you. This is a vestige of the nationalization era. It's old, more than 50 years old. And here there are several reasons, Lata. One is, if you look at a long-term view, you know, we say that our current banking credit to GDP hovers around mid-50s, and we want to take it to 130% as the part of that overall Viksit Bharat. I mean, our banking capital have to go to 50 trillion plus. If you just back of the envelope, where is this capital going to come from? And a lot of that will have to go into PSU banks. Otherwise, it creates a fiscal drag on the government. Every time these banks have to raise, and even if there is no NPA episode, even if they're normal course of business, they have to raise capital, the government has to put out 70-80%, whatever stake it holds. So I think we need access to deeper capital pools for the banking sector as a whole. And remember, this 26% threshold comes out of Companies Act, because after that you become significant minority. Public sector banks are not under Companies Act. Government is hugely privileged. It has 51% ownership, has entire governance with it. So I don't know where the hesitancy comes. My firm view is that we should allow it to go to 49%. Government will continue to own 51%. And look, I don't buy this crowding out argument. Look at the sectors where 100% is allowed. The Nifty ownership of foreigners has gone down. So I don't see that to be an issue that should come in the way of allowing access of capital. And remember, now our regulatory capacity has dramatically increased. There are many instruments RBI has to deal with any governance issues that might come up with higher ownership.
Yeah.
By the way, even at 49, that 5%, 10% single ownership threshold will apply.
Yes.
It's not as if somebody is going to run away with 30% stake. And in case of PSU Bank, the voting cap is 1%, not 26%. Okay. So I'm saying, given all of this, I just don't know why the hesitancy should be.
Okay. Well, fair point. Actually, I am in agreement with Mr. Mundra that the government has that much political capital, and this may be the smallest reason why they have to expend it. They may want to expend it for other reasons. And the other point being that, you know, we may say that if you raise the cap, we will get more capital. Precisely when you want the capital, when we were going through the asset quality review, that is when the FIIs will not come. They will come when you least want them, you know, when anyway the capital markets are friendly. But that's another point. I would very strongly vote with Mr. Harshvardhan on the issue that this is a vestige of a previous era and can be quietly dropped without making too much noise. But Mr. Sinha, you know, the more important question is not really public sector banks. This became important only because of SBI's QIP. But otherwise, it is in the private sector banks that one single foreign bank, and now I want to make this very clear to our viewers, we are not talking FPIs as a category, we are talking about one single private bank wanting to own, foreign bank wanting to own a larger stake in an Indian private sector bank. Mr. Sinha, do you think the time has come to remove this 26% cap on voting rights if it is a widely held institution? You don't remove it for, you know, a single individual, a promoter entity. But if it is a Citibank, if it is a Sumitomo Bank, they're anyway widely held. Should we start this debate at least that this 26% cap needs to go?
So let me make two basic points, and then I'll come to this question. The reason why there is a cap on voting rights, which alternately you could do by putting a cap on shareholding and having a one-to-one correspondence between voting rights and shareholding, is from the perspective that we in India have so far stuck to the point that the ownership and control should be diversified. It should not be too much concentrated in one entity. So that is one. The second thing is that it is an accepted principle and it is documented in RBI circulars that we do not want the Indian banking system to be dominated by the foreign banking system. And the current metric is about 20% of capital and reserves can be held by the WOS and branches. So this is the scenario. Now, the second one has come out of the experience of global financial crisis. And this is not something which only India practices, which others also practice. Now, coming to your specific question, you see, there was a time when there was a cap of 10% for promoters and for everybody else. They were all on par, and even the voting right was capped at 10%. Then it was raised to 15% for promoters. That is, the idea was to create a better status for the promoter compared to non-promoters. And now it has been raised even to 26%. So that is the idea. But there could be situations where you may have to allow more than 26% shareholding. Supposing a bank is in distress and a foreign bank wants to take over. So that is a situation which is a perfect situation for allowing more than 26% shareholding, but the cap on voting remains at 26% for the reasons which I explained.
Yes.
I would agree that the cap should be operated on shareholding limits, rather than through a disconnect between voting power and shareholding. Now look at subsidiary, a foreign bank subsidiary. Now there is no equivalent for Indian banks because in India, a bank cannot have a banking subsidiary. So this is something very exclusive to foreign banks.
Yeah.
Now foreign banks, we allow them 100% ownership. Now here, the voting limit has no meaning at all. No meaning. It is, in a way, you can say it is 100% voting rights.
So,
now, the moment...
Mr. Sinha, actually, we are running out of time. We have to take a commercial break. We will continue the conversation after the break. But I suspect on this issue as well, Mr. Mundra's former point that political capital of the government is limited, and will they use it to remove the voting rights cap of 26%, that too to help a foreign bank, looks a very remote possibility. But it is worth debating whether we have to remove that cap because India is in a growing growth path and we will need foreign capital sooner or later. Those questions after the break. Back in a minute. Bazaar viewers, you can catch the full show after market hours on India.
Shares of IEX hit a lower circuit. In fact, now temporary freeze of 15% as the Central Electricity Regulatory Commission, or CERC as we know it, has approved market coupling in the day ahead market in a phased manner. The stock, remembers, also in an F&O ban and will report its earnings today. But the biggest downward pressure is the market coupling news.
Midcap IT leaders, they slump following the first quarter numbers. Coforge reports a miss on margin expectations. The street is a little bit concerned on the capex spend as well in the first quarter. Persistent Systems revenue growth and deal wins disappoint. Both stocks take a clonk, 7 to 9% lower.
The street cheers for Dr. Reddy's first quarter numbers. Tata Consumer too also trades with gains after reporting a largely in-line set of numbers for both companies.
Syneris Pharma, well, that's rallying more than 10% as it delivers a near 100% growth in the net profit and strong margin expansion in the first quarter.
Viatech Babag shares are higher. The stock's given up some gains, but the company has won a 23 crore order to set up a desalination plant in Saudi Arabia, something that the management had alluded to earlier.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. We've had our day really cut out because 9 to around 3:30 we'll be tracking markets. And post 3:30, our heart and head moves to Old Trafford. Hey, Mangalam.
Trafford is what we're doing. Let's see. And as of now, the way it is going, it looks like it's a good game for us. Poised well. Let's see whether 2-2 happens or not. But for now, the market's 9:15 to 3:30.
And I just hope, Pant can come back, in this game. But it didn't look too good yesterday.
Let's hope he, can bat in the second half.
Yeah.
Whether he does or not, we don't know. But for now, I'm hoping for us to bat out so well and for our bowlers to bowl so well that he doesn't have to come back anyway. But be that as it may, let's get markets cracking. We have Saumil Mehta of Mirae Asset joining in. Saumil, we're not going to ask you about the charts for Team India. There is volatility there. But for the market chart, there is, this range-bound movement that we're seeing. 25,000 at the lower level, 25,250, 25,300 at the upper level. We've been oscillating between that, give or take every piece of news that has come in. Good earnings, bad earnings, great earnings, trade deal, whether it's between US and EU, US and Japan. We are in this range.
Absolutely, absolutely. It's very annoying to see this range and 25,000 levels from last May, from last 4 months that we have been looking at 25,000 levels. But I think I'm positive overall. Monthly charts, weekly charts, all hard top, hard bottom formation. The correction which we saw in the last a few weeks from 25,600, 700 to 24,900. That correction, I think, in the short term is over, and now we are again headed upwards. Crucial supports around 24,800, 24,700 levels, and on the upside now again the trend changes from down to up, and the target would be 25,600, 25,900 levels. But because today is the expiry, I'll be expecting a range-bound movement, but overall hard top, hard bottom formation, I'll be expecting Nifty to close above 25,300 levels, which is the 20 daily moving average very soon, maybe next week. Pharma is looking good. PSU banking has had a good correction, so I think there will be a good bounce back. IT has had a good correction, so there I'm expecting a small bounce back. So yes, overall positive on the markets. I'll be expecting 25,600 levels in the short term.
All right, 25,600. You're a little concerned, Saumil, about the frustration that's going out there. But some sessions you need to just bat out, right? And wait for the good deliveries and then up the game. Then the run rate will pick up.
And not get annoyed. That's most important, no matter what happens.
Don't throw your wicket.
Absolutely. We just have to stay there and just, leave all the balls outside the off stump and stay there on the wicket.
Be careful, but the ball doesn't come in, because
oftentimes no trade is also a trade. No trade is also a trade. Zero is a good position to be in.
That's let's keep the cricket aside. Let's get back to the markets. After 3:30, we'll three of us will get on a call. Maybe grab a coffee or a drink, maybe depending on each of our preferences, and then we'll see. But tell us about individual stocks. What are you tracking?
The first stock I am tracking is from Pharma Pack. Ajanta Pharma is looking great. A small flag pattern broken on the upside. Great momentum today. Stop loss would be 2700, 2700, and target would be 2900. The second stock which I'm looking at is Indian Bank. Indian Bank has been on the uptrend, consolidating in the last last month, and taken support at 40 daily moving average. Good risk reward here. Stop loss would be 614, and targets would be above 650.
All right. So those are a couple of stocks that you've given. Let's view one of the stocks which is under tremendous pressure today and perhaps likely to be going forward as well. That's what the analysts are saying. IEX, temporary freeze of 10% that's open. Now the stock is in another temporary freeze of 15% after CERC has approved implementation of power coupling with the day-ahead market. Vivek joins in. The worst fears come true, Vivek, and the stock price telling you that.
Absolutely right. Every time we've discussed IEX, we've always ended or always cautioned our viewers saying that, the biggest overhang remains the likely implementation of market coupling. And that fear, unfortunately, has actually fructified. Now, let's quickly look at, given the fact that we now know that market coupling will be implemented from Jan 26 in the day-ahead market, let's quickly have a look at the impact that this will have on IEX as well as other listed stocks. Of course, IEX, we'll go through that in detail. Dalmia Bharat, remember, owns almost 11% stake. So that's another company that will see the value of its holding in IEX actually fall down. And the other stock, importantly, is PTC India. Why is PTC India in focus? Remember, PTC India holds close to 25% stake in the rival exchange of IEX that stands to benefit most likely from higher volumes, which is called as HPX. So PTC India today is also under focus. Now, talking about IEX itself, what our brokerage is saying. UBS says that this is a negative surprise both for them as well as compared to market expectations itself of the implementation of coupling. The coupling of real-time market is also going to be considered at a later stage. FY25, just have a look at the contribution to the revenue. Day-ahead market contributed 50% and the real-time market contributed 30% to the revenue. So almost 80% of the revenue will be impacted by the implementation of market coupling. Bernstein says that this particular order is worse and different from what was built in. Not only volumes, they also say that the transaction charges, which are quite high at IEX, also will come down sooner, given the fact that now exchanges will now have to compete on an even footing, given the fact that the price discovery process will happen across all three of the exchanges in a roundabout manner. So now IEX, remember, has 40% market share in the term ahead market, and the DAM is the most important with 46% of volumes of total IEX coming in from DAM. So what they're saying is that moat of liquidity has gone. Only way to compete is through transaction charges, which will be reduced. So overall, a negative development for IEX, and no wonder then you're seeing the stock. Remember, two things to keep in mind. Number one, it's in the F&O ban, and number two, results are scheduled for later today.
Okay, all right. Thanks a lot for that, Vivek. Well, let's focus on Force Motors. That's the other one trading with solid gains. The stock is at a 20,000 rupees stock. I recall we explained this company here on CNBC-TV18 4 months ago when we spoke about the premiumization push. And I've seen way more number of Urbanias on the road, both in Maharashtra as well as in my visit to Uttar Pradesh. Sudarshan joins in to tell us about those numbers. Sud.
So it seems like that unlike other auto companies which have been talking about the slowdown in the demand, there is no slowdown in the demand, at least as far as intra-city buses are concerned, school buses or ambulances are concerned. And this is what reflecting the earnings of Force Motors, which has released a very strong set of earnings for Q1 of FY26. And that was led by healthy volume growth. If you talk about volumes, overall volumes were up 19%. But domestic business forms more than 90% of total volumes. And here domestic volumes were up 26%, and that has led to increase in the realization, which was up almost 3%. Now, talking about the overall numbers, profit was up 52%, revenue has increased by more than 22%, EBITDA too has seen a rise of 33%, and margin has come in above 14%. It was at 14.4% versus 13.2%, and here also it's the expansion of 120 basis points, and this is what reflecting in today's stock price. It's up almost 20%.
All right, that's about Force Motors, up 20% after a good set of numbers, coming in a record high for that stock. What we'll do is take a short break. On the other side, the management of Persistent Systems joins in to detail their first quarter numbers. The stock lower in today's trading session post those results. Welcome back. Look at Paytm. That stock's moved higher right now. Reported its numbers day 4 yesterday. Decent set coming in. The street liked that. The stock continued to move higher. Thereafter, the stock has been doing well. And this, in line with a lot of these new age companies that are seeing a fair amount of buying. So Eternal for one as well has now moved to the high point once again after seeing a big move post its numbers. So immediately after the numbers, the stock was up almost 15% in the preceding, in the following day and a half. And thereafter, we have another 3.5% movement coming in on that stock, taking its weekly gains to 21%. But one stock which is at the lower level in today's trading session is Persistent Systems, down almost in high single digits, trading with big cuts after the first quarter numbers came by. Not so good for the IT pack. Revenue growth missed street expectations, just as all the other companies reported numbers barring Infosys. Margins, however, in line with expectations. Rima spoke with Sandeep Kalra and began by asking him about his expectations from the quarter that we're in right now.
We have said it multiple times. We don't give forward-looking guidance, but if you look at our trajectory, if you look at our performance over the last 21 quarters, if you look at the order book, all of these are healthy. The pipeline is healthy. We'll let the quarter pan by. Keep in mind the macro is a little bit iffy because of the various, tariffs on, tariffs off, various things that have happened, whether it was India, Pakistan, whether it was the Iran conflict. And there is a little bit of, iffiness in the market, but we believe that should get resolved as well. So from our perspective, good performance so far, reasonably confident going ahead. I'll just leave it there.
And H2 versus H1, what's your own expectation?
Okay, so let me give you a bigger picture, and then we'll see H2, H1. So if you look at it, we have always said in the last several years, last couple of years, we want to be a $2 billion company aspirationally. Again, this is not a guidance. By FY27, we want to be at $2 billion. Now, if you do the maths, we have to compound from an yearly compounded annual growth rate at about 19%. That's our aspiration. We are currently at 18.8% on the year. So I'll just leave it there, whether it is Q2, whether it is H2, whether it is next year. If you compound it to the next 2 years, don't worry about one quarter or the other. But if you look at the bigger picture, that's our aspiration. The entire team at Persistent is working towards it. And that may include a tad bit of acquisition. So that is where it is.
But do you think 19% revenue growth that you need to achieve this aspiration of $2 billion can be achieved only organically, or will it require acquisitions? And if those acquisitions come, will they be over and above the $2 billion? And where are you looking at acquisitions?
Sure. So look, it will definitely have some amount of M&A, the acquisition part. Now, depending on the size of the acquisition, we may get there faster. We may have smaller acquisition, bigger acquisition. And to that point, look, at any point in time, we are evaluating multiple different options. We have said our acquisition strategy is twofold. One, Europe as a geography, we are currently at a 8.5 to 9% revenue clip. We have grown Europe at the company pace for the last several years, but we want to take a step change in Europe. We want to grow Europe over the next several years to 15% of our revenue. And that is basically to balance our revenue profile. And also, as we grow bigger, it's a healthy mix to have. Second part, we have said we want to be very well known for what we have always done better, the technology capabilities. So as the field of AI data is evolving, there are two pivots to that. One is the data and AI competency itself. Second is the domain competency in the verticals that we play in, which is banking, financial services and insurance, and healthcare life sciences. So our acquisitions for capability will be in most likely North America, India corridor. Our capability-led acquisitions will be in the areas I talked about. Our geographical expansion aspiration is in Europe, followed by Japan later. So any of the acquisitions in geography will be at scale to basically get us the toehold in customers in the areas, geographical areas where we are not that strong as of this point in time. Hopefully that answers you.
What's the war chest for M&A?
So look, we have $300 million of cash. We generate about $100 to $120 million every year. And we have the ability to raise money to whatever extent we want to. But again, look, our aspiration is to be the best technology services firm out there. And in our mind, the next generation tier 1 companies are not going to be defined by their revenue size. They are going to be defined by the capabilities. They're going to be defined by their ability to add value to the customers. And if you look at the journey of Persistent over the last 5-6 years, increasingly we have taken market share away from the larger companies. if you look at some of the relative sizes, the biggest company in our sector versus us, we have, if you look at the numbers, we have, by any metrics, outpaced any of the companies based on capabilities. So from that perspective, capability-led, focus there, and that's where it is.
Your margins are higher, 150 basis points on a quarter-on-quarter basis. But from here on, from 15.5%, can you expand margins? And what would Q4 exit margins look like?
Okay. So first, Rima, the margins are 150 basis points higher year on year, not quarter. So from that perspective, if you look at quarter on quarter, last quarter was 15.6%, this quarter is 15.5%. But keep in mind, there's a significant exchange rate, fluctuation that has happened. Now, if you compare the last full year was 14.7%. Now, if last full year was 14.7%, our starting point for Q1 is 15.5%. Again, we don't give forward-looking guidance, but if you extrapolate it, you can do your maths. And we have said we want to increase our margin as we go along by 100 to 200, 300 basis points over the period of time. We are on that trajectory. So I'll leave it at that.
But you've decided to defer your wage hikes. You typically give it in Q1. I mean, you typically give it 1st of July. But this time, given the macro, you've decided to wait. Take us through the reason behind that. And when do you think you will have the confidence to go ahead and give a wage hike? Or do you think this year, maybe the industry doesn't give employees a wage hike?
Okay, so two parts to it. Many people in the industry are deferring wage hikes by quarters and maybe for the full year. We are not doing that. We have just said we'll defer it by 1 year, and that is cast in stone. We are going to give the wage hikes next quarter. And if by the end of the year, if things pan out the way we want them to, maybe we will also take care of whatever we deferred. So that's one part to it, because at the end of the day, our employees are our biggest assets. The reason why we deferred the wage hike is twofold. One, there is a tad bit of softness in the market. There's uncertainty. We just want to make sure we have a healthy company. We never get to the point where we have to lay off people. That's point one. Second, we are investing big time into AI. That is going to be our pivot into growing the company in a very differentiated manner, at a very differentiated pace, at a very differentiated profitability over the next several years. We need investments. We can't do everything at the same time. So we are trying to make sure that as we train our employees, as we invest in them, as we invest in our capability build, we are being prudent. So that's where it is. And it is not to do with the entire industry. Even when the entire industry was not giving bonuses, was giving 60% bonuses, I'm proud to say for the last 6 years, we have been anywhere between 92 to 107% of our employee bonuses on a yearly basis. So that's where it is.
Healthcare for you was a bit soft. I think it declined by about 1.9% on a quarter-on-quarter basis. What was the reason for that? And going ahead, what will drive growth for you, Sandeep?
Sure. So two parts to it. What will drive growth for us this year? Banking financial services, followed by high tech, followed by healthcare life sciences. Now coming to healthcare life sciences, if you look at the trajectory of healthcare life sciences in the last 6 quarters, and maybe when you do the analysis, you look at that, healthcare grew at the fastest possible clip in the whole industry for us. And it was at one point in time more than 60% year on year. Now, look, we have grown that sector. There are times where we are signing deals where we have to take the revenue, convert that into offshore-led as a part of the cost savings for our customers. The consolidation of that piece is happening. And as we speak, for the next 1-2 quarters, that will happen in one of the larger customers that we have. Having said that, it's a sum of parts. We are very confident. If you look at the end of the year, all the 3 segments for us, whether it's BFSI, the banking financial services, healthcare life sciences, or high tech, all of them will grow secularly. So that's where it is.
Okay, all right. That was the management of Persistent. For the time being, the stock continues to remain under pressure. Well, before we slip into a short break, a small programming note for all our viewers. As the workplace transforms, so must leadership. In the Bengaluru edition of Future Female Forward, Season 3, India's top business leaders gather to reimagine what inclusive leadership looks like and how women are powering the future of work, capital, and innovation. Catch it live on July 29th, 5:30 p.m. onwards, only on CNBC-TV18, CNBC-TV18.com, as well as on YouTube.
Welcome back. PG Electroplast, stock which has moved higher right now, 361 VAM, as well as the other one which has surged. Indian Bank, which was one of the picks of our tech guest, that too has moved to the high point of trade. But Prime Minister Narendra Modi has arrived in the UK ahead of the signing for the free trade agreement with the United Kingdom. That will take place later today. Parikshit joins in with more details. Parikshit.
Well, the big headline is that India will be reducing tariffs on UK products at an average level from 15% currently to 3% once this FTA is implemented, once the UK Parliament ratifies it. In terms of access for UK goods, UK's cosmetics, Scotch whisky, gin, UK lamb, soft drinks, they are likely to get better access to the India market, even automobiles for that matter. On the auto sector, advanced cars coming in from the UK, especially electric vehicles, will see a 10% tariff, but this is not going to come into effect immediately. It will come into effect in a graded manner, and there will be quotas for a certain number of vehicles which will enjoy a zero duty or a reduced duty access to the India market. Now, coming to marine exports, the FTA will eliminate tariffs on 99% of marine exports from India, including shrimp, tuna, fish meal and feeds. Tariffs on Indian leather and footwear eliminated from 16% to 0. Duties on Indian textiles will be reduced from 12% to 0. India's footwear, textiles, leather exports to UK to get preferential access over Bangladesh, Pakistan and Cambodia. Tariff on engineering goods will be reduced from 18% to 0. India's generic medicines market to get a boost with zero duty access to the UK market. Gems and jewelry, toys, plastics and chemicals, all of them will benefit from tariff relaxation through this FTA, and the Indian MSMEs, Indian workers, Indian businesses in this sector will benefit. The FTA will also support movement of professionals in critical and emerging technologies and digital trade. There is a separate chapter on innovation and how the mobility agreements should support innovation between the two countries. There will be zero duties on 95% of agriculture and processed food tariff lines. So you'll have duties eliminated on India's agri-exports of fruits, vegetables, cereals, pickles, spices, processed foods, ready-to-eat foods, but dairy, apples, oats, edibles oils, wheat, rice, maize, these will not be included in the free trade agreement, as these are red lines for India.
All right, take that point, Parikshit. Thank you so much for that. Just before we wrap up on this show of Chartbusters, pull up the intraday chart of IEX once again. The 15% temporary freeze has opened. Now the stock is down 20% right now. As we speak, 20% lower on IEX at 150. The 15% freeze also has opened. Remember, the stock is in F&O ban. Take a short break, come back. On the other side, we have the team of Trading Hour coming up next. Thank you for watching Chartbusters.
Morning, welcome to Trading Hour. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, Reema Tendulkar and Hormis Patakia. Good morning, guys. It's a Thursday morning. Feels like a Friday already, actually. It's been such a long week. But in terms of the market moves, we saw Nifty surging yesterday, led by banking names. But today, it has come in for some profit booking, taking some rest right now. But for now, if you look at the Nifty, it is down around 56 points. Mid-caps falling more. So 0.5% gone there, but there has been a wee bit recovery from the lows as well. So keep an eye out on that one. Even for the mid caps, we have seen a sharper recovery from the lows around that 10:30 a.m. mark. If we talk about sectoral movers, of course, Reema will talk about Nifty IT in greater detail. Infosys continues to be in focus, and the other IT names as well. But it is IT which is putting pressure on Nifty today, while Pharma is batting for the bulls. So 0.5% higher on Nifty Pharma. Auto index also doing well. A lot is happening around tariffs with respect to the US, with respect to UK, India, FTA. So definitely auto space and auto stocks will be in the wait and watch mode.
You know, and once again, India is underperforming the Asian market. So Nikkei continues to do well. Hang Seng has rallied 3.5% this week. The Chinese markets are up 2%. The Nikkei market is up nearly 5%. I think once this India-US trade deal is struck, there will be that, the release or the relief coming through in the markets, and we would perhaps break out of this range. But as you rightly pointed out, it's mildly lower now for the benchmark indices, down 0.25%. The Nifty is at that 25,160 mark, a cut of 60 points, and it's IT which is exerting pressure. The Nifty IT index, contrary to everyone's expectations, because we thought today would be an IT day on the way up, it's turned out to be an IT day on the way down.
And on the way down, and how? You take a look at Persistent, take a look at Coforge. Reema will just talk about both of them in just a bit. We'll also put the spotlight on Infosys. Guidance raised, but yet the stock is lower. But just before we get to that, there are plenty of earnings reactions that are taking place in today's session. Sensex Pharma is one of them, and that stock is now up 11.5%, the top gainer on the BSE small cap index. Thyrocare is the other one. That too is trading with gains of around 11%. Force Motors, that is up 9.5%. PNB Gilts came out with results yesterday during market hours. The stock didn't do much yesterday, but now is up 9.5% in today's session. So plenty of earnings reactions. And on the downside, if you take a look at, besides what Reema will just speak about, the IT names, the other names on the downside includes Spandana Spurti, that's down 7%. Lumax Auto is down 7%. UTI AMC reporting results today, that is down 5% as well, ahead of the results. So a lot of these asset management companies are reporting results today, along with the likes of Motilal Oswal and the likes. So we keep an eye out on all of these names. But the spotlight has been on IT, the spotlight has been on Persistent, on Coforge, and on Infosys. What exactly transpired, Reema?
Well, first let's look at the way the stocks have corrected, right? It's a very, very sharp decline, not just a mild pullback or profit booking. This is a correction, 7-8% gone on the benchmark IT companies. Now, there is no problem with growth. Growth has beaten expectation. Growth is very strong across the board. For Infi, 2.6%. For Coforge, it's about 8%. Persistent, 3.3%. The management commentary on growth is also very strong. Coforge, for instance, saying that H2 is going to be materially better than H1. Persistent also talking about how, the aspiration of $2 billion revenue top line is very much intact. So then why are the stocks correcting? Let's talk about Infosys. Here, the only reason could be that the upper end of the organic guidance has been trimmed by 40 basis points. Let me explain that. The current guidance, the previous guidance was 0 to 3%. Now the guidance stands at 1 to 3%. So the upper end has remained unchanged at 3%. That's the max in terms of growth. The earlier guidance didn't include acquisition benefit of 40 basis points. The current guidance did. So basically, 3 months back, the best case organic growth was 3% for this year. Now it will be 2.6% because the balance will come from acquisition. That could be the disappointment when it comes to Infosys. Now, when it comes to Coforge, it could be on two folds. One, on margins, and two, on their capex. Now, the company has said that their margins are at 13.2%. Unchanged quarter on quarter, and they're on track to achieve 14% margins. But I spoke to a lot of analysts, and they're saying this 13.2% margin includes a lot of one-offs that the company has done. So, for instance, there is a bonus issue, ESOP cost, there would be the forex element to that. If you strip that out, then the margins are actually a lot lower. You know, it differs. Different analysts are putting it, you know, at different numbers, but the adjusted, you know, the margins X of all the one-time adjustments that the company has done is actually a lot lower. Also, secondly, this capex spend, right? On an aggregate, the company has done a capex spend of $85 million, but it includes about a $65 million capex spend for a data center, which they will be using for their clients. You know, historically, IT companies have never put in any capex. This was a very asset-light business. The only expense that they had was their employee. They used to provide services. But now they're investing in capex also, right? So there will be the depreciation cost. So, you know, analysts are a bit puzzled and they're questioning. Why? Because the costs of running a data center are also fairly high. And that has also resulted in the cash flows being on the negative side. Now, Persistent, that's the third one. Here, maybe you can quibble on the growth because 3.3% falls short of the CNBC-TV18 poll. Plus, the wage hike has been deferred by 1 quarter. And third, the deal wins are strong, sustaining about $500 million. But if you have to find a reason, you can say the deal wins have not expanded. They have been in a similar range. And finally, to top it all, both Persistent and Coforge were the best performing IT stocks, most expensive, trading at about 40 times forward multiples. So that is, of course, doesn't help.
Makes sense, right? And right now, market is basically punishing everything that is not performing well, especially at such valuations. In fact, we also spoke to the management of Persistent Systems. Let's listen into what they had to say.
We want to be a $2 billion company aspirationally. Again, this is not a guidance. By FY27, we want to be at $2 billion. Now, if you do the maths, we have to compound from an yearly compounded annual growth rate at about 19%. It will definitely have some amount of M&A, the acquisition part. Now, depending on the size of the acquisition, we may get there faster. We may have smaller acquisition, bigger acquisition. And to that point, look, at any point in time, we are evaluating multiple different options. We have said our acquisition strategy is twofold. One, Europe as a geography, we are currently at a 8.5 to 9% revenue clip. We have grown Europe at the company pace for the last several years, but we want to take a step change in Europe. We want to grow Europe over the next several years to 15% of our revenue. And that is basically to balance our revenue profile. And also, you know, as we grow bigger, it's a healthy mix to have. Second part, we have said we want to be very well known for what we have always done better, the technology capabilities. Compare the last full year was 14.7%. Now, if last full year was 14.7%, our starting point for Q1 is 15.5%. Again, we don't give forward-looking guidance, but if you extrapolate it, you can do your maths. And we have said we want to increase our margin as we go along by 100 to 200, 300 basis points over the period of time. We are on that trajectory. Many people in the industry are deferring wage hikes by quarters and maybe for the full year. We are not doing that. We have just said we'll defer it by 1 year and that is cast in stone. We are going to give the wage hikes next quarter. And if by the end of the year, if things pan out the way we want them to, maybe we will also take care of whatever we deferred.
The EBIT is going to hit 14% for the current fiscal. And our business, our firm has always seen a sequential increase in EBIT in margins across the quarters. This is quarter one. We've landed at 13.2% despite very strong growth off the back of the ramp up of the Sabre large deal that we talked about. We feel extremely confident that the EBIT number that we will deliver in the current fiscal is going to be 14%. So from our vantage, 5 large deals, a next 12 months signed order book that is almost 47% higher than where it was at the same time last year. EBIT margins profile which should improve very significantly this year. H2 in turn again should be materially better than H1. So the year from a revenue growth perspective and from a margin improvement perspective seems to be turning out to be an exceptional year.
The law of averages finally catching up with both Persistent and Coforge now trading 8% down each after their result reactions. By the way, just before we get to Dr. Reddy's, where Ekta is here to tell us more about how the numbers were and what the brokerages are saying, IEX is now down 20% after the 10% circuit opened up. It went down 15% and now it's down in a 20% lower circuit. And if you check NSE currently, the total number of sell orders that are pending at this lower circuit price comes up to around 4.6 crore pending orders still at this 20% lower circuit. So we'll see how further lower this stock can move as the day goes by. By the way, the stock is in the F&O ban, mind you, so no new positions can be created on the stock here. So go across to Ekta now, who's joining in with Dr. Reddy. How the numbers were, what did the management tell us, and what brokerages are making of the numbers. Ekta.
Well, overall, a mixed performance, you'd say, for Dr. Reddy's, because the numbers were okay, but the commentary probably was better than what the street was anticipating. So the revenue was up around 11.4%. The street was anticipating around 13% growth. The margins were better than expectations at around 26.7% versus estimates of around 25.4%. But there were some estimates of a higher margin of around 27 to 28% as well. Profit was just about flat this quarter versus expectations of a growth. North America, which is the key business for the company, was down 11% on a year-on-year basis. That is because Revlimid generic did see competition come through, or rather price pressure come through. India did well. It was up around 11%. It was pure organic growth, according to the management, as the Sanofi vaccine tie-up was in the numbers same time last year as well. The guidance as per the company on the US was disappointing. So it was flat to single-digit growth, which is expected for FY26 in the US. But the street is probably expecting that somewhere. The EBITDA margins are expected to be north of 25%. This is despite the competition that would come in for Revlimid generic. India, Europe, PSAI, which is their pharma ingredients business, is expected to see double-digit growth. And the biggest kicker will be the semaglutide launch. So they are saying that they are planning to launch semaglutide in Canada in 2026. So approvals in the second half of this year will be something that the street will watch for quite closely. In terms of brokerages, CLSA underperformed, target price of 1120. According to them, earnings are in line with estimates. Morgan Stanley, overweight call, target price 1298. Jefferies underperformed with the target price of 1100. The Ozempic generic approval in Canada and US filing for one of their biosimilars are two important events to watch out for.
All right, so we'll be watching out for that. Thank you so much, Ekta, for joining us with all those details. That's Dr. Reddy's up 2.5% in trade. But what's not doing well is Mahanagar Gas. That stock is lower by 4%. Remember, it reported numbers on Tuesday. And this time around, it was aided by that one-time provision income that had come by, a reversal that they took. And the company held a conference call yesterday. So while overall commentary looks decent, they mildly cut their guidance in terms of revenues and EBITDA per SCM for FY26. It's a very small cut, not a big one. They talk about high single-digit YOY growth in volumes. Earlier, they had spoken of 10%, and this will mainly be led by CNG. They also talk about EBITDA margin expected in the range of 9 to 9.5 rupees per SCM. So the upper band was earlier 10 rupees. Now it has been cut to 9.5 rupees. The acquisition that they had done, Unison, that's where volumes this time around saw growth of 8.5% on a sequential basis. They have a capex guidance of 1,100 to 1,300 crore rupees each for the next 2 years. And CNG volumes in July 2025, it has been slightly above Q1 of FY26. So that's some positive commentary coming in. We were talking about revised zonal tariffs, and they say that because of this, because they move from zone 2 to zone 3, there will be an impact on EBITDA margins by 0.6 to 0.7 rupees per SCM. On the back of this, MOSL says that they value the stock at 15 times to an FY27 EPS. This is the cheapest stock in the city gas distribution space, but they maintain a buy rating at 1700. Nomura also has a buy rating with a 1580 rupees as the target price. They say Q1 was below estimates according to them, but volume was something that they like this time around. CLSA says that they have an outperform with a target price of 1710. They say it continues to be the cheapest in the entire city gas distribution space. That's why they have an outperform rating on this stock. But yes, the management talks about a slight moderation there. And that's why maybe the stock is seeing that cut of 4% in trade as we speak.
Got that. Thank you very much for that. Get into break. As we do that, here is a small programming note for all our viewers. As workplace transforms, so must leadership. In Bengaluru edition of Future Female Forward Season 3, India's top business leaders gather to reimagine what inclusive leadership looks like and how women are powering the future of work, capital and innovation. Catch it live on the 29th of July, 5:30 p.m. onwards, only on CNBC TV 18, CNBC-TV18.com and YouTube.
Welcome back. Still another 80 points lower now on the index. So we are below that 25,150 mark, and there are plenty of earnings reactions that we are tracking. At the lowest point of the day now is where the Nifty lies. But on the flip side, we just spoke of Cenor's Pharma, which was the top gainer on the Nifty 500 today after its results. The company's revenue was up 72%. Profits nearly doubled from last year. To discuss the quarter gone by and the road forward, you're now being joined by Swapnil Shah, who is the managing director of the company. Swapnil, good morning. Thank you for joining in. You know, at the end of the previous quarter, which is Q4, you had highlighted that you intend to have at least a 50% top line growth, to profit growth of at least 100%. You've at least maintained the top line growth very healthily. Even the profit growth as well has been almost 100%. Do you stick with that guidance for the rest of the year, or considering how you have performed this quarter, you would want to revise it higher?
Thank you. Good morning. So we've achieved 95% PAT growth year over year, which is well within the line of our guidance that we had. I would not want to comment on the further guidance. What we have said, I think we are on track to achieve those numbers this year.
Got that. This strong 72% growth, we can see it was a 69% growth in the regulated markets, 32% growth in emerging markets. Going forward, what is the outlook on both these two markets, and even US? How much did you generate from US in the current quarter?
Yes, so current quarter, I think we are on track to what we have said. Full year we have guided at about 400 crores from the US market. So relatively that will captured in this particular quarter as we speak. What I can tell you, we have a very busy year, both on emerging market as well as US side in terms of product launches, in terms of the pipeline that we have, and that will continue to drive the growth that we have guided for.
Okay, so in terms of US itself, can you give us a sense of what was the growth this time around? How much did you get from the US markets from both the segments, be it the retail channel or the government channel?
So currently, our exposure to retail channel is very limited. We would intend to go into retail channel with our acquisition portfolio that we have. We have acquired close to about 20 plus ANDAs from various companies, as you probably know. So that retail piece will start kicking in from H2 of this year. And most of our current product that will go into controlled substance government business, that's about 60-70% of our current business that go into those two class of trade, which will continue to grow both on the CDMO, CMO, as well as our own product side.
Okay, so in the US business itself, especially in the government contracts, how many ANDAs are in the pipeline, and which are the ones which are on the controlled substance from the US? What is the potential pipeline of launches? And if you can give us a sense of what kind of growth are you going to see there? What is the sales estimates that you have from these ANDAs?
So as you know, on the controlled substance side, both the development as well as manufacturing has to be done in the United States. We are equipped in terms of taking up that kind of growth that we have projected for this year and next year. We have installed cages. We have done a lot of installation in terms of catering it to those C2, C3 kind of markets. So to give you exact ANDA numbers will be a little tough in terms of what approval that can come in. But from what we have projected this year, I think largely we'll be able to achieve. Similarly, on the government side of the business, as well as I said, retail, right? Retail as well as specialty channel that we cater to. Both as the guided what we have this year will continue to achieve. And from the US standpoint, particularly from the growth, as we have projected, we'll do about 50% odd on the revenue side from the last year. US will drive that growth. So US will probably be between 50 to 70% of the growth this year as we speak from the last year that we've done.
Swapnil, you have acquired a significant number of ANDAs from Dr. Reddy's in the past, 14 of them, and you've acquired a couple from Wockhardt as well recently. Are there any more ANDAs that you're looking to acquire going forward?
Yes, that would be our strategy, just to cater to the market early on, because typically, the new ANDA filing will take about anywhere between 24 to 36 months, right, from the start of the R&D to getting approval from FDA. With acquisition strategy, we can access market quite early, within 8 to 10 months from the acquisition that we've done. So very carefully, we are looking at the available opportunities and will continue to acquire more as long as it fits into our strategy going forward that we are trying to do for next 2 to 3 years growth strategy.
Okay, so Swapnil, just confirming, did you say 50 to 70% growth is what you're expecting in the US portfolio itself?
That's correct.
Oh, okay, all right. So US definitely will be a growth driver. What about India in particular? What is the revenue contribution coming in right now? And what kind of growth are you going to be seeing here? Is there any launch that is expected in this fiscal itself?
Yeah, so we've done first quarter at about 8.5 crores from branded generics in India. We will be doing 50 crore plus this year from our branded generics business. Launches, we keep on launching newer products, both on the hospital critical care segment side as well as new antibiotics the portfolio that we have. So strong growth on that side compared to last year. There's going to be about 300% on the branded generics that we are anticipating this year. We'll continue to drive year after because our base is small. We are not present in all states. Our team is relatively smaller. But as we move forward, we plan to be pan-India with a slightly bigger workforce and approval in multiple specialty hospitals across India. So that portfolio will continue to grow, and we see significant growth from branded generics this year as well.
Significant, like you gave us a number for US, can you give us a number for the generic market or the generic segment as well?
We say, right, we target to achieve 50 crores plus from branded generics to 8.5 crores. First quarter, we've done about 8.5 crores. And our target is to achieve 50 crore plus from branded generics this year.
All right, Swapnil, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. The management of Cenores Pharma, very confident of maintaining their growth and also see significant growth in the US markets as well. The stock 12.5% higher in today's session. Take a short break. The market has fallen to the lows of the day now. Discuss a quick chart check with Apurva Sheth from Samco Securities on the other side. Stay tuned.
Welcome back. Well, it's a sharp fall on the Nifty. It is at the day's low. It's a 115-point cut that you're looking at, and it has only intensified in the last couple of minutes itself. We'll talk about individual names, but a lot of action that is happening in the F&O space as well. So let us get in Mangalam to tell us more. Mangalam.
Well, like you pointed out, there is a sharp fall that we're seeing in the frontline indices. Early in trade today itself, we have the Nifty, which is lower. The street was hoping for some sort of support coming in from a couple of these IT names. That hasn't been the case. Nifty Bank is lower as well. And the mid-cap index tells you that the number of stocks which are declining are far more than the number of stocks which are advancing. So the market breadth, we still have the red line above the green line as we speak. Importantly, as we move towards the weekly options expiry, the India VIX, which is at very low levels, was factoring in that the market continues to move in that range, has seen a bit of a spike, a smidge of a spike. So let's see where that goes from here on as well. The active Nifty options tell you that there is a fair amount of resistance on the way up. 25,200 call, very active in today's trading session. Writers believe that maybe, upwards of 25,220, 230, there could be a fair amount of resistance for the frontline index. 25,250 call writers as well, equally active in today's trading session. At the lower level, though, we did see some writing at the 25,150 put, and those who are writing both the 25,150 put and the call, they are hoping for the market to stay in this range of 25,000 to about 25,200. Let's see whether that range sustains or not. Early in the day, but we will keep an eye out on that as we progress towards weekly options expiry. A couple of stocks really stand out. Tata Consumers being bid higher, so a lot of fresh longs being added out there. And we have a lot of short positions being added on names like Persistent, Coforge and Mahanagar Gas. Persistent and Coforge, remember both of them reported a weak set of numbers.
Okay, all right. Magnam, thank you so much for that. But we'll come back to you in just a bit because Nestle's numbers, those are flashing for you at the bottom of your screen. Net profits have come in at 646 crore rupees, which compares with a poll of 732 crore rupees. The expectation was of a 2% decline, but the profits have declined 16% on a YOY basis. You can see that sharp fall in the stock price as well. Revenues were expected at 5,080 crore rupees. The number should come up for you on the screen, but looks like the profit number, that is something that the street is not liking right now. We do have some commentary which is coming in from the management as well. They talk about how they have delivered a balanced growth in 3 out of the 4 product categories: prepared dishes, cooking aids, powdered and liquid beverages and confectioneries. They have bounced back to volume-led growth. 7 out of 12 top brands grew at double digit. They also talk about the quarter was impacted by elevated consumption prices across the commodity portfolio. They have also witnessed higher operation costs as a result of significant expansion in manufacturing in the last 7 to 8 months. And that is something that has impacted the numbers this time around. The revenue is absolutely in line with estimates, but it is the profit number which has seen a decline. Can we go across to Mangalam for a quick take on what the numbers are looking like? Okay, the stock is down 4%, but it's the profit number that the street doesn't seem to like.
The higher costs is what they're saying, right? Finance costs are higher, employee benefit expenses are in line, but the cost of materials consumed is also higher. So it is the higher expenses that have weighed on the operating performance. That they have mentioned that there were some borrowings from commercial banks that they had to take to fund the temporary operational cash flow requirements. That resulted in the higher finance cost this quarter. We'll await the volume growth number, but Prakash Diwan is with us on the phone line. Prakash, thank you for joining in. The numbers, well, if you can say on first sight that it was higher costs that impacted the performance, but it is also, do you see that as a result of the sluggish consumption trends that have also remained all through for a better part of this year?
No, absolutely, Ormus. See, if the cost spike is one-off, the market will probably take it in its stride. But if there's a genuine issue in terms of inability to pass on higher pricing and hence there's erosion on margins, then there's a concern. And my sense is it will probably be the latter. See, Nestle is undergoing a significant expansion at its Gujarat facility, and that might take some time before it starts kind of, getting the ROCs to be positive. So that's where, even the balance sheet is stretched. And once that expansion happens, probably things will look very different, provided it gets backed with the demand absorption as well. So I would believe the volume numbers might also not be very encouraging, though the anticipation going into numbers was very moderate. But we'll have to wait to see what's resulted into this cost spike. If it's just interest costs, it's understandable. Raw material is probably only getting benign now. Post-June, so things could probably ease out, but the market will want to understand that.
Oh, absolutely. In fact, let's get in Mangalam as well. Mangalam, higher costs is what the company is talking about. Though they mentioned that coffee prices are expected to remain range-bound at current levels, cocoa and edible oil prices have stabilized and remain range-bound. Milk prices are anticipated to decrease. What's your take on the numbers?
Well, if you look at these numbers, they aren't anything to worry about. Yes, there was weakness in the top line that the street was anticipating. The EBITDA has been slightly below street expectations. We were expecting some sort of margin compression to come by as well. The net profit, now that's lower than street expectations. A large part of that is on account of a non-cash expenditure. So if you look at their overall depreciation, that has increased this time around from around 112 crores to 156 crores. Why is that? Because 2 quarters ago, we had the Sanand plant of the company come on stream. So as a result of which, the depreciation had increased. The EBITDA margins have taken a slight knock. But, the commentary that the company is given is very positive. Why do I say that? Because coffee prices have come off the peak. Going forward, they would see margin improvement in that itself. Secondly, milk prices, which account for a fair amount of their raw materials as well. As the flush season has begun, milk prices are likely to decrease from here on as well. So this weakness that the company has seen in margins may be on account of 2 factors. One, the inflation in raw materials, which was transitory, and company being stuck with high-priced inventory. So all those things now coming down, with the raw material environment looking a lot more benign going forward and the demand environment looking a lot better going forward, these numbers, while the street is seeing a bit of a decline in the stock price on account of reported numbers, the going forward is relatively better. And I believe that maybe, the street will now start looking ahead as against looking behind. And for Nestle, the other big trigger is also Suresh Narayanan. After a great stint, hangs his boots. So you will have a new leader. Manish Pandey joins in, and his strategy is something that the street will be keeping a close eye on too.
Absolutely. Take that point. The stock has recovered as well on the back of that commentary which has come by on the pricing scenario going forward. Prakash, your take now. The company talks about how some prices are expected to moderate, especially for the raw materials, be it milk prices, be it cocoa prices. What do you have to say now?
Yeah, absolutely. So as I said in the beginning, the prices can only become, the environment on raw material is better and benign. I'm not sure about milk as much, but yes, coffee, which had peaked out last quarter, cocoa, all of that could probably just ease out. The other, positive that seems to be the silver lining of sorts is that the company talks about cooking aids, prepared dishes, and powdered and liquid beverages, which is largely Nifty. Those have started to bounce back. Now that is the first indication of urban consumption getting into place. The rural consumption will still have the staples and the basics, but these higher end derivative products are definitely an indication that urban consumption is coming back. And it could only get better post the monsoon for rural as well. So I think, the stock probably could, see one round of bottoming out in terms of this thing. The earnings are showing that. And then, as I said, the Gujarat plant has been significant capex, and that's going to have its impact. But the benefits of that will start coming October onwards. So the market will probably look ahead, as Mangalam rightly said, so will the management.
Well, very quick yes or no answer, Prakash. You would use this dip to buy because some of them are already doing so.
Yes, absolutely. Because I think the overall consumption basket is very clearly showing signs of bottoming out, and Nestle is probably the poster child of sorts in that upturn. So definitely this will look positive.
Right, Prakash, thank you so much for joining in with your quick take on the results of Nestle. The stock recovering from the lows of the day, but still trading with losses of around 3%. Let's get you a quick chart check as well. Apurva Sheth of Samco Securities is joining in. Apurva, quick take on the Nifty. It's a very sharp fall that you have seen from the highs of the day. We are now below the 25,100 mark. What's your call on the index? You'd use this dip to buy, or would you stay away for now? And what are your stock recommendations as well?
So if someone is an intraday trader, then he can use this dip to buy Nifty for 1 or 2 hours. But otherwise, if a positional trader is trading on Nifty, then I would say it's best to take a holiday for a few days. And because there's not much of volatility, just to give you a stat, the index has been consistently trading. The high-low range of the index is below 1% for the last 19 consecutive sessions. Now, this is something extremely extremely rare. And until and unless this range breaks out, so we are in a range of 25,320 to 24,880. So this is what the range has been on the Nifty for the last 10 days. So once we break out of this range, we will get some clear trend. So intraday traders, yes, they can use this dip to buy, but positional traders can maybe wait or take a holiday. Stock specific actions are there. So first pick is Tata Motors. We would like to recommend it with a stop loss of 690 for a target of 745. It's breaking out of a sideways 1.5 month sideways consolidation. So there's some action kicking in Tata Motors, and MRPL is breaking out of a 5-month long sideways consolidation. So 150 was a strong resistance and it is taking it out with huge volumes. So MRPL is another pick for the day.
All right. Thank you so much for joining us with those picks and levels to watch out for. We'll slip into a short break. Up next, we'll discuss the market fundamentals and a lot more. Stay tuned for that. Welcome back. You're still tuned into Trading Hour. Let's talk about market fundamentals now. Manish Dangi, CEO and founder, Mosaic Asset Management, is joining us now. Manish, good morning. Thank you so much for joining in. Well, you're not very positive on the growth aspects of India as an economy right now. What explains that? And do you think that is something which will keep the market range-bound or maybe keep it underperforming the Asian peers for a while?
So growth has been sort of weakish for a while. And even though sort of last quarter, we saw some uptick, but again, April, May, June was almost all high frequency data seems to suggest that we've had a renewed cycle of slowdown. Actually, somewhat surprising given that it's this leg of slowdown. Actually, at least I did not anticipate. Now, in a setup when, of course, nominal GDP growth is single digit. Revenue growth, of course, you're seeing all the numbers coming in, again, single digit, profit growth, 6, 7, 8%. Of course, valuations in India continues to remain expensive. Now, actually, not just in equity, but even bonds, you can't really argue that bonds are very cheap. So to that extent, these are listless markets and unlikely to deliver any significant gains in any asset class, I would argue.
Okay. What about the inflation aspect? We've seen a multi-quarter low inflation. Do you think if we go below that point, it will be worrying? Because yes, inflation should be lower for overall economy, but it shouldn't be so much lower as well. What is your take on that?
I agree. So inflation actually in India has surprised the last 6-8 months almost all analysts. And inflation is actually the best indicator of growth. So to that extent, you could argue that the growth slowdown in India is getting reflected in lots of disinflation that we see. It is pervasive. It's not just in vegetables that some people seem to argue. It's there in core inflation, very, very apparent. So I guess the only path it leads to is perhaps even more rate cuts in India. So to that extent, I sort of remain very constructive on RBI. I know, as a matter of fact, most bets on incremental rate cuts have been pulled back. But I think RBI would still surprise markets, and you will see an additional 50 basis point rate cut in this financial year.
Manish, the next big trigger globally next week is, of course, the Fed policy. And while it's mostly a status quo that has been priced in this time around, a very interesting observation from JP Morgan came in recently that in case there are future rate cuts, that might turn out to be a sign of weakness more than a sentiment booster. What's your take on that? Do you still expect the Fed to cut twice this year despite the economy being the way it is currently?
So US in some sense is behaving a bit like emerging markets, and I'm not stretching the argument, but it is somewhat like emerging market. Dollar is actually weakening. Tariffs, of course, are resulting in the core inflation actually sort of strengthening as we speak, even while growth sort of at margin is actually slowing. So to that extent, Fed's, work cut out for Fed, is a very, very difficult one. There's absolutely no way that Fed would cut rate right now. Now, the competition between more inflation induced by tariff and this growth slowdown, frankly, it's likely that at least in near term, inflation wins, and there could be some more of inflation in the core inflation side of US actually may come in, and to that extent, I think the rate cuts in US are certainly pushed out into the future. Would there be a 50 basis point rate cut? I kind of have been of this view that yes, it would be more driven by, of course, growth slowdown in the US. But I think it's been pushed back again by another quarter.
Okay, take that point. Lots to talk about. We are short on time today, Manish, but always a pleasure speaking with you. It's a busy time with a lot happening with the tariff updates as well, and now earnings. So we'll speak to you very soon again. With that, we'll slip into a short break. Up next, we'll be joined by the management of G&G Electronics. The IPO opened yesterday for subscription. Stay tuned for that conversation.
Welcome back. On to some primary market activity then. GNG Electronics' IPO was fully subscribed within an hour of opening for subscription yesterday, and currently it's subscribed almost close to 16 times the total number of shares on offer. We are being joined by Sharat Khandelwal, who is the founder and managing director of GNG Electronics, and Ajay Pancholi, who is the director of the company, who are joining in. Gentlemen, good morning. Thank you for joining in, and firstly, congratulations on the response that you have received on the first day and a half for your IPO. You know, you've mentioned that out of this proceeds that you plan on raising, the 400 crores through the fresh issue, 320 you'd be using to repay your debt. Does that now make you a debt-free company after this 320 crore is repaid?
Yes, that's correct. That makes us debt-free company.
And what about the rest of the proceeds? How do you plan on utilizing those?
After providing for the expenses, this will be for general corporate purposes, mainly for working capital only.
Okay, take that point. Mr. Pancholi, let me come to you. You do have substantial revenues coming in from export markets as well. It's around 1,056 crore rupees in FY25. Revenue within India has been 345 crore rupees. So substantial chunk coming in from exports. What kind of growth have you been seeing there? There's a lot happening with tariffs as well. So first up, how much is the exposure to, say, US? Which are the other countries that you have exposure to? And what is the growth which is likely in this particular segment?
So we've had a phenomenal acceptability of our product globally. We export to almost 38 countries across the globe. And that's what has been resonated in our revenues historically. We've initially started with a few countries and now export to over 38 countries. US contributes about 17-18% of our exports, and a large part of exports also happens in various other countries across the globe. On the overall growth perspective, we see that we have had a good trajectory and we have a good roadmap ahead in terms of how we see the opportunity going forward. We just need to execute well. On the tariff front, Sharatji, if you may want to just address it.
Yeah, on the tariff front, I think situation is very, very fluid. Still, there is some exemption on computers. But even if the tariff has to come at a later date, because things are very, very dynamic in the United States, changing very rapidly, we still have skill set and cost advantages vis-a-vis things done in America. And tariff will not come on the refurbished; it will come on new as well. So the differential will remain there. US is a very high cost economy. The wage cost per hour is very high. We between India and UAE, we have significant skill set and cost advantages that we carry, and that will remain as competitive in American market. And our business is diversified across United States, Europe, other countries as well.
So you are a refurbisher of laptops and desktops and other products as well. So I wanted to understand, how is it that the exposure outside is more? What is the plan to grow an Indian market? What is the current market share, so to say, here? Who would your competitors be in the domestic market currently?
See, our export share is more because we have gone by the price taking ability. But India remains a very, very important market for us. It's the largest nation on planet and fastest growing economy, very, very vibrant population. Refurbishing is very, very important in this country. It supports e-education, it supports GDP growth. And this is one business which is good as a business, good for employment, good for inclusivity, good for economy in general, good for general employment. So we welcome, respect all the industry participants, but the other competitors that we have are limited to region or selling to a particular set of customers. We are international. We are not. We can buy in the US, refurbish in UAE and sell to Europe, or do the other way around. We can buy in India. We can buy in UAE and sell to America and Europe. So we have multi-country presence. We have no country dependence, no particular set of customer dependence.
Yes.
So we are very unique in this. We buy from long tail, we sell to long tail, so no dependence there, and good levers over there as well. Yeah.
So just follow up on that. I wanted to understand, since India continues to be such a big market, what is the market share that you have currently? Who would your peers be? Just trying to understand the business overall.
Yeah, our market share in India is around, I can say 2-3%. Market is very, very large, so we have very big headroom. Peer comparison, I mentioned we don't have any exact peer comparison. One peer comparison mentioned in our RHP. But see, the people who are selling on a particular set of customers, we are buying from long tail of customers and primarily selling to business as the ultimate customer, business and education as the ultimate customer, India and international markets.
Most of your revenues come from laptops. Are there any plans to diversify into other business lines, Mr. Pancholi? And if I could club in one more question, what is an optimal level of margins that you can face? You are still in the high single digits. Do you expect to go to double digits sometime in the near future?
So we have capabilities across the ICT product suite. So almost 70-75% are laptops. There are computers and other ICT devices that we do. But in terms of capabilities, we have phenomenal capability, and we see a huge runway in these two products as well. So long as your question on margins is concerned, I would refrain to answer anything for this at this point of time, given the situation which we are in the midst of an IPO. So,
no worries. We'll ask you more questions on future guidance and future plans once you're listed. But thank you so much for joining in today, Mr. Khandelwal and Mr. Pancholi. We'll be speaking to you when the stock lists on exchanges as well. Thanks a lot for the conversation today. Time for a short break now. We'll get you more on the markets on the other side of the short break. Stay tuned.
Further fall on the benchmark index, 130 points lower now on the Nifty, below the 25,100 mark now as the lowest point of the day. And in the midst of Persistent Systems and Coforge taking a knock, the other one that has taken a big knock today is Cigniti Technologies. Of course, it is majorly owned by Coforge, and it also reported numbers, and 8.5% knock on Cigniti Technologies as well. Among the benchmark losers, though, Nestle has now extended its losses. We saw a bit of a recovery after that management commentary coming in once the numbers were out, but now the stock is down 5% at the lowest point of the day. The top loser on the index is Nestle. The other one is Trent. And that is after the Goldman Sachs downgrade that came in earlier in the day, where they have cut their target to 5,500 from almost 7,000 earlier. So that stock is down 3%. Some of the other losers on the index, Shriram Finance, Hero MotoCorp, but not significantly, just a 1 to 2% cut that we are seeing on these names. But IEX, just before we take your leave on trading hour, now it's down 26%. The circuit has opened, and at the lowest point of the day now is IEX, still pending or sell orders pending of almost 4.5 crore sell orders that are pending, a 26% cut on IEX. But we take your leave on this edition of Trading Hour, leave you with the markets at the lowest point of the day. From Reema, me and Sonal, thank you for watching. Halftime report on the other side.
Market slips to the day's low. Midcaps drag, IT and realty lead the decline, while healthcare and auto buck the trend.
The Central Electricity Regulatory Commission approves market coupling for power exchanges in the day ahead market segment of Jan 1st, 2026, delivering a body blow to IEX. The move is expected to see business migrating to other exchanges. The stock tanks.
IT stocks fall despite a standout performance from Infosys. Even Coforge and Persistent fall due to steep valuations and some concerns on margins for the former and the deal wins for the latter.
Dr. Reddy's climbs after a sell-off in earlier sessions as sales comes in mostly in line and margins beat estimates. The company also guides for a healthy growth and margin going forward.
Nestle India's profit dips on higher depreciation and finance costs even as sales come in mostly in line. Margins dip on high commodity prices, but price stabilization and a pickup in urban growth improved the outlook.
Hello, welcome and good afternoon. You've tuned into Halftime Report coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. With me is Mangalam Malu as well as Ekta Batra as always. Good afternoon, guys, but not a great afternoon shaping up for the markets, right? We're seeing the Nifty almost near the day's lowest point. 25,000 is what it's managing to hold on to, but a lot of earning movers also coming in today, right? We're seeing Nestle that came out with its numbers, so there's some bit of that impact coming in the stock as well right now. And Nestle is among the top losers, then Trent on the back of brokerages, so we're keeping an eye on that. The broader end of the market is also not doing anything exciting.
Hi guys, yes, absolutely. Definitely disappointing, especially when there's so much enthusiasm with the trade deal in many other geographies. Maybe there is some amount of trepidation for the Indian markets at this point in time. The mid-caps are underperforming this afternoon. So we have the broader markets which are under pressure at this point in time. So maybe your little portfolios are going to feel the pain in today's trading session. A lot of stocks in focus, so that continues to be the larger theme, stock-specific action playing out. So we spoke about IEX, Persistent Systems in terms of a result reaction, Nestle just some time ago, Thyrocare, Seneris Pharma, and not to mention even Indico Remedies, which is on your screen. Margins have dipped very significantly and it's a net loss this quarter as well.
It'll be very interesting to see where the market goes from here on, Ekta. Why do I say that? Because, 25,000 is an important support for the frontline index. We have the weekly options expiry that plays out. And amidst all of this, the street was hoping for some improvement in the IT sector coming in, largely on account of Infosys numbers. But that hasn't taken place. And add to that, I'll be very interested in watching out what Nestle does as well. Because, the results were obviously understandably weak. But two things are playing out for Nestle going forward. From the management commentary, the demand is likely to improve from here on. And secondly, the costs are likely to reduce from here on. So both these factors are positive. And add to that, you have a new leader coming in as well. Manish Tiwari takes on as the CMD and the CEO of Nestle from August 1st. So typically for FMCG companies, a leadership change denotes a strategy change as well. So do we see improved performance or increased growth numbers from Nestle going forward or not is something I'll be watching out for, because the stock was already 12% off its 52-week high ahead of numbers. So we'll talk about that. And the casualty of the day has to be IEX. Opened 10% lower, that temporary freeze, thereafter went to 15% lower, thereafter 20% lower, and guess what? It's down 26% right now as we speak. 47% of its volumes coming in from day ahead market, the volumes, the trades out there. So from becoming an exchange, now essentially the company is limited to becoming a broker for power trades, and as a result of which that big decline. The other factor that comes in is that the stock is an F&O ban. So no fresh positions can be taken to be carried to the next trading session. So that also is further exacerbating the moves that we're seeing on IEX.
Absolutely. So that definitely is the big stock of the day, but you can't ignore a lot of result reactions which have been on the positive side. We in fact spoke to the management of Seneris earlier, where that stock is up around 13% reacting to its numbers. But the other one is Thyrocare, which is doing well. So the diagnostic company is buzzing trade and should come up for you. It's up around 10% at this point in time, reporting what was a strong set of numbers this time. The profit zoomed significantly year on year, and the company witnessed around a 12% growth in patients. We have Rahul Guha, who's the MD and CEO at Thyrocare, joining in to discuss the numbers gone by. Rahul, hi. Thank you very much for taking the time out. This is Ekta. Just wanted to start by discussing the pathology revenue, which is up 25% year on year. Just tell us what took place this quarter in terms of volume as well as prices, and what is your guidance going forward in terms of the sort of competitive environment that diagnostic companies have been dealing with?
Hi, good afternoon. And actually, what you're seeing is, relentless execution, I would say, over the last 8 quarters. As I've been talking about, this is a very simple business. You need to add more franchisees, add more partners, keep them happy, and the growth will come. And if you look at our track record over the last 2 years, we've been consistently adding franchisees. This year versus the same time last year, we added about 1,500 franchisees. And that's what's resulting in the growth. So there's a compounding effect, that I would say we really started on this journey about 2 years ago. And you're now starting to see the compounding effect of that buildup of franchisee addition over the last couple of years. Nothing new, I think, from this quarter. It's just, the continuous trajectory and the compounding effect that you're seeing.
Okay. Well, the compounding effect is one. Just wanted to understand the pricing scenario now. Were there any price hikes taken? If so, when was the last price hike taken by the company? And what is the possibility of price hikes going forward?
See, while, if you break down the 25%, you would say, about 15% is test volume and 11% is what, is realization. But actually, our stated position is to be the most affordable player in diagnostics. So we don't take price up that much. Actually, that 11% that you're seeing in realization is mostly from mix. Over the last year, we've added a number of specialized technologies that effectively increase our realization per test. And what you're seeing there in that 11%, I would say almost 9% of that would be mostly mix. And maybe about 1-2% would be actual real price hikes.
That exactly
our mission is to make testing affordable, and so we very rarely resort to price as a lever.
Yeah, that exactly is what we wanted to know in terms of a lever going forward as well. What proportion of your growth do you attribute going forward to volumes? And you said that 9% of the near 11-12% realization growth has been on account of mix. So what is your revenue right now that comes in from the better realization products, and how much do you intend to take that to as a proportion of your overall tests?
So I'll give you broad numbers because the exact numbers, are internal to the company and actually part of our strategy. But if you say routine and semi-specialized is roughly about half our mix, and the more higher realization is the other half. If you go back maybe 2 years ago, it would have been 1/3. 2/3, 1/3. So that's the level of mix that has moved between, let's say, the run-of-the-mill thyroids and HbA1c and lipid profile versus the more specialized coagulation, histopathology, and more advanced testing.
And what is the delta between the higher-priced half and the routine half? How much higher is the higher versus routine?
On average, the realization would be 3x. Between the routine and the semi-specialized and more specialized.
Right, Mr. Guha, good afternoon. What we also want to know is in terms of overall, what is the revenue that you're generating from preventive testing, Janch, which is the screen testing side as well, and HerCheck. What is the growth this time that you've seen in this quarter? What is the guidance that you have in terms for FY26?
So we are very famously known for preventive testing with Arogyam. Arogyam continues to be roughly about 40% of our revenue. So we are the largest preventive testing player in the country overall. Janch, as I said, is a new launch. So it's probably accounts for about 5-10% of our 5% of our overall revenue, but growing very, very fast.
Okay. And what would be that outlook of growth? What rate could we expect Janch to grow? Now, given that it's newer as well, what is the growth rate that you are anticipating and an internal target that you're watching out for?
We expect Jans to grow between 1.5 to 2x our normal growth rate. So that's typically what we expect Jans to grow faster.
Okay. So you're expecting a growth of around 1.5 to 2x for Janch. How much did Arogyam grow this quarter and how much did HerCheck grow this quarter?
HerCheck is a very, very specialized test, so I'll keep it out of the purview. Arogyam would grow in line with the company.
Okay, all right. Tell us what's happening, Rahul, with Africa. You all have ventured into Tanzania. Tell us about the expansion plan that you have. How much have you generated in terms of revenue there? And how important a piece is Africa going to be for Thyrocare?
It really depends on if you're with us for, a 5-10 year horizon or if you're with us for a 2-year horizon. If I look in the long term, Africa will be a very big pillar for Thyrocare. But in the short term, we are still understanding the market, getting our business model right, ensuring we fully understand the go-to-market. So I would say, in the next 1 to 2 years, both from an investment bandwidth as well as, revenue and profit, Tanzania will not be material. But if you take a 10-year view, I believe, Africa will be a material part of the growth of Thyrocare. But as I said, we are still learning the Africa market. It's only been little less than a year that we've been in Africa. So I think it's too early to, start to bake it into any projection.
Just as a whole for Thyrocare then, you've done around 23% of growth. You've got back to your margins of around 30-odd%. This is a two-part question. Thyrocare at one point in time used to enjoy margins of as much as 40%. What's the internal target when it comes to margins? 1. And 2, in terms of this 20% growth, are we going to see this as a standardized normal growth rate for the next couple of quarters?
Difficult to say at this point. See, normally Q1 is very soft. Very rarely does Q1 exceed Q4. But for us, actually, Q1 has been much better than Q4 as well. So we are very encouraged by the growth numbers that we are seeing. Q2 always tends to be better, but you must go back last year. And if you see the compounding effect I talked about, you started to see it, I would say, around Q2 of last year. So we are sitting on a very high base, as we move into the back half of the year. So it's too early for me to revise guidance at this point. I think, in the mid-teens to, closer to 20% is in the range. I think it's very difficult to say, whether we'll close the year beyond that. But I've always been saying that mid-teens is where we are, we would be happy. We've done very well in the first quarter and very encouraged by the growth numbers that we've seen. But let's see how the back half comes. Maybe the next time we meet after H1 behind us,
And what about the margins, Rahul? Those, historic highs that Thyrocare used to see.
See, the margins is a result of operating leverage, right? If we continue to grow at this rate, margins will definitely improve. But as I said, we are not a company that stands still. We continue to invest. We're looking for more M&A. We're looking to expand our footprints in different parts of India that we are small. So I would say, whatever operating leverage we get, the first priority will be to see where we can invest it for growth, right? So assume, the margins will be stable at this point, at this level, and we'll continue to invest to drive growth further from where it is today.
Rahul, from a stock market standpoint, the street was always curious about the future of both PharmEasy and Thyrocare. At any point in time, you are looking at expansion, you are looking at growth, etc. Is there a consideration of both of them coming together and PharmEasy listing via reverse merger with Thyrocare?
I think this has been asked multiple times. I've been candid,
which is what keeps coming to us from all the people who've invested.
Yeah. See, this is not a subject of any discussion at Thyrocare level. If at all it comes up, as I always say, Thyrocare shareholders, this will be a special resolution which will require a majority of the minority. So it's not that straightforward, that it can be a done deal. But that being said, there has been no discussion on this front, at least at Thyrocare level at all.
Okay, Rahul, thank you so much for giving us those updates over there. Not on a discussion point as of now for Thyrocare, but thanks for joining in with us, giving us those updates in terms of what we should be watching out for the company in FY26, looking at mid-teens growth for the full year. So let's keep an eye on that. But on that note, we're going to sip into a very short break, but a small programming note for our viewers as we sip into this break. As the workplace transforms, so most leaderships. In the Bangalore edition of Future Female Forward Season 3, India's top business leaders gather to reimagine what inclusive leadership looks like and how women are powering the future of work, capital and innovation. Catch it live on July 29th, 5:30 p.m. onwards, only on CNBC-TV18, CNBC-TV18.com and YouTube.
Welcome back. Well, under pressure for the markets, so the Nifty is down around 159 odd points, just about holding that 25,000 level. What's concerning is the advanced decline ratio and the gap that is there between the advanced decline ratio that should come up for you. So around just about 1,600 stocks advancing to around 2,400 stocks declining. So as you can see, the gap is only widened as the day has gone on. But let's focus on an important story and what might be the key focus for today. Prime Minister Narendra Modi has arrived in UK ahead of signing for the free trade agreement with the United Kingdom. That will take place later today. Parikshit is here. He's been tracking this story. He's here with more details on this. Parikshit, over to you.
Well, the big headline is that India will be reducing the average tariffs for UK products from 15% to 3% under the FTA. So UK products such as UK cars, Scotch whisky, cosmetics, gin, soft drinks, lamb and medical devices will get cheaper in India. UK's clean energy industry will also have unprecedented access to India's vast procurement market, and this is according to a statement by the UK Prime Minister's office. The UK insurance industry will be able to expand in India because there will be a binding investment cap in the FTA, and also there will be locked-in access for UK financial services companies. So they will benefit from certainty, transparency, and they'll be able to expand in the India market. On the India side, let me begin with marine exports. FTA will eliminate tariffs on 99% of marine exports from India, including shrimp, tuna, fish meal, and feeds. Tariffs on Indian leather and footwear will be eliminated from 16% to 0. Duties on Indian textiles to be reduced from 12% to 0. India's leather exports to UK will get preferential access over Bangladesh, Pakistan and Cambodia. Tariffs on engineering goods will be reduced from 18% to 0. Generics, they are going to benefit from zero duty access in the India market. So the Indian pharmaceutical industry, the generics market will benefit significantly, and so will gems and jewelry sectors, toys, plastics, chemicals, all of them will benefit from reduced tariff concessions and reduced barriers of entry in the United Kingdom. We will also see zero duties on 95% of agricultural and processed foods. So your exports of fruits, vegetables, cereals, pickle, spices, processed foods, ready-to-eat foods, all of that will get cheaper. But India's red lines on agriculture have been protected. So there'll be no concessions when it comes to dairy, apples, oats, edible oils in the India market, and neither wheat, rice and maize.
Okay, Parikshit, thank you so much for that important updates that we'll watch out for in terms of the India-UK FTA that will come in. But let's move on and talk about the auto sector, because we're seeing some of these names that are gaining in trade, and this is why after US has announced a trade deal with Japan and is inching forward to signing an agreement with the European Union as well. Now, how does this play out for our Indian players? We have Sudarshan joining in with us to give us details on this front. Afternoon, Sudarshan.
Good afternoon, Vinny. So some of the auto stocks and auto ancillary names are in focus because certain reports suggest that US and EU are getting closer to signing the trade agreement. And as per the trade agreement, EU exports to US tariff for that will get reduced to 15%. And as per the reports, trade agreement will also include auto cars and auto parts. Now, if that is included, it would be positive for companies like Tata Motors, Samvardhana Motherson, Sona BLW and Bharat Ford. So why it would be positive for Tata Motors? So already US and UK have already signed the agreement, and as per that agreement, tariff rate for UK exports has reduced to 10%. Now, Tata Motors has an important plant in Slovakia from where higher end of Land Rover is exported. Now, if there is an agreement within US and EU, for that also tariff will be reduced to 15%, and that would be hugely positive for Tata Motors. And remember that for Tata Motors, 33% of JLR volumes come from the US market. Now coming to Samvardhana Motherson. So it supplies to OEM plants in countries like Mexico and Germany, and that exports to the US. So indirectly, it would benefit Samvardhana Motherson also if there is an agreement. For Sona BLW, US contributions are around 43% to its total revenue. Now US President has been announcing trade agreement with so many countries, and now going forward, if we see much more trade deals, then it would be taken positively. And for Bharat Ford also, US exports form nearly 35 to 40% of its total revenue. So in the next few days, if we get to hear an agreement within US and EU, and under which trade tariff is really reduced to 15%, this would be positive for these companies.
Okay. All right. Thanks very much for that, Sudarshan. Well, just watch out for Zydus. They have received an approval, so that that stock should come up for you. It's up around 1%. Well, we need to take a short break, but here is some good news for our viewers. India's business news leader is now just a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or the Google Play Store, or just scan the QR code on your screen.
Welcome back. The Nifty just below that 25,100 mark right now is a significant downtick that we've seen as against an expectation of an up move that we would see. A bunch of stocks not doing particularly well as well. As we move towards the expiry, let's go across to Nigel, who's picking up all the trends from the F&O desk. Nigel.
Well, that's right, Mangla. If you look at it, we have seen that both the Nifty and the Nifty Bank, they're under pressure, but it's not such a big worry. The reason I say that is because there's no big open interest build up out there, and this market as it is net short. So just take a look at the open interest, not too much build up out there. Moving to the Q that you'll track very closely is the Nifty PCR. It started off today, it was at around 1.15. And in the last few sessions, it's moved from around 0.75 all the way around to around 1.15. In fact, in the initial part of trade, it went to around 1.2. Now that's cooled off to around 0.7. Normally at around 0.65, 0.7 or thereabouts is when you see a bounce. Keep in mind, today is a weekly expiry, so things will get volatile from here on. But that's a Q normally you clutch onto. The FIs remain in net short, and you have the PCR that comes down to around 0.7. The combination of the two normally indicates a bit of a bounce in the near term. So that's the important mark to track. Now the call writers, they are feeling very, very good. How does the PCR come down? When in fact there is aggressive call writing. And take a look at the open interest build-up that we have seen. The premium on the 25,200 call, 25,150 call, 25,100 call, all three of these strikes, the premium is down by around 90 to around 95%. So the call writers, they are writing these strikes very, very aggressively. And if you just add the premiums at the start of today to all of these strikes, what it points to is around 25,250 mark. That is the important mark on the upside. So all the three strikes, if you just take a look at the premium, if at around the 25,100, the premium at the start of the day was more than 100, 120 rupees or thereabouts. So there's a sharp decline that we're seeing. Going by the options data, going by the technical factors that you're looking at, well, a few numbers that you should be looking at. The 20 DMA, that's important now for the Nifty on the upside. But in the near term, going by the options data, 25,250, resistance mark out there. On the downside, going by the put writing, the 25,000 mark becomes very, very important. The Nifty Bank, well, that in fact is underperforming today, which is a bit of an issue. But for the Nifty, the 20 and the 50 DMA become the important resistance mark in the near term. So you'll have to keep an eye out on both those two. Stocks that I'm looking at, ITC, big unwinding of long positions is what we're seeing out there. So that's why that stock is lower in trade. And Coforge, the open interest build-up is massive, more than 10%. So big shorting on that one as well. Back to you guys.
Okay, all right, Nigel. Well, that's on the F&O update from our F&O desk coming to you live. But we now have Aditya Agarwal, Head of Research and Investments at Invest4Edu, joining in on the show to tell us what he's tracking today. Aditya, hi, welcome to the show. Well, it's definitely a dull day, but what's your call on the index?
Hi, good afternoon, Ekta. Thanks for having the show. My sense, it's more of a movement that we're witnessing because of the expiry today. It's more of a Thursday expiry move, weekly expiry that we're witnessing. Clearly on the downside, as Nigel was also suggesting, options data do suggest that 25,000 is a key support. And immediately, I think 25,050 is also an immediate support if you take a look at the way put writing has been taking place at both the strike prices, 25,050 and 25,000. My sense is markets will try to hold on to these support levels of 25,050 and 25,000. So for the day, 25,000 remains a very important support zone. Things might change very quickly, Ekta, if we start to trade about 25,100 mark again, because that is where we are witnessing suddenly an unwinding of open positions and then a buildup of writing as well on the call side. So if we start to trade above 25,100 throughout during the course of the day, my sense is you could witness a short covering rally again, and you might just scale back to levels of 25,150, 25,200. So I won't read too much into this correction that we're witnessing in trade today. More of an expiry day kind of a move.
All right, Aditya, we request you to hold on to your thoughts. We'll come back to you. There's breaking news. So we have Manoj Kumar Jawar, who's the Chairman and Managing Director at PTC India, joining us on the phone line. This is on the important news that has IEX lower. The CERC speaking about market coupling in a phased manner. Thanks a lot, Mr. Jawar, for joining in. Your initial reaction on this, your belief around, why do you think this makes sense according to you? And what's your rationale? And what would your steps from here on be for here?
Number one, it is a very good development because you see in the collective segment, there was practically no competition. Now all the three exchanges would have an equal shot and equal opportunity to serve the customers. So whoever is able to serve the customers better would be able to grab the market share. Currently, all the volumes were concentrated in the incumbent exchange, which was IEX. Last year, I think around 61 billion units were traded in the DEM segment in the IEX. Now, if a fair share is captured by other exchanges, so I believe it will be good for the market, good for the constituents, and good for the people whom the exchange is serving.
Mr. Jawar, thank you so much for joining us. Vivek joining in from the research desk as well. Sir, a couple of questions. Sir, currently, what is the total quantum of your ownership in HPX? We believe that you're one of the majority holders there. Number two, what is the current market share, especially in the day-ahead market, where there is going to be immediate implementation as early as January 2026? What is the current market share that you enjoy over there? And by the end of the year, what will be the market share that you will be able to take, given the fact that right now IEX enjoys dominant position?
Yeah, so number one, we own around 22% in the IEX. We collectively own a majority holding in the IEX along with the Bombay Stock Exchange and the ICICI Bank. So our holding is around 22%. That is number one. Number two, currently practically all the volume in the collective segment, which is the DEM and RTM put together, is being served by IEX. Almost more than 99%. There are good reasons for that, that if a new buyer or new seller is coming to the market, he would like to go where the liquidity is. Since there was no market coupling, no one was able to place any bid on any other exchange, even if he wanted to. So we believe that given the chance of coupling, now exchanges would have to compete on services. And on that, I think we being a very, very new and advanced technology platform, we will be able to get a good market share.
Okay. Mr. Jawar, I believe you said you have ownership in HPX, right? That is the quick correction that I wanted to confirm with you.
Yeah, HPX,
right.
HPX, that is what I said.
Yeah. So the other question that we have is, the current transaction charges at IEX are close to 4 paise per unit. In fact, it is amongst the highest as far as, global power exchanges are concerned. What are the transaction charges you are actually, going ahead and charging your customers? And do you see scope to bring it down further? We believe that will actually help shift away volumes from IEX. And, going forward, do you feel that there can be a 33% market share each across all of the three exchanges?
Yeah, I believe the exchange which is able to provide services would be able to win the market share. That is number one. And definitely the service charges would be one variable in this equation. We will see what kind of benefits we can pass on to the customers, whether that can be loyalty-based, whether that can be transaction-based, whether that can be volume-based. That has to be seen. A strategy would have to be evolved. But definitely this competition would be good for the customers, good for the market.
Good for customers in the market, Mr. Jawar. But what we want to understand is, in the current infrastructure that there is, do you think competition would be able to provide the service that IEX is doing? And because IEX will be worried about, their market share going to the others, they would not focus as much on the service as well. So do you think incentivizing one player would have been good for service as against giving it to everyone, and as a result of which maybe customers not benefiting despite the intentions being the same?
You see, monopoly has never been good. It can never be good for the services, can never be good for the customers. If a monopoly, even if not dictated by law, but because of the reality of the situation, if all the volume is concentrated in one exchange, then you can understand that is the human behavior. So I believe competition is good, and since this market coupling provides a fair chance to compete on services, so I think customers will be benefited. There is no doubt about that.
Mr. Jawar, the other important question, just taking a cue from what Mangalam asked you. Number one, do you have the necessary technology in place to actually go ahead and allow for the price discovery process? Currently, majority of the volumes are at IEX, so we believe it's happening over there. So by Jan 2026, will that be on board for you? Or in case you don't, would you be taking the price discovery process, or would that shift to Grid India?
No. Absolutely, we are absolutely capable of. HPX is absolutely capable of discovering a price in a collected market, and this market, a coupled market also. So I see absolutely no challenge on that. Our platform in the HPX is quite capable of handling anything which is required of it to be done.
So, from the point of view of PTC India, where do you believe, the revenues of this particular exchange will scale up to as part of your overall consolidated financials? And typically we understand margins over here are quite high. So consolidated basis at the end of FY27, if you could quantify it for us, what kind of contribution you could see?
You see, we have to see that question examine that question from two angles. Number one, what were the current margins and the current revenue in the collective segment in the exchanges? So if I say that DAM volumes were around 61 billion units, so that roughly translates at the rate of 4 paise per unit into 240 crore rupees. Now, if I say that all the three exchanges are equipoised to garner the market share, that again would become a sizable chunk, let us say around 80 crore or so. So that would be based on what the market size currently is. And secondly, currently HPX was able to contribute only 10 crore rupees to me as total profit. So this would be a huge jump for the PTC consolidated financials. But that remains to be seen as to how much market share this HPX is able to gain. Second thing I would like to highlight that still, although we are trading around 240 billion units or so in all segments put together in short-term markets, but there is a potential to grow the trade and the market itself in the exchanges. So I think a major growth has to come from that. And I think all the three exchanges can survive.
Understood that, sir. Mr. Jawar, so you actually mentioned that out of the 240 crore, you did a quick division by 3 coming to the 80 crore. At this point of time, you've not really accounted for any transaction cost reduction. That is number one. We take your point on board saying that volumes have been growing on the short-term market itself. So we do see that particular probability play out. But realistically, within the first couple of years, do you actually see an 8x jump in the contribution as far as revenues are concerned from HPX?
A lot of work is required to be done. I mean, being able to transact is one thing, but reaching out to the customers and making them understand the benefits of this HPX platform is a task. Of course, we have been in touch and we have pan-India relationships with almost all the utilities and all the generators. So I think it's a reasonable assumption that we'll be able to get a significant market share.
Sir, a couple of quick questions. In terms of operations, suppose there are a buyer and a seller. A buyer at IX, will he be able to sell the same product or the same units on another platform? Is that essentially what market coupling is? And number two, the CRC circular also talks about coupling coming about as far as the RTM market is concerned. So what is the kind of opportunity that you see over there?
You see, the second question first, currently this DAM segment is around 61 billion units and the RTM segment, if I remember correctly, would be around 35 billion units. So that is also an important market and that can also happen in due course of time whenever coupling is allowed on that. There is a roadmap and I need to see how things evolve. So that is the second thing. What was your first question?
What kind of volumes are you expecting, Mr. Jawar, in the first year, as soon as this happens for you?
I mean, it would be reasonable for me to believe that if everyone is competing for the same space and if his services are kind of competitive, then this market would be equipoised and might be divided equally. That would be my starting belief, but then we would like to differentiate ourselves by better connect with customers and better services.
So what market share are you targeting? Ideal scenario would be 1/3, 1/3, 1/3. But what is it that you're targeting realistically?
I would not call that ideal scenario, but I would call it a reasonable scenario. Ideally, I would like to gather as much as possible.
But no, realistically speaking, what kind of volumes do you think you can get? Or what kind of share do you think you can get initially as things ramp up?
You see, I'm reasonably confident that this exchange, if it plays its cards right, it should be able to get at least 1/3 share.
By when? By when?
Let us say 1.5 years, maximum 2 years.
Okay, all right, Mr. Jawar, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's PTC India talking to us. They do own 22% in HPX, and that's the reason they would benefit. And they are saying that it would definitely help them in terms of market coupling. But the market share and how much they gain Jan 2026 onwards will be something that they'll need to see, which will eventually go into the consolidated profits of PTC India. As you can see, the stock is up around 4.6%. We'll take a break now, but a reminder for our viewers, unlock a world of exclusivity, expertise and influence. Become a member of CNBC TV18 Access, our premium members-only experience on CNBC-TV18.com. The membership includes access to CNBC TV18's flagship events, interaction with our journalists along with curated studio tours, e-learning sessions and masterclasses, and curated lifestyle benefits.
Welcome back to Halftime Report on CNBC TV18. As of now, the Nifty continues to see a decline of 0.5% in the trading session. But let's shift focus and talk about some of the earnings that have been reported. We have Supreme Petrochem, which is the next management that is joining in with us, and they reported a weak set of numbers this time. We saw a slip in terms of profit of 34% on a year-on-year basis. We have the ED at Supreme Petrochem, Mr. Rakesh Nair, joining in with us to talk to us about the numbers as well as the outlook of the company going forward. Mr. Nair, thank you so much for joining in with us. What we want to understand and what we want to start by talking about is in terms of the volumes of the company. What were the volumes this quarter? Was there any pricing pressure that you've seen during the quarter as well? And what are we watching out for now?
Good afternoon. We had almost the flat volumes as we had in the previous year. Only a marginal increase of 0.5% was there. But then the growth was not there. It was actually the domestic market was down for us because of the lower lifting by the OEMs. Because of the undue seasonal rains, all the cooling appliances sales were down, like refrigerators and air conditioners, and that's the reason. The lifting by the AC manufacturers was not there. Even in the non-OEM segment, the pickup was not great as compared to the previous years. So the growth was muted this year. As far as the pricing pressure is concerned, yes, the raw material prices, they fell down as I informed you earlier in my April interaction. From March to April, third week of April, there was a drop in prices of styrene monomer. And so that also reflected here in terms of our selling prices. So these were the two reasons mainly that the numbers were impacted.
Okay. Mr. Nair, welcome to the show. You met your guidance of around 3.5 lakh tons of volumes in FY25. What are you guiding for in FY26?
We hope to do almost around 12% more than the previous year, the total volumes. This current was the last quarter gone by was the flat. This is generally a lean period. The second quarter is generally a lean period. But we hope that with the crop doing well and the rains are also good, so the liftings would improve from September onwards. They should do well, and we hope to do almost close to 12% volume growth this year.
All right, 12% volume growth. What about the ABS project, which commercializes in the second quarter? What kind of ramp-up revenue are you expecting in this year and contribution next year?
This will be the first year of our entry into ABS. And already the startup activities have started, and we hope to start the production towards maybe sometimes in August it will happen. The collaborators team is also around here, and the process is on now. So we would be first testing the material at all the processors end also. So I think this year we would be only utilizing at the installed capacity 70,000. Maybe we would be for a 6 months period, it will be 35, and we would be doing something around say 50 to 60% of that this year.
That equate in terms of revenue at optimal utilization?
On a full capacity basis, full utilization basis, the asset turnover ratio works out almost 2. And for the current year's turnover of around 17,000 or so, this will add to maybe around 250 crores or so to the turnover.
Right. So, also just want to understand in terms of your value-added segment, how much does that contribute to the company? Because I believe in FY25, you had highlighted that, the volume growth overall in FY25 was around 8 to 10% that you were expecting. And that time you had mentioned the value-added product contributed around 35 to 40%. Is there an increase there, or could we expect this number going higher in FY26?
Yes, now when the ABS production starts, the value-added products will grow. But in the current quarter also, our value-added products were around 36% only.
Okay. Mr. Nair, you fleetingly mentioned your raw material styrene monomer prices, which have been largely stable in Q1. Tell us about what Q2 was in terms of pricing, or is in terms of pricing, and what is the guidance that you have when it comes to this raw material?
See, the styrene prices in the FY25 were generally closer to $1,100 during this period in the first half of the year. And then they started going down, and the drop came in from the mid-March to April end or so, the drop came by. And after that, the styrene prices have been holding on to around $950, $940. It is holding on right now. And we expect that if nothing else changes in the global scenario, this will continue.
So when you say nothing else changes in the global scenario, tell us what you're expecting or what is that risk that you're envisaging?
The crude prices, the trade flows, the China and US, the trade agreements, all those issues are still hanging open in the global economies right now.
Has that had a bearing? Has that had a bearing on your exports business? What is your current proportion right now?
We did good exports in the last quarter, and we hope to continue doing good exports in this quarter also. But going forward, if the kind of trade flows, if the China stops buying, China's exports go down, so naturally the trade flows changes. The other markets where we are exporting, maybe the other competition will also come in there. So it's difficult to say at the moment.
Can you be a little more specific? What proportion comes in from exports and what are you expecting that to grow at?
See, last year's revenue around 10-11% was from exports. And we expect that the same number would be there this year as well.
Okay, so 10-11% is what you're expecting from the exports going forward as well. So that will be something that we'll be watching out for. And margins over there, what is the margins that you get on exports? Is there something different, better margins there?
No. Currently, the margins there are lower than the domestic margins.
Okay. Just quickly on your guidance, which you are, envisaging in terms of volumes, I'm assuming you're going towards that 4 lakh ton mark for FY26.
That's right.
Again, what would probably be the key risk factor to this particular guidance? Would it just be the global scenario?
As of now, yes, only the global scenario.
Okay. All right. All right, Mr. Nair, we're going to leave it on that note. Thanks very much for joining in and speaking with us. That's Supreme Petrochem talking about their numbers, guiding for around 4 lakh tons in terms of volumes for FY26, or just about those levels. Well, we need to wrap up on the show with the news that the markets are weak at this point, so there's no further deceleration which has taken place, but the mid-cap index is underperforming, down around 0.6%. The Nifty actually has caught up with a cut of around 150 odd points, so 25,071 is where the Nifty is holding at this point in time. We'll wrap up on Halftime Report. Business Lunch up next.
Market slips to the day's low, mid-caps drag, IT and realty lead the decline while healthcare and auto buck the trend. The CERC approves market coupling for power exchanges in the day-ahead market segment from Jan 1, 2026, delivering a body blow to IEX. The move is expected to see business migrating to other exchanges, the stock tanks.
IT stocks have declined despite a standout performance from Infosys, even as Coforge and Persistent Systems fall due to steep valuations and some concerns on margins for the former and deal wins for the latter.
Dr. Reddy's climbs after a sell-off in earlier sessions as sales come in mostly in line and margins beat estimates. The company also guides for healthy growth and margins going forward.
And Prime Minister Narendra Modi and UK PM Keir Starmer are set to sign a free trade agreement between the two countries. Under the agreement, India will cut average tariffs for UK goods to 3% from 15% earlier. A typical expiry session playing out, and we are entering the final 150 minutes of the trading session. You're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Hormus Fatakia. With me as always is Vamakshi Dhoria. Well, Vamakshi, firstly, good afternoon. You'll be losing count of the number of earnings that are anticipated as the day goes by. We've already had a couple of them coming in with Nestle and Indoco, but there is a huge list that's lined up, be it Bajaj Finance and a lot of other broader market names.
Well, absolutely, Hormas. After the session we had yesterday, the bulls would have hoped for a session in the green, but clearly not playing out. Since the get-go, we've languished in trade. In fact, the Nifty is trading with a cut of almost 200 points as far as the day's high is concerned. It continues to be under pressure. The broader markets too not doing too well. When we take a look at the advanced decline ratio, it is largely in favor of the declines. It's almost 1:2 as far as the advanced decline ratio is concerned. The mid-cap end of the market reflecting that, down almost 0.7%. But largely, like you pointed out, Hormas, it's been an earnings-heavy market. Whatever big moves we're seeing on, in the broader markets is largely being driven by numbers. Take a look at Persistent Systems. That stock is down almost 7%. Indoco Remedies on the flip side is doing quite well, up almost 6% in today's trading session. On the other hand, when we take a look at some of the stocks, can't take our eyes off IEX. That stock has tanked in today's trading session, and how PTC India on the other hand doing quite well. But Hormas, any other stocks that you would like to add?
You're just mentioning IEX. We'll just get Vivek with a more deeper dive on this, but we just heard from the management of PTC India, and they mentioned that HPX, where they hold a 22% stake, they are very confident that within the next 18 to 24 months they will have a 33% market share. They're expecting it to be a three-way race now in this market coupling thing. But just as you were highlighting, Vamakshi, it's all numbers driven. And take a look at these names that I just highlighted before we get to the deeper dive on this. Force Motors is one of them, 14% higher at a record high today. Senors Pharma, 11.5% higher. Thyrocare, 10.5% higher. All of them are result reactions. So good numbers are getting rewarded, the bad numbers are getting punished. The not so good numbers, you can't necessarily call them bad, but of course the not so good numbers in the IT sector, from Persistent to Coforge to Infosys, all of them were expecting a good reaction to it, but it has been the opposite of that. Rima is joining in with more, with a deep dive on this. Rima.
Indeed, on the growth front, Infosys, Coforge, Persistent all did very well. Infi was at 2.6%, Coforge was a stellar 8%, but the stocks are correcting. So let's quickly run you through a couple of reasons why. One for Infosys, beginning with that. The upper end of the revenue guidance, which is 3%, has remained unchanged. But now the upper end also includes an acquisition of 40 basis points, which means the organic guidance has been cut by 40 basis points at the upper end. So that could explain the disappointment. For Coforge, analysts are pointing out that the EBIT margin shared by the company at 13.2% has certain one-offs. So for instance, a bonus cost, the forex element. If you strip that out, the adjusted margins would be a lot lower. Secondly, even this capex spend, the company has spent more than $60 million to set up an AI data center for its clients. Now, data centers, up until now, IT companies have never invested in capex. They've always been an asset-light model. But now with this investment, it becomes capex heavy. And it's not easy. There are costs associated with maintaining that. And therefore, analysts are a tad bit worried. And thirdly, let's come to Persistent then. Now, Persistent's revenue growth, you could quibble, was a little short of expectations. 3.3% versus 3.8% expectation. The company has deferred the wage hike by 1 quarter, which means there are concerns, in the mind of the management, perhaps. There is uncertainty. And finally, the deal wins, you can call them steady, or you could, on the other hand, say it's unexciting because they've not increased on a quarter-on-quarter basis. And finally, for companies like Coforge, Persistent, they've been such darlings of the IT cap. The valuations are on the higher side. These stocks are trading at about 30, 35, 40 times PE. So that also, makes it difficult for the stocks at this juncture. Back to you.
Well, thanks so much for that, Reema. That was a good roundup of all the earnings we've seen so far. But we also spoke to the management of Persistent Systems as well as Coforge. Let's listen in to what they had to say.
We want to be a $2 billion company aspirationally. Again, this is not a guidance. By FY27, we want to be at $2 billion. Now, if you do the maths, we have to compound from an yearly compounded annual growth rate at about 19%. It will definitely have some amount of M&A, the acquisition part. Now, depending on the size of the acquisition, we may get there faster. We may have smaller acquisition, bigger acquisition. And to that point, look, at any point in time, we are evaluating multiple different options. We have said our acquisition strategy is twofold. One, Europe as a geography, we are currently at a 8.5 to 9% revenue clip. We have grown Europe at the company pace for the last several years, but we want to take a step change in Europe. We want to grow Europe over the next several years to 15% of our revenue. And that is basically to balance our revenue profile. And also, as we grow bigger, it's a healthy mix to have. Second part, we have said we want to be very well known for what we have always done better, the technology capabilities.
The EBIT is going to hit 14% for the current fiscal. And our business, our firm has always seen a sequential increase in EBIT in margins across the quarters. This is quarter one. We've landed at 13.2% despite very strong growth off the back of the ramp up of the Sabre large deal that we talked about. We feel extremely confident that the EBIT number that we will deliver in the current fiscal is going to be 14%. So from our vantage, 5 large deals, a next 12 months signed order book that is almost 47% higher than where it was at the same time last year. EBIT margins profile which should improve very significantly this year. H2 in turn again should be materially better than H1. So the year from a revenue growth perspective and from a margin improvement perspective seems to be turning out to be an exceptional year.
That was a roundup of the IT earnings, and Persistent and Coforge, both of them continue to sulk in today's trading session. But of course, the big accident of the day has been IEX, and it started off on a 10% lower circuit, and the circuit has only intensified from 15 to 20, and now the stock is down 26% as we speak. And this is after the CERC approved the implementation of the market coupling norms, which was a major overhang for the stock. Vivek is now here with a complete breakdown of what has transpired, what are the implications for IEX, and what does the shareholding look like for the company. Vivek.
Well, thank you so much for that. An all-round comprehensive, analysis as far as this entire development is concerned. Remember, the CERC approved market coupling for the day-ahead market. The implications for exchanges as well as some of the key stakeholders. Remember, the Central Electricity Regulatory Commission has given the green light for the implementation of market coupling in the day-ahead market. So the spotlight will be on several key listed players that stand to be directly or indirectly impacted by this particular development. Of course, IEX with near 100% market share in both the day-ahead market and real-time market, it is expected to see a shift as far as the competitive dynamics are concerned, and also stands to lose market share. Dalmia Bharat, remember, holds close to 11% stake in IEX and could witness a valuation impact depending on IEX performance post the implementation. And along with that, PTC India will be a beneficiary given the fact that it owns a stake in HPX, that is Hindustan Power Exchange, which is a rival platform that stands to gain market share in a coupled regime. What do brokerages say? Remember, UBS termed the CERC's nod for market coupling as a negative surprise. It noted that while only DAM is being coupled in phase 1, the real-time market coupling contributed close to 30% to IEX FY25 revenue. So a total of 80% of the revenue of IEX will be impacted. Now, when you're talking about Bernstein, it has maintained a market perform rating on IEX. However, it has reduced the target price quite drastically to 122 rupees a share. Bernstein points out that the order is worse and quite different from what was earlier expected. It anticipates competitive pressure to reduce transaction charges, affecting IEX margins adversely. According to Bernstein, DAM contributes for 46% of IEX volumes, RTM 40%, and the TAM 14%, reinforcing the significance of the DAM segment for the exchange's overall business model. Looking at the quick shareholding, remember, IEX has strong institutional holding as far as the shareholding pattern is concerned. SBI mutual funds through various schemes hold over 9.5%. Parag Parikh mutual funds holds close to 5%. ICICI Prudential mutual funds through various schemes again holds close to 4.7%. And Mirai Asset holds close to 2.3%. LIC holds around 4%. Retail interest in IEX2 is quite high. It has remained stable, though, on a sequential basis. March 2025, there was close to 28% shareholding of retail. In June 2025, it was close to 29.5%. Now, the outlook towards a post-coupling environment pose a significant risk to a dominant platform like IEX.
Well, thanks so much for that, Vivek. Earlier, in fact, we also spoke to Nikhil Negania, who's the director as well as the senior analyst Bernstein, to understand the impact of the rollout of market coupling in a phased manner. Let's also listen into that.
The impact, we think, will be twofold. Number one, the impact will be on loss of market share. So on the day-ahead market, about 45-46% volume for IEX day-ahead market. Where if you look at global peers, in UK, we saw coupling impact the largest player losing market share from 80% to 60% post-coupling. In India also, in our estimates, what we are building in, we are cutting IEX market share in the day-ahead market from 100% to 60%, but that's over a period of 3-4 years. And second impact, which I think will be equally big, is transaction charge. And now with coupling, we think the only thing exchanges will have to compete against other is transaction charge. And they will start giving discounts to larger players, larger buyers or sellers on the exchange, which could bring the transaction charge down from 4 paisa to 3 paisa or even lower possibly over time.
IEX has now just extended its losses. Now 28% lower is where the stock currently stands, and below the mark of 130. Currently, and Bernstein had cut its price target down to 122, the stock already at 135. Now, the Enforcement Directorate is conducting search operations at multiple locations in Delhi and Mumbai linked to Anil Ambani group companies in connection with a money laundering investigation. Now, the ED sources told CNBC-TV18 that the raids are linked to a money laundering probe being conducted against companies of the Anil Ambani group. The agency is examining allegations of diversion and siphoning off of public money, allegedly around 3,000 crore rupees, and was illegally diverted from Yes Bank between 2017 and 2019. SEBI is also learned to have shared its findings with the ED as part of the ongoing investigation. CNBC-TV18 has reached out to the company as well, and we await comments on this matter.
Well, thanks so much for that update, Holmas. But let's listen to a very short break. Up next, on the other side, we get you the latest on the India-UK Free Trade Agreement. So don't go anywhere. Welcome back. You're watching Business Lunch on CNBC TV18. Well, Prime Minister Narendra Modi has arrived in the UK ahead of signing the free trade agreement with the United Kingdom. That will take place later today. My colleague Parikshit is joining us with more details. Parikshit?
Well, the big headline is that India will be reducing the average tariffs for UK products from 15% to 3% under the FTA. So UK products such as UK cars, Scotch whisky, cosmetics, gin, soft drinks, lamb and medical devices will get cheaper in India. UK's clean energy industry will also have unprecedented access to India's vast procurement market. And this is according to a statement by the UK Prime Minister's office. The UK insurance industry will be able to expand in India because there will be a binding investment cap in the FTA, and also there will be locked-in access for UK financial services companies. So they will benefit from certainty, transparency, and they'll be able to expand in the India market. On the India side, let me begin with marine exports. FTA will eliminate tariffs on 99% of marine exports from India, including shrimp, tuna, fish meal and feeds. Tariffs on Indian leather and footwear will be eliminated from 16% to 0. Duties on Indian textiles to be reduced from 12% to 0. India's leather exports to UK will get preferential access over Bangladesh, Pakistan and Cambodia. Tariffs on engineering goods will be reduced from 18% to 0. Generics, they are going to benefit from zero duty access in the India market. So the Indian pharmaceutical industry, the generics market will benefit significantly, and so will gems and jewelry sectors, toys, plastics, chemicals, all of them will benefit from reduced tariff concessions and reduced barriers of entry in the United Kingdom. We will also see zero duties on 95% of agricultural and processed foods. So your exports of fruits, vegetables, cereals, pickle, spices, processed foods, ready-to-eat foods, all of that will get cheaper. But India's red lines on agriculture have been protected. So there'll be no concessions when it comes to dairy, apples, oats, edible oils in the India market, and neither wheat, rice and maize.
Parikshit, thanks a lot for that update. Numbers from Canara Bank at the bottom of your screen, a decline in its net interest income, an uptick in net profit. We'd be able to check whether that is due to a higher other income component as well. So the stock, though, has seen a spike to the highs of the day now after the results announcement. So it'll be interesting to see how the asset quality picture has shaped up during the quarter. We'll get you more details on this in just a bit. But shifting focus then, the United States and European officials signaled progress in tariff talks on Wednesday after US President Donald Trump announced a pact with Japan, and China said its vice premier would attend bilateral negotiations next week. Take a listen.
Just made a deal with the European Union where they're going to pay the United States of America 100% of the cost of all military equipment. They're going to ship it to the European Union and then they'll distribute it, and much of it will go to Ukraine. It's been a long time since you've heard those words, because we're in for $350 billion, but now we send it to Europe and Europe pays, and we're in the process of completing our deal with China. And as you know, the UK, we made a deal. It was a very good deal for everybody. Everybody's happy. It's always nice when everybody can be happy. But mostly we'll be charging straight tariffs to most of the rest of the world, because we have over 200 countries. People don't realize that's a lot of deals. Even if you're like me, a deal junkie, that's a lot of deals. That would be too much for anybody. Ooh. And we're making deals with various Asian countries that need it. And it's actually hard to believe, you don't think of it, but Asia is very close to Alaska, relatively speaking. It's not the closest, but it is pretty much the closest when it comes to oil and gas and energy. And we're making some incredible deals.
Well, that was President Trump talking about the trade deals, but we're still hoping for a trade deal with India soon. We'll have to wait for more clarity on that. But let's slip into a short break then. But as we do that, a quick reminder for our viewers, it is time to recognize the champions. Get ready for an evening that honors India's most promising SMEs, the champions behind our nation's remarkable progress. From groundbreaking innovation to grassroots impact, these businesses have powered growth, inspired change, and redefined ambition. HSBC presents CNBC-TV18 SME Champion Awards Season 2, India's most coveted SME
Awards platform is all set to finally announce the winners on 25th of July, 3 p.m. onwards.
Welcome back. Bringing you the latest on the Google versus CCI front. Google has moved Supreme Court against the CCI directions on Play Store billing policy. Ashmit is here with more details on this. Ashmit.
Well, this has been a long-standing dispute between Google as well as the Competition Commission. The CCI order, if you remember, had come out with very stern findings against Google, saying that there's been an abuse of dominant position with respect to the Play Store, with respect to Android, and with respect to its in-app billing system. That's something that's at the heart of this entire dispute. What is also relevant is that while Google is directly challenging this before the Supreme Court, the startup community will also be watching this very carefully, because the core concern that had been raised and that was upheld by the NCLAT is that Google was in fact abusing its dominant position with Play Store for asking for imposing conditions on app developers to use the Google billing system for their in-app purchases. This is something that the CCI took objection to, that was upheld by the NCLAT, and now In challenge to that, Google has come before the Supreme Court. Bear in mind, they were looking at a penalty of 936 crore rupees at the hands of CCI. That was watered down to 200 odd crore rupees by the NCLAT. So that issue of the penalty component and the implications with respect to what the fallout for Google's policies, for payment systems, for Play Store could be, for that particular issue, Google now knocking on the doors of the Supreme Court.
Well, thanks so much for that, Ashmit. But moving on, global payments platform PayPal has partnered with India's UPI as part of its new offering, PayPal World, which will link global payment systems and digital wallets. Earlier, we spoke to Alex Chris, the CEO of PayPal, to know more about the company's India partnership. Let's listen in.
India is an essential geography for us, right? This is a country that is moving rapidly into digital commerce. There is vast acceptance of digital wallets. And, I will say, even after we made our announcement earlier today, the number of inbound requests that I had from consumers just thanking me for including UPI, because there's so much commerce cross-border between different geographies around the world into India and out of India. I think this was one of the biggest and most important partners we could have, and I'm thrilled that UPI is a founding partner of PayPal World. I think with the PayPal World offering, we may see significant adoption of the services that we continue to offer. As you mentioned, we've got cross-border capabilities that our customers are loving, and we are continuing to see that business grow. So, India is a very important market for us, and one that we will continue to invest in, and we'll do it with partners that matter, just like UPI.
A slew of earnings have come out over the last couple of minutes. Just pull up them up one by one. Canara Bank, we just addressed these numbers a few minutes ago, and the stock has now surged to the highest point of the day. It gained as much as 4% after the results were out. So Canara Bank is one of them. Asset quality has improved over there on a sequential basis. Indian Bank is the other one. That too has seen a spike after the results announcement. There you can see 2.5% higher on Indian Bank. Motilal Oswal is the other one. Numbers just came out a few minutes ago, and you see if there is any reaction in that stock as well for Motilal Oswal. Choppy moves so far. And V-Mart Retail is the other one. The numbers just came out. All of those numbers will just be flashed at the bottom of your screens. So stay tuned. And V-Mart Retail was the stock. There you can see an 11% jump there on V-Mart Retail. So slew of earnings. We'll keep you posted on right here in all of those numbers that come out. But with that, it's a wrap on this edition of Business Lunch. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, is Vivek Iyer. Low for the markets, actually. It's below the 25,100 mark. And this has exaggerated or aggravated, in the last couple of hours itself. Big pressure coming in across the board, be it Nifty Bank, be it Nifty Midcaps, all of them. In fact, Midcaps are falling in line with the benchmarks right now, which was not the case before.
That's right. So it's an underperformance all across. All of the indices are trading in the red. All of the indices trading with steep cuts, and the cuts have actually intensified in the last half hour or so. We have a lot lined up on the show, some key management interactions. So let's start off with the top headlines. Markets marginally off day's low. IT and realty lead the decline, while healthcare and autos buck the trend. Midcaps trade in line.
Midcap IT leaders slump following first quarter numbers. Coforge reports a miss on margin expectations. Persistent systems revenue growth and deal wins disappoint.
Shares of IEX slump in trade as the Central Electricity Regulatory Commission approves market coupling in the day-ahead market in a phased manner. PTC India, promoter of one of IEX's competitors, tells CNBC-TV18 that the announcement will be good for market and HPX will be able to gain market share.
Mahanagar Gas, the stock is under pressure for the second straight day post the quarter one numbers. Management points to moderate volume guidance. They expect high single-digit growth in volumes in FY26.
Natco Pharma makes a cash offer to buy out minority shareholder stake in South Africa's Adcock Ingram Holdings for approximately 2,000 crore rupees. The transaction aims to give the Indian generic drug maker a significant strategic footprint into South Africa.
All right, those are the top headlines. We've been talking about how mid-caps have been underperforming, and for the larger part of the day, they have been underperforming at the day's low currently. A lot of stocks reacting to earnings as well. We had Indoco Remedies, then we just got Indian Bank and Canara Bank's numbers as well. We'll discuss them in greater detail, but it's a lot about overall markets, really. Everything reacting to new. Look at that, Indian Bank, actually, it spiked to the day's high, 2.5% there. So is the case with Canara Bank.
And V-Mart Retail, you just saw that spiked up almost 10%. But these stocks and a whole host of other stocks is what Hormaz has. This is our special segment, Midcap Movers. Hormaz is standing by the wall to take us through the midcaps moving around in the session.
You know, it's an earnings heavy day when you get 10 numbers in 10 minutes. And that was a very quick delivery as well, if you could call it that. We'll start off with some positive earnings reactions as we speak, since there have been a lot of reactions. Sensex Pharma is one of them. Look at Force Motors at a record high now, 15% higher on that stock. Remember, we addressed this in our midcap microscope segment in March of this year. Thyrocare 2 is up 11% and PNB Gills surging 9% to the after its results that came out yesterday. But there are a lot of negative earnings reactions as well, mostly dominated by two names, Persistent Systems and Coforge, and as a result of which Signity Technologies too has taken a bit of a knock here, 8% lower on that stock as well, and DAM Capital at one point was down 9%, has recovered slightly from the lows but still trading 5.5% lower. The newsmakers of the day, of course, can't not talk about IEX, 28% lower now on that stock, and in the flip side, PTC India, which owns a stake in IEX's rival HPX, is now trading with gains of around 4.5%, and MGL, after a marginal cut to its guidance, has now taken a bit of a knock today, 4.5% lower. Stocks that are bucking the trend today on the back of very strong volumes. Take a look at Vijaya Diagnostics, 7% higher on that stock. Take a look at Gravita, Ipca Labs, and see the spike in Electra Greentech in just a few minutes on very strong volumes, 11.5% higher on that stock as well. And lastly, stocks that are at a 52-week high in today's session. Paytm continues to grow from strength to strength, 3.5% higher today as well. KIMS is one of them. Tilak Nagar Industries, after the confirmation of the CNBC-TV18 news break, 6% higher, and Datamatics too, up 10% yesterday, adding another 10% in today's session. Back to you guys.
All right. Okay. So a couple of those interesting names there. And of course, we'll keep tracking and analyzing that market coupling news that has come by, the impact on IEX, what happens with the other competitors as well. But there's one stock which is on our focus or on our radar today. That's Jaiswal Neco. Nigel is joining us now to give us the analysis. Nigel.
Well, that's right. Jaiswal Neco, that's the one that we're focusing on, and it's buzzing on rather very, very large volumes. So just thought we'll explain a few factors about it. Now, there is an ARC that has a large part of shares in the company. The total number of shares are around 25 crore. And if you look at the action in the last 10 days or so, they've been gradually reducing their stake. I just looked at the kind of volumes that you've seen today. It's massive. The total number of volumes that have got, got traded is very, very large. And that if you look at the delivery-based buying as well, that's close to delivery-based action is close to around 40%. Just keep in mind, besides the ARC that has a very large holding in the company, the total promoter holding is close to around 55%. And most of it is pledged as well. So just keep that in mind before we move forward. But, to come to the next point with regard to Jaiswal Neco, their operational performance actually has been steadily improving as well. So if you just look at the total EBITDA number, that's been gradually improving. If you look at the margins as well, from around 10-11% or thereabouts, it's moved to around 20%. Even the absolute numbers have improved. How has this happened? Well, all their iron ore requirement comes in from captive sources. They've gone ahead, they've upgraded the system out there. Their blast furnace capacity itself has got upgraded. And also because of the modernization that they have done, all this is contributing to margins moving up. And if you look at the EBITDA contribution on a quarterly run rate, from roughly around 300 crores approximately, from around 120, 130 crores, it's moved to close to around 300 crores approximately. So very quickly, just to look at the debt number, that's come down as well. The interest cost as well has come down. So it's not just the EBITDA improvement, it's the interest cost reduction as well that is heartening out there. They did close to around 1,000 crores of EBITDA. Let's see whether or not they can do better. But just wanted to highlight this. It appears that ARC selling is gradually moving out of the way. Back to you.
Thank you so much, Nigel, for joining us and giving us a sense of what exactly is transpiring as far as Jaiswal Neco is concerned. But we have a very important conversation lined up. Harish Saran, the MD of Hindustan Power Exchange, joins us now. Thank you so much, Mr. Saran, for joining us. First up, we want your initial reaction as to how exactly, now since the order of market coupling has come, what is the current market share you enjoy in the day-ahead market? What is the kind of market share that you aspire to be? We also had one of the promoters, PT's India, sounding quite bullish, saying that a 33% market share is not really off the table.
Yeah, so the Honorable Commission's order, which has come yesterday on market coupling, is a forward-looking and say that it is basically a strategic reform that would lay the foundation for a truly integrated and efficient electricity market in the country. See, ultimately what would happen once the coupling takes place, the discovery of the prices in the exchange would be uniform. So by enabling the uniform price discovery across the exchanges through a centralized algorithm, market coupling will ultimately foster competition. It will also give way for optimization of transmission uses, and further it would ensure fair and transparent access for all the participants. As far as the day-ahead market is concerned, because of the liquidity issues, we don't have much volume in that segment right now. But once coupling takes place, I think then it would become uniform for all the exchanges to go to the customer, and whosoever provides the best services to the customer would gain the market.
So, Mr. Saran, right now the market... Please go ahead.
Yeah, and moreover, this reform is also critical because we are moving towards MBED, market-based economic dispatch. So this coupling would help realize this vision of a single national merit order and improving overall system efficiency.
Yes, exactly. So since it's moving towards efficiency, it would give chance to more players to enter the market as well. What would it mean for HPX in general? How much market share will you be able to increase? You said it's almost nil currently. PTC said that 33% is something that you can achieve. What's your own target for that?
Yes, I think once coupling takes place, that would be the minimum target which I am looking for, 33%.
Okay, Mr. Saran, what we want to ask you is, we want to ask you on the competition itself. As far as IEX was concerned, we understand that they were charging close to 4 paise per unit and they had close to 100% market share, like you yourself alluded to. What are the charges that you are currently charging customers? What is the kind of discounting that you can provide? And what is the kind of market share shift you can expect come Jan 26?
See, all these things will be, we will look into details and see all these things are going to be discussed in the days to come. And ultimately what I have told you, because I spent a lot of time in power trading, I have an experience of almost 26 years of power trading. And there people also say that margin is the game changer. But on the basis of my experience, I think that it is not the margin. At the end of the day, consumer wants services. Those who provide them the best services, because in the country we are having a segment which is known as C&I customers. And these are all very small players. They don't have so much of infrastructure available with them to do all these work. So as I said, whosoever is going to provide the best services to the customers will win the game.
Right. Mr. Saran, a couple of counterpoints. Number one, as far as the pilot study itself was concerned, we understand that Grid India actually did mention, saying that customers at this point of time weren't really dissatisfied with IEX's services. And in fact, they did mention that they don't see any significant gain arising out of market coupling. The other question that I want to pose to you is, are you ready with the technology in case, market coupling is implemented from Jan 2026? Are you ready for the price discovery to happen at your platform? So that is the more important question. And thirdly, the RTM market, what is the outlook there?
So as far as readiness is concerned, I am sure that we would be ready by 1st of January 2026. And moreover, we have some time in our hand. And right now also my technology is, I will vouch for it, that it is one of the best technology which is available in the market. So as far as readiness is concerned, I don't have any issue about it.
Okay. Mr. Saran, when we spoke to PTC, they indicated that right now HPX is contributing around 10 crores to them. The more focus on PTC also because it's a listed stock, so the shareholders would be very interested in that. If and when you achieve 33% market share, how much more will you be able to contribute to PTC in terms of financials?
That again depends upon the, what market we are going to have and what dynamics we will be seeing in the future. But ultimately, the growth of HPX will certainly result into growth of PTC, because PTC is having almost 23% share in the exchange.
Okay. Mr. Saran, a couple of questions. We understand that there is a certain restrictions as far as ownership of platforms and exchanges are concerned from the promoters. We understand that there is a 5% upper limit. So a lot of your own promoters actually own in excess of 20%. Would that need to come down? And the second question is, do you feel that IEX can now take this particular or can challenge this particular order from the CERC? Do they have any legal recourse?
That I would not like to comment, because this order has come just last evening.
That's right.
And we are in the process of meeting stakeholders. So as far as IEX is concerned, because it is for them to decide what they would like to do. But as per the power market regulations, any entity, any trader which is having more than 5% share in the power exchange, they cannot trade. So they will have to bring it
down. Okay. Got it. Mr. Saran, it was a pleasure speaking with you. Thank you so much for joining us with the clarifications, with your analysis of this particular order that has come by, and also that HPX is looking at a 33% market share post the implementation of this new CERC node that has come by for market coupling. We'll slip into a short break. When we come back, we get chatting with the management of Supreme Industries on their Q1 earnings. Stay tuned for that. Welcome back. Let's talk about Supreme Industries. The stock is on a radar. Company reported a weak set of Q1 earnings. The net profit and revenue have slipped below street estimates. The stock, though, has recovered after that sharp fall that we saw. Let's talk about the management guidance going forward. MP Taparia, the managing director at the company, is joining us now. Mr. Taparia, good afternoon, sir. Thank you so much for joining in. It's been lower than what the street was working with in terms of estimates. Can you give us a sense of what led to that revenue decline of 4% in plastic piping segment? Profits have fallen as well. How much of it is attributable to the pricing of PVC? And what is the outlook going forward? Do you maintain your guidance in terms of revenues and margins?
Good afternoon. In the first quarter, our business was affected by piping division by two reasons. The rains came 20 days before the normal season, so the irregular demand was contracted, and there was 7 times price variation in PVC in the quarter. That is resulted in some inventory loss. For the full year, we still maintain that our turnover may be around 12,000 crore rupees, and our operating margin will be between 14.5% to 15.5%.
So you are maintaining your guidance, and that is something I think the street has liked as well. So the stock has recovered from the lows. What about pricing right now? You said Q1 was impacted by pricing. Rainfall came 20 days before. What has been Q2 demand so far? Because there are different segments that you cater to, be it agri, be it urban. Can you give us a sense of demand on ground in different segments?
In Q2, demand generally for agriculture segment remains low, but demand from housing is quite well maintained. We are anticipating some demand coming from infrastructure. So second quarter business will have much better volume growth compared to previous year's second quarter.
Okay, Mr. Taparia, so you've said that demand in second quarter should be much better than Q1. A couple of questions. Can you, confirm to us that since May, companies have actually been taking price hikes, and we believe that the latest price hike was in the range of 1.3 rupees per kg for the PVC resin space. Could you confirm that? And going forward, what is the outlook as far as pricing is concerned?
We believe PVC resin prices have reached bottom. Many suppliers are bidding to sell at the current price. We believe the bottom has come, and government is also working on getting anti-dumping duty imposed. If that happens, then PVC prices may rise also.
Okay. Mr. Taparia, you mentioned anti-dumping duty. Two important things that the street was working with and was keenly awaiting. Number one was the implementation of quality control as well as the BIS norms. We understand that that has now been deferred to December 2025. And secondly, what is the status as far as the request for anti-dumping duty is concerned? Where are we on that?
Now, in the BIS, as you rightly said, it is extended up to December. We are not sure whether it is not going to be extended. It may be extended for further 6 months. But local production will be augmented only by end of calendar year 2026 or first quarter 2027 calendar year basis. On anti-dumping duty, government very recently announced a disclosure notice by which showing how much injury has been caused by the respective exporter to India. And this is the harbinger of the thing going to come when final rate of anti-dumping duty, which DGTR will recommend, may come in the month of first half of August, and thereafter, between 2 to 3 months, the Ministry of Finance may issue notification of imposing anti-dumping duty based on the guideline given by Director General Trade Remedies.
Got it. Okay, so we'll be watching out for that. That's an important notification that the street is watching out for. You're maintaining your volume growth guidance, you're maintaining your revenue guidance. How are you getting volume growth versus your peers? Is it discounting? Is it some other measure that you're adopting? And also, have dealers started restocking now, sir?
Now, there is no restocking anymore because restocking took place big way last year. And with the PVC resin coming to a reasonable level, and the trend is a future after 2-3 months, prices may start going up. And the demand is expected to be quite brisk because the rains are quite good. So demand for agriculture also will come up. Housing demand will be better, and infrastructure also will be better than last year. So demand is going to be better also. So with the effect of demand going to be better and small restocking We anticipate that this year the volume growth in plastic piping division will be between 15 to 17%.
Okay, Mr. Taparia, one last question very quickly. So, we wanted to understand what is the final decision when it comes to the injury caused to the domestic sector when it comes to anti-dumping? And did you say that by August, we may see some anti-dumping come by? What will be the impact for Supreme if it does happen?
Supreme Industries, after the local prices go up, then we will be able to pass on the increase. We will have no difficulty.
Thank you so much, Mr. Taparia. We would have loved to have a much longer conversation with you. Thank you so much, and we wish you all the best for the rest of FY26. But with that, it's all the time we have on this edition of Midcap Radar, Mutual Fund Corner, when we return.
Hello, good afternoon. Welcome to MF Corner on CNBC TV18. I'm Vinny Motiwala, with me Sonal Bhutra as well. Sonal, today what we're going to be putting the spotlight on is something very interesting, right? I find it interesting. AI is everywhere, but AI and our finance, our mutual funds, and is that going to be changing how we are looking at our portfolios? I think that's something interesting.
That's exactly what we are going to discuss today, because AI has overtaken a lot of aspects of our lives, right? And that's exactly what we are going to talk about today, from markets to now mutual funds. We'll discuss with some experts, should they really rely on artificial intelligence to make changes to their portfolio, or it's only the human involvement that is the way, because we talk about that EQ or the emotional quotient part as well, right? We have different market cycles, different market moods. How much should investors bank on this, and should they really rely on this? This and more we are going to discuss with our guest today, Deepak Shenoy, founder Capital Mind, and Dhirendra Kumar, CEO at Value Research. Gentlemen, such a pleasure to have both of you on the show today, and I'm looking forward to this conversation because there are diverse views, right? And Deepak, let me start with you, because we've had this conversation earlier as well, how people are using AI even to write comments on social media or to write posts on social media. So for every minor detail in your life, you are seeing AI being used. Now that we are talking about mutual funds or markets, do you really think this is one place where we'll see more involvement? Because 1% of mutual funds are powered by AI in India, which compares with 35% in the US. Do you think we'll also make that shift towards a higher number? Is this in the works? Your first take.
Yeah, sorry, I was on mute. I noticed that you also have noticed on Twitter a lot of these things. So, people using AI to make responses. I think, the way mutual funds are, you can't actually delegate your decision-making authority to anything, including an algorithm, an AI, or whatever you may call it. So in the end, it's the human, the fund manager, that's responsible, and eventually the AMC that is responsible for making those decisions. And at best, AI, I think, can be a useful assistant, because I was talking to someone today morning, and I actually mentioned this. AI is like a 24-hour assistant. You can go in the night at 11 o'clock and say, I want to research something. Can you help me find the right sources for it? AI can actually point things out to you much faster than the traditional search engines, which seem to be polluted with advertisements and too much of this SEO business, which doesn't help you get to the right kind of context fast. It can help you in maybe analysis of data, which is very, very large. Because now earlier you needed to get a programming team to hire to get all this data together and then crunch them and maybe bring something out. Sometimes Excel is too small and unwieldy for such things. Using AI, you can actually write code without even being a programmer. It'll be able to kind of write code to analyze this in much more detail and give you an initial answer. Of course, you have to validate and vet all of this. What I'm really afraid of, and I think we will avoid, is using AI to directly talk to customers where they're looking for help or support or a meaningful answer. I don't think you can delegate any of that to AI. At best, you can train your customer support team to be able to use, to give the right kind of answers. But it has to come from a human being for the most part. And other than mundane tasks like tell me my portfolio value or tell me my transaction status, which doesn't even need AI, I would say that is not. Apart from that, I wouldn't use AI in a customer-facing, unfettered environment. It has to have some ring-fenced controls around it.
Absolutely, there has to be some control around it, as well as customer facing. That is something that would be risky. If I'm looking at my portfolio, I wouldn't go and trust AI blindly, but each to their own view. Dhirendra, good afternoon. What's your view coming in here as well? Sonal was mentioning this number, 1% of mutual funds, that are powered by AI right now. Do you see this increasing, or do you think now, given that we're seeing this shift towards AI, that is a possibility to reach a higher number there?
No, the use of AI will grow. But, in its current form, cannot truly manage your stock portfolio or, mutual fund selection or stock recommendation or even advice. While algo and machine learning can accelerate research and analyze trend and, identify signals, But the act of making an investment decision, in this complex, nuanced, and a noisy market remains a human responsibility. I don't think it is, we are going to delegate that easily, or it's anywhere close to that. And I think, the most successful investors, utilize technology to enhance decision making. And I don't think it is going to replace it. It will be a great accelerator. It will be a process enhancer. But it is quite some time away from, being a substitute for human judgment or discipline.
So we know that investing is purely a human, or I would say it's technical in some aspects, of course, when you have investments in quant funds, but largely it has got a lot to do with human intelligence as well, right? So we have to focus on that purely. So if we are talking about some of the tools which are already being used, gentlemen, Deepak, let me start with you. Are there some AI tools that investors are already using now to access stock holdings, get them analyzed, or is it right now only for tertiary purposes?
Well, I think just saying that AI will analyze a stock portfolio is, I think, a little premature. But you can do different things. For instance, you own a bunch of companies. As an investor, I would like to be on track of all of the news of those companies, right? Even as a fund manager, a fund manager would want to actually go through anything that is happening. So you can use AI to kind of find and track news, analyze a conference call transcript that is maybe 20 or 30 pages long and give you a summary so that you can know where to look inside. So it's a useful assistant for a lot of downstream research. But to just say, oh, take this company and tell me whether I should buy it or not, I don't think you should do it to AI, because AI can hallucinate. You can try this. Use any AI tool and say, tell me why I should buy this company. And then it will give you a nice, very well-reasoned answer. And then you say, tell me why I should sell this company. And it will also give you a very well-reasoned answer. You're the one making the decision. It's detecting the bias in your voice and then telling you exactly what you want to hear. You don't want that from anyone, even an assistant. You want someone with a mind. You want, who can actually discern between right or wrong in this case. And AI is not going to do that for you. So at this point, I think the better thing to do is use it for specifics. I want to get a conference call transcript summary. I want you to summarize a video where a promoter was being interviewed, so that I can figure out which points in the interview I should look at more carefully. I understand this to help me understand the sector a little more. Tell me where to start looking for information. It's useful to kind of give you that overall framework of thinking that you can then deep dive into. But the deep dive is all yours. Eventually, validation is all yours. So I think there is a lot of value, because it helps you go through documents and data in a much faster way than you were earlier used to. And today we have a massive inflow of data from everywhere. You get WhatsApps, you get this, you get that, you get YouTube videos, podcasts. So there's only so much time in the day for you to be able to track all of this stuff. But you need somebody to tell you that something is interesting. This was, let's say, a job done by human beings. That would actually, you require 2 or 3 people to kind of help you with understanding or keeping track of a lot of things. You could perhaps use AI to help you do this a little bit better. But I don't think it should be anything simplistic or decision oriented, because that is going to cause grief more than anything else. We use it for a lot of other things, understanding legal agreements in a framework that we have decided. So saying, okay, are there any things that are non-compliant in these legal agreements before we sign them? Certain other aspects of compliance, it can tell you automatically how, what kind of policy changes are made, so that you can fine tune your operations as well. But AI as a decision maker, I think we are just too early for. People have tried stuff. I think a large amount of fund management in general is about luck also. So you will find that there'll be some lucky AI investment managers as well. But, times will change. And when times change, it's the subjectivity of the fund management process that can perhaps help in understanding how to navigate tough times. So you don't have too much of a tough time in the last 5 years.
Absolutely. So what I'm understanding, obviously AI can be used to compile your data, not to stock pick or figure out what you want to do. Dhirendra, comment on this point as well. Are you using anything in terms of AI for maybe just compiling, researching, anything on that front? And do you think AI can, maybe if people start using it like an everyday thing to pick stocks or pick funds, can it be held accountable like a fund manager? How do you go over that, right? Because you don't have anyone to say that, oh, you made a mistake, so I'm going to be, pointing my finger at you kind of a thing.
No, I'm using AI very intensely for my writing work, and it has added a magical dimension to my work. In fact, after writing my weekly column, and actually, I write 3 columns in a week, so it used to get tiring. Now, suddenly, after these 25, 30 years of boring, mundane writing in a narrow subject, my life has become suddenly interesting. And I really look forward to writing. I really look forward to improvising. I now spend, it's not that it has actually reduced my time. I spend more time because it is enabling me greater exploration, sharpness, fineness of my, the headlining or the section or the structure of us. Writing is a completely different exercise. You do it in a fairly isolated way, or is a lonely exercise. And here you have a very competent assistant at handy, and he's a multifaceted assistant. He's able to put together numbers, and in fact, what Deepak was just referring to, I use it so much more to find. Rather than help me do things, I rather, I use it more to validate things, to verify things, find the errors, find the mistakes, how to improve, what are the principles of writing being violated, what is the principles of structure being violated. I think that is where it has actually made my life very interesting. Coming to value research operation. Here, because we have been a repository of plenty of data. In fact, we are the I would say we were the first historian of mutual funds. I have mutual fund information available, information on Indian mutual fund available since 1964. I have the history of Unit 64 repurchase and resale price from 64. I have the market price of master share, which started in 1986. I have the closed-end funds price as well as NAV, which initially used to be disclosed every 3 months and subsequently every week. I have a history of all that. To be able to retrieve that, make sense of it, it is proving to be a great assistant, a multifaceted. I really can't look forward to hiring any such assistant.
Right. So that is basically impacting jobs as well. That's my biggest takeaway here. But gentlemen, it's a very interesting discussion, but we have to get into a quick commercial break. When we come back, we'll continue our discussion and talk about the legalities as well, because some of the brokerages have gone ahead, tied up for an AI assistant. So let's talk about that in greater detail. Welcome back. You're still tuned into MF Corner, and today we are discussing how AI can assist you in your portfolio management, or can AI become a portfolio manager itself? We are questioning this because recently there was a Mint report which suggested that Zerodha has become the first company to integrate MC with Claude AI, and this is where it is happening users to access and analyze their portfolio. In fact, 300 to 600 users have already started trying that. They are using Zerodha Claude MCP each day to get a sense of what their portfolio is doing. Deepak, in that case, let me start with you again. What can the regulatory perimeter be around AI tools advising on investment decisions? Since it has just started, it's just that drop in the hat. But do you think if it started being used the way it is generally in other aspects of life, some regulation will have to come in?
Well, I don't know. This is people looking at their own portfolio and running it through a tool, and they have to make their own decisions. How can you stop a tool from just emitting out, this is what's happening in your portfolio and this is where you are and all of that stuff? And of course, there must be boundaries, but none of the brokers actually enable any specific kind of advice, right? So all they do is they'll create a model context protocol, which is the way to communicate with the broker to get your portfolio details. The actual differential in terms of how much of this is large cap and what kind of funds you have, what kind of stocks do you have, etc. I think that stuff, you could actually write a non-AI program to access it as well, and kind of give a completely automated summary using some heuristics. AI is just another way to do the same thing, and you have to understand that to a certain extent, AI is limited by the data it is trained on. A lot of times we've seen that data that some of the AI versions are trained on is quite old. So it could be something like 2023 or 2024, and we're in 2025, nearly 7 months into 2025. So we are, I think we should be understanding that the AI framework of, even if it was asked to make decisions, is going to be a little bit stale because the data is older than what we have. So to that extent, if customers are made aware that, listen, if you go to Google Finance and try to get the price of a stock, there's an automatic thing that, there's a formula, there's an API you can use to say, oh, give me the price of this stock on a spreadsheet. But as soon as you do that, it actually has a little disclaimer at the bottom saying prices are delayed, be careful, all that stuff. I think that kind of a disclosure, whenever there's somebody who's trying to do actual decision making, can be enabled by an AI framework, just in case, saying, listen, none of this is investment advice, but this is the framework I'm thinking about. That could be one way, but in the end, it's difficult for a regulator to say, don't do this to people who are doing it on their own portfolios.
Okay. Okay. So, actually, Deepak and Dhirendra, we thought it is going to be enough for this 23-minute show, but we have actually run out of time on this conversation. We never thought that would happen. So, I think we'll have to do a season 2 or an episode 2 of this conversation itself. We have to wrap up because we have to we are done with the show, but it was such an interesting conversation, and I think we'll do an episode 2 of this as well. But thank you so much for both of you to join us today. It's an interesting topic, evolving as well. Let's see which way things go when it comes to regulation. More importantly, implementation of AI when it comes to portfolio management as well. Thanks a lot for joining in today.
Thank you so much.
Okay, with that, we'll take your leave on this edition of MF Corner, but stay tuned for Closing Bell to take you through the last hour of trade.
beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Nikkei, that's managing to hold on to very strong gains for the second day after that US-Japan trade deal.
We've increased the lower end of our guidance as we go closer into the, progress into the year, closer towards the end of the year.
The levels don't change very much, but 25,255 is the first resistance.
I'll keep an eye out on the reaction on Tilaknagar Industries because of the run that we have seen.
The double-digit growth and the profitability are meant to continue also into the future.
It's absolutely flat. Nifty 25,233.
EBIT is going to hit 14% for the current fiscal.
That market coupling will be implemented from Jan 26 in the day-ahead market list.
Good performance so far. Reasonably confident going ahead.
This FTA is implemented once the UK Parliament ratifies it.
The Nifty, it is down around 56 points. Mid-caps falling more.
The first indication of urban consumption getting into place. We own around 22% in the IEA.
So it's an underperformance all across. All of the indices are trading in the red.
Hello and welcome to Closing Bell. Well, we've got an action-packed hour ahead of you. On Closing Bell. For the time being, the market's a little under pressure. I'm Nigel D'Souza. In a bit, my co-anchors will be joining in. Well, for the next 60 minutes, let's run you through what we have got lined up. First up, the casualty of the day, IEX, it hits multiple lower circuits as the CERC approves market coupling in the day-ahead market in a phased manner. Vivek will join in to tell us more about that. There's also a mid-cap IT leader as well, which are slumping in trade in reaction to their first quarter numbers. Coforge, they report a miss on margins and some concerns on the capex spend. Persistent Systems, well, the revenue growth and the deal wins disappoint. Nestle, though, is one of the top losers on the Nifty. Higher cost hits margin and profits in a soft first quarter. Thyrocare and Syneris Pharma, though, they are the big mid-cap movers in trade today, so we'll address that. We'll also get you excerpts from what management's had to tell us shortly. Also on the show, Bajaj Finance is trading with a cut ahead of its first quarter numbers. We'll tell you what to expect from that. All this and more lined up on Closing Bell. Well, we have weekly expiry as well that will play out. And for the time being, you've seen that the markets at least are defending the 25,000 odd mark. I don't think still it's a reason to be very, very concerned about. We still continue to hold on to that broadband, 24,800 on the downside. On the upside, 25,500, 25,350, which is the 20 DMA. First, let's go to Mitesh. He'll tell us about the closing strategies of the day. Hi, Mitesh. What do you make of today's trading action?
Well, honestly, I think nothing much. We've been maintaining that going to range bound, and today morning, we were near the upper end of the range, around 25,300 zone. So we got a high of around 25,246 or something. And now back to the lower side, which should be closer to about 24,900. I think this contracting movement could still extend for next few days, and therefore trading should be stock specific. I have one buy and one sell call. Birla Software, that's something which is turning negative. So Bsoft is a sell. Keep a stop at about 405, and look for a target of around 382. And Fortis is a buy call on the upside. Keep a stop below levels of 834. Look for targets of around 870.
Okay, all right. Thanks a lot for that, Mitesh. Well, there are a lot of stocks that are buzzing around, but let's focus on the accident of the day. IEX has got clobbered in today's trading session from the word go itself. The shocker that came overnight with regard to the CERC approving the market coupling for DAM. That's the day ahead market, which is bulk of their volumes. Vivek joins in to break it down for us. Vivek.
Well, thank you so much for that. Like you mentioned, CERC has gone ahead and approved market coupling for the day-ahead market. what are the implications for exchanges and how are key stakeholders impacted. Remember, now that the green light has come in for the implementation of market coupling in the day-ahead market, there will be a significant impact on key players. Several listed companies stand to be directly or indirectly impacted by this development. Remember, IEX is the one with a near 100% market share in both the day-ahead market as well as the real-time market. And IEX is expected to see a shift in its competitive dynamics. Dalmia Bharat also will be impacted given the fact that it holds close to 11% stake in IEX and could witness a valuation impact depending on IEX performance post the implementation of coupling. PTC India, on the other hand, stands to benefit given the fact that it owns a 22% stake in HPX, which is Hindustan Power Exchange, which is a rival platform that stands to gain market traction in a coupled regime. What do brokerages say? Remember, UBS says that IEX faces pressure. UBS, in fact, termed that CRC's nod as a negative surprise. It noted that while only the day-ahead market is being coupled in phase 1, the real-time market could stand to be coupled in phase 2. And both of these together contributed close to 80% of the FY25 revenue for IEX. Now, the day-ahead market contributed 50% and real-time market contributed 30%. Bernstein maintains a market perform rating on IEX with a target price of 122 rupees a share. They point out that the order is worse and quite different than what was initially expected. Bernstein, in fact, anticipates competitive pressure to reduce transaction charges, affecting IEX margins going forward. According to Bernstein, DAM accounts for 46% of IEX volumes, RTM 40%, and the TAM 14%, reinforcing the significance of the day-ahead market for the exchange's business model. A shareholding pattern implies that IEX actually has a strong base of institutional investors. SBI Mutual Fund, via various schemes, hold over 9.5% stake. Parik Mutual Fund holds close to 5%. ICICI Prudential Mutual Funds across various schemes holds 4.7%, while Mirai Asset holds over 2%. LIC is also a key shareholder with a 4% stake in IEX. Retail interest in IEX also is quite high. It has, however, remained stable in the past few quarters. March 2025, the shareholder base was at 28%. June 2025, it is at close to 29.4%. The outlook towards market coupling now poses a serious risk for dominant platforms like IEX by leveling the playing field for newer exchanges.
Okay, all right. Thanks a lot for that, Vivek. Earlier today we spoke to the CMD of PTC India on CRC's nod for market coupling and how a monopoly is not a good thing for services or a customer. Let's listen in to what he had to say.
Currently, all the volumes were concentrated in the incumbent exchange, which was IEX. Last year, I think around 61 billion units were traded in the DAM segment in the IEX. Now, if a fair share is captured by other exchanges, so I believe it will be good for the market, good for the constituents, and good for the people whom the exchange is serving. You see, monopoly has never been good. It can never be good for the services, can never be good for the customers. If a monopoly, even if not dictated by law, but because of the reality of the situation, if all the volume is concentrated in one exchange, then you can understand that is the human behavior. So I believe competition is good, and since this market coupling provides a fair chance to compete on services, so I think customers will be benefited. There is no doubt about that.
All right, let's get in Gurmeet Chadda, who joins in on the show. Hi, Gurmeet. Good to see you in. What are you making of this newsprint on IEX? It was the biggest fear for the last many years, and the street, it seems, didn't see it coming. Dalmia Bharat is lucky. They knocked off 5%, 4.5% at around 200 rupees. Now, I don't know what they're going to do with the other 10% and whether or not someone is brave enough to come and buy it. But your view on this particular scenario playing out?
So, Nigel, this is a classic case of how a de-rating can happen, due to regulatory development. Now, market coupling, in very simple terms, is an economic model where you want price and offers and bids and offers to come from multiple exchanges, so that can lead to a uniform price discovery. So, the role of IEX, which was very important in terms of price discovery, also virtually now only becomes like a normal aggregator or a bidder. right? So what it could do is, one, their market share right now on day-ahead markets and real-time markets is about 84, 85%. This can drop by 10, 20%, which means you have negative operating leverage. Second, they are also now, if you see the pilot which was conducted last year between December to March, this resulted in some welfare savings of 38 crores. So, and that's almost like 70, 80 lakhs a day. And that was pilot one. Later on, they also want the day-ahead market to move into round robin, and later also combine the real-time market and the day-ahead market. Eventually that's the integration going to happen. So there are a lot of things which will line up, because energy prices, ultimate goal is that should lead to market efficiencies with lower prices, right? Which invariably is not good news for people providing, the technical infrastructure for it. So I think a lot of changes also would need to be done on your tech know-how, software. Plus, obviously, I think government would put pressure on transmission, better transmission also with this order. So my sense is you probably good to wait out. Good thing maybe the price after few days now can become extremely compelling, because I think they will still dominate with 60-70%, but will not enjoy the multiple they used to be. So wait it out. At some point of time, maybe it may become attractive to have a relook at.
Okay, but we could see some derating as its market dominance ebbs. Gurmeet, hi. The surprise today was IT. Numbers look good. First cut, Coforge 8% top line growth, Infy at 2.6%. But the market reaction, the stock price reaction is telling a very different story. So just want to quickly put on board for our viewers, maybe what some of the concerns could have been. On Infy, it is the top end of the guidance. So earlier guidance for Infy was 0 to 3%. This included no acquisition. The new guidance is 1 to 3%, but it includes 40 basis points of acquisition. So basically, the organic guidance, which was 0 to 3%, has now become 0.4 to 2.6%. So Street is saying, why is the upper end of the guidance come down, right? Even though Q1 was strong. So that could be one concern. In the case of Coforge, there are two concerns. One is the EBIT margin, according to analysts, includes certain one-offs. If you exclude those adjustments, then the margins are actually lower. And secondly, why are they making this capex investment, this data center investment of more than $60 million? In the case of Persistent, it's not a bad set of numbers. It's just perhaps lacking excitement, and then there is a rub-off impact. It's falling along with the rest of the tech pack. You could quibble that the revenue growth has come down a bit. It used to grow at 4-5%. This quarter, it's at 3.3%, slightly lower than short of expectations. Deal wins is steady, but there is no acceleration in deal wins. Plus, they've gone ahead and deferred the wage hike. And not to forget that these companies were fairly expensive, 40, 35, 30 times in terms of valuation multiple. But Gurmeet, we'll get to the management, what the management had to tell us, but give us your take. Were you anticipating this kind of a fall? What is it that's spooking the street really when it comes to both Coforge and Persistent?
So Reema, as you rightly said, market is forward-looking, and I think even if you look at Infy, while the guidance was revised, but it's 1 to 3%, while they had a better quarter compared to others, but trades at what, 24, 25 times trailing. And if your guidance is flattish, I don't think so the forward multiple also would change much. You may say, okay, 25 trailing, I could be 22, 23 times. And I think that's where the issue is. They weren't really cheap. It's not that you were getting it at 15 times. But at the same time, I think a lot of negative is in the price. So in large cap IT, probably I think there is some valuation comfort. And with some trade deals happening now globally, the overall IT environment may change. That's my view in the second half. We'll see how it goes. But large cap IT is giving you valuation comfort. If you come to, and Coforge, Persistent are great companies. But look at Coforge, for example, 60,000 crore market cap, 24, 25 rupees EPS. That's almost 70 times, trailing. And if you discount even 25, 30% growth, you're still paying a very high multiple for the growth they are projecting. So I think it's a bit of a resetting the, the multiple in the IT, especially mid-cap IT never really dropped. There was a big variance, 20 times versus 50, 60 times. Even Persistent is 55, 60 times. So I think it's a bit of a resetting of the valuation multiple, but I think market will differentiate once the price adjustment happens post earnings. At some point of time, maybe second half of the year, you might want to do, be a little contrarian and do some bottom fishing here.
But particularly on Coforge, you want to tell us, have you looked at the numbers? What is it? Is the data center investment such a bad investment? What is it that the street doesn't like?
It has to be data center. Otherwise, optically the numbers look, in fact, they look very good considering the environment we are in. And this is one company which has now delivered what? I think this is the fourth quarter now if my memory is right. So I think any price correction, as I said, it's a bit of a valuation reset happening. And in general, when you are negative on IT services with the AI impact, etc., the environment and sentiment is that. So, but I think Coforge and Persistent in particular, I'll be interested with a 10-15% correction more from these prices. And as I said, large cap IT, we are already trying to look at HCL. I think Q2 would be better. It's much better mix between IT services, ERD, and software. The software business is 25% margin business, continues to do well. And I don't think so it gets enough value as far as at the price at which it trades at. So we would start doing some bottom fishing in IT services. I think there's a lot of negativity. It's like what, some of the digital businesses were, the Eternal, not a fair comparison, but Eternals and Paytms of the world, when they had few rough quarters, slow down, and the market really derated them by 30, 40, 50%.
Okay. Talking about falling IEX, falling IT, let's talk about happier things, Gurmeet. Good afternoon. Alcobev, always a buzzing space, right? And now we have this big announcement from Tilaknagar as well. They're getting very aggressive in the space with their latest purchase. So just a take on Tilaknagar, I mean, if you've seen the deal contours and anything else. I mean, by the way, in the next couple of minutes, we'll be talking about the FTA signing ceremony, India, UK. And once again, the import of scotch and what that means, even for companies like Radico. I remember we spoke to them. They're large bulk scotch importers. So to that extent, they benefit from lower tariffs. But just your thoughts on the overall space and any stocks that you may like.
So, we are looking multiple things here. One, obviously, is the UK treaty, which will have an impact. We'll probably need to study. But, what also India is doing, it's creating brands now, especially at the premium end. We saw Rampur, we saw Indri being rated amongst the best, which is, I think, under Picardly Agro. And then you have somebody like a United Spirits, which has, premium brands. And now, with the ownership change, there's massive amount of, you can call up cleaning up, restructuring happening. And the market is exploding. The Gen Z actually takes a liking to this. We may like it, not like it. I think what has happened is the regulatory uncertainty state-wise. So the Bihar came up, then MP stopped giving fresh licenses on liquor shops. There's something which keeps going. Something suddenly comes up even in South, which is one of the larger markets there. So only issue is that. Otherwise, I think it's a market which I think it will probably start getting a multiple like FMCG. So we like Radico Khaitan, we like United Spirits. We are looking at Picardly also, but Picardly has both sugar and the whiskey brand. So looking at that currently, I haven't added anything, but purely from a consumption basket point of view, I think the opportunity size is quite big.
Okay, all right, Gurmeet. Thanks a lot for joining in and filling us in with your take. Wishing you a good day ahead, and we look forward to chatting up with you soon. Well, time to slip into a short break. We'll be back. Varun Goel of Mirae Asset Investment Management will be waiting for us.
Welcome back, and those are the visuals as India and UK get set to finally sign that landmark free trade agreement deal. It's been in the making for a long, long time, many, many months of hectic negotiations, and finally a deal. That's, of course, the Indian Prime Minister with his British counterpart as the Prime Minister Modi's trip continues into the UK, and that signing will be happening shortly as well. We'll keep an eye out on that and keep getting you the latest from that all-important event. But for the time being, let's get back to markets. Markets still nursing a cut of about 0.5% at the index levels. But it is time for the buzzing stock action. And our stockman, Hormaz, is here. Always has something interesting on his wall. Let's see what he's picked out this time around. Hormaz, take it away.
Well, today was a difficult day actually because we have covered most of the usual suspects that have seen some extreme earnings reactions, whether it be on the upside or it be on the downside. But there are some of them, yes. There's Vijaya Diagnostics is one of them. 10% higher in today's session, the third straight day of gains. Very strong volumes that the stock has seen. And when you take a look at those volumes today, they are significantly higher than the 20-day average of 1.3 lakh. Already you have had 22 lakh shares that have been traded. But despite this move, the stock is still around 15% below its record high level. So still, analysts believe that there is still more room for upside to go towards its record highs. The other mover on the upside today has been DCW, and that is up 7% today. It snapped a 4-day losing streak. That is also doing well on volumes of 90 lakh shares that have been traded compared to a 20-day average of around 12.5 lakhs. And between the last 5 years, the stock has grown almost 6x from around 14 rupees that it was at the start of 2020. It currently trades around 80 rupees, and this move has also ensured that it has broken out above its 50 and its 100-day moving average. Today, the list on the upside is a little longer today, and the other one is PNB Gilts. Numbers came out yesterday. The stock was up 8% after results. The stock is up another 8% today, the second straight day of gains, and these gains have come on very strong volumes as well. Take a look at this. 2.1 crore shares have been traded today, 1.1 crore shares were traded yesterday, and that is compared to a 20-day average of just 7.8 lakh shares. So PNB Gilts, another volume-led mover, and this has gone above its 200-day moving average as a result of this 2-day move. Now, the other one on the downside today that has been in focus is after the Persistent and Coforge bashing, Cigniti Technologies has taken a beating as well, 9% lower. Of course, Coforge holds controlling stake in the company, and as a result of today's fall, it has broken below its 50-day moving average. But despite this fall, it still continues to remain above the open offer price that Coforge had made, and that is also on very strong volumes. 5 lakh shares have been traded already, a 20-day average of just 51,000, and the open offer price, of course, being around about 1,400, and the stock currently trading around 1,600. And the last one on the list today is Latent View Analytics. This fall of 4.5% is on low volumes, below its 20-day average currently, and it shows you it is one of India's most subscribed IPOs. Now, when this issue came out in around 2021, the issue was subscribed 326 times, and from the post-listing high that the stock had made of around 750, it's down 43% from those levels. Yet it is comfortably above its IPO price, which was 197. So still almost more than 100% surge from its IPO price. So plenty of movers, earnings reactions, and there are some that are not moving on not so great volumes as well.
Okay, thank you very much for that. Let's talk about two pharma names which are reacting very well to earnings. One of them is Thyrocare. Good set of numbers. The pathology revenues went up 25%, and the company is talking about mid-teens revenue growth and maintaining margins. And the other one is Cenoris Pharma. Again, that stock is higher by nearly 11-12%. Let's hear out what the management's had to say.
About 14-15% is test volume, and 11% is what, is realization. But actually, our stated position is to be the most affordable player in diagnostics. So we don't take price up that much. Actually, that 11% that you're seeing in realization is mostly from mix. Over the last year, we've added a number of specialized technologies that effectively increase our realization per test. We are not a company that stands still. We continue to invest. We're looking for more M&A. We're looking to expand our footprints in different parts of India that we're small. So I would say, whatever operating leverage we get, the first priority will be to see where we can invest it for growth, right? So assume, the margins will be stable at this point, at this level, and we'll continue to invest to drive growth further from where it is today.
From the US standpoint, particularly from the growth, as we have projected, we'll do about 50% odd on the revenue side from the last year. US will drive that growth. So US will probably be between 50 to 70% of the growth this year, as we speak, from the last year that we've done. We will be doing 50 crore plus this year from our branded generics business. Launches, we keep on launching newer products, both on the hospital critical care segment side as well as new antibiotics the portfolio that we have. So strong growth on that side compared to last year. There's going to be about 300% on the branded generics that we are anticipating this year. We'll continue to drive year after because our base is small. We are not present in all states. Our team is relatively smaller. But as we move forward, we plan to be pan-India with a slightly bigger workforce.
Okay, all right. And that was a take coming in from the management earlier. Let's go back to the market conversation. We have Varun Goyal joining in with some perspective on the market. Varun, great to have you on. Thanks very much for being with us. We have to start the conversation with IT, right? Because while you can blame the companies that were not showing growth or had a fall in growth, today's market reactions are also fairly sharp. I mean, what's your take on the sector? Do you have any exposure? Would you try and be a contrarian here and maybe buy the dip?
Yeah, good afternoon, Surbi. Thank you so much for having me on the show. I think we remain constructive on the large cap tier 1 IT names. If you look at, the valuations, they are almost at a 10-year average valuation. I think most tier 1 companies are trading at 4 to 5 times free cash yield, and that remains attractive. One hopes that with the US growth continuing to hold up, the second half of the year should see better deal signage and better volume growth. I think as far as the mid and the small cap space is concerned, that continues to be headwinded. I think the starting valuations continue to be extremely high. So we'll be a little careful on the mid and the small cap IT space. I think there's some small niches like the healthcare BPO space, which seems to be growing a lot faster, which still remains attractive. But other than that, we would be cautious on the mid and the small cap IT.
So IKS, Agility, these are the companies you like?
So Rima, I would not be able to take any names, but broadly, the healthcare BPO vertical continues to be a fast-growing space.
Okay. And large cap IT, valuations are okay, and you're expecting growth to come back in the second half of the year, and therefore you're fairly optimistic about large cap IT, correct?
Yeah, we remain overweight on some of these large cap names, yes.
What has been your read of the earnings season outside of IT? If you could just take it, sector by sector, what were your key takeaways?
I think so far, of course, earnings growth have been a little muted. I think for the year, of course, we expect 10 to 12% kind of earnings growth. There is, of course, an expectation that with so much of monetary stimulus that we have seen from RBI, and yet some more may come, and you combine that with the 1 lakh crore of tax cuts, second consecutive good monsoons, various attempts being made to revive consumption demand. I think broadly we should see a good festive season, and therefore we remain quite hopeful that for the year as a whole, we'll go back to the 30-year average earnings growth for Nifty, which is around 11-12%. It is the small and the mid-cap space, which was very badly beaten down last year. I think the small cap segment had minus 15% kind of earnings growth in FY25. So that is a space where we expect a much stronger 20% plus kind of earnings growth. And hopefully, I think starting from the September-October month, we should see much better earnings picture coming in.
Sorry, and which sector did you say it'll show up in the most explicit way? This 20% growth that you said?
Yeah, so see, if you look at, there are 3 large sectors which showed earning declines last year, or where earnings were under pressure. I think refining cycle was clearly in a downturn. So oil and gas refining companies saw large cut in earnings in FY25. On that low base, we expect things to bounce back. Metals clearly, with the benefit of anti-dumping duties and all, that sector will show strong earnings growth. And the third is the financial space. If you look at the overall MFI, NBFC, small bank space, that is the space which was hurt really badly because of the write-offs and provisioning which happened in the second half of last year. On that low base, again, the numbers should get back up significantly this year. So that is the reason why the small small cap earnings were down last year and which should look a lot better this year.
Got that. Varun, just request you to stay on. We want to just get a quick handle on what's happening in the futures and options market. Today is also the weekly expiry. Manglam is joining in with a 3 p.m. check on the futures and options market.
So as you know, move towards the 3 p.m. mark for the market. There is a decline that we are seeing in the frontline indices, the Nifty Bank as well as the Midcap Index. All of them under a wee bit of pressure. But as we move towards 3 p.m., just keep an eye out on a couple of these strikes which are fairly active in trade. Even as the India VIX has moved higher, we have the 25-100 call, which is extremely active. That has a premium of almost 10 rupees, telling you that the street believes that maybe 25-100 is not a mark that the Nifty can go ahead and cross. 25-100 put writers equally active in today's trading session as well. So if you are writing the 25-100 call and put, the street is believing that the rough range for the expiry that happens 30 minutes from now would be close to 25,075 to 25,125 itself. Were we to break that, then 25,050 is the level that we have to keep an eye out on very closely as well. Keeping a watch on some of the PSU banks which are doing well ever since Canara Bank reported its numbers. So there's short covering that's taking place in Canara Bank, but Indian Bank and Bank of Baroda, both of them have seen a lot of long build-up, and Bandhan Bank is one of the stocks that I'll watch out for, as the threshold for it to exit F&O ban is very close. So if we see some open interest decline, then maybe this evening we get the news that Bandhan Bank is out of F&O ban.
Okay, all right, got it. Thanks for that, Manglam. Interesting. So, yeah, that explains the green that we're seeing on some of these PSU banks today. Varun, going back to you, talking earnings, what are you liking in financials? It's a very large space. So is it more private banks? Is it PSU banks, mid-tier banks? Because this earnings season at least has told us again, that safety is with the big boys. The mid-tier banks still have issues around asset quality or credit cost in some cases.
Yeah, I think we continue to like both the banks and NBFCs. I think NBFC will be the first ones to start showing benefit on the NIM side, because the interest rate cuts will get passed far quicker. I think also with so much of rate cuts and monetary easing, we expect credit growth to start reviving. As of now, we are running at 9-10%. Our sense is by the festive season, we should be seeing system-wide credit growth going to 11-12%, and some of the large banks, both public and private, can grow at, let's say, 14-15%. So I think Tier 1 banks will continue to do well. Some of the smaller private banks, small finance banks are trading at fairly attractive valuations. And I think the credit cycle continues to be under control. We do not expect large slippages on the retail loan book side. And that segment also continues to be attractive. I think NBFCs, again, we expect strong earnings growth because the credit momentum is clearly there, and that should continue to hold. So I think broadly, this is a space which is most reasonably valued. And the earnings growth, secondly, especially in the second half of the year, should look pretty strong.
All right. Hi, Varun. Good to see you, Ben. Well, one segment that's actually given good set of numbers is cement. And the commentary has been encouraging as well. But the stocks have already run up. And it seems, in FY25, they didn't deliver. And the stocks didn't correct. But post that, we saw a run-up in the stocks. And now they're not reacting very favorably to the numbers. Case in point being a Dalmia Bharat, a Sagar Cement, a Nuvoco. All of them reported excellent numbers. But the stocks have not moved too much. Second half of the year, though, could be far better. Your pecking order among these names?
Good afternoon, Nigel. I think we remain constructive on the cement space. I think last year was tough from a margin point of view. There were significant headwinds from a raw material perspective. Pricing was also under pressure. I think this year, there's some very feeble signs of pricing revival, but raw material scenario is definitely a lot better. So we expect significant improvement in EBITDA per ton for most of the Tier 1 cement companies. Our preference, though, remains with the larger names where the pricing power is a lot better. And because of the significant consolidation which is happening in the sector, we hope that once the monsoons are over, the pricing outlook would also get healthier. So we would prefer the Tier 1 names in the space.
Varun, thank you very much for joining in. Need to slip into a break. On the other side, we'll get you a check on what dealing rooms is saying. Nimesh will join in with D Street Chatter and a few BTST calls from our experts. Welcome back. The Nifty is firmly below 25,100, but there you have it. The breaking news that's coming in. UK-India signed a free trade agreement just a while back. We saw the visuals of our Prime Minister Narendra Modi and the UK Prime Minister Keir Starmer, shaking hands and fructifying this the India-UK FTA, keenly awaited by the street. By the way, the next 12 hours are going to see a whole host of big earnings. So we've got Bajaj Finance, SBI Life, Ather, Midcap IT companies, so Infosys, Hexaware, Cyient, eClerx. So 4 of them will be reporting numbers. And today, ahead of the numbers, given the overall weakness in IT, these stocks are down about 3-4%. So it's going to be an earnings-heavy evening. Before now, let's find out what Dealing Rooms is saying. Nimesh is joining in. Nimesh.
Hi, Rimara. So essentially, we've just given up all of yesterday's gains in today's market. And today, I think the big drag is coming from the IT stocks. So the IT index is down 2%. A lot of mid-cap IT, despite not reporting very bad numbers, are down 9-10%, the likes of Persistent and Coforge. So clearly there is pain point in the IT stocks in today's market. And of course, we had a big accident in terms of IEX today. But for me, the big takeaway of today's dealing with feedback is that there is a basket buying in mid and small cap stocks at a leading FI desk. And that probably explains that the Nifty mid-small index, which is a combination of mid and small cap, has relatively outperformed. It's just down 0.5%. And there are a lot of individual stocks which are buzzing in trade in the broader market names. And that, to my mind, is backed by some FI buying. As I said, there is a basket buying today. Earnings is going to be a big dominant theme, and that's playing out clearly in the markets today. And in the second half, we've seen a bit of reaction to the PSU bank stocks after Canara Bank and a couple of others reporting decent sort of numbers. So earnings is going to be a big theme to watch out for. But I guess it's basically a bit of momentum back in the broader markets. And today it's backed by a very large basket buying at a leading FI desk.
Yeah, absolutely. I mean, Canara Bank has been the silver lining today with their credit costs falling, PAT increasing, stocks up 5%. Absolutely take that point. What about any individual stock level chatter, Nimesh, for today?
Well, so the first stock on my list today, Survey, is Kajara Ceramics. That's been under pressure today despite a big upgrade coming in from UBS. So today the UBS upgraded the stock to a buy, big target price increase as well. But I understand the stock is under pressure essentially because there is a block offer at the leading FI. So it looks like some bit of selling is happening from larger institutions in Kajara in today's market. That explains a bit of softness in that stock. Second, couple of stocks where there is delivery-based selling. AB Capital and Axis Bank both stands out in terms of very strong delivery-based selling in today's market. So watch out for delivery stats there. The third name is Sapphire Foods. The company reported numbers not so great, but beyond numbers, I guess the city is now against anticipating some corporate development in Sapphire Foods. So that's the buzz there. And the last one is Electra Green Tech. For second day running, that's been buzzing in trade. Even today, the stock is up 11%. Big volumes from larger FIs, HNIs, is what I understand in the last couple of days. For Electra Green Tech, the next big trigger to watch would be the appointment of the new CEO. And of course, the numbers, my sense is this quarter numbers will be soft. Essentially, the numbers to track would be from next quarter. But in the very near term, the appointment of the new CEO is a big trigger to watch in Electra Green Tech.
Okay, big move in Electra Green Tech, very large volumes. Nimesh, thank you for that. Mitesh is now back with us. Mitesh, it's not gotten worse, but there is no sign of a recovery. No buying emerging at these levels. Your thoughts on the day and any BTST calls?
I think, we might not fall much, but I think the idea is that we might head towards the lower end of the range, close to about 24,900. And on the stock side, Nestle is seeing some kind of a breakdown on the charts. So STVT here, keep a stop about 2345, look for targets below 2300. And the one stock which really could be on the positive side is Jindal Steel and Power. So BTST there with the stop at 990 for targets of 1005.
Okay. All right. Got it. Thanks very much for that, Mitesh. And thank you for all the trading advice for today. We'll catch you again with the market action tomorrow morning. Okay, let's continue our spotlight on earnings. And one more disappointment today has been Nestle. The stock's been down 5%. Margins under pressure here as well. And a sharp reaction in the market. Mangalam's joining in. Mangalam, interestingly, I remember even Tata Consumer had a bit of a margin issue, but the market reaction there was very different. But here in Nestle's case, the market is very unforgiving. Tell us more.
Yeah, it's confounding, the kind of move that is taking place in Nestle, especially given the market that we're currently in, the numbers that the company reported, and more importantly, the outlook that the company gave as well. Why do I say that? Because yes, you know, the margins were slightly below street expectations, but that was on account of a couple of factors. One, the revenue was slightly above street expectations, and the EBITDA was just mildly below. So the compounding effect of higher than expected revenue and slightly lower than expected EBITDA on an absolute basis has the margin impacted. But if you look at the management commentary, two things really stand out. One, demand is improving, and on the other hand, costs are reducing. So things are looking better for Nestle from here on. Yes, there was a miss on the net profit, 659 crores versus street expectations of 750 plus crores. But that's largely because of a non-cash expense, which is depreciation, presumably on account of the Sanand plant coming on stream. Finance costs were higher, but the company has attributed that to a temporary mismatch in cash flow, and that has been taken care of as well. So there were a couple of one-offs. But going forward, they've said that rural demand, urban demand as well as urban demand, both of them have begun to pick up for the company. The quarter was impacted by elevated consumption prices across the commodity portfolio, but from here on they are seeing stability, especially in edible oil as well as cocoa prices, which are coming down along with coffee. And given the fact that it's a normal monsoon, even dairy prices are likely to come down. So going forward, margins are likely to improve as you know, demand improves and commodity prices come down. And also the big trigger that we have for all FMCG companies that we've been talking about, leadership change. Suresh Narayan's glorious tenure ends at Nestle. We have Manish Tiwari starting out as the MD CEO of the company from August 1st. So things are aligning, but the stock price is lower in today's trading session, telling you about the confounding moves that we're seeing in Nestle.
Okay, all right. Thanks very much for that. Indeed, and yeah, thanks for putting that on the radar as well. Big CEO change happening at Nestle as well, MD and CEO. Okay, that's Nestle India, 5% lower. Since we're talking about the consumer space, let's get you inputs from one more company. The focus is on McDonald's franchisee Westlife, and we're talking about you know, the company coming out with numbers yesterday. The numbers were fairly decent. And speaking to CNBC-TV18, the management points out to the company's steady showing despite a tough macro environment. I think this is Mr. Jatia. Let's listen into what he has to say.
There has been some macroeconomic headwinds. The entire category has seen a little bit of resistance in terms of growth. But I think, as we've covered in most of our recent communication, we're quite enthused with a lot of our efforts on the ground. We have delivered, 3 consecutive quarters of positive same-store sales growth in a very tough environment. We are seeing a lot of traction in, West India. We are intervening more specifically in South India. But we're confident, with the experiments, with initiatives like this that we have implemented, the green shoots are visible, and we are confident to get back onto our trajectory of growth to deliver our Vision 2027.
Okay, all right. Well, let's welcome our next guest. We have Ambrish Balika, who joins us on the show. Hi, Ambrish. Good afternoon. Good to see you in. What's that one stock you have for us today?
The stock is JSW Infra. Second largest private commercial port operator with a capacity of 177 million tons per annum. Operates about 14 ports on both West and East Coast with liquid storage terminal at UAE. Growth has been through strategic expansion and acquisition. And I think last year they acquired Navka Corporation. Recently they acquired JSW Utkal Steel slurry pipeline business. In fact, here, we are seeing a huge growth, over the next couple of years. In fact, JSW's target capacity by 2030 is about 400 million tons, which is about 2.5 times the current capacity. And in that, the third-party volumes would be much higher as compared to right now, because currently it's about 50-50. So there the percentage would be higher, which actually means much better margins. And if you look at the Q1 FY26 numbers which have come, revenue growth was about 22%, EBITDA increased by 21%, margin has been maintained at about 50% plus. So for FY27, I'm looking at an EPS of about 11.5, and on that, my target price is about 410.
Okay, hold on, Ambrish. We just want to quickly get a look in on Bajaj Finance and the estimates that the street has as it reports numbers later today. Gaurav joins in.
Well, as when it comes to Bajaj Finance, we have already seen AUM growth of around 25%, which was strong. Even they added customers at a growth of around 21% on a year-on-year basis. And considering these numbers, now the street is expecting net interest income to increase almost by 22%. Now, in this quarter, we may see softer growth for other income because they have stopped their co-lending cards. And when it comes to net interest margins, now we may see flattish net interest margins on a sequential basis. Considering all these effects, all this effect, the pre-provisional operating profit is likely to grow in this tandem with net interest income at around 21% on a year-on-year basis. Now coming to the asset quality aspect, when we talk about credit costs in this quarter, we may see credit costs coming down a bit because in the last quarter we had ECL provisioning from the company, and that is the reason why credit cost looks elevated. So Street is expecting 20 to 25 basis point of moderation in credit cost on a sequential basis. Let's not forget that they also have given a guidance of 185 to 195 basis point of credit cost in FY26. So that is likely to remain in line with that. And as a result, profit is likely to increase almost by 17%. Now, when it comes to the commentary, there is something which we will be watching out for is the credit cost commentary. Let's not forget that the company has said that in FY26 they will be having ROAs of around 4.4 to 4.6%. So definitely any kind of changes there is something that we will be watching out for. And at the same time, how the net interest margin commentary is going to be something, a key thing to watch out for. Let's also not forget that recently we saw a management change. So any kind of commentary there is also something which will be important. But at least for now, in terms of number, we're expecting good set of number from Bajaj Finance.
Okay, all right. Market can do with some good numbers for sure. Gaurav, thanks for that. Let's see if Bajaj Finance can indeed deliver. So back to the screen now. About 150 points still down as far as the index is concerned. Let's look at some of the stocks. We were talking about Thyrocare Industries earlier, and that stock has been up and about. One of the few names that's holding out in positive territory, 3.5% up. The deal is done, the acquisitions happened, and you heard it first right here on CNBC-TV18, courtesy Nigel D'Souza. So, Nigel, now tell us what this implies for Thyrocare.
Well, Surbhi, even after all these years, it still gives that high, right? You heard it first, and now it's official.
Yeah.
Here at CNBC-TV18 told you this is likely to be the case, and bang on, that's what happened. Thyrocare Industries has gone ahead and acquired Imperial Blue from Pernod for around 4,150 crore rupees. Now, this is a massive deal in itself. Why is that? Because the deal is close to around $500 million, and it's the largest deal since United Spirits Diageo took place. And the numbers are telling the picture. That's what Thyrocare's revenues are. Since they're acquiring Imperial Blue, it'll go up by nearly around 3 times. So from a 1,400 crore company, they're going to become a 4,500 crore company. Even if you look at it in terms of cases sold, from around 11.9 million cases, now they'll get added close to around 22 million cases. So in totality, the capacity is going up by nearly around, from around 11, it's going up by 3 times. So there'll be 33 million tons or thereabouts. Management says it will be EPS accretive immediately. That's a positive in this sell because the street is a little bit cautious whether or not they were looking to take a larger sip than what they can handle. But the deal is done at around 1.3 times, on sales. Which is pretty good. Sales is around 3,000 crores. They've done it around 4,100 crores. 1.3 times is something that the street would like, and they're getting a penetration into the largest segment in India, which is the whiskey market, which is 63% of India's alcohol market. The breakup of the debt as well as equity, what they have taken a go-ahead to maximum amount, 2,500 crores of equity. Maximum amount in terms of debt will be 4,000 crores. So we'll have to wait by to see what is the exact split between this. As of the last recorded number, they had more than 100 crores of cash. The key to track from here on will be Imperial Blue's margins. How can they scale up those margins? Point number 1. Point number 2, they're talking about cost benefits because they're saying it's going to be EPS accretive right out of the, right from the word go itself. So we'll keep an eye on both those 2 parameters. But why does the street like this? Because it's giving them scale. Suddenly they're moved into the big league. They're going to be a 4,500 crore revenue company. They're also going to be getting pan-India presence in comparison to South India presence. And they're going to be diversifying away from just being a brandy player only in South India to a pan-India player in the whiskey market. So even after such a big run-up that you've seen in the last few sessions, the street is still bidding up the stock. Ambrish, up for a drink or not? Thyrocare has run its course. A bullish argument would be that United Spirits is a 1 lakh crore market capitalization. And it does sales of around 12,000 crores. Out here, you're going to have a company that's doing around 4,500 crores of sales. And the current market cap is around 9,000 crores. Even if you put in some equity raise, it'll still be, in the vicinity of around 13,000 crores approximately.
That's true.
What is your take? Have they picked up a too stiff a peg? Or do you think this is a re-rating event?
No, see, if you see from a valuation perspective, I think it's a great buy, no doubt. And on paper, everything looks good. But the question is, how will they manage this transformation? I mean, increase of turnover by about, nearly 3.5, 4x. Because you go back 10 years for Thyrocare, their top line was 800 crores. From there, it's not even doubled. So how will they manage this growth is a big question. And in case they are able to do that well, yes, like what you said, the discount between United Spirits and this should narrow down to a certain extent. It can't it can't be equal, but surely it can narrow down from where it is right now. I think that's the game one has to play. But already we have seen Tilaknagar moving up decently well. Based on possibly expectations of a deal like this, and especially after you start talking about it. So I think at these levels, since it's already announced, I don't see too much of an upside from here. Whatever upside would be there, maybe for traders, not for investors. As an investor, I would possibly wait and see, like what I said, as to how they manage this growth.
Okay, all right, got it, Amrish. Stay on, we'll have more questions for you in just a bit. That's the SBI Life number flashing on the screen. We only have the profit number now. Look at the internals. Our poll is suggesting the APE should be up by about 7%, and we're talking about retail APE up about 4%. The initial reaction seems to be positive on the stock. So we'll come back and try and get some more color on this and see, get to more numbers beyond just the profit one. Well, on that note, let's take a quick break. And here's a reminder to all our viewers as we slip into this break, you can unlock a world of exclusivity, expertise and influence. Become a member of CNBC-TV18 Access, our premium members-only experience on CNBC-TV18.com. The membership includes access to CNBC-TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions and masterclasses, and curated lifestyle benefits.
Welcome back. IEX is 28% down now, 135 rupees. I think the low today was about 131. So it's off the lows, but 28% gone. Amrish, at what point does value emerge in a stock like IEX?
I think some more way down, because every time there were rumors of this coupling coming out, it used to fall and then bounce back. But this time is different, and this time it will not bounce back because it's now final that from January it will happen. So I don't really see it, bouncing back from here. Possibly we could see levels of 105, 110. At those levels, I think we'll have to again review and see whether we would buy it at those levels or not. But as of now, not a buy.
Okay, just one more question. You know, on Coforge, that's now down 10%. What exactly about this data center investment that the street doesn't like? You know, they're investing about 500 crore rupees. What is so wrong in this investment?
Rima, in fact, I have not really looked at it very closely, so a bit difficult to comment on this.
Amrish, any view on Jaiswal Neko? The reason I ask you this is because today there are 35 crore shares that have got traded. And the amount that's been marked for delivery is close to 10 crore shares. I was looking at the ARC, they had 25 crore shares in the company. And just in the month of July, they've sold close to around 4 crore shares. Interesting times, but their EBITDA contribution was improving. Their interest cost was falling as well. However, promoter intent is important because we know the past record has been very, very sketchy. Any view on this name?
No, again, Nigel, this is another stock which I don't really keep a tab on. So quite difficult to really talk on this.
Got it. Okay, all right. We have some cement earnings as well that have come in. Amrish, where ACC's numbers actually were not looking too bad. The positive in those numbers was that, in fact, we did see the volume growth that outbeat. Do you like anything from there?
In fact, in the cement space, I think from now onwards, maybe over the next 2 to 3 quarters, we should really start seeing a decent uptick as far as margins are concerned. Because if you see the last 3-4 years, the demand has been extremely good, will continue to be good. But we only saw volume growth earlier. But looking at the supply-demand mismatch, which will come up because of the capacity additions not really happening to the extent expected, we would clearly see the prices moving northwards, and because of which clearly you'll see the margins also improving from here on. So in addition to ACC, I would surely look at something like a Ultratech. JK Lakshmi is the other one where I've been giving a buy and still continue to buy at these levels.
Eternal, 20% up this week. What would you do?
Eternal, I think at these levels one should hold on. But fresh buying, I'll possibly wait for a while. Because post the earnings, the sentiment has really improved quite a lot. Although the stock was performing well even before the earnings came out, but then I think at these levels it's becoming a tad bit expensive. As of now, I'll hold on, but in case I see levels of 260, 270 on a correction, either because of any news or because of the market correction, I think that's the time I would look to buy fresh.
Amrish, stay on. Just wrapping up today's trading session. Tough one, 160 points lower on the Nifty ending at 25,050. So the rub-off from the positive Asian markets didn't help. Midcap index also down close to about 0.6%. The problem really was IT. The Nifty IT index ending with a cut of close to about 2.2%. But other sectors, whether it's FMCG, realty, also seeing a downtick of nearly 1%. I think the only two sectors in the green, one was PSU Bank, so Canara Bank, etc. did quite well. That was up over 1%. And healthcare, very strong numbers. Dr. Reddy's did okay, but you had strength in Synoris and Thyrocare. Quick word on the large cap action. Eternal continues to be the big mover. 3.5% for the day, 20% for the week. Dr. Reddy's on the back of the numbers. Auto stocks generally excited today. Tata Motors leading. That India-UK FTA has also been signed. Details will be known at 5:30. On the way down, IT weak. Infosys, Tech Mahindra, and Nestle. That was the big drag, down 5.5%.
All right. Well, a few more stocks actually from the broader markets that did do well today. Samvardhan Motherson, that was up 4.5%. Tilaknagar Industries, after the big run, that continued its run today. You had Paisala Digital, that's another one that was up close to 10%. PNB Gills as well was running along.
PTC India, an indirect play on a beneficiary of IEX coming in the dock and that coupling being introduced out there. So those are the big volume gainers. On the flip side, you had other names like Dam Capital was down 4.5%, Reddy, Natco Pharma yesterday saw a big spike up. Someone sniffed the deal. It seems that stock came in for big profit taking. MRPL as well, that stock was down close to around 2.5% or thereabouts. At the bottom of your screen, you have Bajaj Finance that is reporting their numbers out there. But let's hop across to UK's Prime Minister addressing the media after signing the landmark India-UK Free Trade Agreement.
And it will deliver benefits for the long term. It will add about £4.8 billion to the UK economy every year and £2.2 billion to wages and hundreds of millions of pounds to regions and nations up and down the United Kingdom.
और ये यहाँ के कंज्यूमर के लिए बहुत अच्छा रहेगा और ये दोनों देशों में जो बातचीत होगी, ट्रेड होगी, जो बढ़ेगा.
Don't bother, we can use English words in between. Don't worry about it.
Sorry, His Excellency, I've lost the speed. His Excellency, I've lost the speed.
Yeah, no problem. Yeah.
Sorry, do you want me to repeat? Yes, okay. I think we understand each other well. I mean, look, and we both know this is the biggest and most economically significant trade deal that the UK has made since leaving the EU. And I think I can say that it's one of the most comprehensive deals that India has ever done. So thank you, Prime Minister, for your leadership and for your pragmatism. And I'd like to thank everybody who's worked so hard to get this deal over the line.
और आज ये जो बहुत बड़ी कॉम्प्रिहेंसिव डील तैयार की है और कामयाब की है, उसके लिए मैं आपको बहुत बहुत शुक्रिया कहना चाहता हूं, प्राइम मिनिस्टर साहब. और ये दोनों टीम जहां काम करके ये जो काम पूरा किया है, इसके लिए मैं बहुत खुशी हूं.
And, as I've said before, and as we were just discussing in our tete-a-tete, we've entered a new global era, and that is one that requires us to step up, not to stand aside, to deliver for the British people by building deeper partnerships and alliances. And today is very much confirmation of that approach.
और अभी वहाँ पे बात सब कर रहे थे आपके साथ बैठ के हमने बातें की कि नई ग्लोबल इरा पैदा करनी है और इसके लिए हमको सब कुछ करना है जो हम सक्षम है, जिसके बाद ब्रिटिश लोगों को यहाँ पे बहुत ही बड़ी पार्टनरशिप मिलेगी आपके देश से और यहाँ पे जो हम करने वाले हैं उससे दोनों देशों को फायदा होगा.
And the UK has been negotiating a deal like this for many years, but it is this government that got it done. And with it, we're sending a very powerful message that Britain is open for business. And that is already generating huge confidence. Today we're announcing nearly £6 billion in investment and export wins between India and the United Kingdom, creating over 2,200 jobs for British workers.
और ये जो ऐसी नेगोशिएशन मैं पहले बहुत की है, पर ये जो अभी हमने किया है ये बहुत ही बड़ा होगा क्योंकि ब्रिटिश लोगों को और संसार को ये जानेंगे कि ब्रिटेन इज ओपन फॉर बिजनेस, व्यापार के लिए खुला है और ये ब्रिटिश लोगों के लिए भी बहुत अच्छा होगा क्योंकि ये 6 बिलियन पाउंड्स के 6 बिलियन पाउंड्स यहाँ पे नहीं पैदा होगा और यूके और इंडिया ने जो ये साथ काम करने का निर्णय किया है इससे 2,200 जॉब्स भी पैदा होंगे यहाँ पे.
But of course, as we've discussed this morning, this is not the extent or the limit of our collaboration with India. We have unique bonds of history, of family, and of culture. And we want to strengthen our relationship further so that it is even more ambitious, modern, and focused on the long term, the step up in the relationship that we discussed in the autumn of last year. And that's why, alongside this trade deal, I am delighted that we're building on our partnership by launching our India-UK Vision 2035 strategy, pledging to work more closely on areas such as defence, migration, climate, education and health.
और इस सुबह जब हमने बात की थी कि एक आपस के साथ कोलैबोरेट करेंगे, इससे ये साबित होता है कि हम लोग अपनी इतिहास, फैमिली और संस्कृति को बहुत ही मजबूत बनाना चाहते हैं और जो मजबूत रहा है, और इसीलिए भविष्य में हम ये दोस्ती, ये रिश्ता स्टेप अप करना चाहते हैं। वो ट्रेड डील बना के और इंडिया और यूके 2035 विजन के आधार में वो जो डिफेंस है, माइग्रेशन है, एजुकेशन है, उस पे ध्यान देके।
We will also build on the fantastic work we already do in technology and innovation, celebrating the one-year anniversary of the landmark Technology Security Initiative and making the most of the opportunities it represents for both of our countries.
और टेक्नोलॉजी और इनोवेशन के क्षेत्र में भी अभी एक पहली एनिवर्सरी मनाया है जो हमने, वो टेक्नोलॉजी, इनोवेशन, सिक्योरिटी के आधार पे है और ये आगे बढ़ेगा, इसका पूरा विश्वास है।
Work together as we strengthen security, growth and prosperity for working people in both of our nations. So let me now hand over to you to say a few words, and thank you again for your leadership on this.
Sorry.
प्रधानमंत्री स्टार्मर, friends, namaskar.
Prime Minister Starmer, friends, namaskar, good morning.
सबसे पहले मैं प्रधानमंत्री स्टार्मर के गर्मजोशी भरे स्वागत सत्कार के लिए हार्दिक आभार व्यक्त करता हूं। आज हमारे संबंधों में एक ऐतिहासिक दिवस है। मुझे प्रसन्नता है कि कई वर्षों की मेहनत के बाद आज दोनों देशों के बीच कॉम्प्रिहेंसिव इकोनॉमिक एंड ट्रेड एग्रीमेंट संपन्न हुआ है।
First of all, let me extend my heartfelt gratitude to Prime Minister Starmer for the warm welcome and gracious hospitality. Today marks a historic day in our bilateral relations. I am pleased to note that after many years of hard work, the comprehensive economic and trade agreement between our two countries has been concluded today.
यह समझौता मात्र आर्थिक साझेदारी नहीं, बल्कि साझा समृद्धि की योजना है। एक और भारतीय टेक्सटाइल, फुटवियर, जेम्स एंड ज्वेलरी, सी फूड और इंजीनियरिंग गुड्स को यूके में बेहतर मार्केट एक्सेस मिलेगा। भारत के एग्रीकल्चर, प्रोड्यूस और प्रोसेस्ड फूड इंडस्ट्री के लिए यूके की मार्केट में नए अवसर बनेंगे। भारत के युवाओं, किसानों, मछुआरों और एमएसएमई सेक्टर के लिए यह समझौता विशेष रूप से लाभकारी सिद्ध होगा। वहीं दूसरी ओर भारत के लोगों और इंडस्ट्री के लिए यूके में बने प्रोडक्ट्स जैसे मेडिकल डिवाइसेस और एरोस्पेस पर सुलभ और किफायती दरों पर उपलब्ध हो सकेंगे।
This agreement does not merely pave way for economic partnership, but is also a blueprint for our shared prosperity. On the one hand, Indian textiles, footwear, gems and jewelry, seafood, engineering goods will get better market access in the UK. Indian agricultural products, processed food industry will find new opportunities in UK's market. This agreement will prove especially beneficial for India's youth, farmers, fishermen and MSME sector. On the other hand, people and industries in India will be able to access products made in the UK, such as medical devices and aerospace parts at affordable and attractive prices.
इस समझौते के साथ ही डबल कंट्रीब्यूशन कन्वेंशन पर भी सहमति बनी है। इसे दोनों के सर्विस सेक्टर, विशेषकर टेक्नोलॉजी और फाइनेंस के उसको एक नई ऊर्जा मिलेगी। ईज ऑफ डूइंग बिजनेस को गति मिलेगी। कॉस्ट ऑफ डूइंग बिजनेस घटेगा और कॉन्फिडेंस ऑफ डूइंग बिजनेस बढ़ेगा। साथ ही यूके की अर्थव्यवस्था को भारतीय स्किल टैलेंट मिलेगा। इन समझौतों से दोनों देशों में निवेश बढ़ेगा और रोजगार के नए अवसर बनेंगे। इतना ही नहीं, दो लोकतांत्रिक देशों और विश्व की दो बड़ी इकोनॉमीज के बीच हुए यह समझौते वैश्विक स्थिरता और समृद्धि को भी बल देंगे।
Along with this agreement, we also have reached a consensus on the Double Contribution Convention. This will inject new energy into the service sectors of both countries, especially in technology and finance. It will promote ease of doing business, reduce from India's skilled talent. These agreements will enhance investments and generate new employment opportunities in both countries. Moreover, as agreements reached between two democracies and two of the world's major economies, they will lend support to global stability and global prosperity.
फ्रेंड्स, अगले दशक में हमारी कॉम्प्रिहेंसिव स्ट्रेटेजिक पार्टनरशिप को नई गति और ऊर्जा देने के लिए विजन 2035 जारी किया जा रहा है। यह टेक्नोलॉजी, डिफेंस, क्लाइमेट, एजुकेशन और पीपल टू पीपल कनेक्ट के क्षेत्रों में एक मजबूत, भरोसेमंद और महत्वाकांक्षी साझेदारी का रोड मैप बनेगा।
Friends, to give new momentum and energy to our comprehensive strategic partnership in the coming decade, today we are launching our Vision 2035. Vision 2035 is a roadmap that will form the basis of a strong, trustworthy, and ambitious partnership in the fields of technology, defense, climate, education, and people-to-people connect.
डिफेंस और सिक्योरिटी में साझेदारी के लिए डिफेंस इंडस्ट्रियल रोड मैप बनाया गया है। हमारी टेक्नोलॉजी सिक्योरिटी इनिशिएटिव को और मजबूत करने पर काम किया जाएगा। It is our commitment that from AI to critical minerals, semiconductors to cyber security, we shall create the future together.
A defense industrial roadmap has also been drawn up for partnership in defense and security. Work will continue on strengthening our technology security initiative. It is our commitment that from AI to critical minerals, from semiconductors to cybersecurity, we shall create the future together.
Friends, शिक्षा के क्षेत्र में भी दोनों देश मिलकर एक नया चैप्टर लिख रहे हैं। यूके की 6 यूनिवर्सिटीज भारत में कैंपस खोल रही हैं। पिछले हफ्ते ही भारत के गुरुग्राम शहर में साउथ हैम्पटन यूनिवर्सिटी कैंपस का उद्घाटन हुआ है।
Friends, in the field of education too, we are writing a new chapter together. 6 universities of the UK are opening their campuses in India. Just last week, the University of Southampton inaugurated its campus in the city of Gurugram in India.
फ्रेंड्स, पहलगाम में हुए आतंकवादी हमले की कठोर निंदा के लिए हम प्रधानमंत्री स्टारमर और उनकी सरकार का आभार व्यक्त करते हैं। हम एक मत हैं कि आतंकवाद के खिलाफ लड़ाई में दोहरे मापदंडों का कोई स्थान नहीं है। हम इस बात पर भी सहमत हैं कि एक्सट्रीमिस्ट विचारधारा वाली शक्तियों को डेमोक्रेटिक फ्रीडम का दुरुपयोग नहीं करने दिया जा सकता। Those who misuse democratic freedoms to undermine democracy itself must be held account. इकोनॉमिक ऑफेंडर्स के प्रत्यार्पण के विषय पर भी हमारी एजेंसी सहयोग और समन्वय से काम करती रहेगी।
Friends, we thank the Prime Minister and his government for strong condemnation of the terrorist attack in Pahalgam. We are united in the belief that there is no place for double standards in the fight against terrorism. We also agree that the forces which espouse extremist ideologies should not be allowed to misuse democratic freedoms. Those who misuse democratic freedoms to undermine democracy itself must be held to account. Our security agencies will continue to enhance cooperation and coordination on matters such as the extradition of economic offenders.
Friends, इंडो-पैसिफिक में शांति और स्थिरता, यूक्रेन में चल रहे संघर्ष और पश्चिम एशिया की स्थिति पर हम विचार साझा करते रहे हैं। हम जल्द से जल्द शांति और स्थिरता की बहाली का समर्थन करते हैं। सभी देशों की संप्रभुता और क्षेत्रीय अखंडता का सम्मान अनिवार्य है। आज के युग की मांग विस्तारवाद नहीं, विकासवाद ही है।
Friends, we have continued to exchange views on peace and stability in the Indo-Pacific, the ongoing conflict in Ukraine, and the situation in West Asia. We support early restoration of peace and stability. Respect for sovereignty and territorial integrity of all countries is essential. Today's era demands development, not expansionism.
Friends, पिछले महीने अहमदाबाद में हुई दुर्घटना में मारे गए लोगों में कई यूके के नागरिक भाई बहन भी थे। उनके परिवार वालों के प्रति हम संवेदनाएं प्रकट करते हैं। यूके में रहने वाले भारतीय मूल के लोग हमारे संबंधों में एक लिविंग ब्रिज का काम करते हैं। They did not just bring curry from India, but also creativity, commitment and character. इनका योगदान सिर्फ यूके की समृद्ध इकोनॉमी तक सीमित नहीं है, बल्कि यूके के कल्चर, स्पोर्ट्स और पब्लिक सर्विस में भी दिखता है।
Friends, last month in the unfortunate plane crash in Ahmedabad, our sisters and brothers of the UK were among those who lost their lives. I would like to express my deepest condolences to the families of the victims. The people of Indian origin in the UK form a living bridge that connects our two nations. They did not just bring curry from India, but also creativity, commitment, and character. Their immense contributions are not just limited to UK's prosperous economy, but are also visible in UK's culture, sports, and public service.
Friends, जब भारत और यूके मिले और वह भी टेस्ट सीरीज के दौरान, तो क्रिकेट का उल्लेख तो करना ही पड़ता है। For both of us, cricket is not just a game, but a passion, and also a great metaphor for our partnership. There may be a swing and a miss at times, but we always play with a straight bat. We are committed to building high-scoring, solid partnership. आज संपन्न हुए समझौते और विजन 2035 इसी स्पिरिट को आगे बढ़ाने वाले माइलस्टोन है.
Friends, I would be remiss not to mention cricket when India and the UK are coming together, especially during a test series. For both of us, cricket is not just a game, but a passion. And also a great metaphor for our partnership. There may be a swing and a miss at times, but we always play with a straight bat. We are committed to building a high-scoring, solid partnership. The agreements concluded today and Vision 2035 are milestones which advance this very spirit.
प्रधानमंत्री जी, मैं एक बार फिर आपके आतिथ्य सत्कार के लिए आभार व्यक्त करता हूं. मैं आपको भारत यात्रा करने का निमंत्रण भी देता हूं और आशा करता हूं कि हमें शीघ्र ही भारत में आपका स्वागत करने का अवसर मिलेगा. बहुत बहुत धन्यवाद.
Prime Minister, I thank you once again for your warm hospitality. I would also like to take this opportunity to extend an equally warm invitation to you to visit India. I am eagerly looking forward to hosting you in India very, very soon. Thank you very much.
Thank you. Thank you.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: India and the UK sign a free trade agreement. Average tariffs to be reduced from 15% to 3%. Tariffs removed on nearly 99% of goods and services traded between both countries. Prime Minister Modi and Prime Minister Starmer say the deal will boost bilateral trade by $35 billion annually. The US and the European Union move closer to a trade deal ahead of the 1st of August deadline. President Trump says EU will fully fund the purchase of American weapons, some of which will be sent to Ukraine. Trump also says Washington is in the process of completing a deal with China. President Trump tells US tech companies to put America first, says the days of companies reaping the blessing of American freedom while building factories in China and hiring workers in India are over. Positive global cues failed to lift Dalal Street. The Sensex and the Nifty declined by nearly 1%. Midcaps fall in tandem with the blue chips. IndusInd Bank gets the board's approval to raise 30,000 crore rupees. Hinduja set to increase their presence on the board as RBI allows promoters to amend the Articles of Association and nominate up to 2 directors. Shares of Indian Energy Exchange plunged 30% a day after India's electricity regulator announces a mechanism known as market coupling. The fall is the second steepest decline among BSE 500 stocks in the last 5 years, behind only Z Entertainment. Market coupling will allow energy markets to create a single uniform price for electricity across different trading platforms and end the IEX dominance. Former Economic Affairs Secretary Ajay Seth appointed as the new chairman of the insurance regulator, the IRDAI, for a 3-year term. RBI, SEBI and the IRDA now being helmed by former Finance Ministry bureaucrats. The Enforcement Directorate raids 40 sites linked to Anil Ambani. Sources say the raids are in connection with the Reliance Communications allegedly defrauding banks with loans over worth 14,000 crores. Anil Ambani Group companies say the raids have no impact on their businesses. Alphabet earnings top expectations. The tech giant announces it will hike capital investments by $10 billion this year. Backlash against Elon Musk in Europe hurts Tesla. The EV giant reports its biggest quarterly revenue decline in more than a decade. Musk warns of a few rough quarters going forward. A passenger plane with 49 people on board crashes in Russia's far eastern region bordering China. The flight, operated by Siberia-based Angara Airlines, vanished from the radar and lost contact with air traffic controllers. Armies of Thailand and Cambodia exchange fire as a border dispute flares up. Thailand closes the borders, launches airstrikes after claiming Cambodia attacked 9 civilians. Well, straight to the top story this evening. India and the UK have signed a free trade agreement which is estimated to boost bilateral trade between both nations by $35 billion annually. British Prime Minister Keir Starmer received Prime Minister Modi at the Chequers House. During the visit, both leaders will review bilateral trade ties and discuss issues including technology, investment, climate, defence and migration. As part of the trade deal, India will lower its average tariffs on products from the UK from 15% to 3%. British Prime Minister Starmer has said India and the UK are launching the Vision 2035 strategy to work more closely on defence and health, while Prime Minister Modi said that Indian security agencies will continue to enhance cooperation and coordination on matters such as extradition of economic offenders.
Those who misuse democratic freedoms to undermine democracy itself must be held account. इकोनॉमिक ऑफेंडर्स के प्रत्यार्पण के विषय पर भी हमारी एजेंसी सहयोग और समन्वय से काम करती रहेगी.
This is the biggest and most economically significant trade deal that the UK has made since leaving the EU. And I think I can say that it's one of the most comprehensive deals that India has ever done, boosting wages, raising living standards, and putting more money in the pockets of working people. It is good for jobs, it is good for business, cutting tariffs and making trade cheaper, quicker and easier.
Cricket is not just a game, but a passion. And also a great metaphor for our partnership. There may be a swing and a miss at times, but we always play with a straight bet, we are committed to building high-scoring, solid partnership.
While using the cricket analogy there, that's Prime Minister Modi and Prime Minister Keir Starmer. Parikshit standing by with more on the India-UK trade agreement. Parikshit, deal finally done. Of course, both sides believe that this is going to be a win-win. Take us through some of the specific contours on what this deal will mean for both sides.
The India-UK FTA will boost bilateral trade by $35 billion annually. The deal reduces the average tariff on UK products from 15% earlier to 3%. UK's soft drinks, cosmetics, cars, medical devices, Scotch whisky, gin and lamb to get cheaper in India and will get better market access. The UK government has said that UK clean energy companies will have unprecedented access to the Indian procurement market. Through this FTA, UK's financial services and professional businesses will get certainty to expand, and insurance companies will benefit from binding foreign investment cap in the insurance sector. UK and Indian financial services companies will be treated equally after this FTA, said the UK Prime Minister's office. India's labour-intensive sectors will benefit from zero duties in UK. Sectors such as leather and footwear, textiles, engineering goods, chemicals, fertilizers, plastics, sports goods, toys will benefit from zero duty access. Also, engineering goods for that matter. Tariffs will also be reduced on gems and jewellery. The FTA eliminates duties on 95% of agri-tariff lines, and Indian fruits, vegetables, cereals, processed foods will also get cheaper in the UK. Duties to be eliminated also on 99% of marine exports from India to the United Kingdom, such as shrimps and tuna. Indian coffee and craft drinks such as Fenny and wines to get cheaper in the United Kingdom. Agriculture exports to UK to rise by over 20% in 3 years, according to the Indian government estimates. However, India will not compromise on dairy, apples, oats, edible oils and other sensitive sectors. There will be greater opportunity for Indian professionals such as those in IT, financial services, management consultancy, architecture, engineering. The FTA will also ease mobility for contractual service suppliers, professionals like chefs and yoga instructors, and there will also be relief from double social security contributions.
All right, Parikshit, many thanks for joining us. We will, of course, get our viewers more comprehensive coverage of the FTA and what it means for India Inc. and for us as consumers. Stay tuned to CNBC TV18. We've got special programming lined up for you. Well, staying with trade, the US and the EU have moved closer to a trade deal ahead of the 1st of August deadline. Speaking at the AI summit in Washington, D.C., President Trump has said that EU will fully fund the purchase of American weapons. He added that some of the weapons would be sent to aid Ukraine's war against Russia. However, a formal trade deal has not been announced yet by the US or the EU. President Trump also said that Washington is in the process of completing a deal with China.
We're in the process of completing our deal with China. And as you know, the UK, we made a deal. It was a very good deal for everybody. Everybody's happy. It's always nice when everybody can be happy. But mostly we'll be charging straight tariffs to most of the rest of the world because we have over 200 countries. People don't realize that's a lot of deals. We're making deals with various Asian countries that need it, and it's actually hard to believe. You don't think of it, but Asia is very close to Alaska, relatively speaking. It's not the closest, but it is pretty much the closest when it comes to oil and gas and energy. Just made a deal with the European Union where they're going to pay the United States of America 100% of the cost of all military equipment. They're going to ship it to the European Union, and then they'll distribute it, and much of it will go to Ukraine. It's been a long time since you've heard those words, because we're in for $350 billion, but now we send it to Europe, and Europe pays.
Well, that's President Trump. Now, Chinese President Xi Jinping vowed to deepen ties with the EU as both sides kicked off a summit in Beijing to discuss the trade conflict and the Ukraine war. European Commission President Ursula von der Leyen urged the Chinese leader to address the rising trade imbalance between the two major economies. The summit marks 50 years since the establishment of EU-China bilateral relations. Now, President Trump has told U.S. tech companies to put America first. He said the days of companies reaping the blessings of American freedom while building factories in China and hiring workers in India are over. He added that the American tech industry's pursuit of radical globalism betrayed millions in the U.S.
Many of our largest tech companies have reaped the blessings of American freedom while building their factories in China, hiring workers in India, and slashing profits in Ireland. You know that? All the while dismissing and even censoring their fellow citizens right here at home. Under President Trump, those days are over. We need U.S. technology companies to be all in for America. We want you to put America first. You have to do that. That's all we ask.
And President Trump is set to make a rare visit to the Federal Reserve later tonight. He's set to join a previously arranged tour for several White House advisors of the construction site where the Fed is renovating its headquarters. This comes after Trump indicated that Fed Chair Jerome Powell's handling of the renovation could be grounds for firing. A U.S. president has not visited the central bank since 2006. Well, to the action on Dalal Street now. Positive global cues failed to lift sentiment on Dalal Street. The Sensex and the Nifty ending at the low point of the day after some sharp cuts. The Sensex lost over 500 points. The Nifty down 150. The Nifty Bank Index fared relatively better. Midcaps falling in tandem with the blue chips. Now, shares of Indian Energy Exchange plunging 30% a day after India's electricity regulator announced a mechanism known as market coupling. Now, this will allow energy markets to create a single uniform price for electricity across different trading platforms. The move will curb IEX dominance. Now, this fall is the second steepest decline among BSE 500 stocks that we've seen in the last 5 years, behind only Z Entertainment. Hormuz is standing by with more on the other times a stock has witnessed such steep losses on Dalal Street. A 30% cut for IEX Hormuz today. I mean, it's hard to stomach.
Hard to sum up indeed, and it's possibly the accident of the day, undoubtedly so. A 30% fall, the biggest drop on record for the stock itself. But this is not the first time that a stock has seen such a big intraday fall. In the last 5 years, we've seen many such accidents take place, and in fact, some of them in the last 12 months itself. We start off with the big one, though. Z Entertainment was that one. It was a 32% fall that took place in January of 2024, and this was the day when the company had called off its mega merger that it had announced with Sony, and that was the day when the stock had taken this knock that it saw. The IEX, of course, we spoke about it, 30% fall today after the market coupling norms, and analysts also cutting their targets on the stock, expecting more downside. So that's a 30% fall for IEX. Adani Enterprises was the one that fell almost 28% on the 1st of February of 2023, and that is the day when it had called off its mega 20,000 crore rupee FPO in light of the Hindenburg report that had come out, which led to the stock seeing that very, very sharp fall along with other group companies as well. IndusInd Bank, of course, the saga came to light this year itself in March. The 27% drop was the biggest that it has seen on record in its trading history after the derivative portfolio discrepancies came to light. The saga now hopefully brokerage is estimating that will end as FY26 moves on. Paytm is the other one, a value destroyer for all these months. 2021 was the date listed on the 18th of November. It listed at a discount. It continued to move lower and continues to remain below its IPO price even today. Now, REC and PFC, both of them saw 25%, 23% drop on the 4th of June last year. That was the day when the Lok Sabha election results were declared, and all of the PSUs had taken a big knock during that trading session. And lastly, Cyient, another 23% drop in January of this year, and this is after the company had cut its growth guidance for both revenue and margins of a key business vertical, and that is what caused this stock price to fall in January this year. So definitely not the first instance, but the street would be hopeful that it definitely is the last for sure.
Well, many thanks, Hormuz, for joining us. Stocks seeing the biggest single-day declines. IEX today down over 30%. Now, IndusInd Bank's board has approved a fundraise of 30,000 crore rupees. The move is anticipated to provide confidence to investors and improve the bank's balance sheet. Shares of the private lender were under pressure in trade today. Ritu joins us now with more. Ritu, take us through the bank's mega fundraise proposal and what it will mean.
Well, yes, the board of IndusInd Bank has approved a fundraise of up to 30,000 crore rupees, which is going to be subject to shareholder and regulatory approvals. Now, this includes up to 20,000 crores through debt securities, through private placements, and an additional 10,000 crore rupees through equity instruments like QIP, GDR, or EDR. Now, importantly, the RBI has also cleared an amendment to the bank's Articles of Association, which will allow the promoter group to nominate up to 2 non-executive, non-independent directors to the board of IndusInd Bank. Now, remember, even currently, promoters Hinduja Group already have 1 representative on the board, which is Sudeep Basu, and this amendment will now allow them to have up to 2 representatives. Now, IndusInd Bank already maintains a healthy CET1 ratio of 15.1% and overall capital adequacy of 16.24%. So this capital raise is really being positioned not out of necessity as much as a strategic move. And analysts on the street are calling it confidence capital, which is aimed at reassuring investors really, especially following the prior asset write-offs and the current accounting issues that the bank is grappling with. Now, after this fundraise, the CET1 ratio is expected to rise to about 17.5%, which will imply a 240 basis point capital accretion. Now, if the bank does go ahead with this equity fundraise, we understand the promoter group, which currently holds about 15% stake in the bank, may also participate to avoid their stake dilution, as they have previously indicated in statements and even in their interviews to us. And this capital infusion by the promoters could also give a positive signal to the street.
Ritu, many thanks. Now, the government has appointed former Department of Economic Affairs Secretary Ajay Seth as the new chairman of the insurance regulator, the IRDAI. He will hold the post for 3 years. The post has been vacant since March of this year after Debashish Panda finished his tenure. Seth has over 33 years of experience in public service. RBI, SEBI and now the IRDAI are all being helmed by former Finance Ministry bureaucrats. The Enforcement Directorate conducted searches at nearly 40 locations linked to Anil Ambani's Reliance Group companies in connection with an alleged money laundering case. Sources say the raids are in connection with Reliance Communications allegedly defrauding banks over loans worth 14,000 crore rupees. Santya is here with the details.
Shireen, ED started raiding premises linked to Anil Ambani and Anil Ambani group of companies this morning. Right now, we are outside one of the locations where the raids started this morning. And as we speak, raids are underway at 40 premises linked to Anil Ambani and Anil Ambani group of companies and 25 people. ED is investigating charges of money laundering and loan defraud and illegal diversion of funds to the tune of 14,000 crore rupees. And according to ED says that its charges and the investigation is also built on input which it received from other agencies like SEBI. Now, ED says that the investigation pertains to Yes Bank loan fraud case and other cases. Now, talking about the overall amount is 14,000 crore, over 14,000 crore rupees as per the ED investigation, and this is just preliminary investigation. ED is investigating charges of siphoning of public money and cheating public banks, investors, shareholders. Also, ED is looking into charges of bribing promoters and executives of Yes Bank and Canada Bank as well. Now, ED says that the raids started this morning. As of now, the raids continue. ED is looking into the charges of illegally diverting the funds. According to ED, the loans were secured in an illegal manner, and then later the loan money was actually diverted into what appears to be shell companies. ED is looking into all these charges as of now, and as we speak, the raids are underway in Mumbai and Delhi. In fact, some residences of top executives of the company are also being raided at present. Shireen.
All right, Santya, many thanks for joining us. In earnings, Nestle has reported a weak set of numbers in the first quarter, missing street estimates on most fronts. Net profit down over 13%, revenues grew 6% on an annual basis. The company said the quarter was impacted by elevated consumption prices across the commodity portfolio. The management also said the company witnessed higher operation costs due to significant expansion in manufacturing in the last 7 to 8 months. Google's parent company Alphabet surpassing expectations on revenues and earnings per share in Q2. Net income increased nearly 20% on an annualized basis. The company also said it would raise capital investment by $10 billion in 2025. The tech major also raised its capital investment figure from $75 billion to $85 billion, citing strong demand for its cloud products and services. Staying with global earnings, auto giant Tesla posting weak numbers, missing street estimates. The company reported a 16% drop in auto revenue and sales, plummeted for a second straight quarter on an annual basis. Elon Musk says the company will face few rough quarters. Time for a break, but up next, Air India gets 4 show cause notices from the aviation regulator. That and more when we return. The aviation regulator, the DGCA, has issued 4 show cause notices to Air India. The notices concern scheduling of crew, training and safety standards. Madhya is standing by with the details. Madhya, take us through the details of why Air India has been show caused by the regulator.
Well, things clearly not looking good for Air India from a regulatory standpoint. We're also seeing multiple flight incidents, especially after the June 12 accident. All 4 show cause notices were issued on 23rd July. I'll talk about what each notice says. One notice is for 3 instances where Air India crew members were not given their mandatory weekly rest. The DGCA says this points to serious lapses in crew scheduling and oversight. A show cause notice has been issued to the Director of Flight Operations. Next is on pilot training lapses. The DGCA has flagged 19 violations in pilot training procedures. Simulator checks were either delayed or not done. Some pilots were even cleared to fly without meeting mandatory training requirements, including for night operations. Then, cabin crew competency. In 3 cases, cabin crew members operated flights either with expired competency cards or without completing the required post-incident retraining. The DGCA calls this a clear breach of rules and has held the cabin crew training management accountable. And finally, long-haul flight safety. 4 incidents where ultra-long-range flights were operated with fewer cabin crew than required. That's a direct violation of fatigue risk norms. A show cause notice has been issued to the Director of Cabin Safety. Air India has been asked to respond to these 4 show cause notices in 14 to 15 days.
All right, Madhiya, many thanks for joining us. In fact, the aviation industry says there were 58 aviation-related incidents reported in the last 3 years. Answering a question in Parliament, the ministry said that these incidents may have happened due to various reasons, including bad weather, technical snags and bird hits. In another reply to Parliament, the aviation ministry said that Air India has released an interim compensation of 25 lakh rupees to the kin of the 128 deceased people as of the 18th of July. For the remaining deceased in the Ahmedabad crash, the compensation is in various stages of document submission by their kin. The ministry added that the Tata Sons Trust has also been registered and formalities are underway to enable the voluntary ex gratia payment of 1 crore rupees each to the victims. 241 people died on the board of the Air India 171 aircraft, while 19 people were killed on ground. The Aviation Ministry said that Air India reported a minor increase in sick leaves taken by pilots across all fleet after the AI-171 accident in Ahmedabad. The ministry told Parliament that a total of 112 pilots reported sick 4 days after the incident. This included 51 commanders and 61 first officers. Global news. Google has moved the Supreme Court of India challenging an NCLAT order that partly upheld the competition watchdog's findings on the company's Play Store billing policy. The case stems from a CCI directive that found Google guilty of abusing its dominant market position. Ashmit is here with more details. Ashmit.
Well, this has been a long-standing dispute between Google as well as the Competition Commission. The CCI order, if you remember, had come out with very stern findings against Google, saying that there's been an abuse of dominant position with respect to the Play Store, with respect to Android, and with respect to its in-app billing system. That's something that's at the heart of this entire dispute. What is also relevant is that while Google is directly challenging this before the Supreme Court, the startup community will also be watching this very carefully, because the core concern that had been raised and that was upheld by the NCLAT is that Google was in fact abusing its dominant position with Play Store for asking for imposing conditions on app developers to use the Google billing system for their in-app purchases. This is something that the CCI took objection to, that was upheld by the NCLAT, and now in challenge to that, Google has come before the Supreme Court. Bear in mind, they were looking at a penalty of 936 crore rupees at the hands of CCI. That was watered down to 200 odd crore rupees by the NCLAT. So that issue of the penalty component and the implications with respect to what the fallout for Google's policies for payment systems for Play Store could be, for that particular issue, Google now knocking on the doors of the Supreme Court.
Ashmit, many thanks for joining us. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here. Stay with us. We're back in a moment with more.
Welcome to Indianomics. Foreign banks like Sumitomo Bank of Japan and NBD of Emirates want to own larger stakes in Indian banks. But the laws are not exactly welcoming because the Banking Regulation Act says no entity, Indian or foreign, can have more than 26% voting rights in a private bank. Now, it is tough for a Sumitomo Bank to convince their shareholders back home that they have 50% stake in, say, a Yes Bank, but only 26% voting rights. That explains why even the IDBI sale is taking so long. Separately, in PSU banks, FPIs, now I'm not talking foreign banks, FPIs, foreign funds, can own only 20%. But there is no such a cap for private banks. FPIs can own up to 50, 74%. So the weightage of PSU banks like SBI and BOB in, say, the MSCI and the FTSE Emerging Market Index suffers. Does this cap need to go? For both these very important questions, I'm joined by former policymakers, actually, two former Reserve Bank deputy governors, Mr. Anand Sinha and Mr. S.S. Mundra. I'm also joined by a banking expert, Harshvardhan, senior advisor at Bain & Company. Gentlemen, thank you very much indeed for your time. Mr. Sinha, let me start with the more easy rule first. This 20% cap for FPIs in PSU banks, is that even needed right now? Since, you know, can that rule be just dropped?
Well, you see, we have to see why there is a cap. Now, government has to have a minimum of 51% shareholding in a public sector banks. So for other shareholders, you have 49% available. Now, the cap of 20% for foreign investors means that in the non-government space, they can go up to 40% of shares. Balance 60% is there for the domestic investors. So this can be modulated. I mean, one can even think of a very market-based situation where you remove the cap altogether and live with the possibility that the entire 49% is taken over by foreign investors. So that is one scenario which can be thought of over a period of time. But I would say that there should be, you can tilt the balance in favor of foreign investors to a certain extent, but not crowd out the domestic investors. That is how I would look at it.
Okay.
So maybe you raise 20 to 25 to 30, but I won't think we are prepared to create a situation where domestic investors can be completely crowded out.
Okay. No, Mr. Mundra, let us look at it more from a stock market angle. I mean, practically, do you think any foreign fund or even set of funds will want 49% when you know that the government of India is going to call the tune in these PSU banks? Why should we even assume that a bunch of foreign funds will cartelize and try to buy 49%? The problem is because of this rule, and I'll put up a table for you which IIFL alternate desk has put out. Because of this, the weightage of SBI and BOB is less. It's a qualitative rule which lessens their weight in the MSCI, and they don't get enough foreign funds, even from passive funds. So, Mr. Mundra, your take. Can this rule be dropped? It's not serving any purpose.
Okay. Lata, there are, I think, to my mind, there are 2-3 angles to it. One, as Mr. Sinha has rightly pointed out, from any, nation's perspective, government's perspective, it would not be a great idea to completely crowd out the domestic investors. They have to have a say and pie in the public sector banking space. That is one point. The second point is the point which you mentioned, but tell me today, despite the government ownership, despite the government calling the shot, whether public bank performance is found wanting in any way. In fact, if you look at the recent history, I think they are performing better than their counterparts in the private sector banks. So that's the second point. The third point is, yes, from the perspective of the market capitalization of the bank, it will be a booster if the foreign investors can have a larger share, and the ultimately beneficiary for that would be the government. But looking to the recent history and where we are today, I don't think government is in a hurry to cash out on that portion. So to beyond the economics and the logic of it, I think there is a political part to it, there is a sentimental part to it, and ultimately, even if you want to do away with 20%, it would need an amendment in the Banking Regulation Act. So while the argument is tilted on both sides, I agree there is a room. Room is not that from 20% you go up to the 49%. There could be a midway. But yes, that would need a political preparedness. That is how I look at it.
Okay. Two things, sir. I am not accusing banks of performance at all. But what I am saying is the presence of this cap, it is a qualitative rule in MSCI. Wherever there are such caps, since there can be a future restriction on the floating stock, the MSCI automatically gives it a lower weight. I will put up that table again for the benefit of our viewers. See, 20% is allowed. The maximum is 11% stake that foreigners have in SBI. In BOB, it is like some 5%. In PNB and other banks, it is in low single digits. It's not as if people are crowding even to that 20%. They will come when they feel like. So the point is, SBI, for instance, could have easily got $1.4 billion more of passive funds. They raised a QIP now. You know, instead of raising it at probably 800 rupees, they could have raised it at 900 rupees if this cap was not there. So, Mr. Harshvardhan, from a purely market point of view, since no purpose seems to be solved by this existence, can't we quietly drop it?
Lata, totally agree with you. This is a vestige of the nationalization era. It's old, more than 50 years old. And here there are several reasons, Lata. One is, if you look at a long-term view, you know, we say that our current banking credit to GDP hovers around mid-50s, and we want to take it to 130% as the part of that overall Viksit Bharat. I mean, our banking capital have to go to 50 trillion plus if you do back of the envelope. Where is this capital going to come from? And a lot of that will have to go into PSU banks. But otherwise, it creates a fiscal drag on the government. Every time these banks have to raise, and even if there is no NPA episode, even if they're normal course of business, they have to raise capital, the government has to put out 70-80%, whatever stake it holds. So I think we need access to deeper capital pools for the banking sector as a whole. And remember, this 26% threshold comes out of Companies Act, because after that you become significant minority. Public sector banks are not under Companies Act. Government is hugely privileged. It has 51% ownership, has entire governance with it. So I don't know where the hesitancy comes. My firm view is that we should allow it to go to 49%. Government will continue to own 51%. And look, I don't buy this crowding out argument. Look at the sectors where 100% is allowed. The Nifty ownership of foreigners has gone down. So I don't see that to be an issue that should come in the way of allowing access of capital. And remember, now our regulatory capacity has dramatically increased. There are many instruments RBI has to deal with any governance issues that might come up with higher ownership.
Yeah.
By the way, even at 49, that 5%, 10% single ownership threshold will apply.
Yes.
It's not as if somebody is going to run away with 30% stake.
Fair point.
And in case of PSU Bank, the voting cap is 1%, not 26%. So I'm saying, given all of this, I just don't know why the hesitancy should be.
Okay. Well, fair point. Actually, I am in agreement with Mr. Mundra that the government has that much political capital, and this may be the smallest reason why they have to expend it. They may want to expend it for other reasons. And the other point being that, you know, we may say that if you raise the cap, we will get more capital. Precisely when you want the capital, when we were going through the asset quality review, that is when the FIIs will not come. They will come when you least want them, you know, when anyway the capital markets are friendly. But that's another point. I would very strongly vote with Mr. Harshvardhan on the issue that this is a vestige of a previous era and can be quietly dropped without making too much noise. But Mr. Sinha, you know, the more important question is not really public sector banks. This became important only because of SBI's QIP. But otherwise, it is in the private sector banks that one single foreign bank, and now I want to make this very clear to our viewers, we are not talking FPIs as a category, we are talking about one single private bank wanting to own, foreign bank wanting to own a larger stake in an Indian private sector bank. Mr. Sinha, do you think the time has come to remove this 26% cap on voting rights if it is a widely held institution. You don't remove it for, a single individual, a promoter entity. But if it is a Citibank, if it is a Sumitomo Bank, they're anyway widely held. Should we start this debate at least that this 26% cap needs to go?
So let me make two basic points and then I'll come to this question. The reason why there is a cap on voting rights, which alternately you could do by putting a cap on shareholding and having a one-to-one correspondence between voting rights and shareholding, is from the perspective that we in India have so far stuck to the point that the ownership and control should be diversified. It should not be too much concentrated in one entity. So that is one. The second thing is that it is an accepted principle and it is documented in RBI circulars that we do not want the Indian banking system to be dominated by the foreign banking system. And the current metric is about 20% of capital and reserves can be held by the WOS and branches. So this is the scenario. Now, the second one has come out of the experience of global financial crisis. And this is not something which only India practices, which others also practice. Now, coming to your specific question, you see there was a time when there was a cap of 10% for promoters and for everybody else. They were all on par, and even the voting right was capped at 10%. Then it was raised to 15% for promoters. That is, the idea was to create a better status for the promoter compared to non-promoters. And now it has been raised even to 26%. So that is the idea. But there could be situations where you may have to allow more than 26% shareholding. Supposing a bank is in distress and a foreign bank wants to take over. So that is a situation which is a perfect situation for allowing more than 26% shareholding, but the cap on voting remains at 26% for the reasons which I explained.
Yes.
I would agree that the cap should be operated on shareholding limits, rather than through a disconnect between voting power and shareholding. Now look at subsidiary, a foreign bank subsidiary. Now there is no equivalent for Indian banks because in India, a bank cannot have a banking subsidiary. So this is something very exclusive to foreign banks.
Yeah.
Now foreign banks, we allow them 100% ownership. Now here, the voting limit has no meaning at all. No meaning. It is, in a way, you can say it is 100% voting rights.
So,
now,
Mr. Sinha, actually, we are running out of time. We have to take a commercial break. We will continue the conversation after the break. But I suspect on this issue as well, Mr. Mundra's former point that political capital of the government is limited, and will they use it to remove the voting rights cap of 26%, that too to help a foreign bank, looks a very remote possibility. But it is worth debating whether we have to remove that cap because India is in a growth path and we will need foreign capital sooner or later. Those questions after the break. Back in a minute. Welcome back to Indianomics. We are in conversation with two former Reserve Deputy Governors, Anand Sinha and S.S. Mundra, and the banking expert from Bain & Company, Mr. Harshvardhan. We've been discussing whether a foreign bank should be allowed to have larger voting rights in an Indian bank. They're allowed to own any amount of stake, but voting rights for any entity is capped at 26%, foreign or Indian entity. And we are discussing whether that cap needs to be removed. Mr. Sinha, of course, made a very strong point why it shouldn't be removed, because we want widely held board ownership, to ensure that no one entity or person has too much of a command, too much of an authority over people's money, over depositors. But Mr. Mundra, one entity is not the same as an Indian promoter. These are widely held companies, like we just discussed, a Sumitomo Bank or an NBD from Emirates. The second point that Mr. Sinha made is that we had a historical bias against why should we give away our markets simply to foreign banks? We should not allow them to swamp us. But now Indian banks, both private and public, are really large entities. Should we really be worried that one NBD owning IDBI or RBL is really going to swamp us?
Okay, valid point, Lata, and I think Mr. Sinha also very well articulated what is the underlying philosophy. But let me bring a different perspective to it. See, you can't think only from the angle of foreign banks. If you have to look at these rules, it has to be looked into the totality. We should also look at the Indian entities, then Indian corporate houses. Now, see, what if there is a cap for the promoter of a company with 26%, and if we are advocating that there should not be any cap for the foreign banks, or even if it goes up to 26%, really question remains then who is the promoter? And with having the equal situation on both the entities, should a promoter should still be held, responsible for something more than all the other shareholders? So that is one point. Second, coming to your point, this so-called widely held. See, when you have to frame a rule, you have to frame universal rule. Then at regulation or supervisory level, maybe you can look at the individual entities. But there are many jurisdictions and the advanced economies where there is, they are really not widely held. Even up to 50% is allowed to be a single entity. Now, if that is the ownership of the parent bank, and by translation they come to Indian bank, I think the whole idea about the widely held thing goes away. So then look at the situation. If something happens there after allowing this, if the ownership of that particular bank undergoes a very radical change in their parent country, it is not in the control of then Indian regulator. So whereas if you ring fence it, it is in the control of Indian regulator. So that is the another point. You mentioned about the Citibank. Not long back in history, Citibank was not widely held. It was held practically by the US government. Okay. So I think, Lata, it has to be looked into totality. It cannot be only looked from the prism of the foreign bank. Yes, then maybe some room may emerge that from present 15%, there could be a room to go to a certain extent. But again, keep in mind who will be the promoter and how you treat the promoter vis-a-vis other, investors in the entity.
Fair enough. I think Mr. Sinha and Mr. Mundra are making very, very strong points. And my sense is that the government is convinced of the point of the two of you. Because even though they have taken about 6 years to divest IDBI Bank, they have not relaxed this rule. Though I'm sure bank after bank like NBD, etc., have been demanding this. Why should we take 50% and get 26% voting rights? And why should we take 26% when we can't call the tune in the bank? These are the questions that foreigners raise. Mr. Harshvardhan, is there a golden mean? Or should we continue to deny ourselves the capital that foreign banks may bring when we are in need of that?
Yeah, I mean, as a stock market person, Radha, you would know that the first rule of capital is that you raise it when it's available, not when you need it. And my view that, yes, there is a golden mean. Here is what RBI can do. They say we'll allow voting rights in voting right in proportion to shareholding, but carve out a set of decisions on which the approval will be needed or where the voting rights will be limited. Let's say CEO, all those issues that are relevant to governance, CEO appointment, etc., etc. If those are the areas of concern, then it can be very easily done. And that would, I think, be enough incentive for the foreigners to take higher stake. There is another irony, Lata, you must note, which I always find amusing. There are foreign banks that operate as branches in India, right? They build very large balance sheet, larger than many Indian banks, and yet have no real board oversight in India. They have advisory board, they don't have board, they don't have statutory boards. So on the one hand, we allow that under where capital is completely fungible, it can go in and come out very easily under the branch setup. And in the digital age, branching and all doesn't matter all that much to build business. And on the other hand, we have all these restrictions. Finally, Lata, if you allow me one more, if the government has limited capital, it has a very simple fix. Repeal the Nationalization Act and put all the public sector bank under Companies Act. So all the private bank rules will apply to them. Problem solved.
Yeah. No, I think that's a great point, sir. I think it was in 2002 that Dr. Y.V. Reddy, then Deputy Governor, had made this point that really we have outlived the need for this Banking Companies Act, which was in place because of nationalization, that they should be all brought under Companies Act for a whole host of reasons. You know, for the presence of independent directors and for the more eventual easy divestment of the 51% stake of the government. But Mr. Sinha, you have the last word, sir. If this law has to be tweaked, I'm not very sure the government is going to buy this rule that for certain things 50% or, you know, higher voting right is allowed, but not for certain things. It's also messy to communicate. Is there a golden mean, or do you think for larger public good reasons, the 26% voting cap should continue?
Actually, Lata, I was not able to complete what I was saying. What I said was that for a 100% owned subsidiary, voting right has no meaning. The moment it becomes 99%, 26% kicks in. Now, this is not logical. Therefore, I would advocate that over a period of time, we should do away with a cap on voting right and link it to the shareholding in 1-to-1 proportion. And then how do you ensure that the people who are having higher shareholding, in fact, in all other countries that I have seen where there is no cap on voting right, but there are thresholds of shareholding where prior approval is required. So we can control it from that perspective rather than from the voting right perspective, because I understand that somebody putting in money and not having the equivalent voting right would not be very comfortable. I also wanted to say, which Mr. Mundra has clarified, there cannot and should not be a separate rule for foreign banks. If we do away with voting right cap, it has to be across the board. Why should we discriminate against Indian banks or Indian investors? So, and you see the regulatory space moves slowly, no doubt, but it's a dynamic one. If you look at the last 10 years, so much has changed. From 10%, it has gone to 26%. So as the situation evolves, there would certainly be changes. And I would personally vote for the change which I just now talked about.
Yeah, of linking the voting rights to the shareholding. And perhaps with other rules not allowing, too much of ownership, keep the ownership widely held. But I think the clincher would be to bring banks under the Companies Act that would perhaps remove a lot of anomalies automatically without the government having to expend political capital. Let's see if we can convince the powers that be. Unfortunately, out of time, we'll continue this conversation when it once again crops up in public memory. Mr. Mundra, Mr. Harshvardhan and Mr. Sinha, thank you very much indeed for your time. We wrap up on Indianomics. Thanks for watching.
It's been in the works for over 3 years, with talks starting in January 2022. United Kingdom has seen 4 prime ministers since then. Prime Minister Narendra Modi says that there may be a swing and a miss, but India will always play with a straight bat. Keir Starmer says that the deal would create over 2,000 British jobs. Hello and welcome to our special broadcast. I'm Parikshit Luthra. The much-awaited India-UK Free Trade Agreement has been signed. Commerce ministers of both nations signed the agreement earlier today. The deal is estimated to boost bilateral ties between the two nations by $35 billion and bring down the tariff guardrails to a large extent. British Prime Minister Keir Starmer received Prime Minister Modi at the Chequers House earlier. During the visit, both the leaders will review bilateral trade ties and discuss issues including technology investment, climate, defense, migration. Now, as part of the trade deal, India will lower its average tariff on products from the United Kingdom from 15% to 3%. Products from the UK, including soft drinks, cosmetics, cars, medical devices, Scotch whisky, will get cheaper. The deal is also going to unlock access for financial and business services for both nations. How will India benefit from this trade deal? Well, the UK has opened up its market for India's labour-intensive goods, which will include leather and footwear, textiles, engineering goods, fertilizers, chemicals, petrochemicals. Agriculture exports to Britain is also likely to increase by over 20% in the next 3 years. Speaking at a joint press conference, Prime Minister Keir Starmer has said that India and UK are launching the Vision 2035 strategy to work more closely on defence, migration, health. While Prime Minister Narendra Modi said that the Indian security agencies will continue to enhance cooperation and coordination on matters such as extradition of economic offenders.
Those who misuse democratic freedoms to undermine democracy itself must be held account. इकोनॉमिक ऑफेंडर्स के प्रत्यार्पण के विषय पर भी हमारी एजेंसी सहयोग और समन्वय से काम करती रहेगी.
This is the biggest and most economically significant trade deal that the UK has made since leaving the EU. And I think I can say that it's one of the most comprehensive deals that India has ever done, boosting wages, raising living standards, and putting more money in the pockets of working people. It is good for jobs, it is good for business, cutting tariffs and making trade cheaper, quicker and easier.
Cricket is not just a game, but a passion. And also a great metaphor for our partnership. There may be a swing and a miss at times, but we always play with a straight bat. We are committed to building high-scoring, solid partnership.
To take this discussion forward, I'm now joined by FICCI's senior leadership, Vice President Anand Goenka. He's also the Vice Chairman of the RPG Group. We also have with us former FICCI President Sandeep Somani. He's also Chairman and MD of Somani Impresa Group. Harish Ahuja, who heads FICCI's Foreign Trade and Trade Facilitation Committee, will also be with us shortly. And so will be Anish Shah, the Managing Director of the Mahindra Group. Anand Goenka, let me begin by asking you, to what extent does this FTA boost Indian industry's demand globally? And how do we also see trade barriers being reduced by both sides?
I think this is a landmark agreement made by our Prime Minister as well as the Prime Minister of both nations. I think at a time where tariffs are being raised, it's a great timing where we are working on various FTAs with many more countries. I think the big benefit to India is that of increased exports and a competitive edge over countries like Bangladesh, China, and increase our share in business in the UK. I'd say also that job creation sectors such as apparel, etc., have been focused on, which will really help creating employment within India. And then you have softer areas such as ease of doing business, digital trade, increased competitiveness of Indian labor movement to these countries. So I think to that extent, it's extremely comprehensive and puts India at a very strong position.
Right. Sandeep Somani, how do you expect businesses like yours to benefit? There's a lot of emphasis from the Indian government how labor-intensive sectors are going to benefit and get greater access, zero-duty access in the UK market.
Good afternoon. So it's quite a comprehensive agreement if you had gone through. And I think there are the government of India in this round of FTA compared to the earlier government's FTAs which were signed, which did not benefit industry. Industry has been, part and parcel of the discussions this time involved by the government to give its inputs. And I think it's a very comprehensive agreement that has been signed. If you look at the labor employment kind of industries, a lot of advantages, competitive advantages will come to apparel, auto and auto components, made-ups, footwear and parts, carpets, the marine products which will benefit our fishermen, marine preparations, which will add value to our marine products. So I think a lot of these areas employ a significant amount of labor, and these will all become zero duty. As Anant had said, this will also help India be much more competitive versus our neighboring countries, Pakistan, Bangladesh, which gets 0% duty in any case, Vietnam, China, and other competitors. So I think this is quite a historic agreement and will benefit Indian exports significantly.
Right. Anant, if I can come back to you and ask you about the RPG Group especially. Now, we've seen how the UK today has announced investments that UK companies will be making in India, and Indian companies, at least 7 or 8 Indian companies, will be making in the UK market. Does this FTA encourage the RPG Group, for that matter, to increase its footprint in the UK, maybe consider more investments?
Yeah, so we've already been committed to the UK in different ways. We sell a fair amount of tires there. We invested in a tech company called Foolproof through Zensar Technologies. And this was possibly the first investment that we did one day after Brexit. So to that extent, even during very uncertain times, RPG Group has been invested in the UK. I think it's too soon just after the FTA to look at further investments, but certainly I think life will get easier. There will be social security benefits for IT service people. To that extent, life becomes easier. We can send more people there. And I think we will evaluate and continue to look at opportunities in the UK.
Right. Now, speaking about automotive, now the UK government has said that India will reduce tariffs from 110% to 10% on the automobile sector through quotas, and this will be done in a graded manner. Could you give us a sense of the tire industry for that matter, or automobile components? What is the kind of market access that you'll now get in the UK, and what is the kind of market access that India will have to give to UK's automotive industry?
Right. So for the tire sector, there's actually not much change. The duty for tires into UK is at zero duty, and that will continue at the current rate. For auto comp, it has gone down. It was at about 8.2%. This will go down to about 0%. So I'm sure non-tire auto components will see an uptick in terms of sales into the UK. As I said, for tires, not much change.
All right. No, not much change for tires, but from 8% to 0% for auto components. So that's going to be a big one. Sandeep Somani, do you expect more investments to be made by UK financial services companies, insurance companies, considering that was a major ask? They were looking for certainty. They were looking for certain binding clauses in the FTA. Do you think this will now be a tipping point?
I think so. The Indian market is huge for financial services. And I think as part of the deal, many of these companies will now be treated at par with Indian companies. So I think that's a big win for the UK companies who are asking for this for a long time. And that will open up the financial services sector to UK investments. So that's a good move.
Right. Let me also go across to past president of FICCI and managing director of the Mahindra Group, Anisha. He's joining us from UK right now. He has met both prime ministers. I believe, Anisha, you were there witnessing that historic agreement. Could you give us a sense of some of the takeaways and how the Indian industry, the Mahindra Group, would immediately benefit?
Hi, Parikshit. I am actually at Chequers, the UK Prime Minister's residence. We were just with both Prime Ministers. And what I will say is that this is actually a fantastic step forward for India. The warmth of the relationship is amazing. Both Prime Ministers talked a lot more about things we will do together as both countries. And that really solidifies India's standing in the world. From a trade deal specific perspective, I think it is very well outlined. And I would give a tremendous amount of kudos to the Commerce Ministry and the Ministry of External Affairs and folks who've been working on this for a very long time. From all the details that I've seen, it is one that will position India very well. Will also encourage manufacturing in India and making India the manufacturing hub, which is something that is important for us by facilitating exports, by facilitating greater innovation. And as the contours of the deal come out, what you will see is that it has been done in a way that is really a win-win and something that positions us extremely well.
Right. I'd like to ask you about automotive tariffs, especially Anisha. The text that we've received from the British Prime Minister's office, the press statement that says the tariffs will be reduced by the Indian government from 110% to 10% through specific quotas. Could you give us a sense of whether this is across the board, or is it only for electric vehicles or luxury vehicles?
But actually, that I will leave to the government to talk specifically about what has been signed. From what I understand of the details, all I would say is that it has been done in a manner that really strengthens the auto industry in India and is a win for both countries.
Right. And do you feel that the Indian industry is now ready for that challenge, the competition from UK car makers? Has this been done in a way which has kept the interests of local car makers, automobile makers in mind?
Parikshit, I'd actually put the question the other way around. Is the UK car industry ready for the challenge that we will pose to them by sending cars from India?
All right, that's a good one. But do you also believe that whatever concessions are being made, this will only be for electric vehicles?
Again, Parikshit, I'll leave the details to the government. All I will say is that from what we've seen, it actually has been put together really well.
Okay. The other question about movement of professionals. How does this agreement actually help the movement of IT professionals, those in consultancy, those working on cutting-edge technologies, emerging technologies, move more freely in between the countries, and also the startup ecosystem between India and UK?
It will help tremendously because, as I understand, there's going to be a 3-year term. I don't have all the details of that as yet. But again, in brief discussions with some of the key leaders here, we feel that it will be a huge step forward in terms of facilitating that movement, making that happen easily, and therefore fostering innovation and a closer partnership in technology across both countries.
Now, within the Mahindra Group, as a diverse business, which are some of the areas you believe will get an immediate boost and may encourage you to increase your footprint in the UK?
I'd say a number of areas, Parikshit. Automobile for certain. IT services will get a boost as well. We will look closely at hospitality and see if there are other things that make sense from a hospitality perspective. And there are a few other areas that we haven't fully understood as yet. As we get more details, we will look at a few more areas also.
Right. And from the text that we're seeing from the Indian side, automobile tariffs in the UK for Indian automobile goods has been reduced to 0. Would that be right? So cars being exported from India to the UK, what will be duty structure?
Again, Parikshit, I won't get into the duty structure of it. I think we will be very well positioned. And this is where we look forward to competing in the UK.
Right. And the important thing is that this FTA will now be a template in a way for our negotiations with the US and European Union. Do you expect similarity and do you hope for alignment in other trade deals?
I think the challenges for each country are different and their asks are likely to be different as well. So you're right that this is a template for other trade deals. But my sense is that there will be some meaningful differences in other trade deals as compared to this.
Right. Let me also go back to Anand Goenka and Sandeep Somani. Mr. Somani, to ask you about the FTA, the agricultural exports. Now, in a way, this FTA reduces tariffs on almost 95% or 99% of the agricultural tariff lines. Our processed foods, our pickles, our beverages, some of our wines also get access to the UK market. But at the same time, we've protected interests of our farmers by not giving in to compromises on dairy, wheat, rice, maize, and certain other items like apples and oats. How do you think the farm exports and India's farmers are likely to benefit in the long term?
I think we'll get better access to their markets, which are primarily fed by other countries. India's share in the total imports by UK is only 1.88%. I'm not now talking only agriculture, but in general. So I think it will, help us get into their food chain better through the big, processors of food and the big retailers of food. Very few items have been actually kept out. The bulk of our agricultural goods can actually be exported now at zero duty. So it will help our farmers penetrate the market better.
Right. I'm going to take a short break, but I'll request both Anand Goenka and Sandeep Somani to stay with us. We'll be right back. Welcome back to our special broadcast. We still have with us FICCI's senior leadership, Vice President Anand Goenka, former FICCI President Sandeep Somani, Harish Ahuja, who heads FICCI's Foreign Affairs Trade and Trade Facilitation Committee, is also joining us on the program. Anand Goenka, coming back to you. Now, when it comes to both nations reducing some of the trade barriers, what are some of the rules or the entry barriers, apart from tariffs, which were hurting businesses on both sides and have been removed with this FTA?
Right. I think it addresses exactly as it's been addressed. The good thing is that it is a win-win. It is complementary on both sides. For India, jobs was important, and I'm sure Mr. Ahuja will speak more about it, but it's a great opportunity for the apparel sector, for the autocom sector. And for UK, the big wins would be on, whiskey, high-end cars, EVs. I think these are the wins. So both have certain strengths, and the agreement has worked out to the strengths on both sides.
Right. Do you also believe, and I'm coming back to the automotive component sector, if tariffs on auto components have been reduced to zero in the UK for Indian goods coming there, do you expect more manufacturing to be set up now in India?
So our overall trade levels are not yet high enough, possibly for setting up more capacity. But certainly, I think there will be an increase in supplies into UK. And then depending on capacity utilization as that comes up, certainly it can be an opportunity. If you look at manufacturing of cars in UK, it's primarily high-end vehicles. So in the end, it depends on really that volume. Is it high enough to take up capacities? I won't have that detail, but it's overall a great positive opportunity for increasing sales.
Right. Mr. Harish, thank you very much for joining us. As someone who understands the Indian exports very, very well, there were a large number of product lines which already had zero duty status in the UK, including the Indian pharma industry and generics. So, realistically speaking, practically speaking, how much do we really benefit in terms of annual gains?
Yeah, you see now, actually, I'm from apparel side, manufacturing of apparel and textiles. So we see this is a big boost for our trade, especially the signing of FTA, because other countries like our competitors, Bangladesh and Vietnam, they already have FTA with UK. So we are also coming on the level playing field with them. And this will open us a huge market. And especially for India, in apparel sector, 90% of the raw material we have in the country, unlike any other countries. If you see Bangladesh, Vietnam, their input of apparel is only 30 to 40%, whereas India has 90% of raw material within the country. This is the highest value addition in any product of export product from India. And also our dependence of our population on agriculture is quite high in the country. So it is also a very good form of bringing unorganized sector workers to the organized sector of the apparel trade, And our cost...
Mr. Ahuja, I would like to ask you about apparels, about textiles. What are our current exports to the UK? Are you already seeing enhanced orders, demands for contracts, long-term orders coming in with the UK? And what's the kind of uptick you're expecting?
Yeah, we are expecting that within the next 3 years or so, we should be at least more than double, because we have got more inquiries coming in. And customers, they know that even though actual effect will happen in about 8 to 12 months, but they have already started looking into India and the major sourcing hub. Because most of the customers, they really like to work with India because of our judiciary system, our democratic system, and also our labor laws. They are the strongest in the whole region. And they think it's very sustainable to work in India. So they already have started plans of increasing placing larger orders in the country. So we see big gains coming in a couple of years.
Right. Are you likely to set up additional capacity for the UK, or do you believe that the market is still not that big for you to put additional money in more factories?
So we already are expanding by 15% almost every year, because we see that till now most countries, especially, they are saying that China is not the final hub for importing all manufacturing goods. We have seen that America has placed 50% duties on China. Similarly, now, they know that they have to look for alternate sources. So India is the best option available at present moment for any country to import apparel from.
Right. Let me go back to Sandeep Somani. Sandeep Somani, a similar question to you. Are you now seeing additional inquiries, more long-term orders from UK? And do you believe that the framing of this FTA will give us that advantage in the region? You know, we've always been speaking about the China +1 opportunity, but we believe that especially in the labor-intensive sectors, the opportunity ends up going to Vietnam, Indonesia, Cambodia. Does this, in a way, give us an edge? And do you feel that now is the time for India to leverage this opportunity?
Absolutely. You know, as Mr. Ahuja said, in the apparel sector, our competitors were already on zero duty. Now we will also get to zero duty. So it gives us that 9 or 10% competitive edge, which, for example, in some of these sectors can be the difference between winning and losing. And I think that generally when so many lines of tariff lines will go down to zero for Indian products, the penetration of Indian products will significantly improve in the UK. And we will be more competitive. India, as you know, is quite competitive in its manufacturing with the lot of steps that the government has taken over the last few years. So I think scale will improve in India over the years with more FTAs coming with other countries, as you are well aware. And I think that scale will provide an even bigger impetus for exports.
Right. Thank you very much, Sandeep Somani, Anand Goenka, Harish Ahuja, Anisha, for joining us on the program. It's been an interesting discussion. Let's see the fine print of the free trade agreement and when it comes into effect. Remember, it has to be now ratified by the UK Parliament. It has already been ratified by the Indian Cabinet. With that, it's a wrap on this special broadcast. More news and updates continue right here.
positive global cues failed to lift the lull street. Sensex and Nifty declined by nearly 1%. Midcaps fall in tandem with the blue chips.
The Central Electricity Regulatory Commission approves market coupling for power exchanges in the day-ahead market segment from January 1st, delivering a body blow to IEX. The move is expected to see business migrating to other exchanges. The stock tanks in trade.
IT stocks fall despite a standout performance from Infosys. Even Coforge and Persistent fall due to steep valuations and some concerns on margins for the former and deal wins for the latter.
Hello and welcome to Markets Forward, your go-to show where we get you up to speed with regard to today's trading action and we set you up for tomorrow as well. I'm Nigel and with me is Surbhi. Hey Surbhi, that's sort of a day, a bit of a dull day actually. The bears were on top and I think an element of expiry as well did play a role today.
Absolutely, and we didn't have a best-in-class earnings. Nothing that could really light up the fire in the bulls camp. So it was literally bears all the way. So just very quickly on the market, let's quickly recap what today's day looked like. Now, yesterday's move above 25,200, that was history very, very quickly because today the market lost about 150 points on the Nifty. And while you can put the blame, of course, on the IT space, it wasn't just IT alone. You know, there was no sector that could come in and offer any kind of a counterweight. So whether it was banks or whether it was FMCG, it was literally a case of all fall down. The IT index, of course, with its story on, a sharp reaction to earnings that were actually not that bad, one can argue. That was really one of the stories of the day. And then, of course, once again, we had weakness in the mid-cap space as well. Today, the advance decline ratio was negative. You almost had 2 stocks declining for every one that was advancing. So overall, yeah, Nigel, as you said, negative day and none of that global trade deal optimism, none of that rubbing off on us.
Well, that's right. So that's about today's market action and the way things are shaped up. Well, let's run you through what we have got lined up for you in store. Well, we start off with all the top movers and shakers. Hormas will be standing by to help us out with that list. Then we got a slew of stocks that witnessed big movements in trade today. IEX hit a 52-week low today following the CERC's approval of market coupling norms. Nestle declined after posting a weak set of numbers, while Canara Bank surged on the back of sequential improvement in asset quality. Last but not the least, we'll delve into all the key market events you need to track to set you up for tomorrow. But as always, a man of the moment, the opening batsman of the show, Hormas is standing by on the big wall with all the movers and shakers. Hormas.
Lots of movers and lots of that shook beliefs as well among a lot of people today. Start off with the newsmakers, then of course can't not mention IEX being the first one, 30% lower on that stock in today's trading session. And of course there were a lot of others as well that saw losses in today's session, including the likes of Trent and so many others. Then there were some of the other earnings reactions that took place in today's session. Take a look at this. Mahanagar Gas, Samvardhana Motherson also among the potential US-EU deal ending 4.5% higher, and Mukand too seeing gains of around 6%. But over shifting focus to the earnings reactions, it was dominated by 2 names, Persistent Systems and Coforge. But after which, the positive earnings reactions that took place. Look at Force Motors, look at Thyrocare, look at Senors Pharma. Canara Bank saw asset quality improve. Indian Bank, and both Canara and Indian Bank took the PSU Bank index higher along with them. But the negative earnings reactions, of course, as I was mentioning, dominated by Persistent and Coforge. But along with Persistent and Coforge, Cignity Technologies also took a battering today, 10% lower on that stock as well. Nestle saw a brief recovery after its results, but that recovery was very quickly sold into, ending at the lowest point of the day. And Motilal Oswal as well, seeing a negative reaction to its results. A sector that stood the test of time today was pharma. Most of the pharma names doing well. Ipca Labs ending almost 5.5% higher. Another 52-week high for Laurus Labs. And Cipla doing well for itself ahead of its results. And lastly, the stocks that ended at a 52-week high in today's session. Of course, another new high for Eternal, a new high for Paytm. So the new age companies continue to make a buzz. And Tilaknagar Industries, after the confirmation of the CNBC-TV18 news break, 4.25% higher, a new high for the stock as well. Back to you guys.
Well, thanks for that, Hormas. Let's move on and talk about the day's key movers and shakers. And IEX was definitely one of them. The stock tumbling to its 52-week low, sharp declines almost a 28% cut. This after CERC, the Central Electricity Regulatory Commission, has decided to usher in market coupling in a phased manner. Let's go across to Vivek. He'll tell us more about it. By the way, Dalmia Bharat holds about 11% stake in IEX as well. Even PTC gets impacted. So let's understand who gets impacted in what way as market coupling becomes a reality. Vivek.
Well, that's right. You know, the single biggest overhang as far as the share price of IEX was concerned was the implementation of market coupling. And a somewhat surprising development overnight, we did see CERC go ahead and decide to implement coupling in the day-ahead market. The DAM market will be done from Jan 2026 onwards. The stock of IEX was actually in the F&O band. Despite that, saw a very sharp knock today. And along with that, like you mentioned, the share price of Dalmia Bharat too was quite volatile. Remember, it holds close to 11% stake in IEX. And PTC India, that holds a 22% stake in the rival platform company called HPX, that particular stock actually saw an up move. Now, what exactly are brokerages saying as far as IEX are concerned post the implementation of market coupling? UBS says that this is a negative surprise both for them as well as for market expectations. Now, this has come despite Grid India actually saying that there has not been too much of a benefit seen as far as market coupling is concerned for the short-term power market. In fact, they are saying that this will have a significant impact on IEX, given the fact that the day-ahead market and the RTM market actually accounted for a total of 80% of FY25 revenues for IEX. Bernstein, on the other hand, says that this order is quite negative compared to what they were anticipating. They're saying that the transaction charges too will come down, given the fact that rival platforms will now have to compete on transaction charges in order to go ahead and attract volumes. Now, what they're saying is that with the moat of liquidity gone, now the only way to compete will be via transaction charges. In fact, they see reduction in transaction charges, and on the back of this negative development for IEX, that particular stock saw quite a big knock in the trading session today.
Okay, all right. Thanks a lot for that, Vivek. Well, we have Amrish Palika, independent market expert, and Ruchit Jain from Motilal Oswal Financial Services, who joins us. Ruchit, coming to you with regard to your call on the markets. But Amrish, first up, tell us about this development, IEX. Actually, towards the end of trade, there was some sneaky buying that we saw, not for the faint-hearted. But what's your view when a stock falls 25 to 30%? Then, you know, it becomes extremely tricky. Pity those who have been holding it for a long time, because the single strike has wiped out everything.
See, I mean, basically, when the stock falls like this, you normally have those bargain hunters coming in to buy, and because of which you could see some amount of bounce back. But then, I mean, fundamentally speaking, this news is extremely negative for IEX. And whenever we have, we had these rumors in the past 1.5, 2 years, we've been getting these rumors on a regular basis. The stocks to crack and then bounce back because the rumors were not getting confirmed. But right now, what we have is a confirmed news. So this is clearly a negative for IEX. And like I was saying earlier, possibly we could see levels of 105, 110. But before that, we could see a small bounce back. But those who have been holding on for long term may finally give up and sell out at this point of time.
Got it. All right. Amrish, Ruchit, give us your call on IEX. How does it look? And technically, if there is support anywhere, because the chart must be absolutely wham-bammed. But how is it looking in the chart? And what about the Nifty? It came down today, but still the VIX is at very low levels. Still you have shorts in the system. The PCR as well came down. I don't know, going at current reckoning, difficult for the Nifty to go down more than 250 points from here. But how is it looking for you?
Yeah, hi, very good afternoon. So if we first, I'll start with the IEX. Definitely a very high volume negative candle today, and usually whenever we see such volume-based selling, now whenever we see any pullback move after such selling, there are many traders or investors who are stuck in the position and they want to exit. So this would restrict the upside in the short to medium term in the stock. Technically, major support for the stock is coming around 110, 120 range. So I think there could be some more downside towards that 120 to 110 range. So any bottom fishing should not be done over here. As far as markets are concerned, we are in a time-wise correction phase. We can clearly see that after some correction from 25,600 to 25,000, markets have been sideways since last few days. 24,900 remains a very important support for the stock, whereas for the index, whereas on the high side, we are not able to surpass 25,300. So this clearly signs of a time-wise corrective phase within an uptrend. But yes, overall trend remains positive. So 24,900 should be the stop loss on existing long positions. And as far as the short positions of FIs are there, I think these are short heavy positions. Since we're approaching the expiry going ahead, I think some of these positions would be squared off on the expiry itself.
Okay. All right, got that, gentlemen. Stay on. We'll have more questions for you in just a bit. Let's move on to something positive as well. IEX was down, but shares of Canara Bank were surging in an otherwise weak market, up almost 6% after the bank reported improvement in asset quality sequentially in the first quarter. The lender's net interest income, however, was down 1.7%. Net profit was up 21%. Gaurav is joining in with the report card. Gaurav, so what worked for Canara Bank in this quarter?
Well, as when we talk about the numbers, net interest income declined almost by 2% on a year-on-year basis. But when we talk about net interest margins, there also we saw a little bit of pressure. And the reason being that yield on advances now, that declined almost by 30 basis points, while the cost of funds remained stable. As a result, we saw net interest margins also declined almost by 18 to 20 basis points. But what played out well is the treasury income. Now, it has increased almost by 300% on a year-on-year basis. And as a result, when we talk about pre-provisional operating profit, we saw a sharp growth of around 12% on a year-on-year basis. Again, when we talk about the asset quality, there also we saw a bit of improvement. Credit cost, it has gone down almost to 0.72% versus what it was at 0.9%. So good recovery is what we saw there as well. And that is the reason why we saw 21% increase in the profitability. Another point to highlight is that the ROA, now bank has reported ROA of 1.17% versus what it was guided at 1.05% for the whole year FY26. So definitely there also we saw some positivity. On the loan book front also we saw a good set of numbers. It has increased almost by 12%, and this also marks as 2% increase on a sequential basis. Deposits also grew in line. It grew at around 9.9%. Let's not forget that for loan book, bank had given a guidance of 10 to 11%. So it was again better than what the bank had guided. And as a result, we saw some spike in the stock price as well.
Okay, all right. Thanks a lot for that, Gaurav. Well, moving to the FMCG space then. Shares of Nestle, well, they declined after it reported a weak set of numbers in the first quarter. The profit dipped on higher depreciation and finance cost, while the margins declined on higher commodity costs. But price stabilization and a pickup in urban growth helps improve the outlook. Mangalam joins us to fill us in with quick analysis on that. Mangalam?
Well, Nestle was lower in today's trading session. The company reported a soft performance in the first quarter. But, the indications are that maybe this quarter was a bottom-out quarter and things are likely to improve from here. Why do I say that? Because, look at the management commentary. They suggest that demand is improving. And secondly, on the cost side, it is actually seeing some sort of relief coming by. So on the reported numbers, revenues closer to 5,100 crores, slightly above street expectations of 5,080 crores itself. The EBITDA at 1,100 crores, largely in line with expectations. The margins coming in at 21.6% as well. The net profit, now that was below street expectations, largely on account of higher depreciation, presumably on account of the Sanand plant coming on stream. And secondly, on higher finance costs, which the management alluded to temporary bank loans to manage operating cash flows. Importantly, they've said that significant rise in demand over the recent quarters has led to growth in urban markets, and also notice stability in prices of edible oil and cocoa. They are seeing a declining trend in coffee, which is beneficial for their margins, and milk prices anticipated to decrease with the onset of a favorable monsoon and flush season. They reported 3% volume growth, again at the higher end of street expectations of 2 to 3%. And going forward, the big trigger for Nestle will be a management change and the strategy under Manish Tiwari, who takes on as the role of chairman and managing director from 1st August.
Yes, indeed, big leadership change, ahead at Nestle. Thanks for that, Mangalam. Amrish, what do you make of the market's sharp reaction? Yes, there's some margin compression and the rise in the finance costs there, but would you be a buyer at all at dips?
In fact, it's just not Nestle. I think, across FMCG majors, we are looking at an uptick in this quarter. But then possibly it's getting deferred by a quarter or more. However, I think the downside for the FMCG space, including Nestle, seems limited from here. And I think it's a great time to start buying into FMCG. Just not Nestle. I think ITC, Dabur, HUL. I think these are the 3-4 stocks which should be there in your portfolio.
Got it. Okay. All right. And Ruchit, you want to comment on the banking names? Can Bank?
Yeah, I think some of the PSU banks such as Can Bank, Bank of Baroda, SBI, I think the price-wise downside seems to be very limited from them. since last 2 months, we are witnessing that whenever there are dips in these stocks, they are getting bought into. So I think overall, still no signs of a breakout, but at least the price-wise correction seems to be limited in these PSU banking names.
Okay, all right. Thanks for that. But we need to talk about tech. Tech stocks, Infosys, TCS, both them fell in trade despite reporting, good set of numbers in the first quarter. That was Infosys. Rima joins us with the IT report card. Rima, take us through the top IT firms and how the numbers did shape up today.
Indeed, on the growth front, Infosys, Coforge, Persistent all did very well. Infy was at 2.6%, Coforge was a stellar 8%, but the stocks are correcting. So let's quickly run you through a couple of reasons why. One for Infosys, beginning with that. The upper end of the revenue guidance, which is 3%, has remained unchanged. But now the upper end also includes an acquisition of 40 basis points, which means the organic guidance has been cut by 40 basis points at the upper end. So that could explain the disappointment. For Coforge, analysts are pointing out that the EBIT margin shared by the company at 13.2% has certain one-offs. So for instance, a bonus cost, the forex element. If you strip that out, the adjusted margins would be a lot lower. Secondly, even this CapEx spend, the company has spent more than $60 million to set up an AI data center for its clients. Now, data centers, up until now, IT companies have never invested in CapEx. They've always been an asset-light model. But now with this investment, it becomes CapEx heavy. And it's not easy. There are costs associated with maintaining that. And therefore, analysts are a tad bit worried. And thirdly, let's come to Persistent then. Now, Persistent's revenue growth, you could quibble, was a little short of expectations. 3.3% versus 3.8% expectation. The company has deferred the wage hike by 1 quarter, which means there are concerns, in the mind of the management, perhaps. There is uncertainty. And finally, the deal wins, you can call them steady, or you could, on the other hand, say it's unexciting because they've not increased on a quarter-on-quarter basis. And finally, for companies like Coforge, Persistent, they've been such darlings of the IT cap. The valuations are on the higher side. These stocks are trading at about 30, 35, 40 times PE. So that also, makes it difficult for the stocks at this juncture. Back to you.
Okay, all right, Rima, got that. Thanks very much. Let's quickly go back to our guests for a take on this. Rujit, on the chart specifically for Persistent and Coforge, which have been the outlier performers in the sector, today's declines, has it violated any important levels? What's the advice now on these two mid-cap IT names specifically?
Firstly, if you look at the entire IT space in last 3 or 4 months, we have not seen that kind of trended up moves in many of the IT names, except I think Coforge, which showed a relative outperformance. So I think IT sector as a whole, there are no signs of any up move coming in the short term. So I think that relative underperformance could continue within the IT basket. Persistent today has breached its 200 DMA support. Even Coforge has witnessed a selling supported by very high volume. So I believe that going ahead, IT would not be the sector which would take the leadership in whenever the markets resume its uptrend, and some relative underperformance could be seen for more 1 to 2 months.
Okay, all right, gentlemen, thanks a lot for joining in, Ambrish as well as Ruchit, and helping us out with the analysis on all those stocks. Well, before we take a break, just want to highlight, the big deal that we announced. Thyrocare Industries surged in trade after signing a definitive agreement to acquire Imperial Blue division from Francis Bernard Ricard. Now, the acquisition will be executed at an enterprise value of around 4,150 crore rupees. Now, this is positive for Thyrocare Industries because it takes them into the next league. To put out a few numbers, last year they did sub 1,500 crores. They're acquiring an asset which has 3,000 crores. So all in all, the total revenues will go up by 3x from what it was doing earlier. Even in terms of volumes, from around 12 million tons, it'll go to nearly around 35 million tons. The management says the deal will be EPS accretive, and the deal is done at around 1.3 times sales, which isn't very, very expensive. In fact, it's quite attractive. It was more than 6,000-7,000 crores. The street would have been a little bit cautious on it. Now, they get an entry into a whiskey market, which is more than 63% of the Indian alcohol market. And how will they fund this? Well, they've taken a resolution that they can go up to 6,500 crores in terms of a fundraise. They don't need that much, but a broad breakup. They've given equity. It could be around 2,500 crores at most. Debt could be 4,000 crores at most. But this is good for them because it helps them in terms of scaling up. It helps them enter, a pan-India presence, and it helps them enter the whiskey market as well, from just being a brandy market or from just being a South-based player. They're saying it's EPS accretive. There are synergy benefits. We'll have to track more on this. But even after rallying more than 20%, the stock put on close to 4.5%, telling you the street believes now Tilaknagar Industries has entered the big league. All right, enough of that. Time to slip into a short break. On the other side, we'll get you all the top corporate voices along with all the events you need to track. Don't go anywhere. Welcome back. Now, India and the United Kingdom have signed a free trade agreement, which is estimated to boost bilateral ties between the two countries by $35 billion. British Prime Minister Keir Starmer received Prime Minister Modi at the Chequers House. During the visit, both the leaders will review bilateral trade ties and discuss issues including technology, investment, climate, defense and migration. As part of the trade deal, India will lower its average tariffs on products coming in from the UK from 15% to 3%. British Prime Minister Keir Starmer has said that India and UK are launching the Vision 2035 strategy to work more closely on defense, migration and health. While Prime Minister Narendra Modi says that Indian security agencies will continue to enhance cooperation and coordination on matters such as extradition of economic offenders.
Cricket is not just a game, but a passion. And also a great metaphor for our partnership. There may be a swing and a miss at times, but we always play with a straight bat. We are committed to building high-scoring, solid partnership.
This is the biggest and most economically significant trade deal that the UK has made since leaving the EU. And I think I can say that it's one of the most comprehensive deals that India has ever done, boosting wages, raising living standards, and putting more money in the pockets of working people. It is good for jobs, it is good for business, cutting tariffs and making trade cheaper, quicker and easier.
Okay, well...
Okay, all right. Well, before we... Me? Oh. Well, before we wrap up on the show, let's get you all the key market events you need to track for tomorrow. Upasana standing by to run us through the list. Upasana?
Well, first up, let us look at the key important results that we'll be closely tracking tomorrow, as we kick off the results season tomorrow. Now, let us look at the key companies such as Bajaj Finance, Bank of Baroda, Cipla, Laurus Labs, GMDC, Petronet, LNG, SAIL, SBI Cards, Sterlet Tech, and even Tata Chemicals will be reporting its numbers tomorrow. Stocks like Shriram Finance and Poonawalla FinCorp will also be in focus as both these companies approve their fundraising plans along with their results for the quarter. Now, stocks like Abbott, Central Bank of India, AkzoNobel, Info Edge, Arvind, ICRA, Lupin, all these will be in focus as they go ex-dividend tomorrow. Now, let us look at the domestic data. Foreign exchange reserve data will be out tomorrow evening around 5 p.m. So we'll be keeping a track of that as well. And also, SC schedules final hearing on 28% GST on online gaming. So the final verdict will be out tomorrow. And coming to the global data lastly, UK will be reporting its consumer confidence data and even its retail sales data. And President Trump will begin its travel to Scotland, UK. So all in all, it looks like quite an eventful day tomorrow.
Okay, all right, Upasana, many thanks for that. And with that, we're out of time on this edition of Markets Forward. Thank you so much for watching. News and updates continue on CNBC-TV18.
Hello, good afternoon. Welcome to MF Corner on CNBC-TV18. I'm Vinny Motiwala, with me Sonal Bhutra as well. Sonal, today what we're going to be putting the spotlight on is something very interesting, right? I find it interesting. AI is everywhere, but AI and our finance, our mutual funds, and is that going to be changing how we are looking at our portfolios? I think that's something interesting.
That's exactly what we are going to discuss today, because AI has overtaken a lot of aspects of our lives, right? And that's exactly what we are going to talk about today, from markets to now mutual funds. We'll discuss with some experts, should they really rely on artificial intelligence to make changes to their portfolio, or it's only the human involvement that is the way, because we talk about that EQ, or the emotional quotient part as well, right? We have different market cycles, different market moods. How much should investors bank on this, and should they really rely on this? This and more we are going to discuss with our guest today, Deepak Shenoy, founder Capital Mind, and Dhirendra Kumar, CEO at Value Research. Gentlemen, such a pleasure to have both of you on the show today, and I'm looking forward to this conversation because there are diverse views, right? And Deepak, let me start with you, because we've had this conversation earlier as well, how people are using AI even to write comments on social media or to write posts on social media. So for every minor detail in your life, you are seeing AI being used. Now that we are talking about mutual funds or markets, do you really think this is one place where we'll see more involvement? Because 1% of mutual funds are powered by AI in India, which compares with 35% in the US. Do you think we'll also make that shift towards a higher number? Is this in the works? Your first take.
Yeah, sorry, I was on mute. I noticed that you also have noticed on Twitter a lot of these things. So, people using AI to make responses. I think, the way mutual funds are, you can't actually delegate your decision-making authority to anything, including an algorithm, an AI, or whatever you may call it. So in the end, it's the human, the fund manager, that's responsible, and eventually the AMC that is responsible for making those decisions. And at best, AI, I think, can be a useful assistant, because I was talking to someone today morning, and I actually mentioned this. AI is like a 24-hour assistant. You can go in the night at 11 o'clock and say, I want to research something. Can you help me find the right sources for it? AI can actually point things out to you much faster than the traditional search engines, which seem to be polluted with advertisements and too much of this SEO business, which doesn't help you get to the right kind of context fast. It can help you in maybe analysis of data, which is very, very large, because now earlier you needed to get a programming team to hire to get all this data together and then crunch them and maybe bring something out. Sometimes Excel is too small and unwieldy for such things. Using AI, you can actually write code without even being a programmer. It'll be able to kind of write code to analyze this in much more detail and give you an initial answer. Of course, you have to validate and vet all of this. What I'm really afraid of, and I think we will avoid, is using AI to directly talk to customers where they're looking for help or support or a meaningful answer. I don't think you can delegate any of that to AI. At best, you can train your customer support team to be able to use, to give the right kind of answers. But it has to come from a human being for the most part. And other than mundane tasks like tell me my portfolio value or tell me my transaction status, which doesn't even need AI. I would say that is not, apart from that, I wouldn't use AI in a customer-facing, unfettered environment. It has to have some ring-fenced controls around it.
Absolutely, there has to be some control around it, as well as customer facing. That is something that would be risky. If I'm looking at my portfolio, I wouldn't go and trust AI blindly, but each to their own view. Dhirendra, good afternoon. What's your view coming in here as well? Sonal was mentioning this number, 1% of mutual funds, that are powered by AI right now. Do you see this increasing, or do you think now, given that we are seeing the shift towards AI, that is a possibility to reach a higher number there?
No, the use of AI will grow. But, in its current form, cannot truly manage your stock portfolio or, mutual fund selection or stock recommendation or even advice. While algo and machine learning can accelerate research and analyze trend and, identify signals, But the act of making an investment decision, in this complex, nuanced, and a noisy market remains a human responsibility. I don't think it is, we are going to delegate that easily, or it's anywhere close to that. And I think, the most successful investors, utilize technology to enhance decision making. And I don't think it is going to replace it. It will be a great accelerator. It will be a process enhancer. But it is quite some time away from, being a substitute for human judgment or discipline.
So we know that investing is purely a human, or I would say it's technical in some aspects, of course, when you have investments in quant funds, but largely it has got a lot to do with human intelligence as well, right? So we have to focus on that purely. So if we are talking about some of the tools which are already being used, gentlemen, Deepak, let me start with you. Are there some AI tools that investors are already using now to access stock holdings, get them analyzed, or is it right now only for tertiary purposes?
Well, I think just saying that AI will analyze a stock portfolio is, I think, a little premature. But you can do different things. For instance, you own a bunch of companies. As an investor, I would like to be on track of all of the news of those companies, right? Even as a fund manager, a fund manager would want to actually go through anything that is happening. So you can use AI to kind of find and track news, analyze a conference call transcript that is maybe 20 or 30 pages long and give you a summary so that you can know where to look inside. So it's a useful assistant for a lot of downstream research. But to just say, oh, take this company and tell me whether I should buy it or not, I don't think you should do it to AI, because AI can hallucinate. You can try this. Use any AI tool and say, tell me why I should buy this company. And then it will give you a nice, very well-reasoned answer. And then you say, tell me why I should sell this company. And it will also give you a very well-reasoned answer. You're the one making the decision. It's detecting the bias in your voice and then telling you exactly what you want to hear. You don't want that from anyone, even an assistant. You want someone with a mind. You want, who can actually discern between right or wrong in this case. And AI is not going to do that for you. So at this point, I think the better thing to do is use it for specifics. I want to get a conference call transcript summary. I want you to summarize a video where a promoter was being interviewed, so that I can figure out which points in the interview I should look at more carefully. I understand this to help me understand the sector a little more. Tell me where to start looking for information. It's useful to kind of give you that overall framework of thinking that you can then deep dive into. But the deep dive is all yours. Eventually, validation is all yours. So I think there is a lot of value, because it helps you go through documents and data in a much faster way than you were earlier used to. And today we have a massive inflow of data from everywhere. You get WhatsApps, you get this, you get that, you get YouTube videos, podcasts. So there's only so much time in the day for you to be able to track all of this stuff. But you need somebody to tell you that something is interesting. This was, let's say, a job done by human beings. That would actually, you would require 2 or 3 people to kind of help you with understanding or keeping track of a lot of things. You could perhaps use AI to help you do this a little bit better. But I don't think it should be anything simplistic or decision oriented, because that is going to cause grief more than anything else. We use it for a lot of other things, understanding legal agreements in a framework that we have decided. So saying, okay, are there any things that are non-compliant in these legal agreements before we sign them? Certain other aspects of compliance, it can tell you automatically how, what kind of policy changes are made, so that you can fine tune your operations as well. But AI as a decision maker, I think we are just too early for. People have tried stuff. I think a large amount of fund management in general is about luck also. So you will find that there'll be some lucky AI investment managers as well. But, times will change. And when times change, it's the subjectivity of the fund management process that can perhaps help in understanding how to navigate tough times. So you haven't had too much of a tough time in the last 5 years.
Absolutely. So what I'm understanding, obviously AI can be used to compile your data, not to stock pick or figure out what you want to do. Direndra, comment on this point as well. Are you using anything in terms of AI for maybe just compiling, researching, anything on that front? And do you think AI can, maybe if people start using it like an everyday thing to pick stocks or pick funds, can it be held accountable like a fund manager? How do you go over that, right? Because you don't have anyone to say that, oh, you made a mistake, so I'm going to be, pointing my finger at you kind of a thing.
No, I'm using AI very intensely for my writing work, and it has added a magical dimension to my work. In fact, after writing my weekly column, and actually, I write 3 columns in a week, so it used to get tiring. Now, suddenly, after these 25-30 years of boring, mundane writing in a narrow subject, my life has become suddenly interesting. And I really look forward to writing. I really look forward to improvising. I now spend, it's not that it has actually reduced my time. I spend more time because it is enabling me greater exploration, sharpness, fineness of my, the headlining or the section or the structure of us. Writing is a completely different exercise. You do it in a fairly isolated way, or is a lonely exercise. And here you have a very competent assistant at handy, and he's a multifaceted assistant. He's able to put together numbers, and in fact, what Deepak was just referring to, I use it so much more to find. Rather than help me do things, I rather, I use it more to validate things, to verify things, find the errors, find the mistakes, how to improve, what are the principles of writing being violated, what is the principles of structure being violated. I think that is where it has actually made my life very interesting. Coming to value research operation, here, because we have been a repository of plenty of data. In fact, we were the first historian of mutual funds. I have mutual fund information available, information on Indian mutual fund available since 1964. I have the history of Unit 64 repurchase and resale price from 64. I have the market price of master share, which started in 1986. I have the closed-end funds price as well as NAV, which initially used to be disclosed every 3 months and subsequently every week. I have a history of all that. To be able to retrieve that, make sense of it, it is proving to be a great assistant, a multifaceted. I really can't look forward to hiring any such assistant.
Right. So that is basically impacting jobs as well. That's my biggest takeaway here. But gentlemen, it's a very interesting discussion, but we have to get into a quick commercial break. When we come back, we'll continue our discussion and talk about the legalities as well, because some of the brokerages have gone ahead, tied up for an AI assistant. So let's talk about that in greater detail. Welcome back. You're still tuned into MF Corner, and today we are discussing how AI can assist you in your portfolio management, or can AI become a portfolio manager itself? We are questioning this because recently there was a Mint report which suggested that Zerodha has become the first company to integrate MC with Claude AI, and this is where it is happening users to access and analyze their portfolio. In fact, 300 to 600 users have already started trying that. They are using Zerodha Claude MCP each day to get a sense of what their portfolio is doing. Deepak, in that case, let me start with you again. What can the regulatory parameter be around AI tools advising on investment decisions? Since it has just started, it's just that drop in the hat. But do you think if it takes, if it started being used the way it is generally in other aspects of life, some regulation will have to come in?
Well, I don't know. This is people looking at their own portfolio and running it through a tool, and they have to make their own decisions. How can you stop a tool from just emitting out, this is what's happening in your portfolio and this is where you are and all of that stuff? And of course, there must be boundaries, but none of the brokers actually enable any specific kind of advice, right? So all they do is they'll create a model context protocol, which is the way to communicate with the broker to get your portfolio details. The actual differential in terms of how much of this is large cap and what kind of funds you have, what kind of stocks do you have, etc. I think that stuff, you could actually write a non-AI program to access it as well, and kind of give a completely automated summary using some heuristics. AI is just another way to do the same thing, and you have to understand that to a certain extent, AI is limited by the data it is trained on. A lot of times we've seen that data that some of the AI versions are trained on is quite old. So it could be something like 2023 or 2024, and we're in 2025, nearly 7 months into 2025. So we are, we are, I think we should be understanding that the AI framework of, even if it was asked to make decisions, is going to be a little bit stale because the data is older than what we have. So to that extent, if customers are made aware that, listen, if you go to Google Finance and try to get the price of a stock, there's an automatic thing that, there's a formula, there's an API you can use to say, oh, give me the price of this stock on a spreadsheet. But as soon as you do that, it actually has a little disclaimer at the bottom saying prices are delayed, be careful, all that stuff. I think that kind of a disclosure, whenever there's somebody who's trying to do actual decision making, can be enabled by an AI framework, just in case, saying, listen, none of this is investment advice, but this is the framework I'm thinking about. That could be one way, but in the end, it's difficult for a regulator to say, don't do this to people who are doing it on their own portfolios.
Okay. Okay. So, actually, Deepak and Dhirendra, we thought it is going to be enough for this 23-minute show, but we have actually run out of time on this conversation. We never thought that would happen. So, I think we'll have to do a season 2 or an episode 2 of this conversation itself. We have to wrap up because we have to we are done with the show, but it was such an interesting conversation, and I think we'll do an episode 2 of this as well. But thank you so much for both of you to join us today. It's an interesting topic, evolving as well. Let's see which way things go when it comes to regulation. More importantly, implementation of AI when it comes to portfolio management as well. Thanks a lot for joining in today.
Thank you so much.
Okay, with that, we'll take your leave on this edition of MF Corner, but stay tuned for Closing Bell to take you through the last hour of trade.
not take me like a celebrity. I want to be an entrepreneur here. So don't think like I will not get into everything.
From that meeting to actually getting things off the ground, how long did it take?
I think it
1 year.
was a year. So we actually launched the brand. We met around my birthday 1 year, and then we launched our brand on my birthday the next year.
Was that by design?
It happened to be. I mean, we had to put a deadline, right? So I was
Right.
like, if we have to put a deadline, let's put this as the deadline. Give me a birthday gift.
You were running M Caffeine. What made you want to do this a second time over?
So we were very clear that Caffeine is a body care brand. We'll definitely venture out in a face care. So Hyphen is a outright face care brand, which essentially means we make everything face care. All your face washes, serums, moisturizers. And then Caffeine does everything body washes, body lotions, right? So the second brand was always in the play.
Ringing the bell is probably the big milestone for every entrepreneur, and many are taking that route. And it's probably a little bit like a big movie release for you. Is that what you're looking forward to as well, IPOing this business a few years down the line?
Yeah, I mean, eventually that's the dream. But I also feel like, we keep chatting, and sometimes he's also like sussing, like, what am I thinking in 2 years, 3 years? Like, why are you doing this? As an actor, like, he keeps asking me this question, and I always feel like I'm doing this to build legacy, honestly. I want it to be, like, when I say I want it to be globally known in a Sephora store, I want it to be that because I want that Indian brand to come out and be known, and that neon bottle be seen on people's shelves.
Do you now envision yourselves being on actual shelves anytime soon? Is that part of the plan, the offline push?
We would someday. We believe.
What is someday?
Offline, we believe.
Is it tricky?
Is a
path.
very, very tricky path. If a large beauty company has taken 50 years to set up their distribution, we need to acknowledge the fact that it is very, very hard to set up offline distribution. We would use data to optimize our offline play. But we still believe online is growing at 20% CAGR. We are still very small as compared to the kind of ambition we have, at least in online. So there's still a long way in online.
India's $21 billion beauty and personal care market is amongst the fastest growing in the world, set to reach $34 billion by 2028, with skincare leading the charge at a 13% CAGR. And betting big on this opportunity are our guests on the show today. Hello and welcome to Young Turks Reloaded. I'm Shireen Bhan. Today we have with us two individuals who launched a skincare brand called Hyphen. In fact, launched just 2 years ago, Hyphen claims it is one of India's fastest growing D2C skincare brands, clocking 100 crore rupees in an annual run rate in its very first year and now eyeing 400 crore rupees. But what does it take to turn a celebrity-backed brand into one that's truly consumer loved? Joining me to answer that question is Kriti Sanon, engineer, entertainer, and now entrepreneur, also the co-founder and chief custom officer at Hyphen, and with her, Tarun Sharma, the brain behind another D2C beauty brand that you saw on Young Turks, M Caffeine, and now also the co-founder and CEO of Hyphen. Kriti and Tarun, what an absolute pleasure. Thanks very much for joining us here on Young Turks Reloaded. I want to start by asking you, engineer to start with, and then entertainer, and now an entrepreneur. Let's go back to the engineering part. How did that happen?
I mean, honestly, I've always been a studious kid. My mother's a physics professor. My dad's a CA. Education was very, very important in my household. And I had an inclination towards science. And I think, like in Three Idiots, sometimes like you don't know what you want to do. And you just got to choose at that point, like, where do you go? And for me, I was like, okay, let's take up science and let's see what happens. I like computer science. Maybe I can become a software engineer, not knowing what a software engineer does. And then ended up getting electronics and communication. Such was fate. But I really believe in destiny. And I feel like you should always keep dreaming, find your passion. And I'm really glad that I finally somehow found my passion in acting, because today I don't think I could have done anything else better.
You know, speaking of acting, and this is a new role that you're playing as an entrepreneur,
Yeah.
how serious are you about this?
I'm very serious about all my roles, let me tell you that. I'm a Leo, I'm a control freak at
Like me,
times.
like
oh,
me,
really?
yes.
Yeah. So for me, it is very, very important to give my 100% to whatever I do, otherwise I can't do it. So it has to come from a place of passion. And this one did too. In 2020, when I hit my 30, I was like, oh my God, I need to take care of my skin more than I used to. And I really got into skincare heavily. I started, and being an engineer, being that studious front bencher.
So what, you were looking at all the ingredients?
I was looking at
and what
all
does-
the ingredients. I was finding, I was understanding the ingredients. I was ordering products from abroad, from everywhere, you know, trying it on myself, seeing what works for me. And then I kind of got really obsessively passionate about skincare, so much so that my mom was like, every second day there are these parcels coming in. What are you doing with
So
these
you
products?
did well for the courier industry.
I did at that point, yes, I did. And I really felt like there was a gap here. So I really, really obsessively got passionate about skincare, and I found a gap. Firstly, I felt like there was a dearth of really, really good quality, credible products that had, you know, actives as well as, like, you know, natural ingredients that were combined. And secondly, I was tired of layering 10 serums, you know. I was like, oh, niacinamide is interesting. Okay, vitamin C is interesting. Oh, if I have pigmentation, I need to put like tranexamic acid. But you can't layer 5 serums and then go on, you know, every single day. So I was like, why can't I put like really good ingredients that are meant for one concern in one bottle together and make life simpler? And that was my thought, you know. I don't like putting a moisturizer and then an SPF in the morning. You're running, you don't have time. I wanted a moisturizing SPF.
Yeah.
So that was my idea, and that's when I kind of met them, my true partners.
So Tarun, then how did the meeting happen? I believe that you have a common friend who set the two of you up.
Yeah.
But you already have a D2C brand. You were running M Caffeine. What made you want to do this a second time over?
So this space is not a winner's take all market, right? And brands are typically like babies. You can't have one brand doing everything for you, right?
Yeah.
Effectively, these are people. M Caffeine is a great body care brand. But, you know, seldom you would find one brand doing all your face care, hair care, body care, cosmetic, perfume concerns, right? So we were very clear that M Caffeine is a body care brand. We'll definitely venture out in a face care. So Hyphen is a outright face care brand, which essentially means we make everything face care. All your face washes, serums, moisturizers. And M Caffeine does everything body washes, body lotions, right? So the second brand was always in the play. Now, how did the marriage happen? I think Dhruv, who is a common connect, texted one day, and out of the blue he texted that, you know, there's this video, why don't you guys have a look at it? And obviously he had things in his mind. We looked at it and we really liked it, and we what we realized is that very few people can speak the language of chemistry, and it should come from a place of passion, right? You can read the ingredients, but you know, how do you know the history of ingredients? How do you know that how those 10 ingredients marry each other and give you the best serum for your concern? We really liked the video, and then we said, why should we not meet her and
you
see?
saw my notes?
We saw
There
your
were
notes.
as
Yeah,
well. I sent
we saw the
notes.
notes when we met her. So we met in Dhruv's office, and we heard her out that, you know, she was extremely passionate about what she wanted to create. But at the same time,
Did she come with a business plan though?
she came with a lot of ideas, which should be the starting point, because, you know, we all will share our own expertise. So she will bring the passion. We might bring the planning into it. What we realized is that, you know, whatever she wanted to create was intersecting with the blueprint which we had.
Right.
And we have never spoken. This is the first time we are meeting. The meeting was about 1 hour. We scheduled 1 hour slot. We'll hear each other out, and let's see how that goes. The meeting went on for good 4 hours. And just after the room, I think she also said to Dhruv that this is it. These are the partners.
So that was it. One meeting and it
One
was
meeting.
done.
All engineers, by the way.
I know, six engineers,
Yeah.
right?
Yeah.
Wow. So it was done in that one meeting.
One meeting.
I think when you're finding a partner, of course, to find common ground of passion and what you want to create, and, you know, compatibility, like in a relationship, it's also the energy. I feel like in the room, I just felt their energy. Everything was so real. Everything was so candid. for me also, I was like, listen, do not take me like a celebrity. I want to be an entrepreneur here. So don't think like I will not get into everything. I'm going to get into everything.
Did that scare you?
Partners who can challenge you are the best partners, right? I mean, look at what Dipinder Goyal has just shared as an announcement of the new CEO. The guy could challenge him in every meeting, right? So we want partners who can challenge us, but they should come from a place of expertise or passion. She was coming from a place of passion, and we could see that she's gonna push the envelope on the product development part. Great for the brand, because that's what we want. We could see that, whenever we would come out with some of our learnings basis, the 7 years, we could see that she will be very flexible. So you need people who are flexible, but at the same time extremely aggressive about their points. That's the best combination.
So from that meeting to actually getting things off the ground, how long did it take?
I think it
1
took
year.
us a year. So we actually launched the brand. We met around my birthday 1 year, and then we launched our brand on my birthday the next year. So
Was
Hyphen and I share my birthday.
was that by design?
It happened to be. I mean, we had to put a deadline, right? So I was like, if we have to put a deadline, let's put this as the deadline. Give me a birthday gift. Let's just launch
You've given
it.
yourself a birthday gift, a pretty big one, a pretty big one at that. But it's a space that is very, very competitive at this point in time. You've got celebrities who are also running their own D2C brands. You've, of course, got large incumbents that are also getting into the D2C space. So what was it that you thought in terms of positioning that would differentiate you from everybody else in the market?
See, I think firstly, whenever someone hears of a celebrity brand, their expectation is high price. And I think I would give it to Tarun on this, because in my head also, I wanted to make it affordable, but I think he had the right vision for where the price should be put, where he was like, it needs to be in this bracket. We wanted to create high quality products hyphened with affordability, because I also wanted that girl in, living in Patparganj to be able to use hyphen, and I didn't want to make it only for me. So I think when we hit the right products with the right pricing is where I feel like that's the USP of hyphen. That's the reason why the brand has been loved and has grown so fast.
A large part of the D2C revolution that we're seeing has been powered by social media, right? The ability to be able to target customers, reach customers directly, talk and engage with customers directly. Would this D2C phenomena be the phenomena that it is if it wasn't for things like Instagram today?
It would have been very hard. I think Instagram, YouTube brings in a lot of discovery. Amazon, Flipkart, Nykaa, now quick commerce brings in a lot of distribution. So if you go back in time, internet came, then internet became cheaper, smartphones kind of got exploded. That enabled distribution. Now I can order anything on Amazon. But I still don't know how to explore the product. So Amazon was the exploration. But suddenly Instagram and YouTube kind of popped out on the back of, very cheap internet, globally the cheapest internet. And that enabled discovery. So when you club discovery and distribution, which in, the older world was a TV ad and your physical store.
And distribution was the big moat for all the large FMCG companies.
Right.
I mean, that was the big muscle.
And now you can build your own distribution. So for example, Hyphen, 53% of our sales could come from our own website and app. which essentially means at a very large scale. And just to give you a data point, a large company would do a consumer research of 5,000 people, 10,000 people.
Yeah.
We get at least 3 million hits on our website and app, which is, if you just look at from a data balance, it's such a big unfair advantage. Couldn't have happened if you...
He's calling it unfair also.
I know,
It is.
fair. That's your leverage.
You have to do a lot of hard work to create that unfair advantage.
Yeah, data.
Right? And effectively then data starts powering each and every decision of yours, whether to what to launch, when to launch, what pricing, what kind of ingredients. And D2C could not have been there if you wouldn't have that discovery layer. So
That's true. But since we're talking about data, we're talking about the use of technology. How much are you A, using technology today, and B, everyone's talking about what AI is going to do to different sectors. Now, personalized beauty is the big trend that everyone's sort of cashing in on. Is that something that you're moving towards? Is that part of the business plan or the vision that you have?
Personalized beauty is
I think, so personalized beauty is, I will take all your inputs and then I'll co-customize
and then do something
product.
for you specifically. Yeah.
So US में there are like
hard to do for
very
at scale. At scale.
Very, very hard to do. And it also restricts the brand. It restricts the brand for not using the distribution which is not customized for you, right? So I think we are a product of discovery. So D2C does a lot of discovery and also does sales. But quick commerce, Amazon, Flipkart, Nykaa are incredible partners to us, right? So we would want to use distribution and at some point of time offline.
I was just coming to that. I mean, do you now envision yourselves being on actual shelves anytime soon? Is that part of the plan, the offline push?
We would someday. We believe.
What is someday?
Offline, we believe
is a tricky.
Is a
path.
very, very tricky path. If a large beauty company has taken 50 years to set up their distribution, we need to acknowledge the fact that it is very, very hard to set up offline distribution. What we have is the power of data. So I would precisely know how many people are buying in car, what product, at what price, at what time.
So whether it makes sense for you to actually set up shop here
go there
or not.
So we would use data to optimize our offline play, but we still believe online is growing at 20% CAGR. We are still very small as compared to the kind of ambition we have, at least in online. So there's still a long way in online. At
offline is definitely there in our dream. That I would say. Board. On my vision board, it's there. On my vision board, even like being in Sephora globally is also there.
Really?
So so the vision board has a lot of things and things will happen. But I think when the time is right, because as he's saying, it's one needs that kind of data and that kind of distribution to be sure of, okay, now I can actually go into the stores.
When you actually finally decided that you were going to do this and you took the plunge and you started the company, did you worry about what the film crowd would perceive it to be? Whether you were then going to move out of films to do this full time, or was this going to be a side hustle? Did that ever weigh on your mind as to how this would be perceived by the film world?
Not at all. In fact, I feel like being who I am, being the actor, having the influence that I do, fortunately, helps the brand in many ways, and I want to use that power and that influence in building something, creating something that that can also help other people in their lives. So no, and I've always actually questioned this, that whenever we're asked, what do you want to be when you grow up? Why is there only one answer? Why can't you be many things? And I feel like people should change that. You can be many things. You can, you don't have to stick to just one profession. You can also, as long as you can find the time and the passion for something else, you can do it. So I still am acting. When I come back from my shoot, I have samples waiting to try for Hyphen. There is a constant group that wakes up at night because I'm coming back home at night and I'm messaging on the group at night. So when you really want to do something, you find time for it.
Let's talk about R&D. I mean, 6 engineers actually doing this, but how many are actually working on the formulations? How many are actually working on the product? Where do you do your R&D? Where do you do your manufacturing?
So we formulate all our products. We have a very large R&D team. We have a 3-pillar kind of a system in R&D. We have very senior advisors who would have worked with all your big beauty companies. They advise us on top-level chemistry. So top-level chemistry would mean how do you design the product in terms of its formulation. Then we have an in-house lab and an in-house team who would iterate back a lot. But we would also partner with sizable global labs to keep on reformulating the iterations which our internal team has done. In these three pillars, the right formulation comes out. Obviously, there is a research which happens on what to make, how to make this is how we do it. And we still believe that becomes our advantage over a period of time. So on records, we would have more than 1,000 formulations which we would have created on our own. So we have a mini R&D company, so to say, right? And that's why we keep on
with
focusing.
patents or no patents
we have
yet?
6 patents.
You do have
Yes.
6 patents, okay. Filed in India?
Yeah, filed in India.
Okay.
So we're big believers of having
IP.
IP as a strong value driver for the company. But I think the core logic of having R&D in-house and focusing right from day one and extensively scaling up is over a period of time when consumers give you feedback or something happens macro in the country or in the geography you're placed, you have the ability to know what piece of the product you would change to get to that desired output. For example, in India, in the last 6 years, we have become more warmer, more hotter as a country. So your product textures will have to adapt to the weather today.
The world is getting warmer. Yeah.
And India statistically would be about 3 months for 40% of India, right? So you have to suddenly tweak your formulations when these things happen. If you don't know your formulations, your ability to tweak becomes easy, right? And hence we at core focus most amount of product, and we keep on saying that marketing is flirting, product is marriage. So at the end of the day, it'll have to be-
Marketing is flirting, product is marriage.
So we keep on focusing on it, but we don't do manufacturing. We believe it's an asset heavy model. We still believe the ROCE which we can make on the capital employed will be much higher in an asset light model. So we would partner with large scale manufacturing units who would have state of the art facility, give them their R formulation, finalize a manufacturing process, and they can partner with us
So
on a
what's the
job.
capacity that you're catering to at this point in time?
We would serve, both brands combined, we would serve close to about 4.5-5 crore units a year.
Okay.
So that's roughly 40 lakhs a month, which is distributed amongst 5-6 core manufacturing units. And we work with them closely to scale them up from a semi-automatic machine or a facility to an automatic machine. Because if they become efficient, we'll be efficient. If they become efficient, cost synergies will also kind of fall into place.
So I'm curious, did you actually invest capital when you started off? Did you put your money? I mean, you did.
Yeah.
And how, may I ask how much?
Enough for us to scale for the first year.
Enough for you to scale in the first year. But did you have targets that you wanted to hit? As I pointed out at the start, I believe in year one you touched 100 crores in terms of your revenue run rate.
Yeah.
Was that part of the vision board?
Yeah, absolutely. It was. And let me tell you, now what started happening is that in the first year, actually 100 crore came from me as well as him. And then in the second year, whatever he says, I add a little and I say it because I'm like, whatever he's saying, he's sure that he can achieve it. Let's aim higher.
And she keeps on pushing.
Yeah.
And I would say one number, so next 4 years we'll do this. We can, but can we do this? And then that's how.
Like, so
that's
what is the target she set for you now?
1,000 crores in the next 4 years,
No,
which
no,
I've
this is his
set
target.
myself on. She's pushing for 1,200. We'll see where we are.
I'm saying 1,000 CR, so matlab we can achieve in like 2-3 years. Yeah,
That's
fine. So I have to see, you got to dream bigger.
Yes. So she's putting the pressure on you to deliver that number.
See, honestly, like for this year, we thought of 400 CR in 2 more years.
So you're ahead of schedule.
Yeah, and it
Much
happened in
ahead
1
of
year. So I believe in my team, and I know that we can do it
And
together.
good partners push each other.
As far as the business is concerned, a solid start.
Yeah.
But now in terms of scale, in terms of expansion, what's next? Besides, of course, the 1,000 crore or the 1,200 crore target that she set for you.
Strategically, we would really want to put a stronger place in the categories where we are not present.
So how many SKUs do you have currently?
We have close to about 31 active ones.
Okay.
Lip balm is a category where we hold a decent amount of market share. In some of the places we are bestsellers, top of the ranks. We are still working on the other categories because we again believe that brands are like people, right? So brands are not app downloads wherein you flush in capital and then you will get 1 million downloads, right? So it will happen step by step. We have acquired customers via lip balm. Now we are trying to tell them that, why don't you test out our face washes and serums and moisturizers? And every 2-3 years, we're going to take a crack at one category, take a dominant position, and then move on to a different category while holding that position. So it's keeping our head down and building.
There's a lot of consolidation that we're already starting to see happen in this space. A lot of the big boys are swooping in and picking up the D2C companies. Are you building to be sold or are you building to last?
Nobody builds to be sold, but I think great things have happened to the space, whether it's Unilever is to minimalist, Nike is to Dot & Key, fantastic strategic story, Plix is to Marico. So consolidation has always happened. Consumer brands have been most exitable, right? Unlike tech businesses. We believe at an institution level, if we have, 2-3 category core commands, India is large enough to create a multi-thousand crore institution. And at a good double-digit PAT, it's a great listable story where markets will not hate you, right? Growing at 15% year-on-year on top line and 10% on bottom line for 10 years. Looks boring, but gives us the fantastic...
No, nothing boring about that at all. Nothing boring about that at all.
Fantastic edge in the market. And India has not seen pure play beauty companies to be listed, right? There's Nykaa, which is primarily a retailer. Hunasa, who have shown the path to how to do it. But I think India market is large enough. So we think we will IPO. 3 to 4 years from now, we'll be in a position. Now, our core brand is very profitable. Hyphen, we are investing. At an institution level, we are healthy.
Do you need capital?
No.
At this point, you're not looking at raising capital to invest in the business?
We are profitable. We are cash flow positive. We are growing. I think consumers are the best fundraisers, we believe.
And no discounting there?
No discounting
No
there.
discounting.
No discounting there. Pure play fundraise from consumers in the form of revenue. And I think with 75% gross margins, you need to be profitable, right? How much will you burn? So we believe a double-digit PAT is 2 years out for us. We are single-digit, healthy single-digit. We'll continue to invest in growth. And at an institution level, we would want to ring the bell.
It's ringing the bell is probably the big milestone for every entrepreneur, and many are taking that route. And it's probably a little bit like a big movie release for you. Is that what you're looking forward to as well, IPOing this business a few years down the line?
Yeah, I mean, eventually that's the dream. But I also feel like, we keep chatting and sometimes he's also like sussing, like, what am I thinking in 2 years, 3 years? Like, do you feel like it's like why are you doing this? As an actor, like, he keeps asking me this question, and I always feel like I'm doing this to build legacy, honestly. I want it to be, like, when I say I want it to be globally known in a Sephora store, I want it to be that because I want that Indian brand to come out and be known, and that neon bottle be seen on people's shelves. So yeah, that is the dream.
So made in India for the world product.
Absolutely.
It's been an absolute pleasure. Thank you so much, Tarun, and thank you very much, Kriti, for joining us here on Young Turks Reloaded to share your startup story and talk to us about where you believe Hyphen is going to be headed in the next few years. We wish you the very best of luck and hopefully see you on Dalal Street someday as well.
Thank you so much.
Thank you so much.
Well, with that, it is time for us to wrap up this edition of Young Turks Reloaded. From all of us here on the team, for now, goodbye. Thanks very much for watching. Do stay tuned to CNBC-TV18. The news will continue right after this.
Welcome to Indonomics. The June CPI number coming in at a 6.5-year low of 2.1% has led to a few things. One, most economists have revised down their average CPI forecast for FY26, this year that is, to 3.2 to 3.3% against Reserve Bank's forecast of 3.7%. Second, many are penciling in another rate cut. Third, most are not expecting it in August itself. And fourth, above all, bankers and bond dealers are watching Reserve Bank's liquidity policy. How much liquidity Reserve Bank will add or remove from the system and when will determine bond yields and the rate cut transmission. Now, equity investors in banks are still penciling in about 12% credit growth on hopes of a 10% nominal GDP. That may be up for threat. And they're also penciling in an end to the rate cycle. These are what equity investors are penciling in. So today on Indianomics, we have three experts to help us understand how growth, inflation and liquidity may pan out. I have with me Saugata Bhattacharya, Senior Fellow at the CPR, Center for Policy Research, more importantly, MPC member. Neeraj Gambhir, the Group Executive and Head Treasury Markets and Wholesale Banking at Axis Bank, and Samiran Chakrabarti, Chief Economist at Citi India. Gentlemen, good morning and thank you very much for joining me in what's a very crucial conversation. Saugata, first your thoughts on the CPI number, deflation in food inflation and core as well, pretty much under control.
So hi, Lata, thank you very much for having me on your show. So a couple of observations. Yes, the CPI food overall headline and food inflation numbers came in a little lower than what markets had been expecting, but this has begun to emerge as a trend for the last 3 or 4 CPI prints. We have seen this happening. This, to my mind, is very much a one-off. One, as everybody now already knows, I mean, this is partially due to the base effect of a very high inflation print, 5.1% in June of last year. So the next 2 inflation prints are likely to be higher headline prints. Overall, we are in a very good place, very good position in terms of inflation. As you mentioned, I think inflation for the year is likely to be lower than the RBI, the current RBI forecast. So that definitely gives us room, gives room for the RBI, the MPC to continue with the easing cycle. It's just that the pace is unclear. On core inflation, which is what is probably important from a policy making point of view. I think the 4.55% that we have seen in June is likely to peak out, given the fact that base rates, the base effect of core inflation, has been increasing. So I mean, I don't expect a dramatic increase in core inflation, given the fundamentals that are driving core metals prices, commodities prices, etc., seem also to be in a good position. They are very unlikely, particularly crude prices, are unlikely to increase. So I think from the inflationary point of view, I think monetary policy is in a good position. But again, I mean, there are multiple other things to consider.
Okay. Well, Samiran, you're the person in the among the people I spoke to with the lowest inflation expectation for July. Your number is 1.1. So tell us your trajectory. Does it get much below what Reserve Bank has forecast in June?
Thanks, Lata. So yes, we are looking at a 1.5 kind of CPI for August, but this will be which will come out in August for the month of July. But this will probably be the trough on the inflation trajectory. We are now looking at the July-September quarter to be averaging about 1.9%. But at the same time, we think that all the stimulus that is going into the economy, that with a little bit lag will start impacting demand also. So we have actually built in a slightly higher momentum in core inflation for the last quarter of the year. And that's why our last quarter average headline CPI is marginally ahead of the RBI's current forecast at around 4.7%. Altogether, the full year average is about 3.2%. The critical part, which always is very difficult to forecast, is the vegetable price trajectory. But other than vegetable prices, I think most of the non-veggie food prices are behaving very, very in a very, very benign way. So given how the monsoon has panned out, we think that trend is going to continue as well. So overall, it seems to be, at least in the near term, a very low inflation path that we are going to follow.
Okay. Well, Neeraj, what are the markets expecting from Reserve Bank? if the number, as Samiran is putting it, is going to be 1 point something, maybe even lower than 1.5, will they go ahead and cut despite the neutral stance?
So I think given the inflation outcome and given what Samiran has said, I think the markets are broadly in line with the fact that the next reading is going to be a low reading, but after that we'll see some recovery in inflation numbers, some pull up in inflation numbers. But given the expected outcome on inflation, despite that, I don't think the markets are expecting a rate cut in August, as you yourself mentioned in the initial part of this program. The key reason is twofold. First is that Reserve Bank has already front-loaded a lot of monetary policy action. I think given what they did in the last policy, it was much more than what the market had expected. And I think with that size of monetary policy impetus given, I would guess the Reserve Bank would like to wait a little bit longer before taking the next step. Second is that the action on the liquidity front is also a little bit unclear. There is ample liquidity in the system. There is approximately 3 lakh crore surplus in the system currently. If Reserve Bank does not conduct variable rate reverse repo auctions, then all this liquidity will sit in the SDF, which is where the rate is 5.25. But if Reserve Bank continues to do VRRs and keeps on, it'll effectively pull the overnight rate up towards the repo rate. So currently the market is expecting Reserve Bank to continue with the VRRs and pull the overnight towards the repo rate, which basically means that, there is an implied 25 basis point hike in the overnight rates, right? So these are the two forces which are kind of playing out, which is why you're seeing bond market to be very, very stable at this point in time.
Okay. Yeah, I agree. Moving more towards 5.4, actually, the call rate from below 5.25 some time back. Saugat, I'm going to ask you 2 quick questions because you're not going to be with us after the break. Our discussion will continue. One is, how should central bankers think of inflation? Should they think of the fact that all through 2025, we are going to have 3% or below inflation, which means the real rate is more than 250 basis points? Or should they think of the 1 year forward, in which case 1 year ahead you may have a 4% plus? What should be the standard way of thinking?
So, I think this question has been settled in multiple papers, theoretical, academic discussions, and Samiran put it very, very clearly that it's not just the next couple of sprints, the next quarter. You have to look at it over the course of the year, probably across the cycle. Again, I still go by the RBI's forecast, but even there, it does seem to be on an upward trajectory after, say, from the third quarter onwards. So obviously, this is not. You hear the argument that it's best to cut the policy rate before start with another easing, make another easing move before inflation starts moving upwards. I don't think that's a correct argument because obviously the monetary policy easing cycle, as the name implies, is over the course of the cycle.
Okay.
So you have to consider that. On top of that, you have to look at various other measures which might impinge on core and headline inflation going forward. The inflation growth trade-off, global uncertainty, volatility, etc. So I think caution that I at least particularly keep talking about. I think that needs to be very much in place in looking at the path of monetary policy.
Okay. Let me pack 2 quick questions before you leave us. One, do you personally think that there is space? Because if you look at current inflation, there seems to be a lot of space. If you look at 1 year ahead, you can even argue there is no space. And the governor's statements can be interpreted either way in his interview to me. That one question. And the other one, would growth move the RBI more? And are you worried about growth? In the sense, the WPI number came in at deflation. It came in at minus 0.3. So, is there a growth scare as well?
So again, growth is definitely the impulses that you see, the data, the high frequency data that you see, definitely suggests that some ambiguity on growth. It's not very clear. I still go by the 6.5%, the forecast for FY26 growth. If we actually do grow at 6.5%, I think we are okay in this current market with the amount of elevated uncertainty that still remains. We have no idea where the overall tariff situation is going, where the trade situation is going. I think we are in a good position in terms of growth. Of course, we need to support growth given the space that the inflation trajectory even over the course of the year provides. But I think at this point in time, as Neeraj mentioned, I think the liquidity support that the RBI has provided, I think that's a far more critical thing in terms of looking at transmission, in terms of credit growth. In terms of credit growth, which is an important part of the monetary policy cycle target, the objective, I need to point out that it's not just bank credit. I mean, the overall flow of resources in the corporate sector, that's very, the amount of money that's been raised to the corporate bond market, I think is very, very, very high this time and is expected to remain high. Transmission has been faster in the corporate bond market. So, we need to look at the overall flow of credit, not just from the bank credit side.
Fair point. So you see space for a further fall in rates?
In short, yes. Okay. Yes, I see space, but that obviously depends on multiple factors going forward, particularly inflation.
Okay. Well, thanks a lot for that, Saugata. We'll take your leave. Neeraj, Samiran, please stay on. Quick break, and we are back with more questions. Welcome back to Internomics. This one has been triggered by the ultra low or unexpectedly low CPI number that we got for June of 2.1, with a large part of the economists community now expecting the full year inflation to be as low as 1990 levels, 3.2%. The resultant impact on what RBI might do in terms of liquidity and rates is what we are discussing. We had Saugata Bhattacharya, the MPC member, plus Neeraj Gambhir and Samiran Chakrabarti speaking to us. Neeraj and Samiran, thank you very much for staying on. Samiran, if you can analyze the impact on credit growth, do you think that the Reserve Bank needs to do more in terms of both liquidity and rates to push credit growth? There are a lot of people who are expecting only single digits. Can Reserve Bank make a difference with liquidity?
It boils down to how you were looking at credit growth, whether you were looking at it from the demand side or you were looking at it from the supply side. Our sense is that the demand side is still weak on the credit growth front, and that's because of two broad reasons. One is that the interest sensitivity of segments of credit demand is often low. There are only a handful of them where the interest rate sensitivity shows up in a big way. And the second is, as Saugata was mentioning, the borrowers are looking at alternative sources of funding, including corporate bond, ECBs, etc., as well as a large chunk of equity funding, which is replacing probably debt funding. So I think the demand side would not be the trigger for credit growth to improve, but we should not be ignoring the supply side. There is substantial amount of liquidity that has been given to the banking system. At some point of time, the banks will try to offload this liquidity onto the system. This can happen through the NBFCs who have a larger feet on the street. So through the supply side, the first trigger for credit growth could come in. So I will not be surprised if the credit growth numbers inch up to 12-13% at the back end of the year when the full effect of this monetary transmission takes shape.
Okay. What's your sense, Neeraj? I mean, put on your banker's hat and think, what will a punishing amount of liquidity, every day bankers forced to give money to the Reserve Bank at 5/4 or even maybe if there is a rate cut at 5% to RBI, would that be trigger enough to force bankers to lend? In the last cycle, of course, it was very long ago, in the 2000 to 2004 rate cutting cycle, you did not see credit offtake up until 2004. It took 4 years. And then, of course, credit growth jumped to 25%. But rates falling from some 10% to 6.5% did not increase credit growth. Bankers remained cautious or borrowers remained cautious. What's your sense now?
So my sense is that hoping that this dose of liquidity and the rate cuts that Reserve Bank has done, coupled with the fact that government is doing spending on the capital side, there is some front loading of subsidies. So there is a push towards increasing sort of demand, even though I agree with Samaran, the demand side is looking a bit weak. I think all of these factors will combine to give us a better outcome on credit in the second half of this year. Currently, the credit growth is at about 9 or 10%, somewhere in between. And we will slowly inch up towards 12%. I still don't see it going significantly beyond 12-13% for this year because the demand from large corporates, the demand from overall corporate sector still continues to be somewhat weak. Now, when will monetary policy deliver? I think it's an open question. There is no clear timeline. I've seen at least 4-5 cycles now. Each cycle is very different. And the drivers of credit growth in each cycle are also very different. I think if you remember between 2012 to 2014, the big driver was infra spending, right? So between 2017-18 to 2020, the driver was retail lending. So every time we've seen a slightly different driver of credit growth. We'll have to see this time around in the revival sort of leg of credit, which sort of segments play their bigger than usual part in terms of driving it back. But I think I would expect that as liquidity settles down in the system, as the rates settle down in the system, they have done to a large extent on the lending side, but also from banks' perspective, the cost of funds steadily comes down. There will be some impetus to bring the credit growth back towards 12-13% numbers by the end of this year.
Okay. A two-part question for you, Samir. And actually, I'll put it in two separate questions. One, this 12-13% number is coming into question more because now the nominal GDP is going to be very low. If we are going with a 3.2% CPI and a lower WPI, then the nominal GDP perhaps will not even touch 9. It could be even sub 9. And then the credit growth, if it is 1.1 times nominal GDP or something like that, we may not get beyond, maybe barely make it to double digit. Is that an argument?
So first, we are not talking of kind of average credit growth here. We are talking more about what the credit growth would be, exit credit growth type of thing. And that, to some extent, will benefit from a bit of base effect of last year when in the latter part of the year, the credit growth actually tapered off. So from there, the favorable base should help. And, there are times when the system is trying to push higher credit. It's not for the first time that we will be seeing that credit growth will be substantially higher than that mechanical rule of X times nominal GDP growth. It could possibly be the case, but my bigger worry actually is that to what extent the non-banking channels of credit and equity would drive the financing rather than the banking credit. As Neeraj said, that there could be different pockets of credit that could emerge, not the traditional ones.
No, fair point. NBFCs are more nimble. And since there's a banking system is actually negative year-on-year terms in terms of their loans to NBFCs, maybe that route will fire. But Samaran, a more general question on growth. The Reserve Bank can be moved to cut if it genuinely perceives danger to growth. Is the 6.5 in danger? Is even 6.3 in danger in terms of growth rate?
Right now, for the April-June quarter high-frequency data, I think we are tracking somewhere around 6.5 only on GDP growth. We will get to see the corporate results now, which have a large bearing on the final GDP number. So we might have tweaked the number a little bit here and there to adjust for it. The open question is that when this tariff-related uncertainty settles down and whether the average tariffs settle down at 20% for US or at 25%, depending upon that, we might see the global headwinds. We have to consider that to what extent that creates a downward bias. But at the same time, I think the markets are generally underappreciating the size of the stimulus. There's a 30 basis point of GDP coming out of tax cut. our estimate is 40 basis point of GDP is the immediate impact of the 100 basis point rate cut on household borrowing. And then there could be about 30 basis point more coming out of higher credit growth. So altogether, about 1% of GDP, monetary and fiscal stimulus is there in the system. So that should show up in numbers at the latter part of the year is what our call is. So not thinking that the growth outlook is necessarily very bearish.
Okay. There have been economists who are telling me that even in Q1, while latter part, even in Q1, if the normal GDP is C plus G plus I plus net exports, especially service exports, have done well. Goods exports were flat even last year. So in terms of input into GDP, exports have not taken away anything, plus government spending much better than last year. So we could get a good growth number. And therefore, we are coming to Neeraj's forecast or the bond market's forecast. If the expectation is that growth is not under threat, and the RBI argues in its own mind that when I go to the August policy, I will have a July CPI which will be 1.1, if you're right, Samiran. So there will be more pressure on me in August, so why should there'll be more pressure on me in October, so why give away the rate cut now? So be that as it may, Neeraj, if there is no rate cut in the August policy, but the governor sounds dovish, saying that, if inflation surprises on the downside, etc., how will the bond markets react? Because bond markets have been, completely ignoring any chances of rate cut or low inflation. They're still sitting at 6.3, a good 15 basis points higher than the low before the June policy. Do you see any fall in bond yields?
Okay, let me just answer this in terms of what the expectation of bond market from MPC is. I think the base case or the general expectation is for no rate cut in August. Obviously, the tonality of the MPC and the language around the forward-looking view on inflation, the forward-looking view on growth is what the market will be watching out for. And I think given what we've seen in terms of data and given the commentary that even Samiran talked about, I think there is a case that you could build a case for an October rate cut, but I think between August and October also we'll have some more data. So my guess is that the Reserve Bank would likely wait until October, see data between July, August and October and see how things are playing out, particularly on the growth fund, before taking a call on the October rate cut. As far as bond market is concerned, unless and until it gets a very clear signal from Reserve Bank that the next rate cut is going to happen, I don't expect a meaningful slide in bond yields. I think we will be in a very range-bound mode, around 6.25% to 6.3%. All the positives have been discounted. Good liquidity has been discounted. If anything, the overnight rates are now going to inch up towards 5.5 possibly. So I don't see a significant positive momentum, but at the same point in time, no reason for yields to actually go up from where we are right now.
Okay. Well, we'll have to leave it at that. I might just tell you that there's one more positive. One person told me before, when I was preparing for this interview, that the borrowing calendar for the next second half may have much fewer 30 to 50 year tenor because, you're getting such an attractive rate at the lower end. The government may rethink or the RBI may advise it to bring it down. Then there is a bit of a rally perhaps at the steeper end of the curve. Let's wait and see. Many moving parts here. Samiran, Neeraj, thank you very much for continuing with this conversation and helping our understanding of what to expect from the Reserve Bank in terms of inflation and growth numbers, as well as how the bond market will behave. That's it on this edition of Indianomics. Thanks for watching.
Let's talk money.
Hello and welcome to this week's edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, it's been a news and noise-heavy first half of the calendar year. Markets have been volatile, yet resilient. They've been dealing with all the war and tariff developments that have been thrown around. But one thing that investors have perhaps rediscovered in 2025 is that making money is not a straight line process. So it's a good time to revisit some of the ground rules of portfolio planning and also talk about why a portfolio shouldn't be too skewed towards any one particular asset class, even if that asset class is equity. Today on the show, I have with me Alek Yadav of Sanctum Wealth, who will tell us the 5 mistakes to avoid in our portfolio. And of course, then he'll also shine a light on how hybrid funds perhaps can help us enhance overall returns just that little bit. Alek, great to have you back on the show. So thank you so much for being here.
Thank you so much. Thanks for having me again.
So I want to start with a dipstick mood check first.
Yeah.
Because this has been, like I said, it's been so noisy, right? All kinds of news,
Yeah.
and you don't know if tariff, and Mr. Trump is telling you that the whole world has to be reset, and geopolitics. What is the feedback you've received from clients? What are they saying? Are they still buying every dip?
Sure. Yeah, so I think there's a little bit of concern that is there amongst investors as well, So they're afraid from committing too much of capital at this point of time. However, what has happened is that the last quarter was such a one-way run, that they're also fearful of missing out on the rally. So I think most of them are staggering, and that's what we're suggesting clients, that instead of fully staying away from equity, stagger the money over a period of time so that you get participation, and if there is a correction in the market for whatever reason, then that could be an opportune time to add more to equities.
So there is fear of missing out, but there's also fear of participation. So
That's
it's like, twin fears working together.
Exactly.
But in generally, as a house call right now, when you talk about any broad portfolio advice, so I know it'll be different for different individuals, but generally, are you fully overweight on equity? Is it more equity skewed?